prices, which have slipped nearly a percentage point in the Asian markets right now. And this is after falling 3% in the previous week. Well, much of this decline really comes in from U.S. statements and U.S. plans and measures on increasing production going forward. Well, U.S. has asked OPEC to reduce prices. U.S. also has announced measures to boost U.S. oil and gas output. And then U.S. also has imposed retaliatory measures on Colombia. So all of that really weighing onto the markets right now. If you look at the metal as a prices, we've seen a bit of a decline here as well, even as the dollar index has declined. But the markets are very uncertain on how the U.S. could proceed when it comes to tariffs. So you have the zinc prices, which are trading at a 19-week high. Copper prices gained last week, especially on Friday, but they're trading at a one-week lows right now as well. So one thing that has continued to stay strong is the precious metal prices. Silver is trading at a 6-week high, and gold prices not too far away from its all-time highs.
Okay, Manisha, thank you so much for that. Surely keeping an eye out on crude as well as silver and gold prices. But on that note, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, we're Bazaar Morning Call.
Relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business is doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Trained the last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because there needs every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it and they are quite happy with it. Yeah.
So what is this going to Do you foresee the need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time and
India's market news headquarters. Cutting edge analysis, influential insights, market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a fresh new week. It's a big one. It's the budget week. It's a long week as well. 1st of February is the budget, which is, of course, a Saturday. I'm Prashant. With me, my colleague Nigel, and Surabhi should be with us in just a bit. Nigel, morning.
Well, morning, Prashant. I think it's going to be a very, very big week. Action is required on ground, and I believe that we'll hear something on that front. And don't second guess what Mr. Trump is going to do next. Colombia is his first target. Let's see how things pan out from here on.
Absolutely. And, is enough and more lined up, right? So actually what we'll do is typically we'd start with a little bit of the last close, etc. But I'll just dive straight into what is ahead. So the graphics will start to come up, and as I said, it's a big week with lots of action and activity really out there. So Fed decision is there. There's the budget, the union budget, which is on Saturday. And then there is mega cap US earnings as well. So just one by one for a quick bit. So Fed decision on Wednesday, the first up, and we'll react to it as always on Thursday morning. The Fed is seen holding interest rates. Will we hear and see something new from the Fed? We don't know. But it's possible that, in that press conference, Chair Powell says something. Remember, Trump has recently said that he'll speak to Powell at an appropriate time, etc. So, something to watch out for. But prima facie, expected to be like a status quo, nothing meeting. Mega caps in the US report earnings, and this is very important. About 40% of S&P's market cap is reporting earnings. I'm just highlighting the big tech names: Tesla, Microsoft, Meta, which report on Wednesday, and Apple, which reports on Thursday, has got the potential one way or the other to change the mood out there. Chinese local markets are shut. And again, because there's been so much focus on China, from the point of view that, Trump is not going all out with big tariffs on China, it's more negotiation, etc. But the local markets will be shut from the 28th, which is tomorrow, to the 3rd of February, which this is the Chinese New Year, the year of the snake. Well, many will argue it's the year of Trump. But anyway, this is another one. On the 1st of February, as has been advertised by President Trump, Mexico and Canada are at the risk of tariffs from the 1st, that is Saturday. And of course, there is the union budget on Saturday as well. We are trading. We are live in terms of market activity, market action. The question, of course, is will the government try and arrest a bit of a cyclical slowdown, at the same time maintaining macroeconomic stability, the fisc, etc. So these are a couple of points. Now, just to rewind and look at the trades on Friday, nothing very much. Nasdaq was down about 0.5%. Dollar index was down 0.5, 0.6%. But that we knew while we were trading in Asia on Friday, that the dollar was lower on the back of, those comments with regards to Trump and China, that he's willing to he's had a good discussion with President Xi in China, and etc., etc. So markets have taken it. By the way, the CNH, the Chinese currency, is up 0.5, 0.6% against the dollar. And of course, gold prices are up about 0.6% on Friday as well. Now, just the levels to circle around quickly. The Nifty had a down session, but we did not, and the reason we had that is because we could not break out and take out the highs of 23,426, which is nothing but the swing high that we've been talking and putting on the table for a while. So on the downside, the level is 22,976. That is a swing low that we are working with. We left off at about just near 23,100. So these are very near-term levels in that sense. Now, the daily Bollinger Band, if the lower level, the recent swing low breaks, is 22,820. That is the next number. Bank Nifty has not yet broken the swing low of 48,074. The Nifty actually once did that. The Nifty Bank has not. And I think that first comes into view, but very close by. Here, the high is 48,892. Which is the swing high, similarly like for the Nifty. And the 20-day moving average for the Nifty Bank comes in at about 49,530, which these will be the resistance levels on the way up. I think, the GIFT Nifty will give you a sense of how we're likely to start. But I think more than that, there are many stocks which we want to talk about with, because of earnings, because of broker initiations, because of other things, news flow, etc., which should be in focus. 170 points lower again, going into a big week like this. I mean, I think that's deep, and there's a deep cut. And if we break below those lows of the swing low that we put out on the Nifty, and it looks like with this kind of an open, you'll be around there. I mean, I think then you'll have to consider even lower levels. But will it hold once we've defended those levels? Will we be able to do it once again as we start this Monday and this week? That's the question. Surbhi.
Prashant, hi, morning. You know, I reckon this has something to do with all the kind of rhetoric and statements that are coming out from the US president. If you look at US futures, by the way, they're down rather sharply, and they're absolutely in sync with what the implied open is suggesting. US futures now are down anywhere between 0.5% to as much as 1.7% on the NASDAQ futures. So it's a sharp, declining start that the US market seems to be penciling in. Asia this morning, many markets are actually already shut. I'll come to the trades in just a bit. But let's talk about, so the Hong Kong market is open, but several are shut. Let's talk about these cues. What could be the market jittery about? Talk of more retaliatory action on tariffs and some hard talk. Let's pull up the quotes. What do we know in the last couple of hours? The US president has threatened retaliatory action on Colombia. Not threatened, he's saying he's going to do it. Why? Because Colombia didn't allow that plane to land with the deported immigrants coming in from the US, the defense plane that was coming in from the States. And now he's talking about 25% tariffs on Colombia. But that's not all. In general, the commentary in the last couple of hours has been, more of the same, but very, very hawkish, you can say. He was speaking to, BBC journalists on aboard Air Force One. What did he say on Greenland? Again, reiterating, saying, I think we are going to have it. He was talking about why Greenland needs to be an integral part of US territory. He again reiterated his stance on Canada. He said that in terms of trading partners, I mean, Canada is, more than 90% of their trade is with the US, whereas it's the reverse with the US, and it's an insignificant country from a trade standpoint, US-Canada. So he says, I don't want to spend hundreds of billions of dollars supporting country unless that country is a state. And if it's a state, the people of Canada would pay much lower tax. So the geopolitical rhetoric is still going very, very strong. Plus, he's following the rhetoric with actions, for instance, on Colombia this morning. And maybe the market is a little nervous about what lies ahead. Anyway, now that brings us to the Asian picture. Asian markets have been trading mixed. Like I said, many are closed. South Korea's closed. Australia's closed for regional holidays. Even Taiwan, I think, is closed this morning. The ones that are trading, Japan is down. The Hong Kong market is slightly higher. Lots of data out of China this morning. It's a little mixed. On the factory activity, there's actually contraction, surprising contraction. That was not what was expected. This is the official PMI data that came out this morning, and the number has slipped below 50. But on the other bit, the industrial profits, there is improvement, because the figure for December is showing 11% increase versus last couple of months where things were pretty challenging for China. So mixed data on China. Let's talk about what cues here tell us. Obviously, we've been in a very range-bound consolidation week. The low of the week is something I'll watch to begin with. Now, with this kind of, these kind of cues coming in the morning, let's see. Last week's low was 29,976, and we managed to recover a little bit from there. Let's see if the bulls can hold on to that. All hopes, obviously, are going to be on the budget. If there's some kind of a magic bullet that maybe the finance minister can fire. Not much positivity to report in terms of the flows picture, but the intensity of selling was a little less on Friday, you can say that. Selling of about 2,760 odd crores, domestic institutions buying about 2,400 odd crores. The total selling in January has now crossed 60,000 crores, 64,156 to be precise. The last big number was 94,000 crores of selling, which happened back in November. Anyway, lots of individual stock reactions and action to track today. And we'll go over these stocks as we go along. And it's a very mixed picture. For ICICI Bank, the margins are steady. The gross NPA level is steady. But if you want to be a nitpicker, you'll say that the slippages are increasing, and you'll watch for that. There's a 20% rise quarter on quarter in slippages. JSW Steel, of course, has been a pretty strong showing. We'll discuss more with Nigel in just a bit. IDFC First Bank, what I noted was that even there's a very sharp rise in slippages because of the MFI portfolio. Let's see how the market's going to read that in. Godrej Consumer, weak as expected. There's pressure on margins that's showing up year on year. NTPC is a mixed bag. The two good numbers are actually DLF, very strong showing in the third quarter. So maybe we'll see some green on these stocks. And Bank of India has seen an improvement in asset quality. Lots of individual stocks that we'll track. But the overarching, starting point this morning is fairly challenging, Nigel.
Well, that's right. And just going by the implied opening that you were talking about, 170, 180 points down. And just going by the price action, going by the way India has underperformed, I would lean to the side that we protect the 22,900 mark and we end off the lows to today. And I say that because we have two very, very important events in the next 10 days or so. One is the budget at the end of this week, that's on February 1st, and then you have the RBI meet and the policy decision out there. And all the indicators you're getting is calling for attention. And I'm sure the regulators are looking at this as well. And I'm expecting some kind of liquidity easing from the RBI and nothing negative from an economy, from a stock market perspective in budget 2025. So I'm expecting that today, if the GIFT Nifty is suggesting 180, 200 point downtick, we should end off the lows. Let's tell you about what the FIs did. Actually, they covered some shorts, but it didn't result in any big price action. 10,000 contracts were down. They added close to 7,000 contracts. And if you look at, pull up a chart, you'll see that from around 3.5 lakh contracts on the short side, the FI net short positions have come down to around 3.1 lakh contracts. So there have been actually some shorts that have covered out, but the price action really hasn't been visible. The FIs, well, they are on opposite ends of the spectrum, 3.1 lakh contracts, on the short side, while the clients are around 3 lakh contracts on the long side. That's been the case for the last few sessions as well. Options data comes up for you in the screen. 23,300 call was fairly active. 23,000 put as well was fairly active. So punching in these data points, punching in the recent highs and lows that we have seen, technically, this 22,950 mark, 22,900 becomes very, very important. In the past week, numerous times you went to 22,950 or thereabouts, and from there we saw a bit of a bounce. So you don't want the 22,900, 22,950 mark to get broken. On the upside, we've been trying to get to that 20,350 mark, but that's been proving as a bit of a resistance. So that's going to be the important mark. The bulls will want to get closer to these levels and, in fact, then try to cause a bit of a short covering bounce, which hasn't happened till now. On the Nifty Bank, well, we'll have to keep an eye out on that one. That 47,900 mark, that's a recent low, that becomes crucial. And we have been seeing a bit of a U-turn from around that 48,900 odd mark. So the GIFT Nifty suggesting a bit of a downtick. Give and take everything. You have the dollar index is a little bit softer. And also you have two important events lined up for the Indian markets. Add to that the weekly expiry that plays out. I think that we should try to protect these lower levels in trade. So let's see how it goes.
Okay, all right. Nigel got that. So plenty to watch as we get started. So let's bring you the equity call of the morning, and it's coming in from Nomura. Chetan Sheth says that tariff headlines cause a whipsaw for markets, and they think investors need to brace for this, at least for the first few weeks of the new US administration. He says no immediate tariffs on China or the rest of the world has brought some relief for equity markets, but the question remains whether this can be long-lasting. We think markets will remain at the mercy of news headlines, and we expect this will likely remain the case, at least in the first few weeks of President Trump's presidency. And that's exactly what seems to be playing out, with a lot of those headlines on politics, on cross-border moves that he's making, which has been keeping markets lower in Asia. And of course, US futures, like we've been telling you, sharply lower this morning as well.
Okay, well, let's quickly run you through what's lined up here on the show over the next 2.5 hours or so. So at 8:35, we'll hear from the management of Intellect Design, Mr. Arun Jain. That's the first corporate interaction you'll hear. 9 o'clock, you'll have Rahul Malani of Mirae Asset, Sher Khan, to talk about ICICI Bank's third quarter earnings. 9:20 a.m., Manish Sonthalia of MK Investment Managers takes us through his thoughts on the market. 9:30, Torrent Pharma will be with us to talk about third quarter numbers. JSW Steel speaks to us after their third quarter. Interesting chat with V. Vaidyanathan of IDFC First after earnings which came through. 10 o'clock, Macrotech Developers on their earnings. And 10:15, it is Shriram Finance on earnings. So lots of earnings talk and outlook talk over the next 2.5 hours or so. Some flashes at the bottom of the screen, and this is, SEBI Chairperson Madhavi Puri Buch's term, which ends on the 28th of February. This is, of course, well known. The government has invited applications for the post of SEBI Chairman by the 17th of February. So, just some alerts at the bottom of the screen, which we'll want to sort of note at this point in time. Anything more, we'll get you as we go along. I think we'll take a quick commercial break here. We'll come back with, perhaps a global view, but also the top stocks to watch with our research team. So stay with us. We'll be right back.
Our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, like even though almost 80% of now, let's say, coding can be done through AI. But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back. Like we've been telling you, cues across Asia are fairly mixed. Several markets are shut. The ones that are open, the big one, Japan is down about 0.6%. Hong Kong markets are actually slightly higher. The implied open is suggesting a really weak start. So let's see if the bulls can buck that or not. Well, we have plenty of stocks to go over, lots of earnings over the weekend. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, hi, morning to all of you. Let's start with the big bank number first. Abhishek, ICICI Bank, how does it look?
Well, it was a mixed set of earnings coming in from ICICI Bank. Their business momentum continued to weaken. However, the return ratios, especially the ROA, has remained steady, unlike peers which have seen a decline. So to begin with, what's worked is that the gross NPA ratio is one of the lowest in last 10 years or even more for ICICI Bank. Core operating profit growth is around 13% on a YY basis, which is one of the best that you are seeing in last 5 quarters. The return ratios, that is ROA, has remained steady at about 2.4% plus minus 5 basis points for now 4 to 5 quarters in a row. International net interest margin is at 4-quarter high for them, coming in at 1.3 versus 1.2% in the previous quarter. Now, what's not worked is that the business momentum has slowed down in line with what you are seeing in the industry as well. Deposit growth of 14% YOY is one of the lowest that you are seeing in last 7 quarters. Loan growth less than 14% YOY is one of the lowest that you are seeing in last 15 quarters. Retail loan growth is the culprit over here. It's grown by just 9.4% YOY, one of the lowest growth with respect to YOY in last 9 quarters, and perhaps for the first time in single digits in last 9 quarters as well. Quarterly slippages of 6,000 odd crores is one of the highest that you are seeing in last 14 quarters, and this is also on account of agri portfolio. Domestic net interest margin as a result of higher slippages has come in at 10-quarter low of 4.32% versus 4.34%. With respect to the PNL, the NII is below our poll. However, the PAT is ahead of our poll. Valuations should augur well for stock movement in trade today. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. I'm looking at JSW Steel in a difficult quarter. They seem to have performed pretty okay. How did that happen? Well, because steel prices, the fall was less than expected. And the fall in input costs or raw material was higher than expected. So that's why, in fact, these numbers looked actually a little bit better. Revenue a little bit better. The EBITDA number was a little bit better. And the crucial number that we look at is the standalone EBITDA per ton. And that's a calculated number. That as well was a little bit better than what we were working with. You had the power and fuel cost. Out there was some kind of leeway because the management had said they are guiding for coking coal cost to drop by $20-25 per ton. It dropped by around $34 per ton. And they're saying for the next quarter as well, it will drop by around $10 to around $15. So that's good news. Moving to their subsidiaries, from Bhushan Power and Steel, that's the acquired asset. It did well. On a sequential basis, you can see there's a bit of of an improvement out there. Even on JSW coated steel, out there as well on a sequential basis, there's a bit of an improvement. So both these two assets did well. The problem was in the overseas operations, and the US business reported a larger than expected loss. In fact, the loss was at around 150 crores, the US operations net loss for the past quarter. So that was a bit of a drag. Debt came down as well, which is another positive because of release of working capital. I expect a bit of a positive reaction because there's optimism. There'll be some duties that will be imposed on imports. And also for quarter 4, there should be an improvement of around 1,500 to around 2,000 rupees per ton. So that's why going with green on this one.
Okay, absolutely. And just a reminder, of course, at 9:40, you can hear more from the management. Mr. Jayant Acharya is going to be with us to detail the outlook ahead for the company. Let's get on to Vivek then. One more Nifty company to look at. NTPC. Vivek, how are the numbers?
Well, good morning. Slightly subdued set of numbers as far as NTPC is concerned, and the main worry remains the fact that the company has not been able to go ahead and achieve the capacity addition as per what their stated guidance was, implying a very steep ask rate as far as Q4 is concerned. Now, talking about the actual numbers themselves on a standalone basis, revenues higher by close to 5% on a year-on-year basis, slightly below our poll. However, when you're talking about the EBITDA came in quite strong, almost 20% higher, coming in close to the 11,960 crore mark. Margins coming in very healthy at 28.9%. Profitability higher by close to 3.1%. However, remember, profitability looks subdued growth. This is on the back of the fact that the base quarter had a one-time income tax refund income. Finance costs have cooled off quite significantly, down 21% on a year-on-year basis. Now, talking about the group generation, slightly subdued, just 2% higher on a year-on-year basis. However, what is it that the company said as far as the conference call is concerned? They have reiterated their target of capacity addition. So 5 gigawatt of capacity addition in FY25, 7 gigawatt in FY26, 10 gigawatt in FY27. But talking about FY25, till Q3, there was just 0.3 gigawatt that was added. 0.7 gigawatt has been added in January. So in the remaining 2 months, they will need to go ahead and add another 4 gigawatt, implying a very steep ask rate. Expect some red in NTPC today.
Okay, all right. Thanks a lot for that, Vivek. Hopping across to Manglam, who's here to tell us about Godrej Consumer. Manglam, take it away.
Well, Godrej Consumer results were weak, but they weren't much weaker than what the company had informed the analysts already in their pre-quarter update. So it's in line with muted expectations. Year on year, the revenues of the company have grown just about 3% with the EBITDA falling about 10% because of the sharp inflation that we've seen in palm oil prices. Net profit as a result of which down by 14%. Were analysts expecting that? Largely, because if you look at it, versus our poll, the revenues have come in at around 3768 crores, largely in line. The EBITDA 756 crores, the street was working with a number of 757 crores as well. And the net profit just shy of 500 crores, the street was working with a number of close to around 529 odd crores as well. Domestic volume growth absolutely flat as expected itself. And the stock is priced that in. It's down about 27% from its highs, trading at around 46 times. So for starters, the stock opens in the red. But remember, from the peak, palm oil prices have come off. And this quarter, along with the union budget, has kept all the FMCG stocks in, some sort of lofty mood from a street standpoint. So will that dip be bought into in Godrej Consumer or not is the big question that we'll get an answer to today.
All right, Manglam, thanks a lot for that. Well, let's focus on JK Cement. Actually, in another difficult quarter for the cement industry, they've reported pretty good numbers. The EBITDA number, actually, the absolute number is 7% better than what Motilal Oswal was working with. So on the top line, there was a flattish number, but sales volumes were up by close to around 5%. And on a sequential basis, you had grey cement volumes that were up by close to around 13%. So the street will like that. The operating profit, yes, it was a little bit lower, but actually it was better than what the street was working with. And the next chart will actually tell you the real picture out there, because the margin improvements on a sequential basis is quite good. From around 11%, they bounced back to around 17%. And in EBITDA per ton from around 650 rupees, it's bounced back to 4 digits yet again. So the street will like that. And the key reason is the power and fuel costs have come down by close to around 15% or thereabouts. So going by these numbers, in a quarter that wasn't that great, and have optimism about quarter 4, I expect the stock to react well in the green in today's trading session. But Abhishek has had a very, very busy weekend. He's tracking a few more numbers. Abhishek, IDFC First Pack and Credit Axis Grameen. That could be the stock of the day on the downside.
Well, yes, Credit could be the stock of the day with respect to downside. For the second quarter in a row, they have revised their guidance. And MFI is the main concern amongst both these lenders, which has caused pain in the P&L. So, IDFC First Bank, the numbers are below pole. Both the ANA and PAT is below pole. And that is on account of the fact that slippage ratio is one of the highest that you are seeing in last 11 quarters. It has come in at 3.9% versus 3.7% in the previous quarter. The retail asset quality has seen deterioration as well. Gross NPA ratio has inched up by 6 basis points. Cost to income ratio that has deteriorated and is one of the worst in last 11 quarters. If you in last 10 quarters, with cost to income ratio at 73.7%. Net interest margin on account of elevated stress has come in at 9-quarter low of 6.04%. Overall, it has impacted the return ratios as well. ROA continues to be weak at 0.4% versus 0.25% in the previous quarter. The risk in the balance sheet has increased, so risk-weight asset to advances ratio is at 14-quarter high of 119.5% versus 117% in the previous quarter. CREDAC, the MFI pain has led to net loss for the first time in last many quarters. FY25 guidance by them has been revised for second time in this year. They have revised FY25 guidance of loan growth to about 7 to 8% now from 23-24% that they had given at the beginning of the year. Credit cost has been increased as well to 6.7 to 6.9% from about 2 to 2.5% that they had given at the beginning of the year. AUM growth is weak over here, just 6% YOY and a decline of 1.3% quarter on quarter. They have reported loss versus PAT of 353 crore same quarter last year and about 186 crore in the previous quarter. The write-offs are at 377 crores, so gross NPA and net NPA have inched up by 63% and close to 68% sequentially. So gross NPA ratio and net NPA ratio both have inched up as well on a sequential basis, which could weigh on the stock price today. Back to you.
All right, this is going to be interesting, all the financial company earnings. Abhishek, thank you very much for that. You'll hear from the IDFC First management, so they'll be with us at 9:50 to talk about their third quarter numbers. Vivek, as always. Well, let's go across to Vinny now. Indigo reported numbers as well. Vinny, good morning.
Good morning. So in terms of numbers from Interglobe Aviation, revenue came in line with estimates, but the profits of the company, that saw a decline this time versus what we were expecting at CNBC-TV18. Now, that was mainly because of the higher forex loss that one actually came in for the company. 1,458 crores was the forex loss. So adjusting that, overall then the margins as well as the profitability of the company is in line with what the street was estimating. Now, yields of the company that have also remained quite flattish, but the passenger load factor, that's a good number coming in at around 86.9%. Fuel costs, they are down by around 6% for the company. Management has spoken about how Q3 has seen robust demand, and for Q4 they've guided a good 20% YOY growth in terms of guidance for the available seat per kilometer. Forex losses is something they highlighted that impacted the net earnings of the company. So all in all, it's a decent number that's coming from Interglobe Aviation. Brokerages are also maintaining their guidance and their rating for the company. So we're expecting a bit of a green year for the stock.
All right, Vinny, Chris Martin over the weekend said, why isn't Vinny here in Ahmedabad for the concert? I said, because she's got too many numbers. After Mumbai as well as the Middle East, Vinny skipped Ahmedabad because you had a lot of numbers, Vinny. Torrent Pharma and DLF, tell us how those numbers were.
Absolutely. So I didn't go to Ahmedabad, but yes, surely talking about a company that's coming from Gujarat, Torrent Pharma. That side, when you look at it in terms of numbers, earnings were slightly below the estimates, though they saw a very strong growth coming in the domestic business. Revenue of the company saw a growth of 2 to 3% on a year-on-year basis. Margins are seeing a bit of an expansion. US business, that was the concern coming in. So US business is something that is yet to revive. So we're expecting a bit of a subdued move today coming in from Torrent Pharma. India business, good growth. US subdued growth. Germany also saw a slight bit of an increase, but Brazil was down because of the currency issues. So keep an eye out on Torrent Pharma. On the back of its numbers, we could see a bit of red, I beg your pardon. While in terms of DLF, we are expecting green coming in for the stock today. Strong numbers coming in. Pre-sales were quite good for the company. Highest pre-sales that they've seen coming in during, in the last few years. Strong response that they saw for the newly launched Uber luxury project of that. Theirs collection was seeing a strong growth of around 23%, and overall, even the rental side of the business has seen a very strong growth. So good numbers coming in from DLF, and we're expecting green.
Okay, all right, got that, Vinny. Thanks very much. Let's quickly move on. In fact, before we move on, Torrent Pharma's management is going to be joining us at 9:30 a.m. So just a quick reminder, Mr. Sudhir Menon will talk about the performance and the outlook ahead. Lots and lots of numbers. Let's quickly recap our stock list for the morning. It's ICICI Bank, JSW Steel, Interglobe Aviation, Godrej Consumer, DLF and JK Cement. All of those on the back of positive news flow. NTPC, IDFC First Bank, Credit Access Grameen and Torrent Pharma are stocks on the radar that could open out on the negative side. So let's watch out for this. But beyond all the earnings news flow, there was also fresh news on the whole dispute that's underway with the Religare Enterprises versus the Berman family. Mr. Digvijay Gaikwad has approached SEBI. Now, he's a new person who seems to have thrown his hat in the ring. And he has approached SEBI to make an open offer for Religare Enterprises. He says he wants to acquire a large chunk of the company. And he feels that the Berman's offer undervalues Religare at this point in time. Let's go across to Vivek to understand where things stand as of now. Vivek.
Well, that's right. So, very interesting twist as far as the control for Religare Enterprises is concerned. A fresh independent investor, US-based Digvijay Gaikwad, actually over the weekend has gone ahead and written a letter to SEBI. Now, what he has done is he has gone ahead and said that he intends to make an open offer for 55% of control of Religare Enterprises. The earlier offer that came in on Saturday was intended to make an open offer for control of 26%. He revised that higher to 55%. Now, this particular offer price is at 275 rupees a share. Remember, the Berman's offer price is at 235 rupees a share. Now, along with that, what Gaikwad claims is that SEBI norms require the open offer to cover shares the bidder would hold post this particular offer concluding, which is why if the Berman family's open offer goes through successfully, they would have take control of almost 53.94%, which is why he has gone ahead and given an open offer of up to 55%. There was a response from the Berman family regarding this particular letter that Gaikwad has written to SEBI. First one, what they're saying is that Gaikwad has not made a competing open offer. He has only requested SEBI's permission. Along with that, they claim that he has missed the 15-day deadline to make a competing offer after Berman's public statement that was put out as advertisements across. Along with that, they say and they claim that Gaikwad's request lacks substance with no source of funds or any capacity to purchase the shares that he needs to go ahead and display to SEBI. They also say that Religare is accused of recklessly disseminating the letter to mislead public shareholders. They say that Berman family would be proceeding with their open offer and confident of its success. Now, what is the way forward? Number one, what is SEBI's response to Gaikwad's letter, whether or not they allow this particular open offer to proceed? Number two, they also need to determine whether this particular open offer was made on time. And an important alert, remember, tendering of shares as far as Berman family's open offer is concerned begins today. So any minority investors who intend to go ahead and tender their shares would be required to start tendering their shares from today. So it's an important development, and Religare Enterprises will be in focus on the back of this particular development.
No, absolutely. And this is an interesting story which we've tracked for a while. Vivek, thank you very much for that. Now, important news just coming in. The government has invited application for SEBI chairman's post by the 17th of February. Remember, SEBI chairperson Madhavi Puri Bhoj's tenure ends on the 28th of Feb. So that's of high interest to markets and something we'll keep track of as well. Now let's move away from equities to talk about commodities. Manisha is joining in with a roundup of what's top of mind and what is making news. Manisha, good morning.
Morning, Prashant. Thank you for that. I'm talking about the crude oil prices, which fell 3% in the previous week and have started Asia 1% on the lower side. Well, the reasons for decline are clear that U.S. keeps calling for OPEC to reduce prices, and U.S. also has announced measures to boost the U.S. oil and gas output. We have seen U.S. imposing retaliatory measures on Colombia. That seems to be weighing onto the markets as well, because U.S. imports 41% of Colombia oil. So markets are looking at various of these developments, but we have seen the pressure continue on the weaker side. For this year, though, until now, the crude oil prices are up by 3.5% for the markets. Well, quickly on metals as well, because we are looking at some declines here, and this is a reaction to the Chinese numbers that have come in, and all on the weaker side, by the way. China factory activity, PMI numbers, services, all of that has come in on the weaker side than what the street was anticipating. It's weaker on a month-on-month basis as well. Is the reason you have copper prices down more than 1%. Zinc is now trading at a 19-week lows. Aluminum prices, even though there is scarcity into this commodity, also has been taken off. So nearly 1 to 1.5% of a decline is how we've seen the metal prices open in Asia right now.
Okay, all right. Manisha got that, so we'll watch for this. Yeah, the cues from China this morning, those macro numbers not looking too great. Let's see if that adds a further weight on metal stocks here at home. We do need to take a break for that, break in just a bit, and we'll come back on the other side. We'll have Prakash Diwan join in. We'll discuss a lot of the earnings that have come in over the weekend.
Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award.
Welcome back. Well, the gift if we're suggesting we're going to see a bit of a downtick, but can we end the day higher than what we start off from? Well, that's going to be the big question today. So let's see how that goes. Prakash Diwan joins us to help us out with some analysis on all those numbers that came over the weekend. Hi, Prakash. Good morning. Hope you had a good weekend. Let's get straight to the top number, which is a big mover for the Nifty Bank as well as for the Nifty. ICICI Bank. A couple of positives in there on asset quality margins as well. The problem was that growth is slowing down. Credit growth as well as deposit growth. How would you rate these numbers?
Good morning, Nigel. Thank you. Thank you for having me on the show. No, I think the numbers are very interestingly positive. I mean, it depends on what is it that you went into these earnings with in terms of expectation. But look at what's not led to credit growth, and that's the retail portfolio. And at some point in time, given the weakness in quality of retail loan assets, you would actually be thankful that it's not grown and led any kind of a diminishing impact on the quality of the book. The other interesting part is this is one more quarter where they managed to do that 2.36 zone of the ROA, which is commendable for a book of this size. My sense is, as compared to other banks, largest banks, you can't compare the smaller ones which are yet to come, and some of them have come. ICICI numbers are best in class for sure, at least in this quarter, which means that there will be more money allocated to it. So I'm quite positive the market will like it. It's just a matter of them gearing up for credit growth as and when they feel the right opportunities will come, which could be probably post the last quarter of this financial year. But very positive numbers according to me.
Okay, so good to start with positive for sure, Prakash. Hi, morning. Now, I want to talk to you about, say, stocks like Credit Access, or let's throw in a Godrej Consumer as well. Numbers are bad. We all know that. Credit Access is a howler. There's a loss. No point going over the obvious, right? And similarly, for Godrej Consumer, margins are under pressure. Raw material costs are high. Sales growth is not really happening. The question is, how much of it is in the price? Now, for both of these stocks, would you be a brave heart and buy on dips, or do you think it's best to stay away for now?
Good morning, Shubhi. So I think MFI is absolutely a big no. There is no reason to catch a falling knife, and the entire sector is going through a lot of systemic issues. So it's not just restricted to Credit Access. It's a good run business, well run business, but you'd have to wait for the sector to start improving. On Godrej Consumer, I think they've indicated the weakness in their commentary earlier. There's nothing new that should surprise us. And till I think the budget comes up with something which ends up having a percolating downstream impact on demand revival, I don't see any reason why the FMCG names will start sparkling at this moment. But there could be an allocation which will start coming to these once FI money comes back, and it's anybody's guess when that happens. But in the meanwhile, credit the demand, the consumption pattern could probably start improving favorably, and that's when you look at it. So again, it's a no for GCPL as well.
Okay. All right. Prakash, just stay on with us. Lots of earnings. We'll quickly go into a management call and come right back to you. Looking at numbers for Intellect Design Arena, and that's the first management we're speaking with on the show today as well. The company reported a weak set of numbers for the third quarter, but there's been some recovery sequentially. Some of the commentary that we got in the press release also was sounding a little optimistic. So let's ask Mr. Arun Jain, CMD, what the environment is looking like. Mr. Jain, great to have you on. Thanks for joining in. So first the hard facts, the revenue is down 3.9%. This is, of course, we're looking at it year on year. But even if I look at the 9-month revenue, FY25, I think it's down a little over 6%. So it's been a challenging environment last 3 quarters now. Do you see any improvement in Q4?
Yeah, so I think what you are looking at last 3 quarters is only a tip of the iceberg. But we moved our strategy in first quarter last year on eMAG.ai, which I spoke about it, and we moved our focus to Europe and Americas. And we are seeing a strong traction on the pipeline, which is moving from 8,000 crore sales pipeline to 10,000 crore pipeline. And these deals are large deals which are in the offing. And so we are very confident that the momentum which is building up on banking modernization transformation space, because a lot of legacy transformation which is happening in banking, these deals are bigger. And coming quarters, we were looking around 700 crore a quarter. I think we are on that line of around 700 crore for the next quarter, which will wipe off a lot of previous quarter shortfalls. So eMAG.ai is a very, very interesting technology what we have brought onto the surface, where huge amount of pipeline is getting built up.
So you're saying Q4, the revenue should be northwards of 700 crores?
Around 700 crore, yeah.
Okay, got that. So that's an important one, and I think investors will watch out for it.
All right, Mr. Jain, so just get to the numbers then. It appears that FY25 will not see that big a degrowth than in comparison to FY24. Do you think it can be more or less flattish? I say this because in 9 months, your revenue is down by close to around 6%. You've done roughly around 1,800 crores. Now, in FY24, you did close to around 2,500 crores or thereabouts. So given that you're guiding for close to around a 15% revenue growth on a base of around 615 crores, do you think for FY25 it will be more or less flattish in comparison to FY24?
I think it will be growing close to double digit if you take out the GEM impact. So when we are announcing the revenue to the government e-marketplace revenue, if you cut it down, then it will be close to a double digit growth on the revenue numbers. So excluding GEM, our CAGR is 15%. Over the 3-year period. So
not excluding it, sir, it will be close to around 2,500 crores for the year, which would mean that will be more or less flattish, correct?
Flattish without a GEM. If you remove the GEM, then it's a growth of
10%. Got it. All right. Yeah. And in the last interview, sir, you said for FY26, things should look up. I think you were guiding for revenues of close to around 15%, if I remember correctly. That's FY26 in comparison to FY25. And margins, you were hinting closer to around 25%. That's on?
Okay, so let me just look at it. 2 or 3 things develop. GTB business is a healthy business on wholesale banking. We are taking a clear leadership over there with the investment in global linkers. Second is GCB business will also be 1,000 crore plus, which is the second business which we've grown in calibrated manner with the acquisition of Canada operations of digital. So there are 160 new customers we are adding to North America. So North America market will become a 1,000 crore market in next 3 years. So North America market, which is consist of Canada and USA, this acquisition is very, very important to take their business acquisition of the business.
Sure.
So that's a very, very significant development. And third piece is the AI piece, which is a Purple Fabric piece, where our technology research engineering group has built up a Purple Fabric, which is the digital workforce technology, where I spoke on 18th of December, investor call. That is a business which can go to 1,000 crore to 5,000 crore kind of a number in next 3 years. So I think.
Yeah, Mr. Jain, just to come to try and circle back. So you've given us the breakup of how this growth will sort of move along different parts of your business. But to circle back to the central question, you're at 19.5% margin roughly in the third quarter. Now, as the recovery plays out, what will your exit margin perhaps be for FY25? And can you look to get to 25%? Something you have stated in the past. But, what's the timeline to that aspirational number of 25% margin?
Yeah, 25% margin is very possible right now, which is a timeline for it. It can be in two quarters, it can be 4 quarters. So those numbers are not clear because of the deal sizes are large. So that we are not able to predict. But 25% margin, we are on design the business for 25% margin. So that's what I would like to have it.
You've got 800 crores, I think, of cash in the books. Any plans? Any acquisition? Anything you plan to immediately deploy it on?
Yeah, we started looking at acquisition now. We started the work right now with the first thing in Canada. Second thing is in global liquor investment. So 2 investments we have made in this quarter. So it's a good start point. And second investment will be go-to-market for Purple Fabric. So the Purple Fabric is a first of its kind AI platform in the world, which is doing the digital workforce automation. It's much bigger than the agentic and multi-agent kind of a platform which is there. So this we are distributing through ISIs and global partners. Sure. That is what we are taking our big bets on.
Okay, so maybe Purple Fabric is the one that will make you see lots of green in the coming quarters. All right, so we'll leave it on that note. Thank you very much for joining in. That's Intellect Design Arena talking about the business improvement sequentially, expecting better revenue and better margins in the coming quarters. Let's take a quick break. Before that, Prashant?
I don't know. I mean, I don't know if we can pull up the NASDAQ futures. If we can, do we have it?
Last I checked, 1.7% down. I don't know how much is it now.
So, I don't know if you guys saw, basically the big talking point is this Chinese AI startup called DeepSeek. Right? DeepSeek has come out with this. Actually, it happened last week. But as these things happen, first of all, it's from China. Second is this AI large language learning model. And this came out on the 20th of January. Now, the thing what is hitting, I think, this is, of course, Friday's close. But what is happening now is that the fear. So what they've done is, I think the cost of building this large language model is about 1/7 or 1/8 of what OpenAI spent on, like all things Chinese, of what OpenAI spent on ChatGPT, what Google spent on things like Lambda, or, for example, what Meta, etc., is working on. And the performance, and this is the new thing, the performance actually came out. I mean, people compared DeepSeek's new large language model to ChatGPT and others. I mean, it's comparable or better. 1/8 the cost.
At 1/7, 1/8 the cost.
1/8 the cost.
96% cheaper.
And so the risk is, will this really in that way pop the AI capex kind of story in the US, right? Because I mean, the only story in the US is we talk about US exceptionalism. It is actually tech exceptionalism in the US, and it spends on AI, which actually is driving all of this. So I think it's a big one, and I think Rima will join us a little later to sort of talk to us about this and sort of put all of this into context. But it's an important one. We'll take a quick commercial break here. I think we have Mitesh and Sudarshan join us on the other side with some technical trading ideas. Stay tuned.
India Business Hour drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving, because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue. That what happened in the past, that 3% growth will happen in the future.
Okay, welcome back. We've got the market open coming up in about 11 minutes or so. Mitesh Thakkar and Sudarshan Sukhani are with us with what they make of things this morning as we start this new session. Gentlemen, good morning. Great to have both of you here. Appreciate it. Mitesh, 160, 170 point knock once again this morning. How would you trade it?
Morning, Prashant. So I think we'll have a gap. And, the weekly pivot suggests that a stronger support is around 22,600, 550 zones. There's mild pivot at 22,800. But I think sometime during this week, good chance that we might actually test 22,600. Unless until the gap today gets filled immediately and we start rallying again, which is a very difficult thing to imagine. So my bet is that don't venture longs in this decline. See if the market, continues to head towards 22,600, 550 zone. From there, if we get a reversal sign, that is the time when I would want to take some long positions. Otherwise, we are trading with more of short buys, though we have some, few long positions as well, which could be counter trade. But then broadly, the idea is that the portfolio or the trading positions are more tilted towards the short side.
Okay, got it. Tilted towards the short side. Got that, Mitesh. Sudarshan, what about you?
Yeah, good morning. Well, my view has been that this market needs to stop falling and build a base of some kind at the lower levels. Then only we say that this correction has come to an end. Now, that has not happened. For the last 10 days, the Nifty was moving in a narrow range between 23,000 and 23,400. So there was a remote possibility that this could hold. But today's market open suggests that this will not hold. We will again break 23,000 and go lower. So that downtrend persists. We have to be patient. This happens once a year, twice a year. And, as somebody said wisely, this too shall pass. It will go away. Just be patient. Don't dabble unnecessarily in trading on the long side. And once this decline stops, once a clear base building is visible, that will be the time when we want to enter the market, not now.
Yeah, absolutely. Gentlemen, get that point, Sudarshan. No, point well taken. The issue is the market's not shown stability. We're challenging the previous week's low every week. I mean, that happened last week as well. Now, let's see what we're in for this time around. So let's talk stocks in the meantime. Morning to you, Mitesh. What is the list? What are you going with today?
So I have more of short side trades. I have a buy on HUL as a counter trend position. Buy here with a stop below 2330. Look for targets of 2400. But on the sell side is about keep a stop at 27,400. Look for targets below 26,900. Federal Bank is a sell with a stop at 190.5 for targets of 183. And Ipca Labs is a sell with a stop at 1541 for targets of 1460. Now, with the gap down, some of these stocks might open lower, so you might not need to short them immediately. Wait for some pullback if it happens. Otherwise, avoid and wait for fresh trades.
Okay, got that, Mitesh. Sudarshan, let's talk about your picks as well.
Yeah, it's a mixed bag. See, the buys are primarily positional buys. These are dips. Take advantage of the dips and buy some good quality stocks. Colgate is a buying opportunity with a stop under 2,700. Same reason as Hindu Unilever, which Mitesh was talking about. Laurus Labs is a buy with a stop under 600. But surprisingly, on the other side, there are pharma stocks which are also giving short selling ideas. So Zydus Life is an intraday short with a stop above 980, and Oil India is an intraday short with a stop above 435. Primarily, this is a market which you really want to watch rather than participate.
And hope that some stability comes in. I mean, let price action dictate rather than preempt. I mean, as Sudarshan is pointing out. Sudarshan and Mitesh, thank you very much for joining us with those trading ideas. We have more questions for you, and we'll come back with those as we go along. We'll take a quick commercial break here. We're going to come back with the pre-open rates. 7 minutes to go for that. Rahul Malani of Mirae Asset Sharekhan is also going to be with us to talk about the ICICI Bank third quarter earnings and what it means for the stock from here on. Stay tuned.
So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that, with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on the other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth. And that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum. But the stocks will grow 200-300%. So the hype, so you ride the hype cycle. And right at the top, it becomes so, what you call, compelling. I can sell the story to even a person like him or anybody, and you sell. While selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you.
Welcome back. Well, we are tracking all the cues, and the cues are not very uplifting, to say the least, across global markets. There's a fair amount of uncertainty and nervousness. There's tech on one side, and then there's all of this, tariff battle. And by the way, Colombia has retaliated with counter tariffs on the US. So, it's getting real now, this whole tariff issue, at least with some of the countries. Anyway, let's talk about some more stocks that we have to focus on. And JSW Steel, of course, is, a shining light in an otherwise rather dull morning. So let's discuss this one. Prakash, so Nigel's been telling us all the internals which are looking actually better than anticipated, but there is an overarching weakness. I mean, this morning we got China data which is not looking too good, so maybe metals could start lower. But all things give and take, plus the fact that there is some hope expected on the safeguard duty piece. How would you look at a name like JSW Steel?
Yeah, so what the numbers tell, the story that comes out is very simple, that they managed to though the price reduction in realizations was not as bad as what was anticipated. It just tells you that some of the quality players will be able to manage their contracts well. The geographies that they sell to, segments that they specialize in, and manage the advantage of the lower coking coal costs as well. Now, this whole scenario could continue to play out even in the current quarter and maybe another quarter. What will change the trajectory is not just the duty announcement, which probably is likely in the budget or maybe beyond that, but is the demand resurrection. If that happens, and a lot depends on what the US is wanting to do with its own growth areas. If that happens globally, it will set a very virtuous trend for ferrous at least. So I'm quite positive things will happen, but in test your patience. Interestingly, within the ferrous space, for me, JSW stands out as a very efficient player because of its scale and, as they kind of keep rolling out some of the newer facilities. And the subsidiaries have done well. I mean, the new acquisitions have also kind of started plugging in. So all in all, looks like you could probably have a buyout dips kind of a thing, but the numbers aren't as bad in as Nigel rightly said, in a difficult quarter.
Okay, Prakash, morning. Prashant here.
Yeah.
Let's do a rapid fire. Because lots of names to address. Religare, what's the call? This mystery of open offer has been made. That's right. The open offer is not mystery, but the person behind it is a bit of a mystery. I don't know if you saw, but yeah.
Yeah, I did.
Good for the price, I guess. 250. The Burmans were at 235. This is higher. Go on.
But too late in the day, I guess, because the open offer would have kicked in from today, if I'm not mistaken. So you can't be making an offer just, on the eve of the start of the valid open offer. You could have done it much earlier. So I don't think it has much of this. It's just probably, some issues, corporate rivalries that keep happening. You don't even know who this guy represents and all of that. So I think it'll probably be no news in a couple of days.
Okay. IDFC first.
It's still an avoid. They keep trying to do a lot to chug along. There's great strength, potential, everything, but I don't think the market's going to be in a great mood. When especially you have even a small bank like DCB's posted some good numbers. PSU banks, BOI, very decent numbers. So this is a season where you don't reward any weakness.
Yeah. IDFC first, by the way, just pre-open has started. It's ticked down 11%, 12%. DLF, Prakash.
Yeah, so I think, again, great sales value, but where is the inventory to continue growing at this rate? So I think peak performance is already priced in. People are forgetting the fact that if DLF has to sell these 30, 40 crore kind of units, they'll need to build as well. And there's not much available real estate assets that they could rely on. The cost of acquisition is not the same as what they are now building on. So I think it's past its prime. Though there could be some sort of upside, you can't time the peak, but I wouldn't look at it. Though the numbers are very encouraging, everything's fine. Time to probably book out at these astronomical levels.
There are two initiations also. There's Vishal Mega Mart. We should just look at the price. And there is this company called IGI. They do lab-grown diamond certification. It's recent listing. So two new initiations there as well. You have your view on any of these?
IGI, I really like that business. It's a very less understood kind of a area. We've never had something like this because LGD itself is a very new presence of sorts in our cognition and in our consideration. But I think IGI, if understood well, will probably become a. So it's like the rating agencies business when it started. Nobody thought CRISIL could grow so much, or a CDSL, or all of these support services which really make a lot of sense in terms of growth trajectory. So picks and shovels kind of a story. Don't go after LGD, go after the guy who certifies it. LGD.
Okay, fair enough, because irrespective, the guys who are certifying and asking for a fees for it, they'll continue making money given the demand. Got that. Yes. Stay on, Prakash. More questions in just a bit, but look at the drama playing out, the global tariff drama. And these are global tariffs and two countries we're talking about. Look what's happened. Now the White House is saying that the US may not actually levy that 25% tariff that Trump threatened just hours back. The Colombians said that they will also levy, their own tariffs. And the reason why this probably is going to hurt a bit is that 20%, I believe, of the coffee that's coming into the States comes in from Colombia, among other things. And then there are things like flowers and so on and so forth. So, all of that also, starts to get impacted. But let's see. Right now, the latest news flash seems to be suggesting that, White House may not actually levy the tariffs at all. They might reach a deal. And just to, in case you missed these headlines, because so much happens overnight now, all of it started because Colombia said this, U.S. Department of Defense plane that's coming loaded with deported immigrants will not be allowed to land. They said, why are you treating our, nationals like criminals? They should have come on a regular, maybe a, Homeland Security flight or something like that. So this is almost like a soap opera, but it's real.
It's real, but I'm not. Surabhi, the thing is, there is, for example, the tariffs on Mexico and Canada, etc. Right? That is essentially the aim behind it is not to reduce trade deficit. It's basically to reduce the flow of fentanyl, drugs into the US, right?
Yeah.
Similarly with Colombo, I mean, this is driven, as you said, because they're not taking back the people they're sending.
So
US is sending
back. It's become an instrument to it's become like a whip. It's not so much economic policy.
Correct.
It's a whip to get people to fall in line.
But my point is, it is easier to solve. I mean, that's my point. As opposed to large trade deficits with countries like, for example, with China.
Absolutely.
Which is not driven by, if you do this, I will not do this. It's structurally, there's a big disbalance. And Trump has kind of maintained that view that we need to solve for it. So that's the only kind of difference, I think, that we are looking at right now. But I think we've got, Mr. Digvijay Gaikwad now joining us. He's an American businessman, and he's thrown in his hat for Religare. Mr. Gaikwad, good morning. Great to have you with us here. Thank you very much. You're smiling. First time on CNBC-TV18, so welcome.
Here is a Sunday night. Yours is Monday morning. I think looks like you guys in a business mode, and we are in the sleeping mode. So let's do it.
No, you don't look like you're in a sleeping mode.
No, and thank you for getting me on your TV.
You look up, bright and perky, sir. So good to see you. So tell us a little bit about your interest in Religare. What is what's this about? Because it came as a bolt out of the blue.
It's nothing out of blue. Any offer you give, it's always be out of blue. Because I saw the value and I thought that it's a good value to go after. I did a very, very reasonable offer. Because in America, if you look at it in US, most of the offers are at the closing time stock. And then you get it about 17 to 20%, 15%. That's all I did. This is nothing extraordinary or no other event. I don't think so.
Yeah. Do you have interest in Indian financial services firms? I mean, do you own shares in any other companies here? I mean, have you been involved in that sense? Because here you're making an offer to buy a significant chunk of equity in a listed Indian financial services firm.
Is this some kind of criteria that you have to own, otherwise you can't own?
No,
you
it's
have
not.
Always the first try, first attempt, first time. Maybe not India, but I have a lot of experience in America.
Okay, so tell us, what's the status of this offer that you've made now? You're asking, you've written to the regulator. What are you seeking to do here?
Not only one letter. I hired the proper attorneys, and we have done a series of letters to the SEBI. So that way it's very easy, So
okay. All right. Hi, Mr. Gaikwad. Thanks a lot for joining in. Couple of quick questions, sir. All right. Do we have him? Okay. I think we'll get back to him. We need to know a couple of more details with regard to, has he appointed a merchant banker? Is a lawyer in place? Because as of now, it appears it's just a letter of intent to SEBI, but he'll come back and he'll give us some clarity with regard to this offer. So we'll wait by. Religare is the stock that we'll be focusing on in just a bit. For now, for the time being, the stock is up close to around 2.5% or thereabouts.
Absolutely. Well, that's an interesting conversation with Mr. Gaikwad. 2.5 higher for Religare. 256 or so is where we are now trading at. Do we have... Okay, I think Prakash is still with us with sort of more on stocks, and we'll go back to Mr. Gaikwad in just a bit from now.
Okay, let's ask Prakash about a couple of other stocks. Prakash, in pre-open, we have DAM Capital that's up close to around 8%. Now, in December, we saw the stock list. It had multiple times subscription. The stock went up, I think, 40-50%. And from there, it came below the IPO price. It came out with a set of numbers. Any view on DAM Capital?
No, I think I haven't looked at DAM Capital specifically, to be honest, but the space is very promising. Remember, there's a lot of activity in terms of IPO, issuance, OFS, QIB, you have, whatever you have. So there's no reason why some of these marquee, well-placed intermediaries won't make money. It's good time for, the plays in the capital markets of this variety, at least, and not just broking. So I'm quite positive, and I'm sure the numbers will kind of continue to improve from here on. And they're smart promoters. They know what markets would like. Things probably will be very well aligned in that sense. So yeah, it can probably be continuing to reward investors. But I don't have a view in terms of numbers, in terms of what expectation you could build on here on.
By the way, I'm actually reading from the letter that Mr. Gaikwad sent to the stock exchanges, and then he's back with us. Great. So just to Mr. Gaikwad, to go back to the point, I'm reading that letter, and obviously because of public disclosure requirements, Religare had to put the letter out on the stock exchange, and it said that our proposed competing offer will be revised for 55% of outstanding equity share capital in compliance with regulation. Basically, you had to match the size of the Berman's offer, which is why I think your own offer is going up. So tell us the details, and more importantly, why? Why are you looking at Religare?
Hello.
Yes, Mr. Gaikwad.
Yes, I'm here online.
Sir, the question is that, tell us the why first. Why are you looking at Religare? And also, apparently, the size of your open offer now will have to be 55% to match the total size of the Berman offer. If you could just give us the details.
So I will give you a very simple question to you. You are an expert. You are always on the television. Tell me why not? Is there any reason one should?
Absolutely can, sir.
Yes, I think I'm confused with your question. If somebody offers to buy something, is this an appropriate question to say?
No, sir. So I'll tell you.
I'm giving my intent. I'm giving my letter. I'm giving my offer. I'm giving my price. And what other reasons can be?
No, sir.
It's a great opportunity. It's undervalued stock. And I thought I can give a better value to shareholders.
Okay, I get that. You can absolutely, make an offer for an entity where you think that a competing offer is undervalued. We're just trying to understand your business intent, Mr. Gaikwad. What do you like in Religare as an entity? What is the business thought process with which you're looking at this entity?
It's a value buy. We are value buyers. I find a good opportunities, and if I see the value is there, and if I can enhance the value, that's called value buy. I thought I will bring a perspective from US, It will be foreign direct investment. And Modi ji and all good leaders are coming, Madam Sitaram and all, they come and say, invest. So we keep looking opportunity, and when we see, we strike it. I mean, it's nothing unusual or anything crazy.
Yes.
It's a very simple open offer. It's not, I'm trying to sabotage anything.
Got it. Hi, Mr. Gaikwad. This is Nigel on this side. And thanks a lot for staying up and joining us. Let's get a few details out of the way. So you're saying you've sent this letter of intent. Have you appointed a banker? Do you have lawyers in place?
Yes.
Both.
Yes,
you have appointed a banker and you have merchant banker has been appointed, right?
Yes, I have a merchant banker. I have lawyers. I have a team of lawyers.
Got it.
And I understood. And that's why I need regulators to give them proper offer. Send first one letter, then second. We only send a third letter in 2 days. Yes, sir. We are following the procedures which are necessary over
Got
there,
it. Got it, sir. All right. Let's go to the next point. You will be categorized as an FII. Is that correct?
FYI?
FII, Foreign Institutional Investor. Will you be categorized as an FII?
I don't know what is your category.
Foreign,
I'm here.
We just want to
developments and investments.
Yes, Mr. Gaikwad, what we're trying to understand is you will be allowed to hold more than 30% as per your legal, experts.
I don't know, but I have to answer you because you asked me legal question.
Yes.
It is very wise. Somebody told me not to talk legal when you don't have law degree.
No, but
I spend money.
Your lawyer said
sure they have seen.
Yeah. Yeah, Mr. Gaikwad, your lawyer said that this offer you can go through and you can legally hold 30% in the company. That's what your lawyers who you have paid the legal fees to have told you, correct?
Yeah, you are putting words in my mouth, gentlemen. If I have to answer for my lawyer, I will ask him your question and let you know. But I'm sure we're doing the right thing. But you're putting the wordings in my mouth, and I'm pretty upset about it. What are you trying to tell me? Oh, yeah, you're doing this because of this, and you are
No, Mr. Gaikwad. Mr. Gaikwad.
Very, very candid conversation.
No, absolutely, Mr. Gaikwad. See, we are here only on behalf of, public shareholders so that they have all the information they need.
Absolutely.
And in light with that, sir, allow me to ask you, see, when there is a counter offer, any entity is coming, as a counter offer for some entity, public shareholders want to know how liquid you are, how will you fund this, large takeover offer? Right. If you could give us some sense of the cash that your group has right now, will you be taking on loans? What is the current, borrowing levels of the group? We just want to understand you a little better so the public shareholders can then make up their mind.
I understood what you're asking me.
Yes.
We have financial capability. We can say that.
Okay.
Even if you go to buy a car in the market, you have to have money. You don't go and just put an offer, So we do have our financial
level of
capability.
cash? I mean,
And
just to
when the
understand
time
your group.
comes, Madam, let me speak 1 minute.
Yes, sir. Yes.
When the time comes, if the SEBI is asking me this question or RBI, whatever those authority, I'm prepared to give them, but I don't want to make it a public debate before, horse over the cart. Right now, I have asked for open bidding. I have asked for other things. I have asked for proceeding. I want transparency and the shareholders understand who I am. That's all.
Okay,
it
all
will
right,
all
fine.
come in a due course because that's what I guess SEBIs and banks or I don't know who are those. They will all ask me all those questions.
Correct. All right, Mr. Gaikwad, we appreciate you fielding all our questions. Just one final question. Are you related to any Religare board member or Ms. Saluja?
No, sir.
Not related to any Religare board member or Ms. Saluja, right?
No.
And have you had Mr. Gaikwad, have you had a word with the Religare chairperson or any other board member?
I would love to have it when the time comes. I would love to have it with anybody and everybody. Why not? We have to all work together.
But so far
This is just a negotiation.
No, absolutely. But so far you've had no contact, you're saying, right?
What do you mean by contact? I know her personally like that, or I go to her house.
Yes. Do you know her personally? Have you spoken to her after you made this offer?
I'm in Ocala. I had a big function in Washington, D.C. on January 19th. I'm right here at my house. You can see my house. So.
Okay, that isn't an answer, but we'll take it for now.
I also don't know Mr. Burman. I know that company, and I said that in my interview clearly. Okay. I would love to know them. Everybody, why not?
Absolutely, next time. Absolutely. Next time you're here, sir, we'd love to sort of have you with us here in our studios. Thank you very much, Mr. Gaikwad, for joining us, taking out the time late for you. So have a good night's sleep. We'll speak again, sir. Thank you. Thanks very much.
It's not that late, but you guys are pretty fast and hostile. Give me this, give me the money, give me that.
No, it's our job to. It's just our job to ask the question, sir. So we just did that. Thank you very much for joining.
Tell you the last comment. Can I give you a last comment, if you allow me?
Please go ahead, sir.
Look,
please go ahead.
All I hope, as an American citizen, I hope it's a transparency procedure. And a shareholder's rights has to be protected. If I'm giving a larger offer, I'm not a criminal. I'm their friend. They're going to enjoy me, and we're going to bring them a new perspective from USA.
Absolutely.
Okay, all right, sir.
What is a fairness?
We appreciate you joining in, sir. We ask all the questions for our viewers as well as shareholders, and we appreciate all the answers you have given. We look forward to having a chat with you as this offer progresses. For the time being, the Religare stop is up close around 2%.
Absolutely. 0.75%. Let's move on to the market and quickly take a look at what's happening. So 22,925, we're basically back at the lows that we were talking about earlier. This is the point which the market, I was saying earlier, defended once. Once this level has been defended, and then the market came back above the 23,000 level quickly. So will we be able to do it one more time? The only difference is that you've got US futures which are lower. I mean, between 1 and 1.5%. At that point in time, US was still sort of nicely cruising along, and the market here was just sort of falling on its own weight. Domestic, local reasons. The Sensex is down about 0.75%. You've got the IT index, which is down about 1%. Look at the Nifty heat map. Everything is down except about 5 or 6 names, which are starting up in the green. 22,900 on the index. Surbhi.
Okay, there's a lot of pain in the mid-cap market, and that was the story of last week. It's extending this week. The mid-cap index is down 1.5%, which means the fall is almost double the large cap screen. We'll come to more mid-caps and what's sort of under pressure over there. But the casualty of the morning, Nigel called it properly, was Credit Access. That stock's down about 14%. Now, with that headline out of the way, let's see what's bruised the Nifty. BEL is down 2%, IndusInd Bank is down 2%. Let's look at the reaction on ICICI Bank. ICICI Bank is actually up 0.5%, pretty decent performance and good numbers as well. JSW Steel, despite a good show, I mean, there are global headwinds this morning. So stock is lower by about 0.7%. Let's check NTPC as well. NTPC is the other result reaction, 1.5% lower on NTPC. So it's an overall fall. Infosys, Trent, M&M, BPCL, Tata Steel is cutting across sectoral lines. Nothing's holding up, at least for the timing, till some some semblance of stability comes in. There is a little bit of buying in FMCG, Britannia, Lever, Asian Paints, ITC. They are either flat or slightly positive. And then there is Dr. Reddy's. Apart from that, everything is down for the time being, and the markets are still trying to find a base.
Well, Surbhi, a couple of stocks are doing well, so let me just highlight them. DCB Bank, we had the NIs that were up close to 15%, and the gross NPAs cooled off as well. So the street has taken note of that. So that stock, in fact, is doing fairly decently this morning. I think it's up close to around 8% actually. So good going on that particular name. On the flip side, a few more stocks that should come up for you on the screen. Pull up JK Cement. Let's see what that stock is doing to kickstart trade. That should come up for you on the screen. The numbers are pretty okay. The mood of the market isn't that great.
0.5%
but
up.
I think that one's up. It's up close to around 0.5%. Sierra Silk Mills, not too high volumes, but that stock is down close to around 8%. Newgen Software is down close to around 8% as we speak. AU Small Finance Bank is taking a knock. And CDSL as well, I think they came out with a set of numbers. That stock as well has now lost close to around 6.5%. Remember, these are some of the stocks that did very, very well, but now they're pulling back a little bit. We'll have the management of Torrent Farmer as well that will join us in just a bit for now. So let's see what the initial take is out there. The way ahead is something that the street would like to know. For the time being, the stock is up close to around 2%. I think they're guiding for better margins in Q4 and from here onwards. And they're also seeing some kind of ramp up in their business. So a start in the red, 22,900 is defended. Can the bulls fight back? We'll have to see who's going to put their hand up and stand up for the bulls. The Nifty Bank as well at a very, very crucial level. 47,800 is from where we bounced last time around. We'll have to see whether or not it can defend that mark.
The interesting thing is that with budget, usually if the market runs up ahead of the budget, after the budget, usually the reaction post-budget is negative. Budgets are rarely positive events. Market ends down, and of course we had that capital gains tax event. It didn't last very long. But this time, the market is already cratered sharply going into the budget. And expectations in any case are running low. So that's a potent recipe. But of course, something has got to come from the budget, right? So it's actually both fronts now. The chorus for the RBI to do something on easing liquidity. And of course, our colleague Latha, for example, wrote a piece over the weekend sort of describing the demands and potentially what can be done, the options, etc. So something on liquidity and of course something from the government side, right, to arrest this cyclical slowdown. Can anything be done? Some relief be provided to the middle class, etc. So those are bigger questions that I think we'll need to track over the next fortnight or so. I think
before Prashant, you get into the market conversation, just some context. I looked at the numbers. We know this, but when you read the number, it really hits you. It's been a tumultuous start of 2025. The Nifty is already down about 3.5%. The mid-cap index is down 8.5%. The small-cap index is down 12%. So it's been a crunching blow. And I think this is the real question of a lot of the retail money as well. And we'll have those questions and those trends play out, whether now retail money can still keep the faith and keep the buying going, because now is when, you're seeing your profits down 25-30%. So what will people do in the event of such a decline? And it's the one that we're in the midst of even now.
Absolutely. And so far they've kept the faith and the money's kept sort of rolling into mutual funds, etc.
And history suggests that this is normally the best time to keep your SIPs going, right?
Yes.
I mean, personally, I'm doing that, so I'm backing myself.
Yeah, absolutely. And the SIP book, I mean, actually the discretionary book in terms of mutual funds has been up and down, but the SIP book has continued to remain very steady. And that's basically, I think, about 85% of the money which goes into mutual funds is through the SIP route, not the discretionary route, which is essentially lump sum based on what the market is doing, etc. So it's systematic plans which have kept things going. You got some bond market flashes there. 10-year yield has fallen to 6.64 versus Friday's close of 6.72. So that's interesting. And we'll have to sort of look at this a little more closely. 86.36 on the currency. I think though that is, the dollar is a little stronger as compared to the last close. We'll have to just sort of put these into context. But, I think a noticeable fall coming in on the 10-year benchmark as well. Okay, markets recovering a little bit. We're back at about 22,950. Manish Sontalia is a market master of the day. He's Chief Investment Officer at NK Investment Managers. Manish, good to have you with us here. Good morning. Thanks very much for your time. So how are we set up with the fall that we've had and all the events in front of us? Would you say a bulk of the fall, at least at an index level, is done?
I think another 5% on the downside and we'd be probably done. I think markets won't sustainably be there below 22,000 for a very long time. All the negatives are largely known and is being priced in the market slowly and gradually. But below 22,000, I think there could be earnings comfort, whatever 10-12% earnings comfort on the Nifty 50 for 26. That's part of the course. And valuation of 17-18 times is doable. I mean, last 10 years average valuation has been 17-18 times. So I would think at the index level, Nifty 50 level, you could see some buying support coming below 20,000.
That's good to hear. That's good to hear, Manish. That maybe we're probably at the bottom of the pit now, and it gets better from here. So you're saying that at around 22,000, given the earnings projections right now, we'll be at 17 to 18 times. So let's take that earnings piece as, up as well. FY26, I'm not talking about FY25. This has been a write-off year anyway. FY26, what are the kind of numbers that you're working with at this point? Give us some sense on the recovery and what makes you hopeful that eventually this trough will move higher.
So FY25 probably will end Nifty 50 EPS levels of 1075. And you add another 10% to that, that's 107. And you add another 10% to FY26 numbers. And you get to a level of 1350. So on the average of FY26 and FY27, you broadly be at 1250 on the Nifty 50 EPS. And you give it a valuation of 17 to 18 times, you're broadly there at 22,000, 22,000. Last 10 years, median valuation has held at around those levels. I think we'll fall to those levels, given the state of negativities that are surrounding in the market. And from there, it is going to be pick and choose on the Nifty 50 numbers. Companies that will deliver good numbers are likely to find support. Companies likely to report better than EPS growth estimates of 10% will likely outperform, is what my understanding.
Hi, Manish. Good morning. Good to see you, Win. So, 5% from here will take us down to the 22,000 mark that you're talking about. My worry is with regard to the broader markets. Now, that's seen a crunching blow. We're not talking about 8-10%. That could be only the headline index. Stocks have fallen 25, 30, 35, 40% as well. Maybe some of them ran up ahead of themselves. What's your view on the broader market? Still more pain to go? Or do you think bulk of it is now getting factored into the price?
So, Nigel, at the index level, it should not be coming as a surprise to anybody that valuations were deviating 1.5 times standard deviation away from the mean. And in extreme euphoric times, even in the past, such sort of valuations for the mid-cap index and the small-cap index were never seen. Of course, we can discuss that, individual names would have merited elevated valuations and so on and so forth. But for the index as a whole, that is what is giving me, right? And even now, the valuations really have not come down to historical averages as far as the mid-cap and the small-cap numbers are concerned, the index level. So that is what is correcting, and obviously there will be individual picks which will be outperforming the index and some will be laggards. But I think broadly that is what is playing out. It was elevated valuations didn't match up to historical averages, and it's just meandering and reverting back to the mean.
Manish, what will you buy? But people are saying this dip is a great buying opportunity for a longer-term investor. What do you think has come to those levels that you like?
Yeah, so medium-term and long-term story of India still hold good. Short-term is a bit of a pain. And I think I have reiterated in the past as well, currency depreciation is the theme for calendar year 25. Buy export, buy banks because they're extremely cheap, buy health insurance and all those plays, and buy capital market-related entities. They would relatively outperform given the growth outlook that you have for the medium term and certainty about it. And the rest of the spaces is a lot dependent on policies, currencies, when you come to import related stuff and elevated valuation. So I think these are the areas where you can hide on a relative basis, which will likely do better than the rest of them.
Yeah, no, you can hide, but you can't. But anything where you can make money, hiding is one thing. Manish, talk to us about a couple of ideas. You're a bottom-up guy. I mean, with full disclosure, something which has fallen enough and where there is value. One or two names, which gives us a sense of how you're thinking about things. Yeah.
Yeah, so Prashant, I think there's a lot of value in health insurance companies, and you know the names broadly. They are at very beaten down valuations. You were discussing one of the names earlier during your conversation before I joined in. These are some of very exciting plays and available at very reasonable valuation. You will have a case of commissions across the health insurance companies coming at par. Today, Care Health is paying high insurance commissions, then maybe a Star Health 1 year down the line, they'll be at broadly the same levels. You are looking at 20 to 30% sort of a growth out here. You are looking at prices which are at 2-year lows. There's adequate margin of safety. When it comes to large cap banks, of course, you have pain in the retail NPA credit cycle. Tier 2 banks won't be able to handle it that well as the large caps. And today we are talking about large cap banks, both in the public and the private sector, trading at less than 15 PE multiple. There's ample comfort out there. Pharma, in any case, both on the generic export side, domestic CDMO side, export CDMO side, the runaway is big. And depending on how each individual company reports numbers, there's a lot of play and value out here. And of course, your platform companies, you have the Zomatos of the year. The numbers were not good. Profitability was an issue. But I would still believe that, on a medium term basis, it should be good.
Okay, all right, Manish, always good speaking to you. Thanks a lot for joining in. As you said, 5%, maybe at the maximum on the downside on the headline index, but individual stocks and themes is what you like. Let's move on to our next management, Torrent Pharma. That's a stock in focus to discuss the past quarter's numbers as well as the way ahead. We're joined by Mr. Sudhir Menon, the Executive Director and CFO at the company. Hi, Sudhir. Good morning and good to see you, Ben. Well, let's talk about the largest part of your business. And in Q3 FY25, the domestic formulation sales grew by around 12% year on year. That even beat IPM growth, which was around 8%. And this was led by chronic therapies. Will India growth from year on as well continue to do well? And will it be led by, chronic therapies? What could the guidance be, say for Q4, for FY26 as well?
Yeah, good morning and thank you for having me. I think before I comment on India business, would quickly want to give some color on the overall performance for this quarter. So Q3 had two lowlights. One is the insulin business, which is a 1 quarter temporary impact, which we had guided in Q2, has impacted the overall revenue by 2%. And the second one was the Brazilian real depreciation of 17%, which again impacted the revenue by 2%. Normalized for these temporary impacts, the revenue growth is 7% and operating EBITDA growth is 12%. And again, on YTD December, if we normalize for these two impacts, the EBITDA growth has been 15%. So the underlying growth continues to be strong for us. And while insulin impact normalizes in Q4, the BRL depreciation should start normalizing over the next 2 to 3 quarters. And therefore, from a long-term story perspective, the story is intact for us. Coming to India business, I think again the market growth of 8%, as you said, we've grown by 12% in Q3, and on YTD December basis, we've grown at around 13%. And while we continue to outperform the market in all our focus therapies, what's more positive is that in therapies where we are over-indexed versus the market, we've seen stronger performance. For example, cardiac, while the market has grown at 10%, we grew at 16%. In Gastro, the market grew at 8%, we grew at 13%. And CNS, the market grew at 8%, we grew at 11%. And anti-diabetic, the market growth was 10% and we grew at 17%, so on and so forth. So essentially, we've been focused on the chronic segment, where the chronic segments contribute 75% of our total portfolio, and it's only 25% which is acute. Our strong growth, I believe, is because of the continuous reinvestments which we have been doing in our domestic business since 2021. And since then, number one, we've expanded our vehicles by almost 50%. Second is our investment in the OTC segment, which has helped us in scaling some of the larger brands where we have seen strong incremental growth coming in these brands.
Right, Mr. Menon, Mr. Menon, you're giving us a good amount of details qualitatively, but since we're a little short on time, we request for some quantitative guidance from here on as well. As you said, you've done a whole host of measures. Chronic is bulk of your business, and that's done quite well. Tell us, what's the outlook? Do you continue to outgrow the industry? What could it be in percentage terms? And what about the US business from around $32 million of revenues on a quarterly basis? Where does that head? Please go ahead, sir. Some quantitative numbers.
Yeah, I think from a next 2 to 3 year perspective, based on the reinvestments which we have done in the business, our objective would be to grow double-digit as well, the same as this year. And as far as US business is concerned, the US business will be a gradual uptick story. The first goal for us is to achieve a profitable growth than anything else, because today US is negative. And we should see 5 to 7 launches happening in FY26, and that could help us to grow the business by 10 to 15% over the current base. There could be higher opportunity in these launches if the competition landscape is looking much better, I would say.
Mr. Menon, hi, good morning. Prashant here, and good to see you on the program, sir. It's been a while. So just to get those numbers out of the way, India's business revenue growth and US revenue growth, what should it be? You said 5 to 7 launches in FY26 in the US. So just those numbers?
Correct. 5 to 7 launches in FY26 for the US business, which could help us to grow 10 to 15% over the current base, which is 120 million.
Okay, 10 to 15% in the US. Got that. I think you've answered that launches question out there. So 5 to 7. Now, insulin CMO sales were nil during the quarter. You began by saying that you would kind of sort of guided around that in the second quarter. Could you give us a sense of how that is likely to sort of come about in the over the next many quarters? What's the normal run rate of sales per quarter?
So the normal run rate is around 75 crores a quarter. And as guided in quarter 2, we have taken a temporary shutdown for upgrading certain European guidelines, I would say. And we had also guided that the manufacturing facility will be released in December, which we did. And the dispatches have started in January. So quarter 4 is normalized.
Okay.
What about margins, sir, if you can give us a sense? You've spoken about improving margins by between 50 and 100 basis points over the next 2 to 3 years. Okay. Is that on track? This is an annual improvement you're aiming at, and what will drive this?
Yeah, so I think this year we should close at 32.5% versus 31.4% last year, registering an improvement of 110 basis points. Our branded segment accounts for 76% of the overall revenue base. And we do not see a significant mix change over the next 2 to 3 years. And that is so, we believe the margin improvement story in the base business between 50 to 100 basis points should continue playing out. Additionally, there is an incremental positive which US launches might give. And all the more, we believe that the margin improvement of 50 to 100 basis points should continue next year as well.
Okay, all right. Mr. Menon, just one query. US business will grow and you're looking at profitable growth. When does it turn profitable?
Well, maybe it will take 3 years' time, I would say.
3 years' time. And what would the revenue number look like? As of now, you're doing a quarterly run rate of around 32 million. So at break even, what would it be? Around what, $40, $45 million on a quarterly basis? Just a rough number, sir.
So it's all dependent upon the market factors, right? I mean, there's one price erosion playing out on the base business. The second is the new launches. If there's no competition coming in, then the story is different, right? So for me to give you a number as to at what level it could be profitable is a little difficult at this point in time.
Okay, all right. Final question before we let you going then. Could you tell us, how is your balance sheet looking like? I'm looking at your interest cost. I think it's clocking around 55 crores per quarter. But I believe you have an intent of getting net cash as well. So what is the trajectory on that front, the current debt in the books? And by when do you turn debt-free?
Yeah, so I think as at 31st December, my net debt position is 1,900. And this being so, I personally believe that maybe first quarter of FY27, we should be net cash.
And current debt, you said, is 1,900 crores, right?
Net debt is 1,900 crores.
We appreciate you joining in, Mr. Menon. Wishing you all the best going ahead. You're guiding for better times for the India business. US business eventually will break even in the next few years and will grow at around 10 to around 15%. And you're going to be net cash by quarter one, FY27. By the way, as we had that chat, the Nifty has cut its losses. We're now closer to around the 23,000 odd mark. For the time being, we slip into a short break. Come back. We'll get chatting with the management of JSW Steel. Don't go anywhere. Welcome back. Well, at least you have the headline index that's seen a good recovery. SBI as well as HUL, both of them have come off the low point of the day. So good on that. The broader markets, though, still in a bit of pain. Less than 200 stocks advancing as of now. As promised, let's focus on JSW Steel, though. The company actually reported a better than expected set of numbers in the third quarter. To talk in detail about the company's performance, what's the way ahead, we're joined by Mr. Jayant Acharya, the Joint MD and CEO at JSW Steel. Hi, Mr. Acharya. Thanks a lot for joining in. Well, before we get to specifics on the results, there's a looming fear of a slowdown on ground. Could you help us with your take? And what does it mean in terms of your guidance on volumes?
So if you look at the quarter two growth, which was a little slower, but it was impacted because of election year, central and state both. And that, I think, slowed down the CapEx spend overall. So the CapEx spend from April to November was a little less than 50% of the overall CapEx spend for the full year. The government has guided that the CapEx will pick up. And we are seeing signs of that being reflected in the last quarter itself in the long products, where although the prices of flats did decline, but in the long product space, the pricing remained better and positive. In the month of January, I would say that we are, even if you look at December, just to go back a bit, we had 13 million tons of demand in the month of December in India, which typically on a closing quarter, this thing is in a weak price environment wouldn't have been so. But that is because of the traction which is now coming in. So January to March overall, we would expect, let's say, a similar rate, if not a slightly better. So we would end the year with 150 million tons of demand, incrementally 14 million tons up. So demand point of view, I think we are more or less at about 10% level up in India compared to what we were last year, which is quite a good growth.
Mr. Acharya, just coming to you, those are important flashes coming in, on the ticker. We'll just go back to Mr. Acharya in a bit. This is from our, sister channel, CNBC-TV18 News. that the airline regulator has asked airlines to regularize fares. Now, this is not something that I think we hear on a day-to-day basis because it's absolute free pricing. We'll have to get more details on that story on what exactly does DGCA mean by regularizing fares. What are they proposing? Because the government has made it very clear that there are no caps. But anyway, let's see what does regularization mean. Back to that story in a bit. But let's ask Mr. Acharya about the trends ahead. Sir, volume growth for the company, your targets, and do you feel that steel prices have bottomed out? Just throw in some more light on this.
First, on the first question, the volumes from JSW, as we had guided, will be very close to the guidance, maybe in the range of about 98%. We expect this quarter's volume to be strong because the JVML capacity is ramping up and we will see increased volumes in January, February, March from the new facility, and also aided by BPSL reaching rated capacity levels. So volumes will be strong in this quarter. From a price perspective, as I said, non-product prices got a traction because of a better project pull. I would expect this pace to continue. On the overall pricing, I feel the prices have bottomed out. We would see lower imports, specifically now from flats coming into India, and that will play into stabilizing prices in this quarter and going ahead. So we would see that support margins. So strong demand, better volumes from JSW. We will also have likely lower costs, and stability in pricing because of lower imports would be supportive for growth and margins both.
Better demand, which results in better volumes, pricing will be stable and input costs will be down. So put all these factors together, will it mean that better EBITDA per ton is what we should look forward to? Also, could you quantify what is the benefit of lower coking coal costs in the past quarter?
Yeah, so EBITDA per ton is one thing. Let me first answer the coal point. Coking coal last quarter went down by about $34. So that is something which was positive. We expect coking coal to further go down in this quarter between $10 to $15. On the iron ore side, also some moderation has taken place, has reduced in the month of Jan, and that will play positively into our pricing. We also do expect, as we have seen in the OMC auction, that the prices have fallen somewhat. So we expect maybe another correction which would come in the near future. So that would be positive for the cost as well.
Yeah, absolutely. So lower raw material prices, better volumes, good demand, maybe stable steel prices, all of it sounding good. So, sir, let's now move on to this whole royalty issue in Karnataka, because there's been some back and forth on whether it's going to be levied retrospectively or not. What is your interpretation? Because if NMDC ends up having to pay higher royalty, then this could impact you, right?
So as we understand the law today, I think this is still under debate. While in the Karnataka mineral law which they're proposing, they are not proposing any kind of taxation on mineral rights for auction mines, except for a small amount on land. We will have to see how the responses which the governor has sought is replied to, and then how it goes. Regarding NMDC's ability to charge, I think that is something which we will have to see as it goes. But we do not think that you would be able to charge anything retrospectively, where there was some kind of feelers from some ends, but that is not legally possible as we understand it today. The government has also filed a curative petition, and there are some other associations and companies which have filed curative petitions. I would expect more rational behavior or more rational policy on this matter from state governments, because at the end of the day, you should not kill the golden goose. If the tax becomes too high and the operations get impacted, then the impact on the mining royalties on an absolute term and the steel GST, SGST impact will be far more than what they expect to gain out of this increase. So the matter is sub judice. I think let us wait to see how it goes.
All right, the hope is that we get a more rational verdict on that front. But let's focus on duties. You all have made a very, very strong pitch. What's the timeline? When do you expect some kind of protection for the domestic ferrous industry?
The government has initiated trade measures or trade investigations to put measures in place in case they find the findings to be positive. We are looking at probably somewhere in the first half of February where the government will be able to take a view. I think the responses were to be filed by the exporters and the consumers by 22nd of Jan. They would have come, so I'm expecting that the reviews would be going on, and we should hear something soon. As far as the level playing field is concerned, I think this is absolutely necessary since the rest of the world is putting barriers to trade. We can see steps being taken by America to look at various tariffs to safeguard their economy. Europe has done the same. Canada has done the same. Many other countries have followed suit. India is vulnerable since we don't have any trade measures in place. And it is only fair that the government looks at a level playing field and puts in appropriate duties and trade measures to arrest this kind of dumping.
Okay, got that. So we'll watch for further developments on both of those important fronts, the safeguard duty and as well as what eventually happens with the mining royalty in Karnataka. Let's talk about debt now, sir. Your debt has come down. Could it reduce even further from here?
So the debt has come down, yeah, you're right, by about 1,900 crores or so. Our cash balances are strong. It has improved to about 12,000 crores. We are focusing on the ratio. We feel that the ratio will now, going into the March quarter, will improve. Basically, the ratios will moderate downwards. Also, the denominator, that is net debt to EBITDA, the EBITDA for the trailing 4 quarters, the denominator is also going down. To that extent, I think the ratio will improve. Positive volume, positive cash flows, and some release of working capital will also aid the ratios to be going down. So that is what we are looking at. I'm not looking at the absolute debt number, but looking at the ratios per se.
All right, Mr. Acharya, we will leave it on that note. Thank you very much for joining in and giving us lots of perspective on your numbers and, of course, some of the bigger issues at hand for the steel sector as well. Appreciate you joining in today. Well, we have to move on to our next management. And as we do that, just a quick glance on the screen. The fall has been arrested. That's the good news. The Nifty is now actually trying to claw its way back to the 23,000 mark again. It's a 100-point dip now, which is better than where we were at the open. So looking slightly better. But moving on very quickly to the next set of numbers, IDFC First Bank is the next stock on our radar. We have the management with us. The third quarter earnings came in slightly below estimates, one could argue. The slippage ratio, of course, is something that the street is looking out for very, very carefully. We have Mr. V. Vaidyanathan, Managing Director and CEO at IDFC First Bank, joining in. Mr. Vaidyanathan, morning, and thanks very much for joining in. I was looking at the basic numbers, and we'll just highlight that for our viewers as we start. Your gross NPA ratio has remained largely steady. I mean, 1.93 in Q2 and now 1.94. That's not the problem. But I think everyone's trying to understand what the situation is in terms of rising slippages. What are you seeing in the, in the unsecured segment, in the overall retail book? If you could start there.
Okay, the really good news is that the slippages have not risen. If you the last quarter to this quarter, slippages have not risen, which is really good news. Actually, analysts are penciling in a 20% increase in slippage as is seen for the rest of the industry. For us, excluding MFI, it is practically flat. MFI is a known issue, so that has increased. And MFI is a cycle. It's a cycle. It'll wind itself way down as the industry gets back to its feet on that front. So the important thing is that from the NPA point of view, let me just share some numbers with you. At a bank level, all excluding MFI, our SMA is only 0.71, quite stable over the prior quarter. GNPA is 1.81%, and NNPA is 0.49%. But the MFI, I must point out, is the gross NPA is 4.5%, SMA is 4.5%, and NNPA is 1.1%. So it's a very specific, isolated issue of MFI. Rest of the book is, as you can see from the numbers, is really stable, and we're quite happy about that.
You know, I'm going to bring in Lata in the conversation in just a minute. She's also here to take some questions. But just to complete the point on asset quality, if you could tell us, by when do you see the MFI pain peaking out? There are different estimates there. Some people say Q4 is the worst. There are rating agencies saying this will go on till, second half of FY26. So what is your reading on MFI? And also the rest of the retail book, X of MFI, can you say now with confidence that you will not see any kind of further deterioration in the retail book?
So let's take them one by one. On the MFI front, our estimates are that the quarter that's going on, Q4 of FY25, will be the max provisions. And we feel that Q1, it should come down, and Q2 should be less than Q1 26, Q2 26 should progressively come down. Because the life of these loans are typically, 2 years, and 1 year has already gone by. So mathematically, it should go there, but we should be very careful. There's just a lot of moving dynamics here, industry changes, and so on. But that's what our analysis is. Now, with regard to your question on the non-MFI book, I read out the numbers to you earlier. The important thing is that we have disclosed to the street product-wise SMA. We have not aggregated it. So product by product, home loans, loan against property, credit cards, personal loans, consumption financing, vehicles, every product category we have defined the gross NPA, net NPA, and SMA. Even within SMA, we have given breakup of quarter by quarter SMA. So they're all numbers are stable. So we are, even credit cards, I know a lot of concern on credit cards, but even credit cards for us is behaving quite well.
Okay. Yeah, just that. Good morning, Mr. Vaidyanathan. Only that part, unsecured loan, if you can repeat for our viewers, what is the experience? Is it a little worse than others, or is it like your other loan category performance? I mean, the NPAs in personal loans, unsecured loans.
Yes. So there are, if we for just a minute keep microfinance apart, because, and just segregate it out and talk for the rest of the book. Like I said before, our credit card NPA, I'll pull out the numbers as discussion progresses and specifically read out those numbers to you. But our credit card numbers, we have put out the numbers trending for 4 quarters. Our gross NPA, net NPA, and credit cost are all trending downwards.
Okay. So unsecured is not a problem for you. It is only the MFI.
So as I spoke to you, I just got the numbers. So just permit me to read them out to you.
Sure.
Our credit card numbers, gross NPA is 1.91%, and net NPA is 0.53%. And, the rest of the book is anyway stable. So we are clearly seeing that our asset quality, excluding MFI, now it's been like 15 years. So nothing suddenly changes once in a year. We even put out 15-year trend, 4-quarter trend, product-wise. So we are seeing it's quite stable.
Okay. Okay, so you're saying that your unsecured is not the problem, MFI is the problem. The other issue that the street will have is with the fall in margins. It's fallen to 6.04. You were at 6.42 year ago and 6.18 quarter ago. This is because of the rise in cost of funds, cost of deposits?
No, our cost of deposit is 6.38 for 3 quarters in a row. So that's also quite stable. We're running a pretty stable machine by now. And still deposit, of course, is growing. The thing is, why it has come down is because we started to doing more of corporate loans now. Because the corporate entire cycle that India saw between 2015-16, right up to 2 years ago, that cycle has cleaned itself out. The incremental credit behavior on Indian corporate sector is quite good. And we are doing it. Cost-income ratio is also quite low, just 31% in corporate book. So what happens is that, of course, the yield is relatively lesser than retail, but the cost-income ratio is also better. In an overall economic sense, we're quite comfortable with that. It doesn't mean we're like going headlong into corporate. Not confusing anybody here, except that we're getting more comfort with it. I must point out to your viewers and to everybody publicly on record, it's been 6 years since the merger. We have disbursed close to 40,000 crores of corporate loans. There is not a single account in even gross NPA, not even net NPA. So that is zero NPA gross, zero net. So we are running the book in a very tight manner, and that is at the heart.
Mr. Vedyanathan, if I could just come in over there, that's a really interesting point you made. And I don't think I personally remember hearing that from you in the last few quarters at least, because the focus for the bank has been very much retail over the last several quarters, right? Now you're saying that you're looking and willing to build on the corporate book as well. If you could just expand on that, say, by end FY26, what's the kind of growth in corporate you see? And what, generally speaking, what will the mix be on the book? There's MFI, there's retail, and now you're building corporate. So just give us some sense in terms of strategy for the next 1 year.
So just to be clear, I'm happy you drilled deeper on that. There's no swing of strategy that suddenly we're going to go corporate. So let me clarify that. So thank you for asking. We have three businesses, what we call traditionally known as RAM in the industry. There's retail, agri, MSME. I told you the numbers. They're all, rock stable. And let me just tell you the specific numbers of retail NPA. Retail NPA is 9.63% gross, 0.59 net, and SME is only 0.82%, even less than 1%. So they're quite happy with that. But incrementally, we're also doing corporate. Like, let me think of a growth of like 20% or so, or 23, 24%, because that book is also a good book. End of the day, we are a universal bank. We are not only a retail bank. We're a universal bank. We have trade, FX, we have salary accounts. That's also an important part of it.
Mr. Vedyanathan, I think Surabhi's question is not that. Will you be upping the ante more on corporate loans? So if your margin is 6.04, should we be prepared for 6 or sub 6? That's the point.
Okay. I'll answer that specifically. So it's not, let me answer that. It's not like a dramatic swing happening towards corporate. Okay. We just like to grow it just almost in line with the retail book now. We don't want to swing more towards retail, etc.
Okay. It's already doing that's a fair point. But what is your margin guidance?
20%. First of all, we'll expect retail grow by 20%, wholesale by 20%, blend, something like that. Now to your margin thing, we think that roughly around the 6-ish odd % we should be able to sustain in the longer run. Next year, of course, is because base effect of MFI will not be there. So income growth of the bank, traditionally income growth has been like 20% and all. Maybe it will come down a little lesser. But the important thing, OPEX also will come down. So we believe that the next year is a transient year. And then after that, the next 4-5 years, we see a one-way track. So short question on NIM as such, we expect some stability from here.
Okay.
All right. Mr. Vedyanathan, it's a pleasure, sir. Thank you very much for joining us and sort of patiently running us through all of the numbers. And we wish you the best of luck as you go forward and look forward to our next chat. Well, let's just look at the market for a quick bit. We are down 120 points, 22,970 is where we are trading at. So there is a recovery, but it's kind of, so many mid caps, small caps, etc. have seen crunching falls in 30, 40%, 50% in some cases. And it's all kind of sort of under the surface, even as the Nifty at a percentage level is down about 10, 12% or so from the highs. Now, real estate, of course, has been a big driver, right? Real estate has done well, stock markets have done well, and kind of both have fed into each other. Macro Tech Developers is, of course, the leading company out of the city of Mumbai, and we have the management with us. Now, they continue to deliver on that 20% sales growth target, so no problems there. Abhishek Lodha is with us, Managing Director and CEO at Macro Tech Developers. Abhishek, good morning. Great to have you with us here. Thank you for your time. Prashant this side. Before I get to the numbers, if you allow me, let me start with some of the news flow, which, of course, I think a lot of the investors would like you to address as well, which is this case in the High Court, which has been filed against the house of Abhinandan Lodha, and this is a brand dispute, Lodha brand name dispute. Could you just outline, what this is about and what has happened, what's your thinking, and what's your position really, Abhishek? Go on.
Hi, Prashant. Good morning, and thank you for allowing me to be with you today. The dispute, let me first set some context. Abhinandan Lodha is my younger brother. He is someone who I wish and have always wished the very best for. And I hope he continues to be successful in whatever he wants to do, including if he wants to do real estate. So that will, set the context of where I am as an individual, as a person. All the mudslinging and other usage of the media is very painful, and our family will not be part of that kind of an effort. It's a simple dispute in relation to the very valuable brand that we at Lodha and Macrotech have built up over 40 years with thousands of crores of investment and tremendous goodwill in terms of our pedigree, projects, as well as the integrity in which we operate. This dispute is not dissimilar from the recent dispute between Indigo and Mahindra when it came to the usage of the term 6E, which is not even Indigo's primary name, but probably something less than that. So I think the courts will take their own view. I reiterate that I have no desire or in any manner to do dirty washing of linen in public. For the last 10 years, I have kept everything private. The company has been through big downs, and now it is doing well because of the efforts of 5,000 Lodha associates who work day and night to make this company successful. And we let the legal system of the country decide who should be very clearly using the Lodha brand and why the consumer ought not to be confused that any other developer using anything which is similar to Lodha is allowed to operate in the marketplace.
Okay, no, and you've explained it very well. And I mean, absolutely, you've kind of sort of, you've been down, you've come up, and of course now you've been doing very well for the last many years. So, you know, the brand is of course all out there for everyone to see. Abhishek, two or three points. I mean, it's at the end of the day, some will argue it's the family name, right? So, you know, when you gave the example of Mahindra and Indigo, but this is, I mean, this is the family name. So when as part of the family agreement, right, was there, and there was a non-compete, which of course finished, etc. Was there anything in the family agreement which makes this clear that, you know, Abhinandan cannot use that brand?
Prashant, I would let the legal process take the view, but I can directly answer your question, and I hope we move on to the company's performance, which is far more interesting and valuable to discuss. But I can tell you in no unclear terms that the family agreement explicitly stated, and that time we were a private company. It was well before we became a listed company. It explicitly stated that all brand, IPR, trademark, copyrights of the group will exclusively and solely belong to Lodha developers or Macrotech as it is known now. And Abhinandan or any new business that he starts cannot use, and I emphasize these words, cannot use the same in any manner whatsoever. But I think we should end this discussion because the courts will take their own course. This will take few months or years to finalize. Let's move on to the company and its performance if we can.
No, absolutely, absolutely. And I just wanted to address that right at the outset. Let's get to the numbers now. Nigel.
Well, you know, Abhishek, all I want to tell you all is hoping for a smooth resolution, and, you know, we'll wait to hear from you on that. But enough said about that issue. Let's focus on your numbers. Now, your pre-sales guidance, I think, for the year was around 17,500 crores. You've achieved close to around 73% of that. So for the year, do you want to outshine what you had given us earlier, or do you think you'll end at around 17,500 crores? And also comment about this perceived slowdown. Are you experiencing it?
So our numbers for Q3, this was our best ever quarter in terms of sales, our best ever quarter in terms of collections. We came in with sales of over 4,500 crores. And at this point, we are very confident about meeting our guidance for the full year. You would also note the strong underlying profitability. Earlier at the start of the year, we guided to an embedded EBITDA margin of 30%, which is now approaching 35%. You'd look at our debt reduction in spite of very significant investments in new land and business development. Our debt has reduced by almost 15% this quarter. And we are now at a debt equity of 0.22, well below our ceiling of 0.5. So all in all, there is a very strong underlying momentum in the business. We like this predictable business. We don't like to have choppiness in our sales or in our progress. And that's driven by having a very granular, diversified business, which is spread across 40 operating projects. No one project contributes more than 15% of our sales. And that's what allows us to have consistency in our performance. I have read with some interest the various media reports speculating on whether there is a real estate slowdown on the way. All I can say is that the real estate is part of the larger macro economy. And if there will be an urban slowdown, then eventually there will be sooner or later some impact on housing and real estate. Having said that, I think real estate is in the midst of a very long 15-year cycle. We are only in year 4. And as I've said in the past, there may be 6 months which are not a straight line, and that's par for course. But if I look at the fact that today what's most important for the consumer is the brand they are buying from, and the supply from the big brands in the country will never be able to meet the demand, and there will always be a big supply-demand gap.
You know, Abhishek, and glad you said that. And you called it out early in that sense, that long cycle, and hope it plays out because it's so integral to many other parts of the economy. But at the margin, even cyclical, in terms of the cyclical, a few quarters, not straight line, as you described it. Could you tell us where is this showing up? Because you'll get straight up signs, right, before anyone else. This slight urban slowdown. Which segments is it showing up sharply?
Prashant, we haven't seen the slowdown. When I refer to the urban slowdown, I refer to all the news reports about FMCG sales in urban areas being slower than expected and so on. So we haven't yet seen it. You'd have to recognize the fact that the housing consumer is not really the full urban consumer base. It's the upper end of that urban consumer base. And we see that continues to remain quite robust and strong. But all I'm trying to say is that ultimately housing is a big contributor to the economic growth, and it's also a big beneficiary of economic growth. So it can't remain unrelated forever.
Abhishek, just finally, you've mentioned that, the market is still booming. Leave us with an outlook on pricing, specifically in, some of the key pockets, like the MMR region where you operate. In general, say over the next 4 quarters odd, by how much would you say pricing can appreciate?
We've maintained this consistently, that pricing growth should be below wage growth. We've delivered that consistently since our IPO, and I think that's what's leading to the sustained strength in our business, that we've not chased pricing when we could have taken bigger pricing increases. Our expectation for the next fiscal year, fiscal 26, is that price growth in other markets that we operate, which includes the Mumbai region, will be in the range of about 5 to 7%. And that will be about 200 to 300 basis points below wage growth, which means that affordability will get even better. And yet those who have already bought homes will experience the, inflation or slightly above inflation growth in values.
All right, we'll leave it there, Abhishek. Thank you very much for joining us and sort of explaining all of that and sort of running us through what you make of the market situation right now. Appreciate it. Well, we'll take a quick commercial break here. Markets down about 100, so just under 22,300 in the Nifty. We'll talk commodities and what's top of mind there. Manisha comes up on the other side.
Straight you'll get to see 500 crore loss. So, I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews, saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money, and HDFC Bank doesn't need to raise capital. And we have met the company, and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global this thing and macro and all that, which right now is again making me do a small mistake, because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody. I say
Welcome back. The risk-off in global markets is still continuing, though we've managed to recover a little bit. But just pointing out that US futures are down anywhere between 1% to 2% on the Nasdaq. So let's watch for what happens. Let's find out what's the latest in the commodity markets, given all the headlines around tariffs and Mr. Donald Trump. Let's go across to Manisha for the latest. Manisha, morning.
Morning, and thank you for that. Well, I'm looking at the crude oil prices, which are trading nearly a percentage point on the lower side in the Asian markets. This is after crude put a weekly decline of 3% in the previous one. And this actually has been the biggest decline since the month of November. January so far, though, has been positive, up 3.5% right now. But I also want to take you through the highs and lows that we already have created for the month of January. So when you look at the WTI prices, we've seen a low of 72 and a high of 79. That's how we saw the prices trade in the mid-January there. And currently, we're trading at around 74. For the Brent as well, we've seen a range of 82 to 75, and we're trading at 77 right now. So somewhere in the middle of the range or on the lower side is how the crude has been. And as you can see, it has been nearly $6 to $7 of a range already coming in for the crude oil prices. There have been various reasons for this recent decline. One, the US has been asking OPEC to reduce prices. Or US also, in any case, OPEC is increasing production from the month of April after that recent postponement. But US also has announced to boost US oil and gas output as well. The markets also are looking at the US imposing retaliatory measures at Colombia. As of now, the kind of imports that US does, nearly 41% of Colombia exports actually come into US. I mean, not a very strong number, but then US is an important market for Colombia. And with the way that we are looking at tariffs moving, this would mean higher crude prices. But that really doesn't seem to be a concern right now. That is because the US oil output itself is on the higher side. When you look at 2024, we hit an all-time high of 13.2 million barrels per day. Now, this year, the expectation is that US will be producing record highs to the tune of 13.6 million barrels per day. So clearly weighing onto the markets there. The other thing is about the US oil and gas rigs, which have continued to decline. But that doesn't seem to be supporting markets right now because the acreage is increasing. As per the Baker Hughes report, in 2024, you saw the rig count decline by 5%, which was down by 20% in 2023. And this year, until now, we are down by almost 7%. But this is still early days, and the markets will want to watch out for further numbers there. Russian sanctions is another thing that you need to keep an eye on. This does impact India as well. So while Indian Russian oil tankers, the clarity says that until Feb 27, the discharge can happen. The second important point is that India will continue to buy Russian oil until the prices are sub $60, and the freight and logistics is not sanctioned by UN or US for that matter. Importantly, when you look at the Indian imports from Russia, pre-Ukraine war, it was just about 0.2% of our total imports. As of now, it stands at a big 33%. So clearly, slightly disrupting for the Indian markets as well. This week is going to be important because you have monetary policy meetings from not just US, but Canada and European central banks as well. And then, of course, the Indian annual budget as well. So going to be quite a volatile week in that sense. But some more decline is what you can anticipate when it comes to crude.
All right, Manisha, thank you very much for that. So that's oil prices in focus. But Lata's with us. It's the economy. Lata.
Thanks a lot. It's actually corporate earnings continuing, and Shriram Finance is the next management on the show. The problem was only with the net interest margin, which has come in lower, a 6-quarter low. AUM growth is actually better than estimates, and asset quality very sound. To discuss these and more, I have with me Umesh Revankar, Executive Vice Chairman, Shriram Finance. Mr. Revankar, good morning. Thank you very much indeed for joining us. Well, give us the overall growth prospect. It is encouraging that you have been able to grow your, AUM at 19% despite commercial vehicles not doing well. What's the kind of, pace of growth you are expecting in the coming quarters?
Yeah, good morning, Lata. Basically, if you look at last quarter, there has been very good demand coming from the rural market, especially if you say the sale of two-wheeler and the tractor. The demand has been quite strong. And for us, even for commercial vehicle, demand from the rural market has been very strong in the last quarter. And basically the Kharif crop has been good, output has been good, plus Rabi crop expectation is good. I think rural will remain strong going forward, even this fourth quarter. And there will be some demand coming back from the urban as well, mainly because I believe the infrastructure projects have been announced in the last 2 months. There are a lot of, at least a lot of commitment, movement, demand inquiries coming into for commercial vehicles. So I feel...
Okay, no, Mr. Revankar, you know, Mr. Revankar, if I looked at your entire mix that you put up, your commercial vehicle sales have grown by only 12.5% year on year. But passenger vehicles, of course, it's a smaller base, but that's grown 25%. Farm equipment has done very well, 42%, MSME 50%. But commercial vehicle and construction equipment, the two things linked to infrastructure, are in very low double digit. I mean, 10% on construction equipment and 13% on commercial vehicle. Will these two numbers be better in Q4? And if yes, approximately how much better?
No, it will definitely better. It will not jump big. I think it will be around 15%. It will not, because the base is very big. And the demand for passenger vehicle is something which continues to be very strong. And I think it will continue to grow there.
Okay. So you think your overall AUM, I think in your con call, I heard you said mid-teens. You've done 19%. Can't you do 19% again for the full year and for next year?
We would like to always grow faster than or bigger than what we have announced as a guidance. But market dynamics, we need to keep watching. I feel definitely the growth prospect is good in the fourth quarter, and generally fourth quarter is large.
Yeah, but since you said mid-teens, I'm asking whether you are therefore discounting some slowdown in the market, slowdown in demand.
No, I'm not discounting a slowdown, but there is a demand. I think demand has come back. Even the construction equipment demand is reasonably bounced back, I should say.
Okay. So you may do better than mid-teens. Is that right?
Yeah, you're right.
Okay. Let me come to the margins. Net interest margins at 8.48 versus almost 9% year ago and 8.74 quarter ago. So that's a big fall. I mean, over a 25 basis point fall in one quarter. Do you see that pressure continuing?
Yeah, see, one of the reasons is we are carrying a little higher liquidity on the balance sheet, mainly because... see, last quarter, the general expectation was that liquidity is tight and we will have little more liquidity in this system. So that's where we worked on the same and had a higher liquidity. And we also had for the one-time big the ECS loans, which we had programmed. Normally we program in the month of January. But we had it in the month of December as a strategy. And therefore, we had that excess liquidity. And we should be able to consume that in the fourth quarter. So that to some extent, the NIM expansion would happen.
Yeah, that's what I was going to ask you. If you will use up that excess liquidity that you are carrying, should we expect NIMs to go up in the fourth quarter, above 8.5?
Yes, it should go up.
Okay. Generally, what is the cost of funds? Has it started at least plateauing? I mean, it's not declining yet, but any guess on what may be the cost of funds in Q4 compared to what you paid in Q3?
In the Q3 to Q2, it was almost plateau and did not really go up. Q4 also should remain same. I don't really see any scope to increase, and there may not be any sign of decreasing in the Q4.
Okay. Where do you see the big growth numbers for next year, FY26?
No, I think the infra is going to bounce back very strongly because the government did spend lesser in the last year, throughout the last year. And that pile-up would be there, and that will create much bigger demand. And that, again, once there is a spent on the infra increases, the other allied industry also will move up. And I think that is the major driver we see going forward, especially in 26.
Okay. The construction equipment and commercial vehicles.
Yes, both. Because ultimately it's a steel cement movement. They are the bulk of the carrying. Once that bounce back, then entire system will churn.
So you're counting on government capex to come back, and therefore commercial vehicle and construction equipment should do well.
Yes.
Is that right?
Yeah, you're right.
Okay. And spreads, or rather net interest margins, can you give us a more precise range for Q4? After all, we are already 1 month into Q4.
Yeah, see, I cannot really predict, but I can tell you that around 10 basis point improvement is something which we see because of using of liquidity. Beyond that, because what happens is the product mix may change even within the quarter. There may be a little more new vehicle lending, especially on heavy commercial vehicle demand. If that happens, then the margin can be a little less. So it is little difficult to predict exactly, but the liquidity being utilized is something certain.
Which will give you 10 basis points, point taken. You've maintained a very good asset quality control. Are you expecting that you will be able to continue? Do you see, other NBFCs which have personal loans and unsecured loans have had a problem? You don't see any such problem with your personal loan book?
See, our personal loan book is basically our existing customer taking that top-up loan after completing the primary loan. So it is basically a known customer. We are not really giving to unknown customer. Plus, their income source is known to us, and the investment for which they need the money is also known to us. It is not going for consumption. So therefore, there is a much better clarity from our side on where the money is going to spend. So
fair point.
There is a less chances of much increase in default.
Okay, no, I get your point. Take your point that you have been able to diversify very well when commercial vehicles didn't do well or didn't do all that well. Just a final word, if you say better than mid-teens, will it be 20% loan growth next year?
For next year's and next financial year, I don't want to really give a number, but I would like to continue with our conservative 15% growth plan.
Okay, one more number. Your ROA was a disappointment. Do you see that bottoming out in the third quarter?
Yes, it should bottom out and improve in the next quarter.
Okay. All right. We'll leave it at that. Mr. Revankar, thank you very much indeed for joining us, and congratulations on a very good set of numbers. No taking away from the credit of asset quality and loan growth. Yes, margins we will squabble a bit, but as Mr. Revankar pointed out, they have excess liquidity on their balance sheet, and that would increase their NIMs by at least 10 basis points going into Q4. Well, the markets are still a little downbeat. The only market that's actually very happy at this point in time is the Indian bond market, because on Friday, the Reserve Bank went and bought 10,000 crore of bonds. So barring that, all other markets a bit downbeat. We'll wrap up on Bazaar on that note. Chartbusters coming.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that. So we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
About India, if we have them growing strong next year, consistent with what they grew this year, it's now moved to the 5th largest economy.
The Honeywell view on India and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
You're watching us here on Chartbusters on CNBC-TV18, and as we speak, we have the markets falling, but one of the stocks on our radar is Godrej Consumer. Reported a weak set in the third quarter, but as the company had guided us earlier itself, that it would be a weak quarter on account of the rise that we've seen in palm oil prices, and at the same time, we've seen some weakness in demand sentiment as well. Asif Malbari, who's the Global CFO and President of the Middle East, Africa and International Markets Business, joins us now. Asif, you earlier called out the weakness in the third quarter. The results reflect that as well. The question is, what next? From the peak, palm oil prices have come off. The street is expecting demand to come back as well. We've seen some recovery in FMCG stocks from the lows as well. Do you believe that, the worst is behind? What are you seeing in this quarter so far?
Sure. No, so thanks, Mangalam. I think one, as we had called out, this was a quarter where we had seen a lot of temporary headwinds against us. And we saw these in two of our core categories. Personal wash is going through a fair bit of commodity inflation, as a result of which a lot of pricing has gone into the market. As we indicated in this quarter, while we kind of saw mid-single digit declines, we actually kind of broadly offsetted most of that with price increases, with giving a flat revenue kind of growth in the category. And then we had some bit of, again, temporary headwinds in terms of HI, where seasonality did kind of not support us in the best of the fashions. So we do kind of see these kind of reverse off as we kind of move on in next quarter. Definitely, there will be sequential improvement. Having said that, we've delivered last 6 quarters. We have been delivering broadly in our India business a UVG of 6 to 7% weighted average. And this was a kind of, I would say, a quarter which we wouldn't want to kind of remember in terms of a growth delivery. There is always an effort to kind of get back to that level of delivery. We should see a sequential improvement, and I think as we get into FY26 in first half, we should kind of start getting back onto those kind of trend lines.
All right, sequential improvement in the fourth quarter and get back to 6 to 7% underlying volume growth in the India business as well. But what about the India business margins? How long before you claw back to your earlier guided range of 25 to 27% point? Because you had been talking about that for the last many quarters. The last couple of quarters have been an aberration. If you could give us a newer range that the street should be working with as well, and how long before you get back to this 25, 27%?
So I think let me kind of break this margin piece in 2 parts. If you kind of see historical consolidated margins for GCPL, they've actually been between 18 to 22%. We closed margins last quarter at a consolidated level at 20% plus. So from a consolidated margins perspective, it's still a good journey. We've been able to kind of hold a good shape of 20% levels of EBITDA for consolidated GCPL as a whole. It's coming in on the back of a significant margin improvement, which we've done over the last 2.5 years onto our international geographies. International geographies margins, almost 2 years back used to be at 10%. YTD 9 months is kind of gone to 16% level. So we've got like a big kick from our international geography margins. India margins, which are range bound between 24 to 27, have breached on the downwards. Definitely, we know that we can bring these and we will operate it within the band. Likely to take a quarter or 2 to kind of get back into that band, because in Q4 we will see some bit of a margin pressure yet, because still there is I would say, a spillover effect of palm oil, and while we've taken pricing, it will still take kind of time to kind of catch up to get those margins in that normative range. So we could see a few months to kind of get there, but we feel very comfortable operating within that banded margin, and it's temporary pressures which have kind of taken us off. So that's the way I would kind of respond to that.
Okay, all right, Asif, hi and welcome to the show. Could you tell us what about household insecticides business, which in the start of the previous quarter, that I think was impacted by delayed winter. Has that seen some kind of pickup in quarter 4?
So again, Mangalam, I think we're very happy with what I would say is our interventions in the household insecticides category, and how consumers have reacted to it. So I think we launched household insecticides, the incense sticks. That's done extremely well over the last couple of quarters, and it's kind of gained high single-digit market share in a very short span of time. And we are seeing a great runway to growth there. Our new product, which got introduced with the new molecule, is also seeing early green shoots of gaining share in the electric segment. So if you look at it from a segment performance perspective, we're kind of doing well in pretty much all the segments, and showing early signs of gaining share in all of that. There has been a bit of a seasonality / I would say urban consumption stress for the larger industry as a whole. And we're hoping that that will kind of fall in place as we go along.
All right, so the industry is facing headwinds, but you believe that you're doing better out there. What about the Raymond portfolio? I mean, we did see a big growth in the KS business, that portfolio, but perfumes or deodorants, that's still struggling. What's the likely growth rate here that you're seeing?
That's right. So definitely KS has delivered a strong double-digit volume growth and is doing extremely well. Very strong green shoots in terms of our ability to kind of bring in the new products and to kind of premiumize the portfolio. So quite happy with the sexual wellness part of the business. In terms of deodorants, we did take some time to kind of get a balanced GTM strategy. As we speak, we are seeing market share gains in urban, we are seeing market share gains in e-com. On the GT part of the business, especially in urban GT, we did make a few changes. The changes are falling in place as we speak, so we're quite confident that that part will also start seeing double-digit growth. So I think structurally, we're happy with the portfolio. Some bit of the corrections in terms of the sales system is something which we've made. So happy with the acquisition in totality.
All right. And earlier in the conversation, Asif, you did speak about the improvement that you've seen in your international business itself from around 10% to 16%. So the question is there more room for growth out there? I presume anywhere between 18 to 20% would be the international business band. Would that be a correct assessment?
You are right. I think there is a scope to kind of take up margins in the international business up by another 200 bps for sure. We will need to kind of consolidate. Given that we've had a good runway, we need to just consolidate margins at these levels and then build from here. But we do have plans to kind of take it up further. We're also seeing early green shoots in some of our international geographies in terms of the macroeconomic conditions. So like countries like Nigeria, countries like Argentina are kind of showing much more stability in terms of currency. We're seeing much more stability in terms of macro conditions compared to what it was a year and a half back. And that's also kind of supporting the journey to kind of hence lead improved conditions. But yes, there should be an improvement from here on.
All right, Asif, let's get some simple details out of you. What would GCPL look like at the end of FY26? You could give us a few details on revenues, margins, net profit outlook as well, with the visibility that you have.
Sure. Yes, it is. I think it's interesting times. So I think would kind of wait possibly, Mangalam, for a quarter to kind of start giving guidance for FY26. We typically kind of do it after we close the year at the time of our annual conference. So let's wait for a week on that. But definitely we would want to kind of get back to our running rates of high single-digit UVG for the India business. Get margins moving towards normative levels, both in India and improving it for the international business. Pet care business, what we'd announced, the actions are progressing very well, both in terms of the product and in terms of the plant. So you should hear from us very soon in terms of our launch plans.
All right, we'll hear soon from your launch plans. Asif, thank you so much for joining in. Target moving towards single high-digit volume growth for the next year, along with margins towards that normative levels, though will take a couple of quarters for it to settle out here as well. The stock opened lower as the street saw those numbers, but thereafter there was buying at lower levels because a lot of that was perhaps priced in as well. Though the market's not in a good mood at all. The Nifty now down 250 points. We opened lower. Thereafter there was a recovery, and that recovery has been vociferously sold into. Currently at the low point of trade, the mid-cap index bearing the brunt as well. So what we'll do is take a short break. On the other side, shift full tilt to markets itself. Rahul Sharma of JM Financial Services joins in to discuss the market technicals, what the outlook is from here itself.
The last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because there needs every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it, and they are quite happy with it.
So what is this going to... Do you foresee the need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time, and at least we've seen this in our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, even though almost 80% of now, let's say, coding can be done through AI. But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, let's welcome our next guest. We have Rahul Sharma of JM Financial Services who joins in for a technical check on the markets. Hi, Rahul. Good morning and good to see you win. Well, the market mood is a little bit subdued, but I believe you're thumping the table and you're saying that with the shorts in the system and give and take everything, you believe there's a good reason for the markets to see a rally from here. Give us the rationale and where do you think we're headed?
Yeah, very good morning, Nigel. So a couple of things happening over here. One is there is a clear bullish divergence on the momentum indicators like RSI, MFI. Last week, we did see FIs covering their index shorts. Around 3.5 lakh was the peak that they hit. And from there, as of Friday, we've come down to 3.09 lakh contracts on the short side. Now, there is also an important Fibonacci level placed around the 22,500 mark. We believe that 22,700, 22,800, which is where we are trading right now, offers a very good risk reward for a possible capitulation from here. We are also into the monthly expiry week, which means this could be the final leg of volatility where we are seeing, selling across the board, mid-cap indices down like 2.5%, 3%, small caps also bleeding. So these are clear signs of that markets are extremely oversold. Also, the gap with respect to the US markets has widened to the maximum in the recent times. So we feel that from these levels, one can look to do some bottom fishing, possible bottom fishing with a stop loss placed at 22,400 on the Nifty. And once the bounce back happens, once the reversal happens, possibly from Friday onwards, which is where the new series begins, the budget is also something which is happening on Saturday. So we feel the bounce back can be at least 1,200 to 1,500 points on the upside from current levels.
That's a bold call you're making. 1,200 to 1,500 on the upside is a possibility with a 400-point stop loss that one can put in. Rahul, just one question. Because you believe that the upside could start from Friday itself, which is the new series, would you recommend those who are, acting on your trade or your idea to build positions in the next month futures as against this month itself and maybe do nothing for this series?
Yeah, absolutely bang on. So if you are into the derivative side, the best thing to do is buy the February futures for the Nifty. Alternatively, if you are looking to buy on the cash, I think this is a good time to buy Nifty ETFs and hold it for the medium to long term long haul. So, February is something where we are expecting this bit of a recovery in the market. And this recovery is something, which probably there are some stocks, like for example, the two heavyweights in the Nifty 50 space have not given bad results. I'm talking of Reliance and HDFC Bank. So these are the reasons why initially the market started following. And now I think there is some divergence building up in some of these counters. So selectively, in case you're trading stocks, it's best to be selective. Something like a Titan, Eicher Motors, Bajaj Twins. These are stocks which are, giving divergences, meaning they have not hit lower lows when Nifty has actually gone down to hit 22,800 as we speak. So these are the stocks where one could look to, cherry pick and buy these stocks for the February series.
Okay, all right. Just one query, Rahul. If you're expecting the Nifty to see a good amount of bounce from here, the biggest constituent that's been an underperformer has been the Nifty Bank. Where does that find support?
Yeah, so Nifty Bank has almost reached to its support area. So 47,500 roundabout is where the crucial support for the banking index is. And like I said, the heavyweights at least are not witnessing fresh shorts in a big way. So that is something which is very close, to the support area. Now, having said that, between the two, I think it has to be the Nifty because it has the diversification of let's say an IT, let's say, FMCG, which is actually doing very well. So, the best thing to do is avoid banks at this point in time. Start with Nifty. Once Nifty gives a confirmation, then I think it is better to switch on to the banking side, which is relatively not really given a very strong reversal signal as of now.
All right, we take that point. Thank you so much for joining in. A bold call that you've made. Most definitely hold you on to this one, and we'll have a conversation perhaps sometime in the next week as well to test this hypothesis itself. With that, what we'll do is shift focus to our special segment. We get you a few ideas for profit coming in from our colleagues at Money Control Pro. Anubhav Sahu joins in with an interesting stock. He's positive on Laurus Labs, stock which is down 15% in today's trading session. Third quarter results were good, but the stock lower in today's session. Let's hear out what Anubhav has to say.
Well, this month is turning out to be a tough one from markets perspective, given global macro headwinds and continuous FI outflows. However, particularly in a period like this, bottom-up approach helps one such improving underlying businesses that are Laurus Labs. Company posted a strong Q3 led by ramp-up in the new assets of the CDMO business. EBITDA margins have sharply jumped to the level of about 20% after 6 quarters. And Q4 results are expected to be even better due to scheduled project deliveries for late-phase clinical programs. Now, company highlighted about a small molecule CDMO pipeline of 70 plus projects, wherein 10 products are commercialized. Further, company is working on 20 active projects in animal health and crop protection chemicals, which are undergoing commercial validation stage. Here, peak potential is expected by fiscal 27-28. In addition, company's new R&D facilities helping it to fetch early stage projects. Among other segments, antiretroviral sales are soft due to capacity allocation priorities, but biodivision is doing well in terms of customer pipeline and capacity enhancement. In fiscal 26, we expect operational leverage and financial deleverage to help in exhibiting strong earnings growth, and therefore we believe one should accumulate the stock on any weakness.
Thanks a lot for that, Anubhav. Well, time to slip into a short break, though. Let's dive into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, in a special interview, CNBC-TV18's Prashant Nair interviewed SEBI whole-time member Anant Narayan and asked him about the risk involved in the derivatives market.
You've done a fair bit in terms of weekly options and other things. Or is that work in progress still? Is this going to continue to evolve, and we will see more sort of regulation and efforts to make people aware of the risks in this kind of activity?
Derivatives aid in price discovery. They give you depth in the market. They allow for risk management. They allow for trading, all of those things. And we do need all of these things for capital formation. So let it be very clear, SEBI is not against derivatives. We did have a problem, though, on two fronts. One was our first principal mandate is investor protection. And it was very clear from the two research reports that I quoted to you that small investors were losing out and that we cannot close our eyes to it. While we are a disclosure-based regime, we are not a nanny state. At the same time, we can't allow this to continue for a very, very long time. That is one particular issue. The second issue was we also saw a fair amount of overtrading and therefore increase in system-wide risk, particularly on expiry days. And when we spoke to our market participants and we consulted with them, what we realized is that the core issue really is not across the spectrum of derivatives, but specifically in the area of index options trading on expiry day, right? So out of the 6 steps that we announced in October, 5 of them were clearly and squarely directed at trying to curtail this question of over trading in index options on expiry day. Now, we haven't directly tried to address investor protection, but by this oblique route of trying to bring down over trading on that expiry day in index options, we think that will have some kind of a benefit for investor protection as well. We've taken the first set of steps. We are still looking at how the impact is kind of playing out.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda.
Welcome back. The market's still lower. A couple of stocks, though, very interesting moves out there. Signed after the big fall that we saw in the previous trading session, is trying to make an attempt to recovery. Currently moving in the green in an otherwise wobbly market. But the other stock which continues to see selling pressure is Kalyan Jewelers. That stock, at yet another low point of today's trading session, has fallen almost 45% in just the last 7-8 trading sessions itself. Reports its numbers this week, so it'll be very, very crucial to track what happens post the results are announced, whether promoters go ahead and act on the stock itself or not. But meanwhile, for the markets, no respite really. Even though the Nifty Bank has come off slightly from the lows, the Nifty is still down by almost 250 points. So what we'll do is take your leave on this edition of Chartbusters. On the other side, we have the team of Trading Hour coming up with all the market action next.
Award-winning India Business Hour, live every night on YouTube. With me, Shireen Bhat.
India Business Hour, live on YouTube at CNBC TV18, weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay
stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving, because markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue. That what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether the industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that, with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this was a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
So markets will always be mispricing. But mispricing to start with, but eventually it misprices on the other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth. And that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum. But the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top it becomes so what you call compelling. I can sell the story to even a person like him or anybody. And you sell. While selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer, and this is turning out to be a very tough morning for the bulls on our markets right now. Benchmark indices are down over 1%. The mid-cap, small-cap selling off close to about 2.5%. We had a gap down opening, but the selling pressure picked up in the last one and a half hour of trade. The Nifty is now below the 22,900 mark for the first time since June, and the sell-off in the mid-cap index has now extended itself to a 13.5% fall since the start of the year, and the picture is even worse for the small-cap. 10% for the mid-cap index and about 14% for the small-cap index. Very few places to hide right now. On the way up, you only have an ICICI Bank up in the green. A State Bank of India is holding up, and then you've got a few consumption names like Britannia, HUL, maybe hoping for some budget booster. But on the way down, top losers include Power Grid, HCL Tech, Wipro, Tech Mahindra, Hindalco, BEL. So the losers are cutting across sectors.
Good morning, Reema. You're absolutely right. Losers cutting across sector. And like you mentioned, the advance decline ratio, or the number of stocks advancing to the number of stocks declining, very much in favor of the bears, and that is something that is spooking the markets currently. Only 164 advances to over 2,300 declines. What are the stocks, especially today, that are seeing quite a bit of selling pressure? Well, the entire pharma pack, the Nifty Pharma Index, is the one under most amount of pressure, and within that, stocks that have focus to ARV or that have exposure to ARV, that is antiretroviral, especially with the AIDS program, all of these stocks are seeing significant selling pressure. Names like Loris, Aurobindo, Ciplastride are some of the stocks with exposure there, and on the back of worries about funding halting as far as US is concerned towards the AIDS program, all of these stocks we are seeing significant selling pressure. On the other hand, the banking pack, divergent views over there. AU Small Finance Pack, the management of the company has gone ahead and downgraded a few key metric guidance, and on the back of that, Nomura downgraded the stock today has slipped almost 8%. The only bank, Rima, that's holding out in the green is ICICI Bank, and it's pristine asset quality over there. So ICICI Bank, the sole gainer, especially as far as in today's market is concerned.
Well, not to forget DCB Bank too, and Bank of India. DCB Bank higher by nearly 4.5%. In fact, that's our cue to invite the management of DCB Bank. The company is up, the stock price is up close to about 4.5%. The street is giving a thumbs up to the improving asset quality, and more importantly, the advances and deposit growth is above 20% in Q3 on a year-on-year basis. Praveen Kutty, MD and CEO of DCB Bank, is now with us on the show. Thank you very much for joining in. So, Mr. Kutty, first, is this 20% plus kind of deposit advances growth seen in Q3 sustainable, and where is growth coming from, and what can you guide as you end FY25 and looking ahead to FY26?
Thank you for having me here, and good morning to everybody. We are reasonably pleased with the growth that we are seeing on the deposit side and the loan side. If you look at the last 5 quarters, we've been consistently growing near about 20%. And what is more relevant here is that the kind of growth that we're getting, our top 20 ratio on deposit remains below 7%. It's a tough market out there. The liquidity is tight, but we're finding ways to garner deposits in this market. Likewise, on the asset side also, there are headwinds, specifically in the unsecured space, but we've managed to keep the growth going in the areas that we are focusing upon. I presume that we will see a similar trend in the future as well.
Understood that. So loan growth was quite robust. Slippages have declined sequentially, and you're one of the few banks who've actually seen a sequential increase as far as CASA deposits are concerned. So what led to the rise in CASA deposits? Q4 FY26, can you continue to outperform the industry?
It's still a tough fight on the CASA front. While the overall deposits have grown by 20% plus, CASA growth Y-on-Y has been 17%. We're far more focused on savings account. Most of our growth, can I, I'd like to
please go ahead, yes.
This point very clear. The SA growth has been 17%, not CASA growth. Yeah, the 17%. So it's been a SA-led strategy. The CA has been remaining flat. So we continue to focus on small individual customers, and that's where the area of our CASA growth would come from.
Got that. Your net interest margins have expanded to 3.3%. And I believe you are saying that the steady state NIM is expected to be 3.65 to 3.75%. So when do you get to higher margins, and what will drive the NIMs?
So after many quarters, we've seen the uptick in NIM, and that has been led by the yield and advances going up, a steady credit cost, NPA ratio coming through. While there has been an increase in cost of fund, which has been unanticipated because we thought it will remain flat, the increase in yield advances has been higher than the increase in cost of funds. So we've now seen, hopefully, the last of the NIM dropping. Now you'll see it increasing. So 3 bips increase in this quarter, and possibly we'll see the trend continuing for the next few quarters as well.
And this 3.65 to 3.75% of a NIM guidance that you had indicated?
I think once you see the cost of funds stabilizing, it still hasn't, but once you see it stabilizing, 2 things will come into play.
Today, when we grow 20% on top line, you're seeing a 15% growth in NII. If you were to see the past, we were growing NII by about 4 to 5%, single-digit NII growth, despite a 19% growth in the top line. For the first time this quarter, we saw 20% plus growth on the top line and a 15% increase in NII. This ratio, we are working very hard to ensure that the NII growth matches with the top line growth, and that would result in it will primarily come from improvement on NIM. But having said that, the components, the fundamental strategy of the bank remains the same. We're not going to venture into the unsecured space even at this point in time. We continue to focus on the products that like mortgages, secured assets, small ticket, retail, granular deposits and loans. So that will continue, but you will soon see the increase in top line and the increase in NII matching. Understood that. Mr. Kuti, we want to understand a couple of points. First one, in terms of ROAs, you've highlighted a few steps that you're, undertaking to go ahead and increase the ROAs. Number two, could you confirm whether you've marginally toned down NIM guidance by 10 to 15 basis points? And also, has credit cost guidance inched up a few basis points as far as FY25 is concerned? So the way we see the DuPont, so to speak, is that 3.3% of net interest margin on earning assets would on total assets, a fee of around 1.1%. Currently, we are at 1.04. Cost to income, cost to average assets get it to a 255 kind of level. Currently, we are at 259. And from a credit cost perspective, it'll range somewhere between 0.45 to 0.55. We are at 0.38. So that'll inch up at some point in time. So what we see is there are 2-3 of these metrics are well within arm's reach, specifically the fee line and the cost to average. So if we continue to perform the way you're performing, the one area that we will necessarily have to move by a large movement would be the NIM part. The others are well within within seeing distance as we speak. Okay, Mr. Kuti, as far as FY25 and FY26 is concerned, could you reiterate for us and for our viewers, number one, loan growth guidance, deposit guidance, the CDR ratio guidance, what is it that you're looking to maintain, and also NIM guidance, you've mentioned that there could be a slight moderation, FY26, where do you expect NIMs to go ahead? And also in the case of an interest rate cut, how do you see NIMs panning out? Yeah, so the guidance is that within the next 3 to 3.5 years, we would double our balance sheet. So roughly growth about 20-21% is what we see in this environment. We expect to hit a 1% ROA in the next full year. And as far as CD ratio is concerned, we'll be more comfortable, closer to 80% than where we currently are.
Got that. Mr. Kuti, we leave the conversation here for now. Thank you very much for joining in. Need to slip into a very short break. We'll come back and discuss what's happening in the commodity space. Manisha Gupta joins in on the other side.
We have written in one of the papers, but so any highs, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you'll get to see 500 crores loss. So I mean I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull like Rakesh, and I used to collect bulls and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money and HDFC Bank doesn't need to raise capital. And we have met the company and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India. or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global this thing and macro and all that, which right now is again making me do a small mistake, because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody I say.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent, for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturer.
Welcome back to Trading Hour. Well, one particular stock today that's in the eye of the storm is Laurus Labs. The stock has seen significant selling pressure, but we have the management of Laurus Labs exclusively to CNBC-TV18. Mr. Satyanarayana Chava, founder and CEO of Laurus Labs, joins us now. First of all, good morning, Mr. Chava. Thank you so much for joining us. While we will get to the results, and it's a very good set of numbers from Laurus this time around, the results have been overshadowed by the fact that there has been a development over the weekend regarding the Trump administration's decision to go ahead and halt funding as far as ARV tenders are concerned for the AIDS program. Could you give us a sense of how it impacts you? What percentage of your top line comes in from this particular business, and how is your business impacted?
Good morning. If you look at the amount of money spent on purchase of drugs to treat HIV patients is $1.5 billion. This is about 10% of the total money spent on the entire HIV program. If there is a fund constraint, we don't believe they will stop buying drugs because they have achieved so much progress in controlling this disease. We believe the funding, whatever available to them, will be utilized mostly for purchase of the drugs. That's one point. And second, the amount of money contributed by US on the HIV program is significant, but is not the 100%. So a lot of other countries also contribute significantly. And third, countries like South Africa, India, China, Thailand, and Brazil, where HIV burden is very high, apart from other African countries, they are funding these programs by the respective governments itself. The patients living in these moderate income countries is about 10 million patients out of 27 million patients on treatment. So 1/3 of the patients who are living in these countries are funded by their own governments. And the other additional point is, for Laurus Labs, we sell API to most of the formulators. That contributes about $200 million sales, and we sell about $100 million formulations. Currently, it contributes about 40% of our sales, and we believe it will have no or very insignificant impact on our business prospects. And lastly, even there is a news that US is reconsidering joining WHO, and that is under consideration. So considering all these, we don't believe this will have any impact on our business, HIV business.
Okay. But just to get the numbers right, you're saying that the ARV-related portfolio is 40% of your revenues, and what percentage of your EBITDA? And if I could just go one step further in, what about the PEPFAR-related ARV business? Some estimates suggest that it could be 500 crore. That's about 9% of your overall sales. Would that be a correct estimate of the current position?
See, we sell 1,500 crores for APIs to all other formulators, and we sell about 800-900 crore formulation ourselves. So the money, the revenue what we are generating directly from orders or tenders from PEPFAR is not that significant in our overall revenues.
But what would that number be? I understand it's not significant and they may not be a big, overall impact. But as of now, what is the revenue that you generate from PEPFAR-related tenders?
Oh, we have orders for the end of this year. See, it's not that people place tender orders and then they look for money. So 2025 PEPFAR funding, global funding were secured, and all countries contributed to that. So see, even in FDA, even US government is saying there's a 90-day freeze, and then during this review period, they take decisions which programs will be funded, which are not funded. So it is a 90-day freeze, and but that has no impact on our immediate orders or orders during this calendar year 2025.
Understood that. Mr. Chava, also one more thing which I want to understand is, could you explain to us the life cycle of the tendering business? What is the inventory in the system? When is the next set of tenders about to come about? And, is there already been channel filling that has been done as far as this particular set or the 2025 set of tenders are concerned? So will 2025 business be impacted? There's been quite a bit of to and fro, like you mentioned, they're also considering going back into the WHO. But could you give us a sense of that?
See, each country follows its different tenders. Some country do multiple tenders in a year. For example, you take South Africa, they do a 3-year cycle. That cycle starts very soon. And South Africa is not funded by PEPFAR or Global. They do most their own. And India, NACO, is funded by the government. And that Indian government do 2 cycles generally. And China has their own program, Brazil and Thailand and all, they have their own program. So whereas other countries are funded by Global Fund, PEPFAR, USAID, and their in-country programs. So there are multiple things. One program don't contribute more than 1/3 of HIV treatment across the globe.
Understood that. Mr. Chava, if you have any more thoughts on this particular development, please do share with us. But we'd also like to understand a little bit about business itself. Q3, after a while, you did see very strong turnaround come about, especially as far as the CDMO business is concerned. You've given a guidance to the street of 20% EBITDA margin, which shows that the implied ask rate for Q4 is quite steep. Do you continue to hold on to that guidance? And would you be able to give us the top line guidance for, where will you end FY25 at? And also FY26, how is the CDMO business outlook looking?
As we informed in our investor call last Friday, we are very much committed to bring our EBITDA margins for the entire year closer to 20%. We are committed to that. We have orders on place, we have production done or going on, and we are delivering strong numbers in our CDMO, this better than the Q3. And also our FY26 for overall business is looking good, non-ARV is looking good, CDMO is looking good. I think things are in a good shape.
So just getting back to, again, the concern that the street has on your ARV business, the PEPFAR-related funding. Do you think estimating a 5%, so let me rephrase it, sorry. The street worries that the worst case impact on your EBITDA margins in FY26 would be 5% at the EBITDA level, a 5% impact at the EBITDA level. Do you think that's realistic, or it may not be as much? And the impact could be the tune of 1-2%, or what to your mind could be the impact at the EBITDA level?
See, if US stop funding entire HIV program, say 30% of the people who are getting treatment are not getting treatment. then assuming everybody gets 30% beating, so and Laras will also get 30% beating. So it will have some impact on our program. But see, these formulations is fungible ARV APIs. We will take some time to recoup that into other APIs. So for 2025 calendar year, everything is visible, and we have no impact on our ARV business and also other businesses. And it is too early to comment what kind of knee-jerk reactions people are taking. Whether how much truth is there, how much pain is there in that, we have to wait. When it comes to 2005 calendar year, that means Q4 and the next 3 quarters, the next financial year, we don't see any impact.
So one last question from our end. 2024, the US Biosecure Act didn't play out as expected. 2025, are you hopeful it goes through? Despite that, in your results, you're seeing the CDMO business pick up. What is the strength or the pace at which RFQs are coming in? You've mentioned that you see a bit of visibility, but are you seeing increased business coming in from US clients, especially for the CDMO space?
Most of the business in CDMO currently is coming from US customers, but there are a lot of opportunities we are pursuing for CDMO business from European customers as well. See, the CDMO business, small molecule business itself is growing for big pharma. So there is a need for capacity in CDMO space. And since we have invested around $400 million in the last 4 years in CapEx, that CapEx is coming to very fruitful use right now. And we have several programs, APIs and very advanced intermediates are produced. And our CDMO future looks very bright.
Okay, thank you very much, sir, for joining in. So you're committed to hitting the 20% margin, even though the ask rate in Q4 is quite high, but 20% margins and the impact, on this US withdrawing from the PEPFAR funding, the WHO funding for malaria, you don't believe the impact is going to be too much. For 2025, you have visibility, orders are secured for 2025. That's Laurus Labs for you. Stock still down close to about 10-11%. Manisha is now with us. She's been patiently waiting by. Manisha, what's the latest on metals?
Well, we have seen a bit of a decline continuing into this space. Remember, the last week also was quite jittery, and this week again you have European Central Bank, Canada and US coming out of their monetary policy. So you will be looking at a choppy markets. But at this point in time, we already are reacting to the whole of weak Chinese data that came in today, whether it was about the PMI numbers, the factory activity, even the services sector saw a bit of a decline, much lower than what the street was anticipating and lower than previous month as well. That is weighing onto the markets. So when you look at the copper prices, we've seen almost a percentage point of decline here. Zinc has continued to decline. It continues to be an underperformer within the state, and we are looking at around multi-week close onto this one as well. Zinc actually has declined by 7% in last 1 month and is trading at a 19-week close. And it's not just contained up to the base metal prices. The precious metal prices also have seen a bit of a decline. Last week on Friday, gold was just away $10 from an all-time highs, but we have moved away from those levels right now and a bit of a decline coming in. In the past 1 month, though, the gold prices still have gained up by 5.5%. Same goes for silver. With the decline in base metal prices, that seems to be rubbing off on silver, which is a part metal, part precious metal. And we are looking at prices here as well coming off their multi-week highs, $30 per ounce, just about holding on the international markets right now.
Thank you so much, Manisha ma'am, for joining us and giving us a sense of how precious metals outlook is panning out. Let's now slip into a short break. More on the markets on the other side.
CNBC TV18 special coverage here, live from the World Economic Forum's annual meeting in Davos.
If I were to say even heart and mind put together, India is an exciting story.
CNBC TV18 will celebrate 25 years. The Honeywell view on India and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
Years of covering Davos.
Cement is cheaper in India than potatoes are.
IT services as a business, we are at the cusp of a very big inflection point.
What has the Maha pitch resulted in terms of MOUs?
So it's 60 plus and around $200 billion.
It's a pleasure, let me say this on camera, to speak to the diva of Davos.
We should see a better year than 24.
And the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that. So we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Welcome back. Nasdaq futures down close to about 500%. And one of the reasons for that is the fear that this entire AI-related trade that we've seen over the last couple of months will unwind. You know, what we're seeing right now is the ultimate AI face-off or showdown, whatever you want to call it, because ChatGPT, which is so far the reigning champion of generative AI, and it's versus DeepSeek. It's a rising challenger from China, And this conversation is taking the world by storm. All over Twitter, that's all you are seeing. ChatGPT versus DeepSeek. So here's what's happened in the chronology of events. Now, in late December, Chinese AI startup DeepSeek unveiled its free large language model, DeepSeek V3. Now, within weeks, it had become one of the top iOS app, in the top iOS app store, and it's positioned itself as a free alternative to OpenAI's ChatGPT. But the real deal came in on 20th of January, exactly a week ago, when DeepSeek released its latest model, DeepSeek R1, and performance tests show that it rivaled OpenAI's most advanced model, OpenAI O1. In fact, Satya Nadella, the CEO of Microsoft, he himself said at Davos, we should take the developments out of China very, very seriously. Now, scientists are thrilled by DeepSeek's breakthrough, but Wall Street is a bit worried. And here's a comparison between the two, because DeepSeek was built in less than 2 months and for sub $6 million. And the efficiency of DeepSeek has also rattled the industry because it compares with that of OpenAI. Also, reports suggest that DeepSeek's engineers have achieved their results using very few GPUs, and their GPUs of a far inferior quality compared to what NVIDIA's the kind of GPUs which were reportedly required to train ChatGPT. And that's the reason why NASDAQ futures have been tumbling since Sunday night, because investors fear stocks like NVIDIA, which were the poster childs of the AI rally. NVIDIA, for instance, was up 135% since 2024, or even the Magnificent Seven, the entire AI, Broadcom-related stocks, they will all come under pressure. So that's been an overhang and the big story that's playing out in the tech world right now.
Well, thank you so much, Reema, for taking us through, what is essentially a very interesting development as far as DeepSeek is concerned. Well, we'll now slip into a short break, but before we go into that particular break, some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Play Store or Google Play Store, or just scan the QR code from your screen.
The last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because there needs every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it, and they're quite happy with it.
So what is this going to Do you foresee the need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time, and at least we've seen this in our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, even though almost 80% of now, let's say, coding can be done through AI. But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports. are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing.
Welcome back to Trading Hour. Well, Pramod Damte from InCred Capital joins us now to discuss market fundamentals and his top sectoral picks. Good morning, Pramod. Thank you so much for joining us. First up, what are you making of markets at the current levels? And especially, do you have any specific view on the pharma pack today? The entire pack seems to have taken a big knock.
As we released a recent report clearly stating that we cut our Nifty targets, considering the fact that the challenges in the economic growth momentum are very much visible, and hence we feel that we will be either sideways to downward direction is where our discomfort is. The trade to look at is definitely the rupee depreciation, where our preference is both in terms of IT and pharma. Even though there might be short-term challenges in terms of US policy action threat, or in terms of technology challenges, which may be a short-term overhang for stock performance in these two sectors. But I think broadly, the outperformance for these two sectors, which was seen in the second half of CY24, we expect them to continue to deliver for CY25 in a market which is going to be a flattish to marginally downwards.
Pramod, hi. Morning, Rima here. You have a bear case Nifty target of 21,016. So if we have to get to this bear, what goes into your bear case target? What has to happen? What has to unfold? And what is the probability of it? Because so far, it's not that the earnings have gotten off to a great start or the price reaction to it.
So the way we try to do it is, considering the volatility, we try to put across different economic parameters to reach bull or bear case scenarios, and as a part of which we are called out the bear case for the same. We currently look at a bear case probability of around 40% versus a base case of 50% for FY26. Some of the factors which we are trying to put across is definitely one is oil, which has started moving up recently. Second one is in terms of GDP growth, we seems to be inching more towards 6%. If there is a hope that we should bounce back, but it needs to be more towards 7% than below 6%. So I think, and also the repo rate cut expectation is somewhere around 75 basis points. If it doesn't yield that, and we are hardly do 25 basis points for this year, so then it will call off for a bear case scenario, which we feel is a 40% probability as of now. That leads to a 21,000 target in the worst case scenario for us based on the FY26 earnings.
Understood that. So in the current market scenario, which are the sectors you like and which are the sectors you look to avoid?
So the sectors which we have, as I indicated already, IT and pharma, we would be a buyers into pharma in the today's correction. Even though stock specific wise, couple of names might be impacted, we await a detailed policy report from the US, how they will plan to handle it. Where we are constructively remain positive is one in terms of aluminium. Second, cement, we expect the worst is already captured. It should come back as the infra spend comes through. We are positive on the broader EMS space, where there is still a very strong, nearly 80 to 100% type of EBITDA growth momentum, which is continuing. And we are turning constructive in terms of agri-chemical space, even though the rest of the chemicals remain negative for us. So those are the couple of sectors where our comfort lies.
Is Laurus in the pharma space a stock that you look at and track? And what have you made of the reaction to the developments today? A bit of an overreaction, or it's warranted?
I think broadly the market itself is in a correction phase. So hence the probable negative news are getting discounted much sharper. As I said, it is a possibility which may come through for a couple of stocks, and hence the worst is getting discounted in a very short time frame. We have been consistently upgrading pharma names in the last 6 months, of which even Laurus is the one which we upgraded. We'll wait out for the policy action report to come through, but I think the results were pretty decent, especially for companies. Our preference is still a large caps in pharma, where we would prefer companies like Lupin, Ipca as compared to even. So the broader story which we are trying to play in pharma is near double-digit growth in domestic, select drivers for global export molecules, than a broad-based US driver.
Okay, let's get to some of your high conviction stocks. And to that, you've added Deepak Fertilizer and you've deleted Exide Industries. Take us through that call.
So specifically to Deepak, the drivers which we are looking at is one, the cost reduction happening through its own internal ammonia capacity expansion and the gas contract which they have. So that will be an initial EBITDA driver for them, followed by the end product capacity expansion, which should play out in the next 2 years phase. So those are the 3 drivers which we are looking at specifically to Deepak Fertilizers. We initiated on Deepak last month and added to the high conviction list on a bottoms up strong earnings growth visibility. Exide is been underperforming the broader market in last couple of months. It's almost near our target price. And we feel that the people are getting realistic about the challenges in ramping up the EV cell plant as compared to the euphoria generated by the signing of Hyundai deal. So as a result of which, Exide has been removed from the list.
Thank you so much, Prabodh, for joining us and giving us a view on the markets as well as a fundamental stock call. So, well, time now for a short break. The management of Mankind Pharma joins us on the other side to discuss their Q3 numbers.
Of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big theme.
Welcome back. Mankind Pharma is the next corporate on our radar. They reported numbers last week, a muted set of Q3 numbers, revenues and margins in line with estimates, with profits after tax decline in the quarter. We have with us Rajiv Juneja, Vice Chairman and Managing Director at the company, now joining in. Thank you very much for joining in. We have the Q3 numbers, but if you could look ahead, how is Q4 likely to shape up, and what would your guidance be for FY26?
Q3 numbers were on the lines of our expectations, because the last couple of quarters we have taken certain corrective actions. Because there are two kind of companies you'll find. One company which basically are worried about their outlook, how they are appearing. The second is how they are from inside. So we are from the second side of the company. We are always worried how strong we are from inside. So once you take certain corrective actions, we have taken it, keeping future in mind. So naturally, these numbers have come, but whatever corrective actions have been taken, they are nearing to end. 80-90% has been done. Whatever will happen in this quarter will be finished off. We're quite optimistic about next year. Again, our commentary is simple: 1.3 to 1.4 times to in pharma industry, and EBITDA would be better.
How much better would the EBITDA be?
Would be better. I mean, for example, this year, once you take certain corrective actions, so your growth is muted, but your margins become better. We expect the same. By the end of this year, we expect our margins to be better. Growth would be a bit less than what we basically projected. Next year, we feel that our growth would be better, our margins would be better. These are the expectations.
Mr. Juneja, you did mention that this time around there were a couple of one-offs that impacted your top line. This is regarding the IPM. But analysts are highlighting that the core IPM miss has been quite significant, taking aside the BSV contribution. So what are those one-offs? You did mention you've taken a few corrective actions. What kind of corrective actions have you taken? And can we see the results of those corrective actions as early as Q4?
So please understand how many people work in the field of Mankind. Approximately more than 15,000 people work. And once you start taking corrective actions, it takes time. And corrective action in the form of IT, in finance, in leadership, in marketing, in the field. Every place we have taken corrective actions. The same kind of corrective actions we took 5 years back, when we saw muted growth. From where this idea came? The idea came from our OTC division. Last year, we took a lot of corrective actions in our OTC side, and we saw wonderful response to that. Once in a while, it is important for all the organizations to go for a deeper diving. We always see ourselves as a management, we are doing good. But once you go for a deeper dive, you go deep dive in a company, you find a lot of lacunas are there, inefficiencies are there. And as we have time and again said, that we want to move towards super specialty. So the leadership, the total ecosystem, the training, everything should be aligned to that. So these things have been done, and we started this journey approximately in the month of, say, Jan-Feb last year. So 90% things are being done, 80-90% things have been done. The rest would be done this quarter. So we expect a lot of good things next year.
So, as far as the analyst call was concerned, when it comes to the BSV business, you said that for FY25, top line growth over there would be flat. You're expecting growth in export market, but maybe a slight decline as far as the domestic market is concerned. So FY26, can we expect growth over there? And can we expect better margins also to come as far as the acquired BSV business is concerned?
Let's divide BSV into two parts. One BSV is what original BSV we acquired. The second BSV is the TTK business of BSV, which they acquired in the last 2 years back. So that TTK business has been taken over by Mankind side, Delhi side, because that's a prescription kind of a business. We are a much better company to operate that. There, the dip is there. As far as the original BSV is concerned, the growth is okay. The growth is 15%. As far as export is concerned, the export is good. Next year, what we expect as a whole, 15% plus kind of a growth from BSV business. This TTK business will come in Mankind side, so we'll take care of that.
Okay, one final word. Your net debt to EBITDA, you want to bring it down to 2x by when? And how much more will you be repaying by, of your debt in FY26?
Yeah, I mean, whatever we said in the past, we have always been very, very fast in executing things. One, we said that we'll go for a QIP. We did that. The second was that 4,000 crore rupees we basically paid through our cash we had in our treasury. The third basically is we have one of the business which is not pharma business. It will be done in next few days time. We'll announce it. So by the end of this year, it will be less than 2 times to EBITDA.
Understood that, sir. So we want your outlook as far as 2 key portions of your business are concerned. First one, we want your outlook as far as the acute therapies. We understand that contributes close to 65% of your total top line. And we also want to understand that there has been some amount of weakness when it comes to the domestic formulations business. So the outlook on both of these businesses for Q4 and FY26.
You take corrective actions. What's the meaning of corrective actions? You replace your some kind of some percentage of leadership, present leadership to the new leadership. When you replace these things for a few months, some kind of a hiccup and bumps are there. So whether it's acute, whether it's a chronic, some kind of a problems are bound to be there. And what are the problems? Maybe extra goods were there, more primary was there, extra discount was there. When you come to this path of correction, these things really appear. We have never been bothered by these bumps. What we are always worried about, how is the business, how is the strength of Mankind within? How is the substance of Mankind? We are always worried about that. These 1 quarter down, that doesn't worry us. What worries us, the longevity of Mankind's growth, that is always in our mind. Keeping that in mind, we have always done everything. Just look at Mankind. One Mankind is Delhi-based, mass division. Second is our specialty division. Third is our OTC business. Fourth is now this BSV. BSV has come in the fold of Mankind October 23rd of October. Just not even 3 months back. So it takes time, a bit of 1 or 2 quarters. And once this would come in our fold totally, a lot of synergy will happen, a lot of good things will happen.
Thank you very much for joining in. Need to slip into a very short break. We'll come back with more. Stay tuned.
The business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. They're a new bunch of companies. So it was a great mistake to think that you could look back and see.
I think one of the things you told me is really struck with me. You said and we'll talk about the nitty-gritties. MTNL is an example, and many others will share other examples as well. But when you began and when you sort of started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, well, we could sort of, that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted you to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue, that what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that, with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth.
Welcome back to Trading Hour. Well, one particular stock that should be on your radar is Larsen & Toubro. The company just a couple of hours ago has informed the exchanges that they have been selected as the preferred EPC contractor for the north side of the world's first 24/7 solar PV and battery storage gigascale project. Remember, on Jan 20th, CNBC TV18 had told you that L&T, along with the Chinese partner, had emerged as the lowest bidder for this particular one-of-a-kind large-scale gigawatt solar project. That particular news has fructified the stock mild recovery from the day's lowest point. But with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003. When mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth, and that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum, but the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top, it becomes so, what you call, compelling. I can sell the story to even a person like him or anybody. And you sell, while selling the story, you are obsessed, and you allocate, and that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers, but so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you will get to see 500 crores loss. So I mean I have incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money, and HDFC Bank doesn't need to raise capital. And we have met the company and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish.
Stocks here, broad-based sell-off with very few counters managing a green tick. Industrials, utilities are the biggest drags.
ICICI Bank feels the industry pressure on business growth but manages to report a strong operating profit while maintaining asset quality and return ratios. The stock gains.
The plot for the control of Religare Enterprises thickens with US investor Danny Gaikwad proposing a bid for 55% equity as he sees value in the business. Berman's question the most say they'll proceed with their open offer.
The government kicks off the process for appointing a new SEBI chief by inviting applications from candidates by the 17th of January. The term of the current SEBI chief, Madhavi Puri Booch, is slated to end on the 28th of February. You're with us here on Halftime Report on CNBC TV18. I'm Hormaz Patakia and with me is Mangalam Malu. Well, some bit of support coming in from lower levels, at least for the index. But the same can't be said for the broader markets. It is everything, right? You're heading towards the monthly expiry, the budget. You're also counting down to the uncertainty that's also coming in from the Trump tariff moves as well that we saw earlier this morning. And of course, the impending sell-off in a lot of these US tech shares, considering the new Chinese AI app that has come up. And that is causing a bit of a sell-off on the Nasdaq futures, which are down almost 500 points as we speak. But for now, the Nifty at 22,900, which is up almost around about 80 points from the lows of the day. The mid-cap index and the small-cap index, though, are the ones that are feeling the pain in today's session, as was the case last week and as is the case this week as well. 2.5% down on the mid-cap index, almost 4% on the small-cap index. And now the small-cap index is down 15% from its September 2024 peak, Mangalam.
It's all happening this week. You know, you have a bunch of result reactions, you have a bunch of cues coming in from a macro and micro front as well, and global action also reigns supreme. So very crucial levels for the market to support this time around this week, which is fairly event heavy. It's good to see that the Nifty's held on to that 22,800 to 22,850 sort of support, though every time we've seen a bit of an up move from there, the decline has been more vociferous as well. So we'll keep an eye out on how that pans out. But let's get stock specific. Supriya Life Sciences, the first management of the show. The company reported a good set in the third quarter. Profit after tax for them zoomed by more than 57%. Margins too expanded. So to discuss this and more, we do have with us Satish Wagh, who's the chairman and whole-time director at Supriya Life Sciences. Thanks a lot, Mr. Wagh, for joining in. You know, you were expecting 22 to 23% growth for the entire year with margins of around 39%. I wanted your thoughts on whether you are on track for that or not. And more importantly, apart from that, I wanted your thoughts on what happens to the business in the US, largely because of reports that Trump may stop funding for, you know, some of these medical aids, so to say, for WHO, etc. 75% of the funding for the world comes in from the US itself. Will that have an impact on businesses like yours?
Good afternoon. As far as Supriya Life Sciences is concerned, you know, you can see the revenue for third quarter, financial year 25, 185.6 crores, that is 33% year on year. If you see EBITDA for quarter 3, financial year 25, is 65.9 crores, that is 59% year on year. PAT is for quarter 3 is financial year 25, 46.7 crores, 57%, and that is on year. We are sure that we have done it in Europe, almost 40%. Now in Latam, we are going with 21% to 8%, and good growth from Europe and Latam and North America. We are having little presence in US, but we are expanding in US, and whatever we are discussing and whatever we have in hand, we will definitely do our best as far as US and other countries are concerned.
Mr. Wagh, good afternoon. Thank you for joining in. But since you mentioned you are expanding in the US, does this recent news flow that has come in with regards to Donald Trump stopping funding for the WHO and all of that, does that have an impact on your expansion plans, or do they proceed as they are?
Sir, our business is sustainable. We don't have any effect as far as any funding or anything is required. What we are doing, that we are already in the business for last 40 years, and we have seen ups and downs, and we are confident that we will definitely grow this year also.
All right. So if you could revisit your guidance once again, you know, third quarter was very strong for you, and you had said that the CDMO business will start reflecting in your overall performance for the third quarter as well. If you could revise your guidance or revisit your guidance for the start of this year, you had said that this year you will grow between 22 to 23% with 39% EBITDA margins. By the end of this year, will you be able to manage that? And what's your prognosis for the next year with all the plans that you have in LATAM, Europe, as well as the US? What's your growth prospect for the next year? That's FY26.
Sir, if you see today, our exports are 79%. And that will definitely touch whatever we have promised as per the last. Also, we have already filed 4 CEPs in Europe because we are very strong in Europe. And 2 US DMS, they are in progress. If you see the total year, the top line is 512 crores. 193 crores is our EBITDA and 137 crores is the PAT. I'm quite confident whatever we have already said in our previous quarters that we will achieve, we will definitely achieve. And next year also, we will do our best.
900 crore guidance for FY26. Does that stand, Mr. Wagh?
Sir, I will not be able to tell you on any figures, but whatever commitments we have so far given, you will definitely say that we have already achieved and we have done it. We will continue to do that.
All right. What about the CMO opportunity? You said that, it will start kicking in the third quarter. Has that kicked in? Is that reflected in the performance that you've reported so far? How much bigger can it be as an overall proportion of your sales, say, in the next 18 to 24 months?
Sir, as far as CMO, CDMO, our Ambernath plant has already started qualifications. The production lines have already started. And we are confident that we have said whatever we will achieve. We will do the needful. I cannot give you any figures, but the things are on track.
In the past, you've said CMO will be 20% of your revenue in the future. You want to comment on that?
So we'll not be able to comment, but definitely.
But this is something that you've said.
No. See, we already have invested 130 crores in the CMO, CDMO sector. And we are confident that we will achieve and we will get good results from the CMO, CDMO activity side.
How is China Plus One playing out, Mr. Wagh? Do you see any further potential upside to your business from that?
101%. There are a lot of things which we are going to do in the CMO, CDMO sector. Some projects have already started, validations are over, and the products will be delivered. And I'm confident that the second half of the next year, it will be started as far as the revenue is concerned.
What about, some of the opportunities, therapy opportunities? You said that 2 opportunities were at an advanced stage and you would have more clarity by the third quarter. Have you had any clarity on that? What's the update here?
See, the projects which we have taken in our hand, recently the protein project has already started because the FSSAI has issued the licenses. Now the things will be on track. The volumes are very big as far as the protein is concerned. It's almost more than 18,000 tons. So it's a big volume. And we are the only player as far as whey protein is concerned in India with the American technology. And we have signed the contracts with them for the next 20 years. We will do our best in that sector also. Many more projects we have already signed. The discussions are going on and they will be also rolled out next year by the second week.
All right, and a final question on the regulatory front. You had recently had a Health Canada audit that was cleared, no further notification. You were expecting a US FDA audit in the second half as well. Has that happened? What's the update here?
Sir, it has not happened. But we have a customer base of 1,500 all over the globe. So every week we have always 2 audits, which is coming from either from LATAM, it's coming from US, from Europe. So we are always ready for any type of audit. And our people are very well versed with the audits and they will do the best.
All right, Mr. Wagh, thank you so much for sparing time and joining us. Wish you good luck for the rest of the year and for FY26 as well. The management of Supriya Life Sciences expecting to see healthy growth continuing for the company going forward. Time for a short break, but before we do that, let's dive into Growth Code, which is an initiative by Grow and CNBC-TV18 that offers valuable insights and strategies to help you make well-informed trading decisions. Now, this week in a special interview, CNBC-TV18's Prashant Nair interviewed SEBI's whole-time member Ananth Narayan and asked him about the risks involved in the derivatives market.
you've done a fair bit in terms of weekly options and other things. Or is that work in progress still? Is this going to continue to evolve, and we'll see more sort of regulation and efforts to make people aware of the risks in this kind of activity?
You know, derivatives aid in price discovery. They give you depth in the market. They allow for risk management. They allow for trading, all of those things. And we do need all of these things for capital formation. So let it be very clear, SEBI is not against derivatives. We did have a problem though on two fronts. One was our first principal mandate is investor protection. And it was very clear from the two research reports that I quoted to you that small investors were losing out and that we cannot close our eyes to it. While we are a disclosure-based regime, we are not a nanny state. At the same time, we can't allow this to continue for a very, very long time. That is one particular issue. The second issue was we also saw a fair amount of over-trading and therefore increase in system-wide risk, particularly on expiry days. And when we spoke to our market participants and we consulted with them, what we realized is that the core issue really is not across the spectrum of derivatives, but specifically in the area of index options trading on expiry day, right? So out of the 6 steps that we announced in October, 5 of them were clearly and squarely directed at trying to curtail this question of over trading in index options on expiry day. Now, we haven't directly tried to address investor protection, but by this oblique route of trying to bring down over trading on that expiry day in index options, we think that will have some kind of a benefit for investor protection as well. We've taken the first set of steps. We are still looking at how the impact is kind of playing out.
And since then, I have become more cynical in general and also connect more to global, this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit and I no longer defend anything to anybody I say.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that, so we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship.
Down 200 points for the Nifty right now. We have holding around that 22,900 mark for the frontline index. The mid caps are the ones which are seeing a bigger cut. So good time to get in all the F&O updates at this point in time, largely because it's the expiry week. And that's how it has begun on, the side of the bears itself. The series has been on the side of the bears. We have Nifty options. The 23,000 put writers have been fairly active on the covering side. So those who had thought that, maybe this would be an important support for the market, those guys have been caught on the wrong side, and we are seeing massive short covering at the 23,000 put. But meanwhile, just keep an eye on the 22,900 call as well. Those call writers are fairly active, telling you that around 23,000 and 23,050, we will see a fair amount of supply coming in for the markets as well. Were the markets to cross this, then all these call writers will have to cover their position. So that's something we'll most definitely watch out for. Another important marker that I'm looking at is the India VIX as well. Now it's crossed 18, and it is likely to rise further as we move towards the budget. So those are a bunch of things that we will keep an eye out on. Hormuz.
We need to keep an eye out for that indeed, because the VIX climbing ahead of an event is par for the course.
Yes.
Right? It had the same thing during the general elections as well, and at the outcome now 8% higher for the VIX in today's trading session. But as we mentioned, there is plenty of pain in the broader markets in today's trading session. There are a lot of stocks that are seeing double-digit losses today. Laurus Labs is one of them, 14% down on the stock, back to the lowest point of the day. Netweb Technologies continues to sell off. Its shareholder lock-in comes to an end this week, and the stock itself has corrected almost 35 to 40% before that. But the one stock that is in focus over the last few minutes has been Balkrishna Industries. It reported an inline quarter, but the volumes have risen 5%. Now Sudarshan, who was on the company's earnings call, is joining in now with the key takeaways from that. Sudarshan, tell us more.
So Balkrishna Industries reported earnings for Q3. The earnings were in line, but now in the focus is commentary that's coming from the con call that company held just few minutes ago. Now two things have to be in focus. First, on volume front, company has maintained the forecast for FY25, that is the minor sales volume growth. But if you do the calculation, it comes out that in Q4 volumes are expected to fall. Second is margin. Now there was a raw material price increase just ahead before Q3. Now company is saying that raw material prices have stabilized, but the increase that company had seen earlier, its impact company will see in Q4, and margin impact may be seen somewhere in the range of 100 to 150 basis points. So overall earnings were in line, but commentary that's coming from con call is negative for Balkrishna Industries.
All right, con call commentary is negative, and as a result of which we are seeing that decline in the stock price as well. Speaking about stocks itself, take a short break, come back, get you more on the stock specific action, the markets on the other side. Stay with us.
CNBC TV18 special coverage here, live from the World Economic Forum's annual meeting in Davos.
If I were to say even heart and mind put together, India is an exciting story.
CNBC TV18 will celebrate 25 years. The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
Years of covering Davos.
Cement is cheaper in India than potatoes are.
IT services as a business, we are at the cusp of a very big inflection point.
What has the Maha pitch resulted in terms of MOUs?
So it's 60 plus and around $200 billion.
It's a pleasure, let me say this on camera, to speak to the diva of Davos.
We should see a better year than 24.
Very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
Think about India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Trained. The last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because there needs every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it and they are quite happy with it.
Welcome back. Shifting focus to the paint space, which has been a subject of intense conversation over the last few months. Now, in an exclusive interaction with Shireen Bhan in Davos, JSW Group's Parth Jindal told CNBC-TV18 that they are keen on buying AkzoNobel's India paints business and that they have put in a bid. Listen to what he said.
With JSW first and then Birla's entering, I think the industry has definitely heated up, and it's led to the first bout of consolidation with AkzoNobel putting its India assets on the block. My true belief is that the paint industry is not a winner-take-all market. It's not a capacity-driven market. You can't just build plants and expect the consumer to choose your paint. I think there's a lot of brand equity that has been created over the years by the incumbents. And this is an industry where you need to win the micro battles. You need to win over the influencers, whether it's the contractors, the painters, the interior designers, the architects, and finally the end consumer needs to select your paint. So it's been an interesting journey. It's completely B2C, and it's the first time JSW Group had gone into B2C. Now with automobiles, it's the second one. But it's exciting, and I think the AkzoNobel opportunity is a really exciting one.
All right, so what Parth Jindal's comments have done is set the cat among the pigeons once again in the paints sector, which has actually been quite, it's been in a bit of a flutter ever since the Birlas announced their entry, their capex, and the way they're growing, the derating that we've seen in the names like Asian Paints, the biggies of the industry, and everyone and their neighbors having said that, okay, they might be looking at AkzoNobel as an asset the minute it was announced to be on the block itself. So, perfect to get in an expert view on the sector right now, where things stand and what should investors do from here on as well. Manoj Menon, who's the head of research and consumer analyst at ICICI Securities, joins in now. He tracks the paint space very closely. Manoj, let's get this straight then. What are your views on this sector right now? This asset itself, who do you think is the best place to buy it? And is it at fair value right now?
Yeah, thanks, team, for having me today. So there are three aspects to the paints, industry and the stocks at this point in time. Post a significant recovery in demand, what we have seen in paints post-COVID, it seems that the general industry slowdown, consumption slowdown, seems to have caught up with the paint sector also, which is what we saw in the September quarter across the board. And the forecast for December is, that it's not really getting better despite the festive season, etc. Right. So that's point number one. There is an industry deceleration. Point number two, on the ground, to the channel checks, which we see with a fair amount of regularity, we are definitely finding that the competitive activity, which translates into higher competitive intensity, let's say when it comes to, let's say, trade discounts, consumer discounts, etc., has also kind of increased, let's say, over the last 6 months, thanks to new players and also probably the existing players wanting to save their turf, right, protect their turf rather. Point number three is the potential M&A opportunities for many of the players, and we remember actually writing a thematic about a year back on potential consolidation industry, even though we didn't expect let's say the current situation of AkzoNobel exiting India as a base case at that point in time. So at this point in time, look, when you look at the Akzo NV having decided to exit the decorative business in India and part of the industrial business also, except that they probably want to keep the powder coating, for the longer term, which is a small, portion of the India enterprise value. Look, I think it's a great asset for, honestly, all the play incumbents, except probably in Asian Paints. It does make eminent sense for them to bid for the Akzo asset.
Manoj, good afternoon. Thank you for joining in. With all this chatter going around the AkzoNobel asset, which incumbent or company do you think is best placed to acquire this asset?
Okay, so let's take one name at a time. Let's see if you take Berger Paints. Dulux is actually a great fit for Berger. Given the fact that Dulux paint brand is over-indexed in urban, and competes quite effectively with Asian Paints, so that aspect actually is very much there. Second, is that for a Berger which has got over-indexation in the eastern part of India, again it actually makes sense from a geographic point of view and even from a product portfolio point of view. You take, for example, in Indigo Paints, right? Indigo has got about 20 or 15 to 20% or maybe slightly higher revenue coming from Kerala, which actually is a market which a premium brand like Dulux could actually do far better than what they're doing today. Again, there is a great fit. And Pan India, the Indigo as a brand, which is positioned as probably mid plus or mid minus slightly, whereas Dulux is clearly premium. So again, a great fit. And also the non-Dulux part, which an Akzo brings to the table for an Indigo Paints, which is currently the process of building. You look at a JSW, which had a fair amount of presence in the southern part of India. Again, a geographical presence which a Dulux brings to the table. Apart from the fact that Dulux being kind of very sharply positioned as premium, right? I think in which they are the number 2 after Asian Paints Royal. It's a clear winning proposition for any of these suitors actually. So difficult for me to actually pinpoint one of the plays. It's actually makes sense for almost everyone except Asian, which doesn't really have any white space.
All right, but in that case, the question is price, because if there are so many players vying for this asset itself, chances are that there may be a bit of a bidding war. So at what price is it good for whom? Because from a JSW Paint standpoint, immediately investors won't get affected because, it's not going out of any of the listed JSW companies. But players like Indigo, players like Berger, players like, Kansai and Nerolac, if at all they're looking at it, or even an outside chance, something like a Pidilite, when they're looking at it, given the sort of money that they will be paying for it, do you think it will be accretive for shareholders if the companies go ahead and pay top dollar? What, according to you, would make most sense?
So let me address this in two parts, without getting into numbers, specific, etc. If you look at AkzoNobel India, a stock we cover, right? So we have an ad rating and a fair value which is about 20% higher than, let's say the current price. So that's our fundamental view to begin with. That's our published view, right? So that's a sense on what we think as a fair value, irrespective of the M&A. Now, the second way to think about this is that, the current around $2 billion market cap, which AkzoNobel India trades at. If you look at AkzoNobel NV, the parent company, which is approximately around 10 odd billion euros, market cap and a few $1 billion of debt. The fact of the matter is that, let's say anything materially higher than, let's say the current market cap, given the fact that India contributes about 4% to the parent company revenue, 20%, of the market cap, etc. I think there is a cap that, given the contribution of AkzoNobel India to the parent company, or put it the other way around. If you look at the other paint companies, particularly in the last 6 months, which is all corrected significantly, I think these interlinkages will actually decide the incremental fair value, which, let's say, the strategic value, etc., the suitors may want to pay.
All right, that makes sense. Just a final question, and this one's not from the paint space. You also have views on other consumer stocks. In particular, Kalyan Jewellers is something that I want to ask you about, because you've been fairly positive. Fundamentally, nothing has changed. The company reported a strong, third quarter update as well. But the kind of price damage that we've seen on the stock reeks of things beyond fundamentals. Could you give us a sense of, if you're in the know of, what possibly explains this rapid decline in the stock price? Because now it seems to be, getting into that spiral of promoters increasing their pledge, the stock falling further, then promoters to manage that, perhaps pledging some more of its stock. What's exactly happening here?
Mangalam, thanks for asking that question. Look, in Kalyan Jewellers, Titan are the two jewelry companies which we cover fundamentally. Titan, we have a hold rating. Kalyan, we have an ad rating. That's the last published view. So no change to the rating, no change to the estimates, until it is published next time. Look, I think the fact of the matter is the jewelry industry has been having a very good tailwind of industry formalization. And Kalyan, in the last few years has definitely executed better than the peer group. There are a few other listed peers also, right? So I don't think that has really changed in the last month or so. So our fundamental optimistic view on Kalyan absolutely remains. Based on our observations and interactions with investors over the last 2-3 weeks, it appears that most of the chatter, most of the, let's say, news flow, etc., seems to be on the technical phase. As it stands today, we will go by what the company came out in your channel 2 or 3 weeks back, and also in investor call subsequently. Ramesh Kalyanaraman and the team, presented a lot of things from their side of the story on a lot of the chatter which is going on in the market. It was an open call for any investor to ask questions, and I think they responded to many retail investors also. As far as we are concerned, we are taking a position that the fundamental stance is absolutely intact. Technicals, will take its own course.
Fundamental stance is absolutely intact. Manoj, thank you so much for joining in, sharing with us your views on the paint sector and, of course, Kalyan Jewellers, which has been the subject of a lot of chatter over the last 2 to 3 weeks. That was Manoj Menon there of ICICI Securities. By the way, Kalyan Jewellers, as we speak, is recovered from the lows of the day. A slight recovery, of course, 3.5% down still, and down almost 45% now from the peak that was close to 800 rupees a piece. Time for a short break, but before we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. You can get instant access to breaking news, in-depth articles and financial world updates at your fingertips, and you can download the CNBC TV18 app from the Apple Store or the Google Play Store right away.
This is going to Do you foresee the need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time, and at least we've seen this in our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, even though almost 80% of now, let's say, coding can be done through AI, But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to Global Market?
Welcome back. With us here on Halftime Report, and Transport Corporation of India is our next management on the show. It reported a good third quarter. CVA's division continues to drive its profitability. While to discuss this and more, we have Vineet Agarwal, who is the managing director of the company, who is joining us. Vineet, good afternoon. Thank you for joining in. You've given a FY25 guidance to grow between 10 to 15%. For the first 9 months, you've done 12 in terms of revenue. Which is at the midpoint of your guidance. Do you expect to remain at the midpoint, or by Q4 you would expect that to go to the higher end, which is 15%?
Well, 10 to 15% is a guidance based on some numbers that we forecasted, and things have been quite slow this year. So I think we'll be probably at the mid end of this number itself at 12-13% for the full year also. But the profitability is much better. We had projected a 10 to 15% increase in the bottom line, but we are slightly above that.
Take that point, and a lot of that profitability has been led by the Seaways division, where you've called out that route changes and increased freights, etc., have supported your realizations out here. So the question is how long this is sustainable for, because you've said that Seaways margins on a sustainable basis could be around 28 to 29%. Freight margins around 3%, and supply chain margins around 6.5%. We've seen deceleration in both freight and supply chain, whereas Seaways from the 28-29% have moved to around 33%, keeping your overall margins at around 10%, which is pretty much in line with your 10 to 11% sort of guidance. How does the internal of this change, and what's your prognosis here?
Yes, so Seaways, the business has been positively impacted because of the Red Sea crisis, where we know that some ships that were on our sectors that we operate, which is on the west coast from Kandla to Cochin and Tuticorin and Mangalore, that got affected. Some of those ships moved from that sector, and that meant there was a less capacity available, which also meant freight prices went up. And also in the last quarter, actually fuel prices, that is bunker prices, came down. So for us, it was a double positive from the Seaways perspective. On the other businesses, there is a general slowdown, as we already know, in the economy, and that affects both those businesses. Freight is directly linked to GDP growth, and that was slow in the last quarter. As we know, that has had some impact on margins as well. And in supply chain, I think the interesting thing is that we are actually in a very large investment mode. It's like we're creating new facilities for lots of clients. We have a lot of bench strength that we have created for people, and that's in line with the pipeline that we have for the next few months. So very interesting times there, and this is just a temporary blip in terms of margins, but I think it's going to come back very shortly.
You mentioned higher freight rates, Vineet. What is the situation currently? It stands, especially when it comes to the seaways freight rates, and how is that impacting business?
Well, currently there is enough demand. This is Q4, and Q4 is essentially the best quarter of the year for us. Also, a lot of corporates are closing their books at the end of March, so there is a push towards sales. So there is a high demand, and consequently there are lesser ships. So freight rates are stable, and they're stable, and they are helping us get the clients that we need to move all the cargo that is right now available.
Right. And what about the cold chain business? How much has that turned out as an overall proportion of your sales in the third quarter of the first 9 months of this year? What's your outlook for this one as we move forward? And also quick commerce. You had said that you've done well there with the fulfillment of dark stores, etc. This comes in light of some of the other competitors also starting this 2-hour delivery, at least in the cities, for D2C players. So how does the environment look out there in both quick commerce as well as the cold chain business?
Actually, on the quick commerce side, we don't do any deliveries. So we only do the fulfillment. That's the back-end warehousing, because we've realized that the deliveries are really a very low price point kind of business, and really the margin structure there is not very good. So we focus more on the fulfillment side. We run a lot of warehouses for the quick commerce guys, including cold chain warehouses. I think the interesting bit here is that the cold chain warehouses have a separate kind of a delivery system, because when you're delivering from that particular fulfillment center to a dark store and subsequently to a customer, the cold chain has to be precise. I mean, you don't want a melted ice cream to reach the customer. So that is high quality and high frequency deliveries that is happening from these fulfillment centers. So both the cold chain business and the supply chain business, where some of these quick commerce guys have just started to really pan out and go into smaller cities, we are seeing a massive growth opportunity. Again, as a percentage of our business, this is going to be quite small. But as a function of how we can change the network design of supply chains, this is a big deal. Because how consumer companies, FMCG companies were servicing other sectors, other channels, this is another new channel that has gotten added.
Right. So, just a quick follow-up before we let you go. You always guide for 10 to 15% revenue growth basis your assumptions, and similar growth on the bottom line as well. This time around, you've done better on the bottom line. What's your early prognosis for FY26, and what is it that the budget can do for you to grow faster than this?
We don't expect anything major from the budget in the sense that there is, for our sector, if there is continued growth in investment into capital infrastructure rather, that will help us because we are a multimodal logistics company. We need those connecting infrastructure of road, rail, sea, air to be integrated together. So that continues, that helps our sector. General GDP growth, EXIM growth, I think those are factors that are going to help us in terms of our growth. I think we are looking at a slightly the softer growth for the first few months of the year, but then post the August, September festival season, we are anticipating a higher growth. So I think, it's just repeating the same, maybe a 10 to 15% on the top line for FY26, but I do expect the bottom line to be slightly better.
All right, Vineet, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Transport Corporation. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned.
Before crafting your investment strategy, how about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, you know, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and say,
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, well, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late...
Welcome back. And the sell-off in the US futures has intensified as we speak. The Nasdaq futures are now down 550 points and we're still a while away from market open on Wall Street as the concerns over DeepSeek and its potential impact on this AI rally that has led the markets in 2024. The Dow futures too are down almost 350 points. But back home, there is no let-off in the market whatsoever. The Nifty still remains at the 22,850 mark, but the list of stocks with double-digit losses has also increased. We spoke of Laurus Labs earlier. We spoke of NetWeb Technologies earlier. Kaplan Point is another one that's down 10.5%. Tejas Networks is down 10%. It was down almost 10% on Friday as well. NetWeb is now down 11%, and Kaplan Point also is another one. And Newgen Software is the other one that is down 10% in today's session after that downgrade that came in from Jefferies last week post its quarterly results. So no let-off whatsoever in the broader markets. Take a short break. On the other side, Manisha Gupta will join in with Rahul Sharma, who is the Director of India at International Zinc Association. Stay tuned. Back on the other side.
India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue, that what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that with the simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. You know, so that was a kind of scorching growth, and that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum, but the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top, it becomes so what you call compelling. You know, I can sell the story to even person like him or anybody. You know, and you're a seller. While selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right. You know.
Welcome back. 250 points lower on the Nifty, still continuing to hold on to that 22,850 mark though. But the broader markets, as we went into the break as well, there is absolutely zero relief that is coming in. Aditya Birla Sun Life AMC reporting results today is down 8% ahead of the results announcement. And some other losers in the broader markets include the likes of Piramal Enterprises, which is down 7%. CAMS is down 7%. Of course, that might be also a sentiment impact when it comes to the results from CDSL and the reaction to that. CDSL itself is down 9%, and that is having a residual impact on names like CAMS as well as on shares of BSE that too are witnessing some selling pressure in today's session after that results that came in from CDSL. We'll talk more about this over the course of the day. But there are some names that are bucking the trend, though it's not all red. Bank of India is an earnings reaction that is on the positive side. That's trading with gains of around 5%. So there are some stocks at least that are bucking the trend in today's session, some earnings reactions as well. Over to Manisha Gupta now for our commodity corner.
Well, thank you so much for that. And the metal in focus is zinc right now because we've seen the prices decline. Well, remember, zinc was an outperformer in the previous year. We saw almost 14% of gains come in. But for this year, until now, it clearly has seen a lot of decline. In last 1 month itself, it has been a 7% of a cut coming in for zinc. It's trading at almost 19-week lows right now. And while, of course, there are tariff concerns, but the fact today clearly has been about all the Chinese data that came in on a weaker side. So whether it has been about China's PMI numbers, services sector, factory activity, all of those numbers came in on the weaker side. What is the sense from here on when it comes to zinc? For that, we are going across to Rahul Sharma. He's Director India at International Zinc Association. Rahul, hi, good to have you. First of all, your sense on the prices itself, because it's been a bit of a disappointment for manufacturers in this year until now.
Yeah, good afternoon, Manisha. Well, we are undergoing through a very uncertain times, you know, because of various, I will say, variables, you know. For example, President Trump has again come into picture. But overall, you know, if you look at the zinc, it has been the best performer of LME base metals, you know, last year, trading about 3,000 tons in December compared to 2,537 in January. So this puts last year's average price 6% higher than the 2023 average. So the price strength seen this year can be attributed to supply pressures, including production disruptions at key mines. For example, Glencore MacArthur River Mine in Australia halted operations in March owing to extreme rainfall. And Chinese mining company MMG's Dugald River Mine in China was placed under care and maintenance during the third quarter. Right. So this zinc market had a 164,000 tons of deficit in 2024 as per the International Lead and Zinc Study Group. So, but there are few other things like, you know, the Boliden Stara mine in Ireland and Portuguese mining company Almina Aljustrel mines in Portugal, they also reduced mining output. So,
but Rahul, for this year now, this profit-taking, this price correction, how are you reading this now?
Well, there is a lot of volatility in the market, and because of, you know, unpredictable circumstances. For example, it all depends on the President Trump's policy, you know.
Oh, yes.
where he's taking the world. So the prices may crash also, or if it in terms, make a bullish trend also. So
But how are you
really,
looking?
it's very difficult. Yeah.
I can understand that. Rahul, how are you looking at the Indian demand right now, the production, the cost of production and cost efficiency for that matter?
Well, India, India is very much stable in that sense because, first of all, we are the fastest growing economy in the world. India produces almost 880,000 tons of zinc. We are getting a lot of zinc demand from Middle East because Middle East is really facing zinc deficit, because the Iranian companies, they are sending material to Turkey, and European smelters, they were struggling with the TCs, high TCs in the market. Right. And then same is the case with the Southeast Asia. So Indian zinc smelters, they are getting a lot of inquiry from Middle East and Southeast Asia, as well as domestic growing demand, So I will say, yes, it's a good time for Indian zinc companies.
Okay. A quick word on the prices. Do you believe the prices to come back to 3,000? Because currently all the estimates that we are seeing for 2025 mostly believe that the prices will be lower than 3,000.
Yes. So many, consultants, they predicted that the prices might crash and it can go up to $2,600 something. But if you ask me, I will say I am a bit positive about the global scenario. So current prices are almost more than USD 2,800. So if you look at the long term, I will say the prices will be in between 2,800 to 3,200 in 2025.
Okay.
There are few reasons. If prices comes below 2,700, the Chinese buyers, they buy bulk quantities in the tune of say 100,000 tons. So that's a big quantity, and that impacts global scenario.
China has been always smart. Yeah, China has always been very smart onto that. But I get your point. But I get your sense, as you said, that 2,800 to 3,200 really looks like a probable range, because below that you'll have a lot of buying. Above that we will perhaps have demand destruction. So either side, the range that you have put out really seems on the well side. Rahul, thank you so much for joining in, but that's all the time that we have on this show. Thank you for watching Business Lunch. We'll take all the action ahead.
Only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you'll get to see 500 crores loss. So I mean, I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews, saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money, and HDFC Bank doesn't need to raise capital. And we have met the company, and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody I say.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which frankly, I'm surprised they didn't do before the election. That didn't show a lot of love. by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand...
Stocks see a broad-based sell-off with very few counters managing a green tick. Industrials and utilities are the biggest drags. ICICI Bank feels the industry pressure on business growth but manages to report a strong operating profit while maintaining asset quality and return ratios. The stock gains. The plot for control of Redicare Enterprises thickens with the US investor Danny Gaikwad proposing a bid for 55% equity as he sees value in the business. Berman's questioned the move, says they will proceed with their open offer. The government kicks off the process for appointing the new SEBI chief by invitation applications from candidates by January 17. The terms of current SEBI chief Madhu Puribuch is slated to end on 28th of February. Bond prices surged and the 10-year yields fell to a near two-year low of 6.64% as data over the weekend revealed that RBI has been buying bonds in the secondary market. The rupee, however, remained under pressure under the weight of FPI selling equities. Hello, good afternoon. You've tuned into Business Lunch on CNBC-TV18 and I'm Vani Motiwala. A quick look at what the market is doing today. Nothing pretty today. Clearly, Monday blues coming in for the equity markets. Handover from US wasn't that exciting. And what we saw is that the Nifty currently is trading at 22,870 levels. Day's lowest point is what the Nifty is trading at, down almost 1%. Similar for the Sensex as well, down trading with a downtick of almost 1% in trade. Let's look at the contributors that are coming in for the Nifty 50 and which are the names that are leading to that fall today in the Nifty 50 will be key to watch out for, because we have IT and pharma that are clearly among the top sectoral losers. But in terms of the contributor wise also, we have HDFC Bank, Reliance, Infosys, and Bharti Airtel among the top contributors in terms of the drags that are coming in. While in terms of the support that's coming in from SBI, ICICI Bank because of its numbers, M&M and HUL which are managing to support the up move in the Nifty today. So supporting the downfall or supporting and stopping the downfall a bit much in terms of Nifty were those stocks. But like I said, IT and pharma are among the top sectoral losers today. We're seeing a sharp fall coming in all these names and pharma names specifically. So keep an eye out on that. But let's move on and get started with the show for today. We'll talk about bond prices that have surged on Monday as that data that was released on Friday evening showed that Reserve Bank has been buying bonds since Jan 15th. 10-year bond yields have consequently fallen to a near two-year low of around 6.64%. The rupee, however, that has remained under pressure. Lata is joining with us to tell us more details on this front. Good afternoon, Lata.
Well, the big positive news for the market, which it discovered on Friday evening after market hours, was the Reserve Bank data, which indicated that the data is for the week before, for the week to Jan 17th. It indicated that Reserve Bank has bought on 15, 16 and 17 a total of 10,000 crore rupees of bonds. This in dealer parlance is called OMO or open market operations. This is an open market of buy operations. Now, the market suspects that if they bought in the week to Jan 17, they would have also bought in the week to Jan 24, the subsequent week. So there is a lot of cheer that there is one more buyer in the market. And it also shows that the Reserve Bank is doing all out to improve liquidity in the market. The 10-year bond yield, for instance, the yield fell all the way to 6.64, which is the lowest we have seen since February 2022. But of course, it's moved back again to about 6.67. The dealers are, concluding that the Reserve Bank is now doing everything possible. All the bankers are crying that liquidity is tight. So we saw that they were doing two kinds of repos. They were doing daily repos Repo is the way in which they give money to the market on a daily basis, and the amounts have been increasing from 50,000 crore to 1 lakh crore to 2 lakh crore and even more. And there are 14-day repos, and they have doing FX swaps, which is buy-sell, so that they provide liquidity to the market. As well now the OMO. So the entire suite of tools available to the RBI has been used by the central bank to pump in liquidity, which is good news. Actually, that also explains why you see that the Nifty Bank has fallen less than other indexes, because this is bank positive. They hold a lot of bonds and the bond prices are rising. And of course, the Reserve Bank also did a CRR cut, if you remember. The markets are happy that the Reserve Bank is now in an all-out mode to provide liquidity. Contrary-wise, on the rupee market, things are still very much under the weather. We saw the rupee give up most of the gains that it notched up on Friday, and that is in step with all the other Asian currencies. Rupee has lost about 0.25%. Most currencies have lost between 0.2 and 0.75% versus the dollar. That also is explained by the dollar strength. The dollar on Friday had hit a low of 107.15, now 107.7. So that's a fair amount of strengthening. But more than that, it is this event that has happened with Colombia. Colombia refusing migrants and deportees, that is, and the US retaliating by saying that they will increase tariffs. So that entire thing has left a bad taste, and there is a fear that the United States will weaponize tariffs anytime, who is to say. And that's why you're seeing most emerging market currencies under the weather, and that goes for India as well.
Okay, Lata, thank you so much for that update coming in there and explaining us the details. But let's move on, and on the earnings front, we have ICICI Bank that's surging in trade today after reporting its Q3 numbers over the weekend. Abhishek is joining in with us to tell us how the quarter looked like this time. Abhishek, good afternoon.
Well, ICICI Bank reported a mixed quarter wherein the business momentum, that is deposits and advances, have slowed down, while return ratios, that is return on asset, has been impeccably strong over the last few quarters. So what's worked for them? The gross NPA ratio is one of the lowest that you are seeing in last 10 years or even more. Gross NPA ratio now stands at 1.96%. The core operating profit growth of more than 13% on a YOY basis is perhaps one of the best that you are seeing in last 5 quarters. Now, cost to income ratio, or the operating efficiency that we call in banking sector, is at 8-quarter low of about 38.5% versus 38.6% in the previous quarter. The return ratios, that is ROA, has been remaining consistently around the 2.4% mark with plus or minus 5 basis points. So ROE has been above 15% for last 13 quarters in a row. International net interest margin is at 4-quarter high of 1.3% versus 1.2% in the previous quarter. What's not worked in the results? The business momentum. Now, deposit growth on a YY basis at about 14.1% is the weakest that you are seeing in last 7 quarters, and the loan growth at about 13.9% is the weakest that you are seeing in last 15 quarters. Domestic loan growth was impacted from the retail portfolio. Domestic loan growth was about 15% YOY, one of the weakest that you are seeing in last 17 quarters. Risk-weight assets to advances ratio is at 18-quarter high of about close to 118% versus 116% in the previous quarter. ICICI Sec Primary has given a PAT decline both on YOY as well as sequential basis. The domestic net interest margin is at 10-quarter low of 4.32% versus 4.34% in the previous quarter. Subsidiaries PAT has declined on a sequential basis, perhaps for the first time in last 9 quarters. With respect to the PNL versus RPOL, the NII was below RPOL, however the PAT was ahead of RPOL, and due to the fact that stock had seen recent underperformance, it's up in trade today. Back to you.
Thank you so much for that, Abhishek. Now let's move on. Relicare Enterprise has received a counter bid from a US-based investor, Digvijay Gaikwad, which is in response to the Bourbon family's open offer for the company. Gaikwad initially proposed an open offer for 26% of Relicare's equity at 275 rupees per share, but later he proposed to up his offer for 55% of the stake. Now, earlier today, we spoke to Digvijay Gaikwad, and he says that this is the first time that they are trying to buy a financial service company in India. He added that he has merchant bankers, lawyers, and will send the third letter to the SEBI in 2 days. Let's listen to what he had to say.
It's nothing out of blue.
any offer you give, it's always be out of blue, because I saw the value and I thought that it's a good value to go after. I did a very, very reasonable offer, because in America, if you look at it in US, most of the offers are at the closing time stock, and then you get it about 17 to 20%, 15%. That's all I did. This is nothing extraordinary or no other event. I don't think so. Is this some kind of criteria that you have to own, otherwise you can't own? Don't you have always the first try, first attempt, first time? Maybe not India, but I have a lot of experience in America. It is a great opportunity. It's undervalued stock, and I thought I can give a better value to shareholders. It's a value buy. Just we are value buyers. I find a good opportunities, and if I see the value is there, and if I can enhance the value, that's called value buy. I thought I will bring a perspective from US. I don't know, but I have to answer you because you asked me legal question. It is very wise. Somebody told me not to talk legal when you don't have law degree.
Okay, let's move on. And I just quickly want to mark Adani Wilmar, because we've seen a spike up coming in the stock. The company's just reported its numbers a short while ago. So yes, we're seeing growth in terms of revenues of the company. Profits have also seemed like on the face, they've seen a doubling in terms of profits. Now we're waiting out for if there's any one-off that I'm checking out for. But yes, doesn't seem like there's an exceptional item, at least as of now. But a jump up in terms of profits, revenue growth of around 30-31% is what they reported. We're seeing a spike coming in terms of the stock price of the company. We'll wait out for more internals that may come in later. But yes, keep an eye on Adani Wilmar. Let's move on and talk about, Lodha or Macrotech developers. Now, moving on to that, we spoke to Abhishek Lodha, who is the MD and CEO at Macrotech Developers, and has filed a rupees 5,000 crore lawsuit against his younger brother's firm, that is House of Abhinandan Lodha, over the Lodha word as a trademark for the group and the dispute that is going on that. Now, we spoke to him earlier on this issue, and listen to what he had to say.
It's a simple dispute in relation to the very valuable brand that we at Lodha and Macrotech have built up over 40 years. I reiterate that I have no desire or in any manner to do dirty washing of linen in public. For the last 10 years, I have kept everything private. The company has been through big downs, and now it is doing well because of the efforts of 5,000 Lodha associates who work day and night to make this company successful. And we let the legal system of the country decide who should be very clearly using the Lodha brand and why the consumer ought not to be confused that any other developer using anything which is similar to Lodha is allowed to operate in the marketplace.
And on to some more earnings. Interglobe Aviation posts an inline set of numbers for the third quarter. The CEO, Peter Alvarez, spoke to CNBC earlier on, and these are the highlights for the third quarter. What is he indicating? Listen in.
One is a very strong demand, what we have seen in the market. The first half year was still a bit moderate, but we've seen a very strong recovery in the last quarter, which really enabled us to welcome a record number of 31.3 million customers in a single quarter. So first of all is the enormous demand. I would say secondly, we continued our strategic expansion, mostly internationally, and today 28% of all our available seat kilometers is operating international. And thirdly, we had a very strong operational performance in that very quarter. So I would say those are the three highlights of the quarter which has just been closed.
Okay, on that note, we're going to step into a very short break, but after the break, we'll come back and we'll talk about the government that has invited applications for the SEBI chairperson's post by mid-February. We get you the details on this one on the other side.
Drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that. So we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
Welcome back, and thanks for staying tuned into Business Lunch on CNBC-TV18. We have numbers that are pouring in as well. And this is actually the guidance that has come in from Credit Access Grameen. So keep an eye out on that. We're seeing the stock that is down today around 5% in trade as of now, recovered from the day's lowest point is what they are seeing. For Credit Access Grameen, this is the guidance that they're flashing at the bottom of your screen. Let's move on. And the government of India has actually invited applications for the SEBI chairperson's post by February 17th. Remember, SEBI chairperson Madhvi Puri Puch, her tenure ends on February 28th. Now, Yash is joining with us to give us more details on this one. Good afternoon, Yash.
Good afternoon. So, of course, the government has initiated the process to, start looking out for the next SEBI chairperson. What it has done is that it has invited applications from interested participants when it comes to applying for the position of next SEBI chairperson. The applications, as far as the last date of submission of those applications is concerned, would be February 17th. Post which, the government will evaluate all the applications. There will be, of course, a couple of rounds of interviews also with, the shortlisted applications when it comes to the position of next SEBI chairperson. Two important dates to remember here. First one, as I said, is February 17th, which is the last day to submit applications. And the second important date is February 28th, which is the last day of the current SEBI chairperson, Madhvi Puri Puch's term.
which means the term ends on February 28th and February 17th, the last date of submission of applications, which means about 10 days when it comes to selection of the next SEBI chairperson. It will be very interesting to see the kind of applications that come in, either from the exchange community or from other regulators or bankers, so on and so forth. And then it will be very interesting to see if the government goes with a private individual again this time around, or does that change this time?
Okay, Yash, thank you so much for that. Let's move on. And the Chinese AI startup DeepSeek overtakes ChatGPT to become the #1 on iOS App Store within a week of its launch. Reema is joining in with us now to tell us more about the AI battle. Reema.
Thanks so much for that. Call it the AI showdown, the face-off. But, you know, things are hotting up between ChatGPT, which was dominating generative AI so far, and the new kid on the block, which is DeepSeek, which is a Chinese AI startup. Well, till 2 months back or even a month back, you probably wouldn't have even heard of DeepSeek, but it rose into prominence in December of last year when they unveiled their free large language model, DeepSeek V3. Now, this was positioned as a it was positioned as a free alternative to ChatGPT, OpenAI's ChatGPT. But the real deal came last week, on the 20th of January, when DeepSeek released a more advanced model, their latest model, DeepSeek R1, and their performance matches up in terms of efficiency to OpenAI's latest model, which is OpenAI O1. In fact, Satya Nadella, when he was asked, and he's the Microsoft CEO, when he was asked at the World Economic Forum about this, he said we should take the developments out of China very, very seriously. Now, here's why scientists are quite excited, but analysts, Wall Street analysts, are quite worried. For one, DeepSeek, again, it's a Chinese AI company. It's formed by this hedge fund. And this was actually made using fewer and inferior GPUs compared to the NVIDIA chips that were used for making OpenAI's ChatGPT. That's reason number one. Secondly, according to reports, this was built in less than 2 months, and the overall cost was $5.58 million, a fraction of what it took for OpenAI to build ChatGPT, which is why analysts are thrilled, but Wall Street is a bit worried. And talking about the fear on Wall Street's mind is that will DeepSeek be the pin that bursts the AI bubble in a way? Some who believe that perhaps the tech stocks, the AI stocks like NVIDIA, which have had a fantastic run up of 135% last year, was that getting a little excessive? And will they get a reality check? Which is why NASDAQ futures too have come under pressure today.
Okay, Reema, thank you so much for that. But on that note, we're going to slip into a very short break, and we'll get you more news and updates on the other side. So don't go anywhere.
Is going to be the office of the world. You and I discussed about it.
The last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because there needs every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it, and they are quite happy with it.
So what is this going to Do you foresee the need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time, and at least we've seen this in our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, even though almost 80% of now, let's say, coding can be done through AI. But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports.
Welcome back and thanks for staying tuned into Business Lunch on CNBC-TV18. Now on to some national news. India's Foreign Secretary Vikram Misri is in China to enhance economic engagement and work on specific issues. Parikshit is joining us to give us the latest update on this one. Good afternoon, Parikshit.
Well, this is a part of the consensus that was reached between Prime Minister Modi and President Xi Jinping in Kazan on the sidelines of the BRICS summit in Russia last year. Since then, we have seen disengagement at the border in eastern Ladakh. We have also seen patrolling resume. We've seen foreign minister level talks. We've seen talks between special representatives on both sides, talks between military commanders as well. And now in the same breath, we are seeing talks between the foreign secretaries of the two countries. So this mechanism is known as the Foreign Secretary Vice Minister mechanism between the two countries, and they are going to discuss resumption of bilateral ties. So what's really important for India here? One is resumption of the Kailash Mansarovar Yatra. We are also going to express concerns about the dam that China is building in the Tibetan plateau, which could impact the flow of the Brahmaputra into India as well. There will be talks on border trade also and resuming normal bilateral ties. So the Foreign Secretary Vikram Misri is meeting Liu Jianchao, who is the head of the International Department of the Chinese Communist Party Central Committee, and also Vice Foreign Minister Sun Weidong. On the Chinese side, we hear that there is a big push on having a greater economic engagement with India, removing ban on Chinese mobile applications, discussions on criminal action and probes against Chinese companies such as Vivo, resumption of visas for tourism and business purposes. So let's see what happens in these talks, but it's said to be a significant meeting taking place between both sides.
Okay, Parikshit, thank you so much for that. But with that, we're absolutely out of time on this edition of Business Lunch on CNBC-TV18. Thank you so much for tuning in. Up next, your Midcap Radar.
We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with
It's Midcap Radar time on CNBC TV18 as we count down to the final 2 hours of Monday's trading session. I'm Hormuz Fatakia and with me is Vivek Iyer. Vivek, good afternoon. The indices were trying to attempt a recovery, but now they are also firmly in the red, 250 points down on the Nifty. But the actual pain, though, is in the broader markets.
Absolutely right. The name of the show is Midcap Radar, and the midcap and the small cap space are the set of indices that are seeing the most amount of pain. Let's start off with the top headlines. Quite a packed show is what we have for you today. Good afternoon. Welcome to Midcap Radar. The top headlines for the day. Stocks see a broad-based sell-off with very few counters managing a green tick. Industrials and utilities are the biggest drags.
Laurus Labs falls over 10% on concerns related to its antiretroviral business after the US withdraws from the World Health Organization, possibly impacting funding relief for AIDS, impacting its ARV medications.
DLF shares surge over 5% after the company reported its best ever quarterly new sales booking on a high base. The real estate players' Q3 net profit jumped over 61% on a year-on-year basis.
Credit Access Grameen tanked as much as 17% but recovered from the lows after the company once again cut its guidance for the full year. AU Small Finance Bank also is down over 6% after cutting its FY25 loan growth guidance from 20% from 25% earlier.
CDSL declines almost 10% following its Q3 earnings. Operating income stood at rupees 221 crore versus 248 crore on a year-on-year basis, and its EBITDA fell by 37% from the September quarter to 146 crore. Well, good afternoon. Welcome to Midcap Radar. Like we just said, it's the broader end of the markets that are seeing the most amount of pain. The pharma pack is taking it on the chin today. In fact, the pharma index, the top laggard, with few of the names like Laurus Labs, Strides Pharma, seeing the brunt of the selling pressure. But this is our special segment, Midcap Movers. Vamakshi is standing by the wall to take us to the midcaps that are buzzing in today's trading session.
Well, good afternoon, Vivek. The mid-cap index and overall the broader indices, in fact, are under fair bit of pressure today. Just to put it out there, nearly 20 stocks in the mid-cap index have touched 52-week lows today. Let's bring up the list of the stocks that are declining in trade today. That includes Anant Raj, Laurus Labs, NetWeb, as well as Tejas Networks. Now, keep in mind that Anant Raj has seen the biggest fall since June 4, which is the election day. Laurus Labs and Tejas Networks both are seeing the biggest intraday retreat since 2020, and NetWeb has seen the biggest fall on record. Apart from that, on the flip side, let's look at the list of the stocks that are gaining momentum in such a weak market. That includes Sobha, that stock is up nearly 8%. Cyient again up nearly 4%. Yes Bank and Gujarat Ambuja Exports are some other counters that are gaining in trade today. Let's also look at some stocks that are reacting to the numbers. First, let us look at the stocks that are up in trade. Bank of India, Central Bank of India, these PSU banks are up in trade nearly 6%. In fact, we also have DAM Capital that reported its numbers over the weekend. It's a new kid on the block. That stock is up. DCB Bank is another counter that is surging by almost 5%. There are some other counters that are declining on the back of weak set of numbers as well. That includes IDFC First Bank, CDSL, Credit Access Grameen, as well as Ugro Capital. Keep in mind that Credit Access Grameen has seen the biggest intraday fall since March 18, 2020. Lastly, let's look at the stocks that are moving on the back of strong volumes as well. All of these counters, TBO Tech, that stock is down nearly 7%. ZF Commercial, Supreme Industries, as well as Inox India are some of the other counters that are down and out in trade today.
Makshi, thanks a lot for that. By the way, Canada Bank's numbers flashing on your screen. Some improvement seen in its asset quality on a sequential basis as we speak for Canada Bank. You keep an eye out on that. Its gross NPA for the quarter is around 35,000 crore rupees compared to 37,000 crores in the previous quarter. The net NPA too has seen a slight reduction from almost 9,800 crores to 9,000 crores at the end of the December quarter. We'll keep an eye out on the numbers in percentage terms as well. Now, gross NPA for the quarter is at 3.34% from 3.37 in the 3.73 in the September quarter, while the net NPA number is at 0.89% from 0.99% earlier. So a slight improvement seen in the asset quality for Canada Bank, and the stock seeing some volatile moves after the results announcement. Also pull up Adani Wilmar before we take that break, because just a few minutes ago that too came out with its results, and the EBITDA was up 57% on a year-on-year basis. Margins also saw an expansion compared to last year of almost around 80 basis points, and that is reflecting in the price as well. Almost at the highest point of the day is Adani Wilmar, 3.5% higher there. Earnings reactions will continue through the day, but we take a short break. But before we do that, it's time for Growth Code, which is an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, in a special interview, CNBC-TV18's Prashant Nair interviewed SEBI's whole-time member Anant Narayan and asked him about the risks involved in the derivatives market.
You've done a fair bit in terms of weekly options and other things. Or is that work in progress still? Is this going to continue to evolve, and we will see more sort of regulation and efforts to make people aware of the risks in this kind of activity?
You know, derivatives aid in price discovery. They give you depth in the market. They allow for risk management. They allow for trading, all of those things. And we do need all of these things for capital formation. So let it be very clear, SEBI is not against derivatives. We did have a problem though on two fronts. One was our first principal mandate is investor protection. And it was very clear from the two research reports that I quoted to you that small investors were losing out and that we cannot close our eyes to it. While we are a disclosure-based regime, we are not a nanny state. At the same time, we can't allow this to continue for a very, very long time. That is one particular issue. The second issue was we also saw a fair amount of overtrading and therefore increase in system-wide risk, particularly on expiry days. And when we spoke to our market participants and we consulted with them, what we realized is that the core issue really is not across the spectrum of derivatives, but specifically in the area of index options trading on expiry day, right? So out of the 6 steps that we announced in October, 5 of them were clearly and squarely directed at trying to curtail this question of overtrading in index options on expiry day. Now, we haven't directly tried to address investor protection, but by this oblique route of trying to bring down overtrading on that expiry day in index options, we think that will have some kind of a benefit for investor protection as well. We've taken the first set of steps. We are still looking at how the impact is kind of playing out.
These times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that would also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and say,
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. Our per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue, that what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher.
Welcome back to Midcap Radar. Well, shifting focus to SBFC Finance, the company saw its assets under management surge 30% on a year-on-year basis, while net interest margin has improved sequentially. Asset quality has been stable. To discuss more on this, we are joined by Mahesh Dayani, who is the Chief Business Officer at SBFC Finance. Thank you so much, Mr. Dayani, for joining us. In a quarter where a lot of the lenders have seen significant amount of pain, you've managed to come through unscathed in this particular quarter. But as far as key metrics are concerned, Q4 FY26, how are you looking at loan growth? How are you looking at net interest margins? We understand you've guided for a bit of moderation as far as margins are concerned.
So we've always been guiding that the growth is going to be anything between 5 to 7% on a quarter basis, and that's what we've been delivering. This quarter was no different. We grew by almost 6%, and all through the cycles, probably you'll see us delivering on the higher end on a positive cycle. When you do see an environment which is slightly a bit challenging, probably you'll see us delivering more towards the lower end of our guidance. But largely what we've said is that we will move between 5 to 7% on a growth. And even on the last quarter basis, we don't see that guidance changing. Also, what's happened for us is we're coming off from a small base. So clearly it doesn't really matter how the overall economic environment moves and how the market share moves. We're in terms of assets close to around 8,100 odd crores. And we're fairly confident that if we continue to grow at 5 to 7 odd %, you compound at almost 24%, which practically means that you double every 3 years. So we're pretty comfortable with that range of growth.
Mr. Dayani, good afternoon. Thank you for joining in. You've been fairly, your rejection rates in terms of applications are now increasing. Are you being cautious on the lending side because your disbursements too for the quarter were down almost 3% from last year, although they were up sequentially. But what's the stance being when it comes to lending?
So what's happened is at the beginning of the year, we had, we did give a sign of caution with respect to the applications that were coming in. And while it was pretty early days, we were looking at the leverage moving up significantly. So what we said is that we are going to be tightening a bit of our filters, which we did in Q1. And we did follow it up in the beginning of Q3 because we didn't see a significant shift in behavior. And despite CIBIL scores being positive, I guess the inquiries continued to increase. Incomes we didn't see move up significantly, which would justify higher exposure. So that explains why our disbursal numbers were stable. Although our originations have moved up significantly, so we originate close to around 20,000 applications in a quarter, but our approval rates did dip. That range is anything between 6 to 7% odd. If you were to budget for it, that's roughly around 1,000 in a quarter, which is at an average ticket size of 10 lakhs, adds up to almost 100 crores. So that's something that we are consciously leaving on the table. And that's a conscious growth that we are saying that we wouldn't want to probably digest, because at some point of time, it's going to come back and bite you in terms of the credit cost.
Understood that. So with taking that as the cue, how do you see credit costs pan out for you going forward? Much lower compared to what your peers are facing. And also, in the call you've guided that you'll be going slow in two states especially. So which are the states that are seeing increased stress in terms of collection? And could you name them and give us some broad indicators as to Q4 and FY26? How do you see that panning out?
So answering your first question, the credit cost, we've been range bound between 80 basis points to 100 basis points. In an environment currently that we are in, we would be around 100 to 110 basis points. We don't expect that to move up significantly. On the secured side, that's largely been the range. Unsecured has a different outcome, but we are largely a secured company. It's either secured by property or gold. So we're pretty comfortable estimating our averages anything between 80 to 100 or 110 basis points, nothing more. As far as the states are concerned, I think there were two states where the overall bureau numbers weren't very positive. One was obviously Bengal, the second one was Punjab. And that's something that we've gone a little slow because the overall bureau scores haven't been too great on the secured side. So there we're being a little cautious even from a Q4 perspective.
Mr. Dayani, your AUMs were growing at 30% this quarter. Do you expect that growth rate to sustain for the full year as well? And do you expect this trend to continue into FY26 as well?
So we said that whether it's sunshine or rain, we'll continue to be on 5 to 7, and that hopefully should contribute anything between 25 to 30% even from a next year perspective.
Thank you so much, sir, for joining us, giving us a sense of how business panned by. We'd love to have had a longer chat with you, but due to paucity of time, we'll cut this particular interview short. Let's now slip into a short break. Management of Mindspace REIT joins us next to discuss their third quarter performance and more.
What happened, all the changes, whether the tax rates came down, whether the industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that with the simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth, and that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum, but the stocks will grow 200-300%. So the hype. So you ride the hype cycle. And right at the top, it becomes so, what you call, compelling. I can sell the story to even a person like him or anybody, and you sell, while selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested, say, 1,000 crores, straight you'll get to see 500 crores loss. So, I mean, I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews, saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money, and HDFC Bank doesn't need to raise capital. And
Welcome back. Continuing with corporate conversations, and Mindspace REIT is the next management that is joining us to discuss the quarter gone by and the outlook going forward. Ramesh Nair, the CEO, is joining in. Ramesh, good afternoon. Thank you for joining in. You know, your revenue from operations were up around 7.5% from last year. Now, can you break down the key drivers for this growth? And do you expect this 7.5% to say around about 8-10% revenue growth trend to continue going forward as well?
Thanks, Vivek and Thomas, for having me on the show. If I rewind back 1 year back, what are the big concerns about REITs? First was distribution growth. We have fixed it. We have shown distribution growth of around 11%. Price appreciation, I was just checking the numbers. Last 12 months, our appreciation has been 17%. You add dividends of around 6%. So we're talking of a product which is around 23% in terms of total returns. SEZ vacancy used to be an uncertainty a while back. With the government allowing flow-wise demarcation, that's behind us. Work from home, which was a challenge 2 years back, that's again been fixed. In a portfolio like ours, what we're seeing is almost all our parks are more than 75% plus attendance. Back then, I remember when the government change had happened in Telangana, there was also a concern if there would be any worries regarding the overall political continuity in terms of stability, which we have seen because Hyderabad again has seen record numbers in terms of office leasing. So overall, the market is looking phenomenal. The leasing numbers are through the roof. Market is every quarter, when I read the IPC reports, I see new records being broken again and again, both on net and gross leasing.
Mr. Nair, that gives us very good perspective to ask our next question. So currently, what is the total lease or total area under leasing? FY26, FY27, what is the proportion of area that will be added on? Can you also help us with a DPU guidance? We understand that you are regulated, to give out 90% of the proceeds. But what is the kind of guidance that you are going ahead and helping investors with? We understand that with higher leasing, you will be able to give out a higher dividend payout.
So right now our occupancy is 91.5%. By end of this financial year, which is March 31st, we hope the occupancy will go up to around the 92.5 to 93% mark. We are quite confident that we will start seeing distribution growth happening. We typically don't give guidance on distribution. We're also looking at a ROFO asset. We are looking at a third-party acquisition. Any acquisition we do will definitely be a strategic milestone for us in our growth journey. We are still looking at expanding our footprint in the key markets, committed to invest in high-quality, premium potential assets. And I think this ROFO and this third-party acquisition will be a step in the right direction.
What about data centers, Ramesh? Your delivery of your second data center in Airoli was well ahead of schedule. What's the expansion plan in that space, and how much of a contributor to your business do you expect this to become over the medium to long term?
So what we're seeing in the country is every year we're seeing around 250 megawatt of capacity addition in the country. For us, we are extremely well placed to capture the demand. We have 5 data centers in our portfolio, out of which 2 which has already been delivered. These 5 data centers would be 285 megawatt capacity. This is also 1.7 million square feet of our portfolio. It helps us because we have long-term leases. It helps diversify our tenant base. It helps diversify our tenant risks involved with tenants. These data centers typically give us longer lock-ins. We're very happy to have delivered our second data center, 315,000 square feet, 2 months ahead of schedule.
Right. Mr. Nair, a couple of quick questions. First up, what is the current debt level? What is the level of debt you will take on to go ahead and make these acquisitions that you spoke about? The other question is, at the end of FY25, how many leases are expiring? Have there been any that have already been renewed? And are these happening at higher tenancy rates?
So our current debt is around the 7,000 crore mark. Our LTVs is at a very healthy, lowest in the industry at 22.6%. We would be doing these ROFO acquisitions and third-party acquisitions mainly through debt. In a portfolio of our size, we have close to 35 million square feet of 27 million square feet is ready and completed. What we typically see in a year is 2 to 2.5 million square feet of leases which come up for expiries. We try and see if we could get at least 50% of them to renew, and the balance 50%, we try and get newer clients. Many a times we've seen that when some of the clients who signed up long back, maybe 9 years back, 10 years back, when the markets weren't as hot as it is right now, when some of these tenants leave, it gives us those mark-to-market opportunity. Just in this quarter, the quarter we just got over, releasing spread was 26.4%, which means when a tenant vacated us and we gave it to a new tenant, we were getting 26% more rental. So in a portfolio of this size, tenants vacating is part and parcel of the business.
All right, Ramesh, thank you so much for sparing time and joining us. Wish you good luck for the rest of the year as well. That is the management there of Mindspace Business Park REIT, the stock doing fairly okay in a market that is otherwise full of red on the screen. By the way, numbers from ACC were just reported a few minutes ago. The third quarter volume growth at 21%, which is the highest ever that it has reported in a quarter is for ACC. So that's the big number to watch out for in terms of ACC, the volume growth figure. The stock, though, continues to remain choppy, around 1.5% lower as we speak for now. The revenues also includes a grant of 720 crore compared to a 59 crore grant that has come in the base quarter. Other income too has seen a substantial surge that has aided the bottom line, and that is also because of a favorable income tax order that has come in for the company. So numbers from ACC to watch out for, the stock looking to recover from the lows of the day. But with that, it's a wrap on this edition of Midcap Radar. From Vivek, me and the team that put the show together, thank you so much for watching. Your stocks and a slew of other earnings on the other side.
And it is growing 30% per annum, which was the case of HDFC Bank that year, and the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global this thing and macro and all that, which right now is again making me do a small mistake, because I think the world is good, therefore India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody I say.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous.
Hello, good afternoon. You've tuned into your stocks on CNBC-TV18 and I'm Vinny Motiwala in the Mumbai studio. Today, what we're seeing across the market is a sea of red coming in, especially in the broader markets as well as the Nifty. Nifty is down now 1% in trade, almost near the day's lowest point. Let's pull that broader market up, so mid and small cap, because that's seeing a sharp fall coming in today. Nifty mid cap down more than 2.5%. Small cap also down more than almost 3% approximately is the decline that we're seeing coming in for the Nifty small cap. Actually, it's down 4% in trade. So yes, that's also almost near the day's low. So yes, broader markets is where we're seeing the clear pressure coming in. A lot of individual stocks that are moving in terms on the back of their numbers as well. But this is a show where we will solve all your stock related queries. And before we get started with the queries, let's actually go across to Abhishek, who's here to tell us Canara Bank. Okay, we'll wait for that. But let's get started with the query segment then. And we have Vaishali Parekh, who's joining in with us right now from Prabhudas Lilladher, Vice President and Technical Research at Prabhudas Lilladher. Vaishali, very good afternoon and thank you so much for joining in with us on the show. Before we get started, with those queries today, what a fall that we're seeing coming in, whether you look at the Nifty or the broader markets, we're seeing clear pressure today. Any thoughts on the markets? What are we watching out for now in terms of levels?
Hi, very good afternoon. Yes, so market has been non-stop giving us a downward slide. And today also we are holding on to the lower levels. So maybe minor bounce back can be expected, but the bias is still corrective. We have our projected target of around 22,600, 22,500 levels. But on near term, 22,800 is holding. So let's wait and watch. It's a very pathetic scenario. I mean, I think all sectors are beaten up. Even Bank Nifty is quite under threat. So I guess wait and watch.
Okay, yes, wait and watch. Surely we'll do that, Vaishali. There's no other option right now but waiting and watching. But let's go across to Abhishek, who's here to tell us what happened with Canara Bank, because that's trading at the day's lowest point. What were the numbers looking like? Abhishek, good afternoon.
Good afternoon, Vinny. So the numbers are weak, especially on the top line front. The NII miss with respect to our poll is more than 5%. So they have reported an NII of 9,149 crore. We were working with a number of 9,658 crore. Now, other income is what boosted the bottom line this time around. Other income was up 35% YOY and more than 16.5% on a sequential basis. So, cost to income ratio is at 47.6% versus 46.5% in the previous quarter. The business momentum on the deposit side is really soft. So, deposit growth is at 8.5% YOY and 1.6% sequentially. With reference to the YOY growth rate, it's one of the lowest lowest that you are seeing in last 6 quarters. Advances growth on a sequential basis is healthy. So 11% growth YOY and about 4% sequential growth. So sequential growth is very strong over there. The annualized credit cost is at 17 quarter or more low of 0.77% versus 1.05% in the previous quarter. The gross NPA is one of the lowest that you are seeing in last 9 or 10 years, with gross NPA ratio coming in at 3.34% versus 3.7% in the previous quarter. Back to you.
Okay, Abhishek, thank you so much for the latest update coming in on Canara Bank in terms of the numbers. Stock trading at the day's lowest point as of now. But let's get started with the query segment. And we also have Gaurang who's joining in with us as well. So Gaurang, good afternoon to you as well. Now let's start with the first query for today. We have the first query which is on TVS Motors. Rahul Datta, who's writing to us from Chandigarh, holding 30 shares of TVS Motors at a price of 2,000 rupees per share, making some bit of a profit on this one. But he wants to know whether he should continue to hold or look to sell this. Gaurang, let me start with you. What are your thoughts on TVS Motors?
Well, thank you so much, Vinny, for having me on the show, and apologies, I was having some issue with the Zoom link. I hope I'm audible right now. With respect to TVS Motors and the entire market, Vinny, let me give a brief. I think corrections like this, first of all, are great opportunities for investors to add on to their investments into very strong and fundamental stocks with growth prospects, even looking more positive. Now, coming to TVS Motors, well, we've been maintaining a buy and a hold for a long time. And when you have lower digit quantity of any fundamentally large cap sound stock, I think the next approach that you should have is try to save and invest a little bit more. So continue to hold, first of all. And if you do have investable amount, my advice would be to add on to the stock. And if somebody is looking at a fresh entry, new investment, he or she can definitely do that. As of now, we have a target of 2,775 from a long-term perspective.
Okay, can make some fresh entry also in TVS Motors. That's a word coming in from Gaurang, given that we're seeing a correction. Vaishali, let me take it to you. Technically, what is TVS Motor indicating on the charts? Would you also suggest that maybe the viewer could look to average, given that in the last 6 months, we've seen almost 10-11% decline coming in for the stock? So what should the viewer do now?
So technically, too, my view matches with Gaurang. Actually, yes, we have seen a good erosion in the stock, quite oversold. And I think overall full auto index is showing signs of, there isn't much of a downside if you were to ask me. So I would say these are the levels when the market is at such lows. These are the times one can start averaging stocks and better the cost price, and get good returns when it gets into a momentum. So I would say yes, it's highly oversold. So I would say 2100 as a near term is the support level. So these are the levels that he or she can watch to start buying the stock.
Okay, let's move on to the next query. We have Nabendu Das, who's writing to us from Kolkata. He's holding 100 shares of ITC, and this is at a price of 446 rupees per share, making a bit of a loss on this one. Wants to know the medium to long-term outlook for ITC. Gaurang, what's your view coming in on ITC now? Obviously, we have that value unlocking that's already happened for ITC in terms of ITC hotels. But what are we watching out for now in terms of long-term story?
Well, so Vinny, there are a lot of more expectation in terms of some of the important businesses which are in the consolidated balance sheet to get hived off and listed as a separate entity. Let's wait for the management to decide it. But as is where is the view on the stock? Well, first of all, hold on to it. The view in terms of whether you should average, we would definitely say you can average. Minus the hotel business, the other verticals are contributing quite smartly and strongly to the balance sheet. And the FMCG and the, e-Chopal, that is the agri-business of ITC, we expect that to really be the growth driver as we go forward from here on. Targets, 525 would be the target. So hold and average in case if you have investable amount, and fresh investment as well as can be done.
Okay. Your view on ITC, Vaishali, charts also indicating similar trends?
So, well, there's really nothing much happening. So there's a consolidation of a support band of, 420 to 430 levels. So I would say not in a hurry. I mean, one needs to wait for these stocks because normally it is the FMCG. When markets are so corrective, it's the FMCG which try to give a bounce and participate in the market. So I would say, yes, 420 would be the support. the stock would give us a conviction of a good strength of an up move will be only above 450, 470 levels. So till then, I would say just wait it out.
Let's move on to the next query. We have Shikhar Datta, who's writing to us from Mumbai, holding 100 shares of IDFC First Bank at a price of 60 rupees per share. Wants to know, he's looking to invest for 10-year time period. So wants to know the outlook now for the stock. Vaishali, let me take it to all the charts. What is the indication coming in? Long-term story is, does it merit continuing to hold the stock?
So I would say actually, these are the stocks. I mean, this is one of the stocks which technically always showed that, yeah, it's oversold and all. But there's no return that we've been seeing even for a long term or a short term. I would say rather get into stocks like ICICI, SBI. I guess that would be a better stock at this juncture to get into. Shift your position right from IDFC First to SBI, ICICI, because I think at least they have a clearer picture.
Okay, yes, absolutely. There's some clearer picture on that front. But let's move on and Gaurang, your view on IDFC First Bank. Obviously, they reported their numbers also over the weekend. And we did have some commentary that came in from the management today. But your outlook for IDFC First Bank?
Well, so I agree and concur with the view Vaishali has that, when it comes to priority investment into banking sector, large cap would be definitely the preferred side. And over there also between the large cap, I think strong public sector banks like SBI, a bank like ICICI Bank, which announces numbers on Saturday, very strong set of earnings. But down the line also, if you have to go to mid cap and maybe small cap banks, then as a disclosure, we do have a coverage on IDFC First Bank, I beg your pardon. There have been difficult times, Vinny, as far as earnings is concerned for IDFC First Bank, not only in third quarter, but even the quarter gone by, that is the second quarter. MFI segment exposure led to a higher degree of provisioning, which led to a squeeze on the bottom line, that is profitability reported. Whether these things are going to slip on to fourth quarter, well, it looks like, because the management said that fourth quarter, though it may slip over, but the impact is not going to be as severe as we've seen in second and third quarter. And with the new financial year, 1st April 2025, the situation can get better. Hold on, and 71 is the target on IDFC First Bank.
Okay, keep an eye out on those target levels over there. Let's move on and Rainbow Medicare. That's the next query that we have. The viewer asking and talking about in terms of stocks. Unnikrishnan C is writing to us about this from Chennai, holding 200 shares of Rainbow Children's Medicare at a price of 1,635 rupees, currently making a loss. The stock is trading at 1,379. Wants to know whether you should continue to hold or look to sell this one and book out their losses. Also wants to know the overall outlook for the stock. Vaishali, what's your view coming in for this one?
So technically what I'm looking at even from the weekly chart, I mean, the trend is quite intact. So I would say these are the stocks like Rainbow, Apollo Hospital, Fortis, etc. They would have a good growth story anyway. So I would say technically, since it matches my view, I would say continue holding and look for a good time. Once we see good up move coming in, this stock is likely to go towards 1700 levels. So in my opinion, this is a hold.
Okay, hold coming in for Rainbow Children's from Vaishali. But Gaurang, your view on the fundamentals, do you also think it's a good growth story that could play out?
Well, it definitely looked a good story. And when the IPO was there, Vinny, way back in April 2022, if I'm not mistaken, we had come out with an IPO. Floor was at 516 to 542. Shares were given out at 542. In case if you're a long-term investor, keeping the IPO note as a base, and the kind of performance that we've seen in terms of numbers, specialty hospital, especially focusing on children's health side, long-term looks quite positive.
Okay. Long-term looks positive. That's the word coming in from Gaurang as well. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more of your stock-related queries after this break.
Unfair relationship, and we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that, so we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
Think about India. We have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Trained. The last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because
Welcome back and thanks for staying tuned into your stocks on CNBC TV18. We still have with us Gaurang Shah of Geojit Financial Services as well as Vaishali Parekh of Prabhudas Leeladhar to solve all your stock related queries. Let's move on to the next query then. We have Sharaya, who is writing to us from Kerala. She's holding 200 shares of IRCTC at a price of 950 rupees per share. Wants to know whether she should continue to hold the stock or book her losses in this one. Gaurang, what's your view coming in for IRCTC?
Well, so, it's one of the strongest contenders in terms of the changes and the transformation that we are witnessing in the Indian Railways, Vinny. Unfortunately, we don't have a coverage, so I won't be in a position to say buy, sell and hold. But, a lot of people are under the understanding that this is just a ticketing company for the Indian Railways. But it does a lot more than just ticketing. It does a lot of catering also. And with the kind of new launches that the Indian Railways are planning in the next 3 to 5 years, I think this company could be one of the biggest beneficiaries of the transformation that we are witnessing in Indian Railways.
Okay, and on the technicals, Vaishali, what's the indication coming in for IRCTC? Should the viewer continue to hold or book her losses?
So now that she's held on for so long, continue holding. Keep a stop loss of 730 because I'm seeing chart of all periodicities, even the monthly chart. The final support lies at around 730. And if the stock has some inherent strength, it should bounce from these levels. That is 730. Failing which, it would negate the trend of the long-term period also. So I would say continue holding and keep a stop loss of 730.
Okay, keep an eye out on those levels over there for IRCTC. The next query we have is on Tata Motors. You have Samuel John who's writing to us from Mumbai. 70 shares of Tata Motors is what he had bought at a price of around 945 rupees. So currently, obviously, they're making a loss on Tata Motors. The stock is trading at 714. What's the long-term view on this one, Gaurang?
We have been maintaining a positive stance on Tata Motors, even when the stock was a huge underperformer, Vinny, in the entire order pack. We maintained a positive stance, then stock recovered, saw levels of in excess of maybe about 1,050, 1,100. From those levels, we saw correction, unfortunately, because of the numbers reported and, of course, the concerns as well as the JLR revenue contribution is concerned. But we're maintaining a positive view, Vinny, and our targets currently are somewhere close to about 855. There are a couple of triggers. One of them is, of course, in terms of reducing the debt on the balance sheet. The second one is hiving of the commercial business and listing it as a separate entity. And the third one, which is work in progress, is manufacturing JLR in their plant in Sanand, Gujarat. I think if all these things augur well, then we are definitely going to see a turnaround. There are new launches also, Vinny, a host of them lined up, almost about 6 of them, if I'm not mistaken, for this calendar year 2025.
Okay, surely keeping an eye out on Tata Motors. Vaishali, on the technicals, what's the chart indicating for Tata Motors? Obviously, because last 6 months has been a disappointment in terms of returns, right? 36% downtick for Tata Motors. What should the viewer do?
Right. So as a disclaimer, we had suggested a sell strategy on this for a trading perspective, right from 750 levels. So currently it's at around 714. And I would say even if there is some more corrective move left, I think a prominent support lies at around 670, 680. And I don't see much of a downside from there on. So I would say these are the levels that one should continue to start looking at for a buying opportunity.
Okay. The next query we have is coming in from Navendra Sharma, who's writing to us from Bihar, holding 100 shares of Star Health at a price of 510 rupees. He is a medium to long-term investor and asking the future prospect of Star Health. Gaurang, what's your view coming in for the medium to long term?
See, when you are, when you are invested in stock market, and in case if your investment has gone the other way, and if you are in red, then you should change your time horizon and put a workable strategy in place. So firstly, we are maintaining a positive stance. There was a difficult time for Star Health Insurance in terms of the market share and the kind of news flows that was there. There was some data breach also, which the news flows that was there in the market. I don't know how credible it was. And in terms of reported numbers, there was a disappointment. But we believe that health-related insurance business and companies are likely to do well. In case if you have investable amount at this kind of corrections or maybe close to about 400, you can look at adding a little bit more. We maintained a price target of 740. This with the caveat that if earnings are something that looks much positive than what is anticipated, then definitely 740 could be a target, or else we will revise it accordingly.
Okay. And Vaishali, Star Health on the charts and technicals, should the viewer actually go and start averaging at this point of time, given that we've seen a fall coming in, or continue to hold?
So technically, it is very, very much corrected, and it's in deep oversold. So if there is a fundamental strength, then I think one can start averaging at these levels. The confirmation of a reversal will come only above 465, 470 levels. So I think no harm averaging out at these levels. Keep a stop loss of 420. And once we see a clarity above 465, I think we are on the right track there.
Okay, can look to average also. Keep an eye on those levels that Vaishali also mentioned there. But let's move on to the next query. We have Nikhil Arora, who's writing to us from New Delhi, holding 350 shares of GAIL, and this is at a price of 193 rupees per share, currently making a loss. The stock is trading at 169. He wants to know whether he should continue to hold this or maybe look to sell it at the current levels. Gaurang, your view on the fundamentals for GAIL, what is it looking like?
So I think the entire exploration side, oil and gas, needs a boost with respect to not only the policies that will be out on 1st of Feb, that is on the budget day, when the Honorable Finance Minister, Srimati Nirmala Sitharamanji, will unveil the budget. But even otherwise, outside the budget platform, I think the exploration sector needs a huge boost in terms of policy changes, exploration policy that we have in India, etc., etc. We have a positive coverage. 207 is the target. And by the virtue of the level that this gentleman has got invested, my advice would be that maybe at these levels or on dips, try to add on to it so that you can maximize your profit.
Okay. Thanks so much for that, Gaurang. But that was the last query for today. So thank you so much, Vaishali, as well as Gaurang, for joining in with us on the show and helping our viewers solve all the stock-related doubts. But with that, we're absolutely out of time on this edition of Your Stocks on CNBC TV18. Remember, you can always email us your queries and we will address them with our experts. Anyways, that's a wrap here, but don't go anywhere. You have a closing bell that will take you through the last hour of trade.
every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it, and they're quite happy with it.
So what is this going to... Do you foresee the need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time, and at least we've seen this in our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, even though almost 80% of now, let's say, coding can be done through AI. But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating.
Hang Seng especially is trading with gains of 0.9%.
It was a mixed set of numbers coming in from ICICI Bank.
On the downside, the level is 22,976. That is a swing low. The government has invited application for SEBI chairman's post by the 17th of February.
I saw the value and I thought it's a good value to go after.
22,925. We're basically back at the lows that we were talking about earlier.
The government has guided that the capex will pick up, and we are seeing signs of that being reflected in the last quarter itself in the long products.
Rural will remain strong going forward, even this fourth quarter.
Benchmark indices are down over 1%. Real deal came in on 20th of January, exactly a week ago, when DeepSeek released its latest model, DeepSeek R1.
They are going to discuss resumption of bilateral ties.
The indices were trying to attempt a recovery, but now they are also firmly in the red, 250 points down on the Nifty, but the actual pain, though, is in the broader markets.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, it is painful session this Monday afternoon. Markets are absolutely cratering. And when I say markets, I don't mean the Nifty, which is down just about 1%. It's the broader markets, anything between 3 and 4% down on the mid and small cap part of the market. 10:1 declines to advances. So just that kind of a day where very few places which are actually up and about in the green. I'm Prashant. With me, my colleagues Reema and Surbhi here. Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon, folks. But today, the one thing that we can say, not that it really helps, that this is not just an India-specific problem and fall, which is what has been the case for most of these days. Today, this is global in nature. I'm looking at futures right now. Look at the NASDAQ futures. They're down 3%. The S&P 500 futures are down 2%. So this is sort of a bigger issue at play.
Surabhi, actually, more than anything else, that is the problem, because so far, if the US had all this deep seek and this China, and Rima will talk more about this, but if all of this did not happen and US was okay, we were, for the last couple of days, we were wondering whether markets are they are oversold and there is a bounce which is due. Now, but if later today you find NASDAQ down 3% and you wake up in the morning with a 3% cut, then, that bounce the case for a bounce disappears.
Yeah.
So I think that is the new unknown which has kind of been thrown into the mix. Otherwise, around here, I think it's about time that you actually find a decent kind of a bounce. The other thing, of course, which I find a little peculiar is that while the small cap index is down 4, mid cap index is down 3, the Nifty is not selling off that hard. It should have by now, with these kind of broader market levels, the Nifty should have also broken down. But that is not happening in a very meaningful way. So you're kind of holding with about a 1% cut. So, but of course, otherwise, broader markets, as I said, declines to advances, etc., pretty bad. And of course, the US thing, we'll learn more about what the market wants to do. Remember, the cracks in US, large names like NVIDIA, etc., started Thursday, Friday, last week. Friday, especially, NVIDIA was down about, I think, 4% or so. And as Surabhi said, there's a big 3% odd cut coming through on the future side this morning. So I think that's the newer element which has kind of been thrown in with everything else which has been happening in any case as far as the market here is concerned. Guys.
Well, Europe is also down nearly 1% and more than 1% when it comes to the German index. So the DAX is down about 1.25%. The key issue at hand, as we've been pointing out, is that so far OpenAI's ChatGPT was dominating generative AI. Now, over the last couple of days, and 2 months back, you probably wouldn't have even heard of DeepSeek, but now you have a rival, which is it's a free alternative to ChatGPT. It's made by a Chinese hedge fund company. It's called DeepSeek. On the 20th of January, that's exactly a week back, they revealed their latest model, which rivals OpenAI's latest model in terms of efficiency and all the parameters, in terms of reasoning, etc. But it was made at a fraction of the cost, at about $5.6 million in less than 2 months, and with far inferior and fewer GPUs in terms of chips. So therefore, the street is worried that will DeepSeek in a way burst if there was an AI bubble in the US, because stocks like NVIDIA had gone up by nearly 135% last year. Will it burst this, stocks like NVIDIA, burst the bubble there? Will Magnificent Seven come under pressure? And that's really the issue at hand. And even back home, there shouldn't be a rub-off impact, but the tech stocks are selling off quite deeply.
Absolutely. Apparently, this released on the App Store just 2 weeks back, and it's already overtaken OpenAI in terms of the most happening app or the most popular app. So I think the word is spreading fast, and it's definitely spreading fast through the markets. So this is the bigger global issue. We'll talk about this as we go forward. What is DeepSeek? It's the newest, deepest worry for markets, I think, around the world. Just very quickly to talk about some stocks. It's a wide sell-off, so what to name. But tech is falling quite a bit. Right now, Tech Mahindra, HCL Tech, Wipro, Infosys, all the large cap tech stocks are lower, including a TCS as well. And there are hardly any counterweights for the market. So that's tech, which is down. Let's look at the other bigger stocks. If you pull up the contribution chart, you'll find a lot of big bank names lower. Reliance is lower. Tech is lower. So there is not much respite for the Nifty, which is the issue. HDFC Bank, for instance, is down 1.5%. The saving grace was ICICI Bank post numbers, and that's been the lone ranger in its own peer group as well. ICICI is the one that's trying to pull on the upside, but it's not enough. The Nifty, as we speak, is hitting fresh lows. 22,800 now is in question. But Nigel, that's not even half of the pain. The bigger brutal sell-off has been in the mid-caps.
Well, that's right, Surabhi. And that pain in the broader markets is extremely, it's hurting investors actually, because when we started off in the morning, you had 190 stocks that were advancing, and as we speak, there are still only 195 stocks that are advancing. So that's telling you that a lot of these stocks, the dip, as of now at least, is not getting bought into. And I think now the crucial factor will be when the last bull throws in the towel, that will be the time when, in fact, the markets could turn around. But for the time being, even as you all were taking that market check, the Nifty has now moved. The last tick on the Nifty is at the day's low. And a few stocks that come to mind, you have CDSL, the numbers are disappointing. The stock is down 10%. ACC, the street is trying to cut, these numbers and try to analyze it because remember, it'll have an element of volumes coming in from Ambuja Cements as well. And adjusted for that, the numbers don't look that great. So that's why that stock as well has come off from the top of the day. Adani Total Gas is the other one that slipped a little bit. A painful looking screen, as we've been saying, a bounce is overdue, but you'll want a sustainable one from here on because that crucial support zone of from 22,900, that's got broken. 22,800, the next mark you're looking at, we're almost there. So a very, very crucial juncture. Let's get in Mitesh Thakkar, who joins us to help us out with what is he doing. Mitesh, what do you make of it? Oversold? Yes, we are, but no signs of a bounce. How are you trading this one?
So, Nigel, a couple of things. Good afternoon. I think one, we are definitely oversold, but the gap down which happened, there was no attempt to fill the gap. Despite the fact that the bank Nifty was doing better than the Nifty, I think the index itself showed no sign of pullback. And in the morning I talked about possibility of Nifty heading towards 22,600 550 zone. So I think 22,600 550 is my target area, and I think we're not very far away from there, about 250 points away. The idea is that don't try to get into long positions till we see a significant sign or signal of a reversal. At least the price on hourly chart starts making higher highs. Till then, I think no point getting into the long side of the market. So, trade with short bias. I have a sell on Hindalco, which I would recommend selling with the stop at about 603 and a target of around 555, 560 is what I think the stock can do. And the other one is a sell on IRCTC, which I would recommend selling with the stop at 766 for targets of 720.
Thank you very much for that. Let's get to Laurus Labs. That's down nearly 10%. Well, they came out with numbers last week and the numbers were good, the margin recovery. But today there are concerns related to its antiretroviral business, ARV business. This is after the US withdrew from the WHO. Vinny joins in for more on what the management had to say as they try to allay concerns.
So absolutely, Rima, what is the main concern coming in? And I'll just explain what this is actually. This is a funding that goes from most of the countries to the WHO. Now, US accounts for around 75% of this funding. Now, this is a PEPFAR funding, which is around 20% of the total ARV program that are going on globally. And obviously for Laurus Labs also, about 20% of ARV sales are these PEPFAR sales that are there. And the funding, if Trump has highlighted that he wants to maybe stop the funding to WHO, then that becomes a concern. So Motilal Oswal also said that this could cause an impact of around 9% on the total consolidated sales of the ARV business, and that is the main business for Laurus. So 9 to 10% impact of that. And maximum impact in terms of EBITDA that they expect on Laurus was around 4 to 5% in FY26. Now, when we spoke to the management, what they highlighted is that, currently, obviously, 46% of the sales comes from this ARV business. And in that, obviously, a smaller portion is something that comes in from the PEPFAR funding, which is a very small and insignificant amount in terms of funding. They said for 2025 calendar year, there's not going to be any impact of this funding that could maybe see a bit of a freeze or a stopping for 90 days is what they've highlighted as of now. So not much of a concern for calendar year 2025. Maybe post that, maybe we could see a reaction coming in. As of now, there is not any impact is what the management is highlighting. So keep an eye out on that.
Dipan Mehta of Elixir Equities is now with us on the show. Dipan, the management says not much of an impact. Analysts are pointing out that the EBITDA could be hit by as much as 5% for FY26. Where do you stand? Is the reaction a bit overdone? Because numbers are looking up.
Yeah, Rima, good afternoon and thank you for having me on your show. I think there's a bit still uncertainty around this funding and other things. So considering the market conditions and considering that the business model of Laurus is largely I would say supplying of APIs, which in turn is cyclical, I would just like to avoid whenever the stock reacts the way it has, there's something still deeper which we do not know. So I would just like to wait and watch, especially after a good number. So for the time being, it is an avoid. I think there are other good quality pharma shares one could look at.
Okay. Deepan, hi, good afternoon. Good to have you on. There's a raft of earnings to go over. For the time being, if you just ignore the market's fall, though it's hard to ignore. By the way, 300 points down and 22,800 is under threat now on the large cap screen. That would be a near 300-point decline on the Nifty. Let's see if the bulls can defend it or not. I want to get your sense on some of the BFSI numbers that we saw over the weekend, Deepan. There's Credac. I don't know if you're willing to see any light at the end of the tunnel or not. But more importantly, let's talk about names like, say, an IDFC First Bank or a Yes Bank, tier 2 banks, basically. We had a chat with Mr. Vedyanathan of IDFC First in the morning, and he was sounding reasonably confident on asset quality X of MFI. But margins are under pressure, and the market doesn't like that. Your thoughts, IDFC First or anything else that stands out for you in terms of tier 2 lenders?
Surabhi, Mr. Vedyanathan may be extremely optimistic, but he can't talk ex-MFI. MFI is part of the company. And the management took a decision to grow that particular book so that they could get nice interest, nice spread as far as interest were concerned. And now I think they are suffering from all the kind of what is taking place in the MFI space. We are seeing major problems over there, and investors need to rethink their strategy for MFIs and banks which are overweight MFIs also. This may certainly turn, I would say, in a couple of quarters or so, but this is not as great a segment within the banking sector as it appeared to be so. Other than that, I think, valuations, everything is fine. But look, the entire banking industry is getting extremely competitive. It's like a red ocean, and there are so many banks, investors are overweight in banks, and even overall growth rates, if you look at the net interest income and the pre-provisioning operating profit for a lot of banks, it's not as was maybe a few years ago or so. And if somebody's already overweight banks, I would certainly not want to add any more bank positions over there. And selectively, one could look at being underweight banks also. IDFC First Bank, the way it has corrected, I don't think it makes sense to sell, but I wouldn't be averaging. And maybe at an appropriate time when the stock goes back by 15-20% higher, we could look at exiting our position. Having said that, we and our clients are invested in IDFC First Bank.
Okay, I completely understand then the pain and sort of the patience that you'd have to exhibit, at least for now. But that's an interesting point that Dipan is making, right? And it always comes to my mind, because when you talk to analysts, they're willing to look at businesses X of segment A or Y of segment B. But for a shareholder, it's all put together. Ultimately, if the EPS is down, if the revenue is down, it's down. It doesn't matter X of this or Y of this, or adjusted for this or adjusted of that. I think that's the point that Dipan is making.
No, absolutely, and I think that's absolutely a valid point to be made as well. I think we got a breach of 22,800, and then we've got the market coming up a little bit, just above the 22,800 level as we stand right now. I think let's talk about CDSL, right, which I think is facing some selling pressure. Numbers came through. Vamakshi is here with just the street view out there now. Vamakshi, take it away.
Well, absolutely, Prashant. CDSL came out with a weak set of numbers. When we look at the revenue, that degrew by almost 14% sequentially, coming in at 278 crores. The margins too have contracted by 424 basis points to 57.8%, and the net profit has seen a decline of almost 20%, coming in at 129 odd crores. Now, when we look at the revenue, largely the degrowth is being led by a fall in transaction charges, which declined by 29% from 83 crores to 59 crores, as well as the online data charges, which saw a dip of almost 23%. They also witnessed a degrowth of almost 36% in their other income. When we look at their operating expenses, the employee expenses actually saw an uptick of almost 2.7%. They're also investing in tech, and therefore they also saw a 23% sequential uptick in the computer tech expenses, and that sort of negated the fall of nearly 17% that we saw in the other expenses. And overall, the total operating expenses for the company declined by only 4.1% as compared to the 14% degrowth we saw in the revenue, which is why the company's margins saw a very sharp fall. Now, when we look at the other key internals for the company as well, that was also quite lackluster. CDSL net account opened in the quarter dropped to 92 lakhs. This is a 22% drop on a quarter-on-quarter basis. The demat custody, which is in rupees lakh crore, that saw a decline from 78 lakh crore to almost 75 lakh crores. This is a dip of almost 4%. So overall, a weak set coming in for CDSL. The stock is tanking in trade on the back of that.
Got it. Thanks a lot for that, Vamakshi. Dipan, what do you make of these numbers? CDSL, well, the stock looked so good just a short while back, and now these numbers have come and no mercy whatsoever. The last stick was at the low point of the day. What are you making of this one?
Nigel, my reading is that the CDSL business appears to be far more cyclical than was previously envisaged. And with primary market and secondary market slowing down, volumes coming off, we are seeing it reflected in the top line of CDSL as well. And it's still quite richly valued, I think 55, 60 times thereabout or so, trailing 12 month. I'm not completely sure. So from that point of view, I think, and it's a stock and a lot of investors are overweight and it's done exceptionally well. So from that point of view, I think this correction may be justified. Stocks like CDSL, BSE, stockbrokers, wealth managers, RTAs are best bought when markets are in solid bear situation, volumes are low, IPO activity is non-existent. And at that point of time, if you buy these stocks, then you can ride the bull wave when the cycle turns. So I would say even at these levels, CDSL is an avoid, and you could look at even selling it off because this stock can correct even more. Next quarter may be worse than this quarter as well if the market trends remain the way they are.
Actually, look at the entire capital market space, right? Nuvama is down to about $5,000. I mean, those are high flyers. KFintech had a very sharp fall. Exchanges like BSE, I think, has come off quite a bit as well, although not as much as some of the others, some of the other ancillary names there. Deepan, if markets remain bad, I mean, I think this is a straightforward kind of thing, right? Volumes will get impacted and consequently, volume of business these companies are able to do straight away starts to get hit.
That's right, Prashant, and these businesses have very high operating leverage. So if a slight decline, also 8-10% decline in the revenue can lead to 30-40% decline in the net profits. And this kind of cyclicality is not reflected in the P multiple. You pay high P multiple for consistent, steady performers, secular growth stories, not impacted by too many cycles within the industry. But these capital market businesses are certainly not so. Last 4 or 5 years, things have been so good. We forgot that you could have a situation where 6 months, 1 year, markets could be down and activity could be low key, which we are seeing just now. I think that was completely missed by a lot of analysts and shareholders of such capital market related businesses.
Dipan, Trent, 25% lower since the beginning of the year. At 5,400, is the stock attractive?
No, Rima, actually, I'm not looking at buying anything. I look at the screen and I'm wondering why have I not sold more, considering I was so bearish for a long, long time. But I don't see any point in buying high PE stocks at this point of time. Even a minor miss on trend will cause a 8-10% decline easily in the stock price, because if investors will look at its high P multiple and say, look, what are we paying this kind of a P multiple for a business like this? Although it's got great dynamics. But look, valuation plays an important role. And I've noticed one thing, that when you buy a high PE stock, it's very difficult to get the alpha. It may appear to be so for 1 or 2 quarters, but 3-5 years down the line, you realize that there's hardly any return from such stocks. So for me, Trent and all such high P multiples are an avoid. I think I don't look at anything above 40 P multiple. I just say, okay, let's just keep it on the side for some time. Let's look at something which is available slightly cheaper.
Okay. 1,500 points lower on the mid-cap index at this juncture. Deepan, I'm going to ask you that tough question again. I think I asked this last week as well, right? In this falling market, what to buy? Any one stock? And I'm not putting like a 2-month time frame on it or whatever. I'm saying, what to buy, say at least from a 1-year perspective, if not longer.
No, see, I think tactically investors should be overweight pharma companies. And that's something we are looking at quite closely. If you have less appetite for risk, companies like Sun Pharma, Lupin, I thought even Dr. Reddy was okay. It will do well at least next 3-4 quarters or so. So that is one segment. And we are fielding for some of the high quality platform businesses, like maybe a Zaggle Prepaid or a RateGain Technologies, could be Car Trade. These businesses, these companies are done exceptionally well. And they have created great value, and they're trading at extremely rich valuations. So if they come off for some reason or the other, overall market correction or a soft quarter, then those are the companies we are looking for in terms of investing. But as I said, these are just ideas on the horizon, and they have some way to decline for us to come in that, for us to feel comfortable into looking at them in positive light.
Zomato down 35% from the highs, Deepan?
You could add Zomato to the list also, Prashant. Zomato, Swiggy, RateGain, Zaggle Prepaid, all these platform companies, even companies like Affle India, IndiaMart, Intermesh, Just Dial. I think all of these have got great business models, and they're expensive. So in bear markets, you want to buy such great business model companies at reasonable valuations.
And that point that you were bearish for so long and you're wondering why didn't you sell more? I think that that's an important point. But I think you now for somebody, seeing prices down of the 25, 30, 40% in some cases for individual stocks, Deepan, becomes it's psychological more than anything else, right? Unless you have a very strong view, which is very difficult to take, to sell now becomes very hard. Even though, would you agree, Deepan?
Yeah, I agree.
If prices stay here for the next 1 year, 1 year later it becomes easier because the the reference price has changed.
You're right, Prashant. Mentally and psychologically, it's difficult to sell a stock after it's down 25, 30, 40% or so. You tend to justify that now it's corrected so much and should not fall. Even I go through those thought processes. But yes, I think the time to sell for a lot of stocks is gone. And, might as well wait through this challenging period. It could last, 3 months, 6 months at best. End of the day, Indian economy, the demographics, the capital market, and a lot of other structural factors are positive. So things will revert back to mean. But as investors, we need to ride out this bearish phase.
Actually, the small cap index, Deepan, is down 14% from its all-time high. The last time we had a 10% plus correction was November 2022. That lasted 4 months. The small cap index fell 12%. So you get these. Maybe the frequency of these corrections has gone down and down over the last 3-4 years of this non-stop rise, but you do get these once in a while. Of course, back then the index was at 16,000. Now we're at 22,000. So that is the other kind of thing. But we'll wait and watch. Thank you very much, Deepan, for joining us. Good speaking with you as always here on CNBC TV18. We'll slip into a quick break, but here's something for our viewers. India's business news leader is now a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app from the new Apple Store or Google Play Store, or just scan the QR code now on your screens.
Years of CNBC TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the
14.15.
Welcome back. 270 points lower on the Nifty. Let's welcome in Dinshaw Irani, CEO of Helios Mutual Fund, who is joining us now. Dinshaw, great to have you with us here. Thank you very much. It's all red and worrisome looking screen out there, Dinshaw. What are you doing? How are you looking at it? What's the team's view at Helios? Your view and what's coming out of those discussions?
Afternoon, Prashant, and good afternoon to your viewers too. And thank you for having me on your show. By the way, morning I was wearing a white shirt and it's turned pink because of blood on the streets. But anyway, Prashant, our feel is that the market, I think, is overstretching now. I mean, the fact that we are correcting so heavily, and that too, what were the negatives? Negatives were that earnings growth wasn't happening, the quarter looked really not that great and stuff like that. But despite that, we're talking about flattish earnings, right? And flattish earnings doesn't ensure that you lose, 13-14% on your narrow indices and probably 14-15% on your broader indices. So it's obvious that there's a panic building in. And probably, hand on heart, our feel is that probably this is a time when you can, stick your neck out and say, look, I like this stock. I like the valuations which the stocks are quoting at, and I want to buy. So I'll start picking. And that's what actually we're doing. We're very nibbling right now at the markets for whatever little cash that we have and whatever little cash that we get every day. I think it's time to just go and pick your stock that you want to, which you believe is a winner, which you believe the valuations are looking very reasonable. Go and pick those up.
All right. Hi, Dinshaw. Good to see you in. So what are those stocks that you like, Dinshaw? It's come to a good level. Name a few if you can. I recall, we had a brief chat about some of these new age themes. They look good and maybe they still look good. But for the time being, some of them have come off a little bit. A good entry opportunity or any other stock that you like?
Yeah. So, you said it. Some of the platform companies are now unnecessarily being hammered down for no reason. Obviously, the IT names are getting hammered because of what's happening in China. DeepSeek supposedly is having a big impact, but I remember the same was the case when WhatsApp, the data issues were there. Finally, people came back to WhatsApp again, but I'm not saying that the same thing gonna happen. But things have to work out there. So IT companies, I think, are getting hammered for no reason. So these are the few names where you want to, obviously the banking names, whichever we like, we're slowly picking them up, though they haven't corrected much as such. But wherever, and obviously, Nigel, I will not tell you the names that we are picking up for obvious reasons, but this is how it is. And each one may have their own view.
Yeah. Dinshaw, hi, good afternoon. We know you can't tell us the names, but you can give us some hints about at least what you're liking in the market, where valuations are looking attractive and where you think at least like 6 months down the line, you as well as shareholders will be happy, Dinshaw.
So as I said, the fact is that we've been very selective. Anyway, we were very selective in picking our names in the beginning itself. So private sector, again, I'm not saying the banks, private sector banks I'm talking about. Again, there we've been very selective. We've not got into names which are microfinance exposed and, vehicle financing exposed. We got into pure consumer banks where the franchises were pretty strong and they come out with flying colors. You saw the results of ICICI Bank. It was fairly a good result and it came out fairly well. So these are a few names in the banking space. Then obviously, as I already stated, the platform companies, we like them a lot. IT space, in fact, if anything, I think they're coming out stronger out of this mess which is happening right now. So those are a few names that we like. And that's about it. So I don't think I need to name anything beyond that.
Okay. No, we won't push you. I know you have your compliance issues. But every time I hear the term DeepSeek, the only thing I can think of is that this is a market that is deeply seeking some gains. I don't know about any other kind of DeepSeek, frankly. We'll get to know more when the US trades tonight. But
actually, Subi, we believe that this will be the time period when real alpha can be found in stocks. And if you don't panic, the investor doesn't panic and continues with the SIPs and all. I think this is the time when he can really average out as such. So that's why our fingers are crossed. I think we're getting good value now. So that way.
Yeah, absolutely. You know, Dinesh, on a different note, we'll deal with this global sell-off, see what happens overnight. But on a different note, it's also the budget week. So right now, while obviously you won't take a budget-related trade, I mean, you know, short-term 2-3 day trade, but what I'm trying to ask is that in general, over the next 2-3 months, would you rather position your portfolio expecting some sort of a consumer, you know, focus budget, some consumer push, or would you go back to beaten down capex names, expecting that to remain a big focus for the government?
So, okay, Sumi, that's a good question, because I think basically the government has done is build on the capex. And frankly, I mean, looking at the maths that we normally work as we go into the next budget, our feel is that the government doesn't have much left to, you know, even spend. I mean, given that the GDP growth has slowed down, and obviously the additional revenue that you gather from that is not going to be that exciting. So it's obvious that, and obviously they want to keep the deficit in check. So I think the only thing that they can do is make it a very consumer-focused budget. You heard some sound bites, right? I mean, in fact, some of the government officials have gone on record saying that we've done enough for corporates, we've done enough for the low-income guys, we need to do something with the masses and stuff like that. And I'm sure they're talking about something to do with the tax or something like that. I don't know how they're going to push this thing. But obviously, the government is also cognizant of the fact that, look, consumption is suffering and urban consumption is suffering. And by the way, even after the budget, there's this RBI meet which is going to happen. I think it's going to be a very concentrated effort on both sides as such if you want to push consumption going forward. And I think that is what is needed, the need of the hour. So let's hope that it's a consumption-driven budget rather than anything else. On capex, I'm not keeping any bets right now.
Dinshaw, hi. You were bullish on the wealth management, capital market related plays. Now stocks have corrected 20-25%. Are these the sectors which you're selectively looking to buy? Tell us how you're approaching the sector which you've liked after the correction.
So Rima, we like these plays anyways, and I mean, frankly, I mean, the valuations are fairly stretched at some point. If you remember, I also said that we're trimming our positions in a few of these counters because we think the positions are pretty stretched out here. So we did that, and obviously we got some money left on the side. But I think still right now, I mean, rather looking at the way the markets are so choppy and volatile, I don't think we're gonna get into real high beta names like those. So I would rather go with, you know, steady plays right now than go into these mid and small cap in a big way. We will nibble, but not in a big way. So I would rather be away from these names right now.
Okay, all right, no, absolutely. Point taken there. But broadly, the view at Helios now is that enough damage has happened. I mean, for now, right? And this is a little overdue. Yeah. Absolutely.
Yeah, overdone.
You know, Samir was with us on the program. I don't know if you saw that, the Confessions show, Mistakes Made, over the last Friday. And he was he was kind of saying that actually in the context of global, his point was that global is looking good and India is looking somehow bad. So it should not, I mean, it should align. My only thing is this, if this global thing, and we're not really clear, right? You spoke about DeepSeek, etc. Will that be an issue? How big an issue? You know,
so actually,
so that's the only thing. Yeah, sorry, go on.
Prashant, actually you're right, because the 7 guys who rallied in the US and which pulled up the rally for the NASDAQ and S&P and everybody there were all related to OpenAI, to AI rather, artificial intelligence as such. And if DeepSeek is going to be such a cheap alternative, which anyway was going to happen. I mean, I don't think it was when it's going to happen. It's whether it will happen or no. It was only when it's going to happen, right? So it's happened pretty early in its life, I think, in the life of AI, that is. And I think all these guys have to catch up there. I don't know whether how long this will last or how long will this pain will go on in the AI bit. But one thing that we are very clear about is if India can have I think the rush of money outside India, in fact, I don't know whether you're aware, in fact, year to date, the outflows out of EM are $7 billion, and most of them have happened out of India per se, and that all money has rushed to US. I think the rush is mainly because of the currency as such. And if we can give an answer to that, I think the whole, all the FIs are pretty panicking on the rupee right now. I mean, they're I don't know what reason is there, but whenever you talk to them, they say, look, we are very concerned about the way the rupee has been propped up, and we expect the rupee to depreciate sharply and stuff like that. So I think that is what we need to answer, and I don't know how that's going to be answered as such. So let's see how that works out. I think the main flow is because of that uncertainty on the rupee rather than anything else.
That's point taken. Absolutely. And I was also wondering, sometimes you look back at history and there are points in time when you, obviously it's only clear with the benefit of hindsight that was the point, right? November 2022, Chat GPT was announced, and that sparked off this big rally in AI, data centers, robotics, what have you, right? I mean, that has essentially been the big theme. Of course, I mean, when it came out, I don't think anyone realized it, but it just sort of, that was the point. Absolutely. Dinshaw, thank you very much. Great speaking with you, and thank you very much for joining us. Great conversation, and I hope some of what you're saying pans out and we see stability sooner rather than later. Thank you. All right, well, we'll take a quick commercial break here. We'll come back and we'll tell you what's happening in dealing rooms. Important check. Nimesh is going to help us with that in just a bit.
Changed to make quick commerce a high conviction bet.
2020, when we were sort of raked through the coals for ruining a perfectly good food delivery company and like bringing their stock price down, I think we had a lot of conviction that this will work.
When Dippy puts out a note to shareholders to say that this is actually going to be the engine of growth over the next 10 years, how does that make you feel?
Over the years, we've gone through enough to not sort of be either in the vindictive zone or to be in the celebratory zone. I think we try to stay very stoic about it.
How are you looking at the race that's currently on?
A lot of those bets are being taken for sector-focused quick commerce companies, and they will probably do a better job for those use cases than we will.
Of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving, because markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and see.
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, well, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted you to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue. That what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that, with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on the other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because.
Welcome back. Some signs of stability, some kind of recovery from the lows. At least it appears as of now. On a closing basis, the bulls want to try to defend the 22,800 odd mark. That said, let's get an insight in terms of what's going on in D Street Chatter. Nimesh, it's been a painful trading session. A bounce is due, not come about today. But what's your reading?
Well, Nigel, you said the bull wants to defend. I don't think how many bulls are left now with the kind of carnage we've seen in the broader markets, right?
Yeah.
Again, the mid-cap index is down 2.5%, small-cap index is down 4%. It's not a single sign of recovery in that broader market indices. And this is after, I mean, if you look at 1 month, all these indices are down more than 10%. So clearly, at least more than 10% fall, and you call it a bear market in those sectors. So clearly that's playing out. The real estate index in the last 1 month is down 20%. And we're seeing, big reaction in the stocks as well. I was looking at Anantaraj. That stock in a single day is down 18%. That's the kind of pain we are seeing in the broader market names, Nigel. And now there are clear signs of capitulation from very large holders, retail investors, you name it, and they are looking to sell or at least book the losses. So that's the kind of mood which is there in the system right now. I guess even from a flow perspective, while DIs have been supportive to some extent, but the bigger fear is the large selling that is happening from the FIs over the last many days. Even there, the one positive feedback was I was told that there was a bit of reallocation happening across emerging markets, and to that extent, the large selling in India seems to be largely over. So maybe that's something to watch out for in terms of whether the FI numbers turn positive. If not turn positive, they're less negative in the days to come. So that's something to try going forward. I guess technically we've broken that another crucial level of 22,900 on the Nifty. 2800 at 29,900 is a level to watch. If that gets taken out, then you'll see further selling in the broader market names. So that's overall feedback. But purely, looking at the screen, looking the way the mid and small cap has collapsed, I guess there is clear signs of capitulation now in the broader market stocks.
Well, indeed, and the stocks have got hurt very hard, Nimesh, and portfolios as well. But let's see. Tomorrow we hope to get some stocks from you in the second part of D Street Chatter. For the time being, thanks a lot for joining in and giving us all of those details. Well, let's get in Mitesh Thakkar. Mitesh, at least it appears for now 22,800 will be defended. What's your view on the index and individual stocks?
Nigel, I think for the day, yes, maybe. But I still believe that we have a good chance of testing 22,600, 550 zone. And if we break below that, even lower levels. The structure is turning weak, and that is my worry. So for the timing, I have an STBT on Zydus Life. That's STBT with a stop at about 932 and a target of 904 can be looked at. And also an STBT on DV's Lab with a stop at about 5605 for targets of 5530.
Okay, all right. Got that. Thanks very much, Mitesh, for the trades. Let's go back and revisit some of the numbers that we've seen and some of the sharp reactions that have played out through the course of the day. And definitely IDFC First Bank is one of them. The stock really never recovered. It's been down almost 7-8% after the third quarter earnings print came in slightly below estimates. The issue really is on asset quality and the fact that the MFI pain is continuing, even though the management is guiding for it to peak out in the fourth quarter. We did catch up, as I said, with Mr. V. Vaidyanathan, CEO of IDFC First Bank, on the way forward.
That it's not like a dramatic swing happening towards corporate. We just like to grow it just almost in line with the retail book now. We don't want to swing more towards retail, etc. It's already doing well. Now, to your margin thing, we think that roughly around the 6-ish odd % we should be able to sustain in the longer run. Next year, of course, is because base effect of MFI will not be there. So income growth of the bank will, traditionally income growth has been like 20% and all. Maybe it will come down a little lesser. But the important thing, OPEX also will come down. So we believe that the next year is a transient year. And then after that, the next 4-5 years, we see a one-way track. So a short question on NIM as such, we expect some stability.
All right, that was IDFC First Bank, the management there talking about the path forward. Sudeep Bandyopadhyay of Inditrade Capital is with us. And as we're saying hi to Sudeep, let's just take stock once again. For what it's worth, I mean, the bulls are trying to defend now the 22,800 mark. The mid-cap pain also continues, 1400 down. But I mean, yeah, the market's not fallen further. Trying to pick on silver linings here, Sudeep. Sudeep, what's your advice? Let's talk about, if we can just put aside all the gloom and doom and the, doomsday scenario kind of feeling, if we can put that aside and focus on earnings, is there anything that you saw over the weekend, over the last 2-3 days, where you feel that the underlying growth is good, the commentary is solid, and maybe, one can actually take a medium-term call? Any stock, any company that stood out for you last 2-3 days?
Surabhi, ICICI Bank, of course. I mean, it goes without saying. I think fantastic set of numbers in spite of all this gloom and doom. I think, great numbers. I would also put Ultratech numbers in a category which is close to that. The expectation was much lower, but Ultratech did well. There was a problem as far as demand is concerned, but the cost management was exemplary, and they continue on their growth path. So I think both Ultratech and ICICI, amongst the large companies, definitely stand out in terms of Q3 performance. And I would definitely look at both if there is a significant correction in either of these scripts, but there hasn't been. So we'll have to, if somebody is going to be investing for long term, they should look at that. I just want to mention one more thing. Yeah, I know this is a gloom and doom kind of a scenario as we speak, and markets have been falling rapidly. There is this deep seek, which is kind of destabilizing US market as well. And one doesn't know how US market reacts today once it opens. But we are into a week where we end the week with a budget. And budget is a tool in the hands of government to do a lot of things. And remember, this is the first budget, full budget of this government. So I think this is a great opportunity for the government to do multiple things. Yes, there are challenges. Yes, there are, the fiscal discipline needs to be maintained. But still, in spite of all these constraints, a lot can be done, and the market mood can be changed if the budget is, what we expect, or what even we can't expect is better than what we can expect.
So Sudeep, it appears you're expecting something. That's good news. Hopefully there'll be some delivery. You mentioned a few words out there. Government has got the tool in the hand. You had a little bit optimistic. So the hope is that, at least nothing negative comes about in this budget. But I want to ask you, Sudeep, about a couple of these stocks like Tata Steel, which has seen a fair correction from the recent peak. It comes out with a set of numbers, I think, in the next 3.5 hours from here on. So let's run our viewers through the expectations. Top line degrowth of close to around 5%. EBITDA number will take a harder knock. It will be down by close to around 25%. Remember, for the volume numbers, we already have that with us. So deliveries have come up by around 8.5%, which is good actually. They have capacity that's coming on stream, so that's what helps them. The UK business is going through the refurbishment, and that's why that's down by close to around 12%. While Netherlands, the deliveries are up by close to around 18%. It includes some bit of, an element of the movement between Netherlands to UK. So that's why, in fact, it got a bit of a bump up. So that's about the volumes number. Why is the top line decline? Because pricing has been very, very weak, and that's the pain point. However, now for Q4, you're expecting prices to stabilize. Hopefully, China gets its act together, and that's what could support prices. Moving to the margins, the weak average selling prices will lead to a drag on margins. But better volumes and lower costs, coking coal costs should cool off. For JSW Steel, it cooled off by around $34 per ton. So hopefully, there is some cool off even here, and that's what could help them. The losses that Tata Steel Europe is expected to reduce. So the number we are working with is around negative $58 per ton. That's for the European operations. For India, it's expected at around 11,300 rupees per ton. As always, commentary will be crucial. What are they seeing in terms of demand on ground, both in India as well as in the European operations, and any kind of debt reduction plans. The stock is corrected from 180 to 130. We'll have to see how much of the bad news is in the price. Sudeep, your view. JSW Steel, actually, the numbers are pretty good in a difficult, scenario that's playing out. And now they're saying $30 per ton of coking coal cost declined in last quarter. This quarter will be another $10 to $15, and pricing will stabilize. So things should look better in Q4. Your take?
Absolutely, Nigel. I think this cost, which is coming down, is definitely helping the steel producers. And both of them, JSW as well as Tata Steel, should benefit. Also, there is a strong possibility that some anti-dumping measures will be announced by the government. JSW has been talking about it, coming most probably in early February. And if that does happen, this can probably help in Q4 as well. I'm not sure whether it will happen in February, but JSW seems to be very confident about it. And let's see what happens there. But that anti-dumping duty, whatever and whenever it is imposed, will definitely help this industry in a big, big way. Let's wait and watch what happens. But this coking coal price reduction has definitely helped, and Q4 should be better. That's what I expect.
Thank you very much for that. Do stay on. Need to slip into a very short break. Some more stocks. Yatharth Hospitals reported their numbers, and it was a muted set of numbers. The bottom line has gone up by only 3.4%. Margins have contracted sharply. From 28%, it's down to 25%. So despite a near 30% increase in the company's top line, because of the margin contraction, profit growth has been flat, and the stock continues to remain under pressure. Remember, just last month in December, I think, they had done a QIP and they raised money at a price of 595, and the stock today is at 424. Canara Bank too is down nearly about 4-5% on the back of a disappointing set of numbers. So the stock is under pressure. IOC, again, a big miss. The numbers were just flashing about 10-15 minutes back. Sudarshan tells us this is the worst set of numbers in the oil marketing companies. Big miss in the company's GRMs, gross refining margins below $4 per barrel versus expectations of $6.5-7 per barrel. So IOC is under pressure, and Swiggy has taken a big knock, 8% down. We'll get into a break and come back.
CNBC-TV18 special coverage here, live from the World Economic Forum's annual meeting in Davos.
If I were to say even heart and mind put together, India is an exciting story.
CNBC-TV18 will celebrate 25 years. The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
Years of covering Davos.
Cement is cheaper in India than potatoes are.
IT services as a business, we are at the cusp of a very big inflection point.
What has the Maha pitch resulted in terms of MOUs?
So it's 60 plus and around $200 billion.
It's a pleasure, let me say this on camera, to speak to the diva of Davos.
We should see a better year than 24.
Like this one, Bharti Airtel came in 2003. When mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth, and that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum, but the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top it becomes so what you call compelling. I can sell the story to even a person like him or anybody, and you sell, while selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you're right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see, we have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you'll get to see 500 crores loss. So I mean I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews, saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money, and HDFC Bank doesn't need to raise capital. And we have met the company, and it is growing 30% per annum, which was the case of HDFC Bank that year, and the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global, this thing, and macro and all that, which right now is again making me do a small mistake, because I think the world is good, therefore India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody I say.
Welcome back. About 5 minutes left for markets to close. The Nifty is still down, close to about 270 points, but above 22,800. The problem is in the broader markets where the pain is running deep and wide. The mid-cap index is down 3%, advanced decline ratio at 1:10. We're in conversation with Sudeep Bandyopadhyay. Sudeep, we were just chatting with Dinshaw Irani of Helios Capital, and he said perhaps this is the time to go out there and buy individual stocks, at least some of them. Be selective, be cautious, but go out there and look, hunt for ideas. Anything that you like?
I think, if you're a long-term investor, definitely this is a time when you should start looking for bargains. One area which I definitely would consider is the pharma. There is absolutely no doubt in my mind that this is one sector which should do well over a period of time. And if you're a safe, and not an aggressive investor, maybe you can go for the biggies, Sun Pharma, maybe Lupin, maybe even Dr. Reddy's. I think these are good bets in this kind of a market from a 1 year plus kind of a time horizon. You can also look at, it's my all-time favorite, Reliance. I think correction has been sharp and deep over a period of time. From 1 year perspective, with the kind of value unlocking which is possible, definitely Reliance can be looked at. Insurance space, I like LIC, and that can be looked at. Some of the platform companies which have corrected deeply, including Zomato, can also be looked at.
Okay, all right. So those are some ideas to go with. We're quickly sort of moving towards the end of today's trade, and it's 1,500 down still on the mid-cap screen. So I'm very quickly taking stock of the key losers today: IDFC First Bank, Loris, Anantraj, a couple of others like Tejas Networks down in a big way. Just to round this off, you mentioned some platform companies. Sudeep, beyond that, there are some mid-cap IT companies. Like I still remember Coforge was a massive mover and some great numbers to back, right? So would you buy anything in IT in this fall?
Well, I've been, positive on some of these IT companies. Look, I don't know what generally IT will perform, but some specific pockets of IT which are catering to segments which are in a, cyclical and structural upswing. Let's say travel and tourism. We all know that travel and tourism is doing fantastic all over the world. So IT companies catering to travel and tourism, whether it's a RateGain Technologies, whether it's Coforge, definitely will do well. And this has been my theory for last 1.5 years. I maintain that, and it's kind of getting reflected in their numbers. Coforge talked about how the airline industry demand is helping them continuously upgrade their performance. So yes, Coforge can be looked at, so can RateGain Technologies, and this correction, whatever correction is happening in these stocks as well, provides an opportunity for acquiring them.
Sudeep, counting down to the close. By the way, Swiggy is at 408, so now getting very close to its issue price of 390, while Zomato, which was above 300, is now down to levels of nearly 205 on Zomato. So the correct has been swift. And the correction has been running deep for many of these platform companies. Well, it's been a tough Monday morning. The Nifty ends down 270 points, holding above the 22,800 mark. But intraday, we did breach that level for the first time since June. Benchmark indices falling more than 1% across the board, selling pressure. But the mid-cap index down 3%, small-cap index similar cut, advanced decline ratio was 1:10. IT stocks led the fall. HCL Tech Mahindra, Wipro under pressure. Other notable losers include Hindalco, Shriram Finance, Power Grid, Tata Motors, BEL. On the way up, ICICI Bank was the only one in the banking pack, along with State Bank of India in the green, and then some consumption names like Britannia, HUL.
Okay, let's now talk about the brutal sell-off in the mid-cap and small-cap arena. By the way, at an index level, while the mid-cap index has sold off almost 3%, the small-cap index is down 4%. That's the extent of the fall. Talking about the losers, we're just outlining some of those names. Look at Swiggy, it's down 9%. Lotus Lab about 12%. Piramal Enterprises about 9%. Big list of losers out there. NetWeb down 13%. It's just been a sea of red across this space. In terms of some of the major result reactions today, CDSL was quite disappointing, 10% lower. Keynes is down about 6.5% as well. There's Canara Bank, which is down about 5%. So these are the negative result reactions. However, imagine on a day like today, Bank of India has managed to do really well. The numbers were quite good. Asset quality improved quite dramatically. Stock was up about 5.5%. Those were some of the key trends that come out. But otherwise, yes, you have to acknowledge the fact that it's been a very painful day for the broader market. Okay, and with that, it's curtains on what has been a manic Monday yet again on the street. 22,817 being the last rate on the Nifty. We'll take your leave on that note. That's the team of Closing Bell, but don't go anywhere because all the action continues. Markets Forward coming up next.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it...
Markets end your day slow, led by a steep sell-off in the mid and small cap indices. Pharma and metal stocks lead the fall, while financials do a relative outperformance.
Stable asset quality paid off for some select banks. Shares of ICICI Bank, Bank of India and DCB surged in trade despite a decline in the Nifty Bank.
Laurus Labs plunges in trade on the back of US order, pausing the foreign aid. The fall was despite the pharma company reporting better than expected numbers. CDSL under pressure after reporting Q3 numbers that missed estimates. Another pharma company, RPG Life Sciences, surges 10% after reporting a solid set of numbers.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I'm Rima and with me is Nigel. Hi.
Well, hi Rima. Today was that sort of a trading session where you'll feel that your portfolio wasn't looking very, very good.
I'm pretty sure it wasn't.
Yeah, but I'll tell you what, history suggests that these are times when you build a good portfolio for the longer term. So I think, as domestic investors and as the retail audience out there, need to keep the faith, keep your SIPs going. In the longer time frame, this actually is a good entry opportunity where you keep your SIPs going. You're getting the similar stocks that you bought via your SIPs, say around a couple of years ago, at lower numbers. So that's why, in fact, the only advice is that to keep your SIPs going. But let's tell you about today's trading session. It was another weak session for the bulls. For the Indian markets on the whole, the Nifty, well, on a closing basis, at least we protected the 22,800 odd mark, which intraday we did go ahead and did break that mark. The Nifty Bank, well, that was the lone spot to go ahead and and hide, because that was a relative outperformer in trade. While the Nifty IT index, a lot of fears with regard to how the AI space is going to turn up, and in fact, some of them, how much behind are they in the game? So that's going to be important to track from here on. But for today's trading session, the fears gripped the street, both for the IT index as well as for the broader markets. You had only around 220 stocks that were advancing, while you had 2,000 stocks that were declining. A weak trading session, Rima.
A full manic Monday today, but let's also tell you what we have for you on our show today. We start with the top movers and shakers of the day with Hormuz. Stock-specific action include Laurus Labs, ICICI Bank, CDSL. We'll get you the key reasons why these stocks were under pressure and finally are reacting positively, and we'll delve into the key market events to watch tomorrow. But first up, it's over to Hormuz now. He's at the big wall with the top stock movers.
It was a sea of red, and that red was a very deep shade as well. It was very difficult to find stocks that were in the green in today's trading sessions. We'll start off with some of those names that were in the red and were down over 10% in today's trading session. And this is beyond the earnings reactions or the usual suspects that we'll be talking about in today's trading session. Look at Anantraj down 17%, Kaplan Point, NetWeb, whose lock-in period ends later this week, that is continuing to sell off, another 12% shaved off today. Nugent Software continues to decline after its results, a 10% down tick today. And Tejas Networks as well, another earnings reaction from Friday, down another 10% in today's trading session. What also did not do well were some of the earnings that were reported today and across Friday. You look at ACC's numbers, volume growth of 21%, but the stock ended at the lows of the day. There were a lot of one-offs in the numbers as well. Indian Oil as well, numbers, a significant miss on estimates, 3% lower there. Canara Bank, a miss on the net interest income front, a 5% downtick there. And Credit Access Grameen, though, is the stock possibly off the afternoon, almost 20% downtick at the start of the session, but since then it was a one-way move upside and ending 2.5% lower, a significant recovery from the lows of the day. Pressure also seen in IT names, courtesy the sell-off that we are witnessing in the Nasdaq futures, with almost every constituent of the IT index ending lower, losses anywhere between 5 to 5.5% in today's trading session. What also did not do well was Pharma, taking cues from the underperformance in Laurus Labs. Most of the other names in the Nifty Pharma index also ended lower today. Look at Gland, Natco and Mankind Pharma too, recovered from the lows of the day but ended in the red. And lastly, some stocks that managed some green in today's trading session, and most of them were earnings reactions itself. Bank of India was one of them, ending at the high point of the day in a session like today's, 6% higher there. Adani Wilmar's numbers were on the good side as well, 3% higher. Torrent Pharma, Kirloskar Brothers and Soba were some of the names that bucked the trend as well today. Back to you.
Okay, all right, Hormuz, thanks a lot for that. Well, those are some of the top movers in trade. Let's go across to our guest. We have Siddhi Bandyopadhyay, Group Chairman at IndiTrade Capital, and Jay Tucker, Head of Derivative Research at ICICI Securities. Jay, go first. We're going down. Manic Monday, as Rima said. Are we overdone on the downside?
Good afternoon to you, Nigel and Rima. Well, see, Nigel, I would say that as far as the index is concerned, and definitely, the way the 23,000 levels have been broken, and in my last conversation with you last Monday as well, I said that the probability of mid and small cap indices, Nigel, breaking their November lows is quite high, and yes, we have seen that happening, and they have fallen quite sharply. Interestingly, what has happened, Nigel, is now 22,700 is the immediate support. I would say that's the most critical support now on the Nifty on an immediate basis. If those levels are held, the probability of Nifty bouncing back in this monthly settlement week on account of short covering is there. Otherwise, if you look at the India VIX, I mean that's already at 18 levels. That's what we anticipated. And it's already in an uptrend which can go until 2021 levels as well. So India VIX, so the volatility is likely to remain higher until the budget at least. And mid and small cap indices have actually fallen below the exit poll results high. In fact, we had seen the dip coming in all the indices on the day of election results, and a day prior to that, Nigel, I would say there was a big huge uptick, and that was the bottom on the day of election day. So that was a huge candle, and a day prior to that, those levels have been now broken as well on most of the indices. So that's very critical level, I would say. So the overall trend still remains down. The momentum is still weak, although there are huge shorts in the market. So there can be some short covering in the monthly settlement week. That trigger could only be seen if Nifty moves beyond the levels of 23,000 now. So above 23,000, one can assume Nifty is reversing, else the trend remains down.
Okay, all right. The trend is down. And what is the support level? We missed that. 23,000 is the resistance. Support is where?
Nigel, 22,700 on an immediate basis. If that breaks, it's 22,500.
Brilliant. Thanks for that. Vinny joins us, though. She wants to tell us about some of the big movers. Loris was down. You had RPG Life that was up, and CDSL was down as well. Vinny, give us the list.
Absolutely. So we have all these stocks that have been in focus today. Loris Labs, mainly numbers which came out on Friday were good, but what is the impact today that we're seeing and why the fall? One, there was Donald Trump has spoken about, withdrawing the funding coming in on WHO. Now, right now, it's a 90-day freeze that is coming in on this funding. So now, because of this, Loris Lab is surely going to be impacted because they cater to a business that is the ARV business, which accounts to 46% of their sales. Now, of that, 20% of the ARV sales come in from this PEPFAR funding. Motilal Oswal is also highlighting that they could see some bit of an impact coming in of this, which forms around 9% of their total business, the PEPFAR sales for the ARV side of the business, and that could be an EBITDA impact of around 4 to 5%. But when we spoke to the management, they said that they are not expecting to see any major impact coming in on this. This side of the business in terms of funding is very insignificant for the company in terms of the business proportion, and for calendar year 2025, they're not expecting any impact on that. So let's keep an eye out on Loris Labs going forward as well. Now, CDSL also is in focus on the back of its numbers. Revenues saw a degrowth of around 14%, driven by the fall in transaction charges, online data charges, as well as other income. Higher employee expenses as well as computer tech expenses so was something that partly offset the decline that we saw, the increase that we saw in other expenses. Margins also saw a very sharp decline coming in, so there was some bit of an impact of that. RPG Life, good set of numbers that was reported by the company. Strong momentum seems to continue for the company in the last few quarters. Revenue growth of 12% led by domestic formulation. Even the international business has picked up pace and has seen a double-digit growth is what the company highlighted, and a strong expansion in terms of margin. So that is why the stock was rising in trade.
Thank you very much for that. Sudeep, there is considerable uncertainty surrounding Loris Laboratories now, even though the management is trying to allay concerns and saying the impact is not going to be very material. But Loris Labs, do you suspect more downside? And if someone is a shareholder in the company, what would you advise?
I will advise them to just keep watching the scenario. There's absolutely no need to panic. I think the management has come out and given a clarification that this will not have a significant impact. In any case, this US exit and stopping of funding of WHO, this entire thing is in a kind of a flux. We'll have to wait and watch the developments. My suspicion is that this may not have a significant impact because WHO probably will, figure out a way of handling the entire issue and ensuring the supplies continue because these are critical supplies. So I'm not too perturbed, but I'll keep watching the space and would advise the same thing to the investors.
Okay, one of the reasons for the fall today is that the street fears that Nasdaq is going to come under pressure, especially the Magnificent Seven stocks. So the Nasdaq futures at one point of time was down in excess of close to about 3%. It precipitated a sell-off even in the European markets when the Indian markets were trading. Now, the reason for that is that, stocks like, OpenAI, which powered a rally in NVIDIA, for instance, right? OpenAI was ruling generative AI, but now there is a free alternative to it, and it comes from China. So China has revealed a similar generative AI model called DeepSeek, and their latest version, which they released last week, actually compares pretty well compared to OpenAI's latest model, which was OpenAI O1. So they're matching each other in terms of parameters, in terms of efficiencies, and analysts are pointing out that this company, DeepSeek, managed to do it at a fraction of the cost. Reports suggest that it took them like less than $6 million to construct it. Secondly, they did it with fewer and inferior chips. And thirdly, they did it in just less than about 2 months. So if it's possible to do that with fewer and inferior chips, then what happens to stocks like NVIDIA, which have rallied close to about 130, 140% last year? So I think that's the fear in the market, that perhaps that AI rally that we had, especially in Magnificent Seven, well, that might get punctured to some extent, and the futures are under pressure. And we had that sell-off, rub-off impact even in the Indian IT names. Sudeep, it's hard to say how this will play out for now. But do you think, given the valuations of the US stocks right now, the rally that we are seeing, US tech stocks could come under pressure, and that could be a reason for a big fall globally?
It's a matter of huge concern as far as top tech companies in US is concerned. This entire rally, which started from somewhere in end 22, was on the back of this entire AI excitement. Whether it's NVIDIA, whether it's multiple other businesses, the AI excitement took them up to stratospheric levels. So if this doesn't require that kind of sophisticated chips costing so much and such amount of time and energy to produce the AI like what DeepSeek has done, I think the entire business case for NVIDIA and multiple other companies will become weak. So we'll have to wait and watch this space. But yes, it's a matter of huge concern and a significant valuation risk, obviously, for the US Big Seven.
Okay, all right. So you would stay away from tech, right?
At this stage, definitely. Fortunately, Indian tech companies, most of them are not anywhere near, developing something with which is comparable with either NVIDIA or the OpenAI or DeepSeek. So the risk also is not there. They never got that kind of valuation either. So Indian IT companies are in a different space altogether.
Got it. Okay, all right. So a little cautious on tech in the near term, but let's find out what's your view on some of those banking names. Abhishek joins us to tell us about a few bright spots in trade. I think ICICI Bank, Bank of India, DCB Bank. Abhishek had a busy weekend. Abhishek, run us through the list.
For ICICI Bank, the return ratios continue to remain impeccable. ROA continues to remain around 2.4%, and ROE for last 13 quarters in a row has been north of 15%. Asset quality continues to see improvement. Their gross NPA ratio is one of the lowest in last 10 years or even more. The core operating profit growth at 13% YOY is one of the best that you are seeing in last 5 quarters. For Bank of India, advances growth was at 5.5% sequentially, which is one of the best that you are seeing in almost 9 years or 35 quarters. Deposit growth, one of the best that you are seeing in 15 quarters on a year-on-year basis. Quarterly annualized slippage ratio is one of the lowest in last 16 quarters, coming in at just 0.7%. For DCB Bank, the risk in balance sheet has reduced. So risk weight assets to advances ratio has come in at 74%, which is the lowest that you are seeing in last decade or even more. Advances growth have been around 7.5% sequentially, which is one of the best growth in this bank for 7 quarters if you take a record. However, it's one of the best growth that you are seeing amongst banks as well. Credit deposit ratio has inched up due to this strong growth. So they are one of the highest that you are seeing in last 8 quarters. Back to you.
Okay, got that. Thanks a lot for that, Abhishek. Well, let's go across to Jay. Jay, coming across to you first. What's your take on the banking space? Any particular bank that you like? Because, if you need to fight back, some of these guys will have to find their form. So what do you like from there?
Absolutely correct. And, this has been one of the, outperformers in the past or the previous two rallies, Nigel. And today also it was outperforming the market. If you see that the kind of fall across the market which you have seen, Bank Nifty was somehow able to hold on to 48,000 levels. I mean, that's a very critical level, 47,500, 48,000. I think Axis Bank from the expiry point of view, this week expiry point of view, I would say that has a good chance of a bounce back because we have seen the open interest addition to almost up to 110 to 120%, in this particular month and, overall. So I think that would be a good short covering out there and we can see the levels of 975 to 990 in the very near term. And Kotak Bank is where we have seen a good strength and momentum and long additions as well. So these are the two banks to watch out for among the private sector banks. Kotak on behalf, on account of long additions and access, definitely from the point of view of short covering, there are huge shorts built up out there.
Jay, earlier Sudeep was talking about the pharma stocks in the, in our closing bell show, and he said he likes Dr. Reddy's, Sun Pharma, some of these larger pharmaceutical names. Any stock technically that you would support as a buy?
Well, see, as far as pharma is concerned, Uma, then I would say right now, like that of IT, pharma also seems to have reversed this trend. It was one of the outperformers in the previous fall, 3,000 points fall of Nifty, which we had seen earlier, October, November. There is where, Nifty Pharma, Nifty IT really outperformed the Nifty. But right now, due to the overall weakness in the market, the overall trend seems to have reversed out here as well. Divis was one of the top performer or the stock which was not falling, and that has also broken the, I would say, consolidation on the lower side. So as of now, I don't see any good pharma names which could be, helping markets or can bounce back or outperform from here on. Most of them are reversing the trend from up to down.
Got it. All right. Sudeep, what about you? Anything you like?
Yeah, of course. I mean, there are a lot of these pharma names which I like, and I mentioned some of them earlier. Apart from that, some of the platform companies, particularly Zomato and Delivery, these are the two stocks I like. And, if one goes out of these platform companies and pharma, some of the IT companies, particularly those catering to segments which are flourishing like travel and tourism. And I did mention about RateGain as well as Coforge. One can look at some of the automobile automation, automobile electrification related technology companies as well, whether it's Tata Technologies, Persistent. These also IT companies can be looked at because they are actually in doing cutting edge work for EV transition for the automobile sector. Some of the auto ancillary stocks as well, I would say, can be a good long-term bet because they are in a space where they can serve both IC as well as EV cars. And some of these companies have become global companies. So whether it's Samvardhana or some of the other companies in the auto ancillary space can definitely be looked at.
Quick word on CDSL. That was the darling of the capital market play. The stock corrected 10% post Q2 numbers. And it's fallen over the last couple of days along with the rest of these stocks.
Well, I think, what's happening is that, when the capital market is down and the IPO and pretty much the entire wind is going out of these companies' sales. So we have to be a little careful because a significant part of their income depends on how the capital market is performing and what's happening in the capital market. So at this stage, considering the valuation at which they were quoting, bit of correction was par for the course, and that's what is happening. I'm not saying that CDSL or BSE or some of these companies, particularly market infrastructure companies, are not a good long-term buy, but not even now because some more correction will make them attractive. But even at this stage, post this initial bout of correction, they still look expensive considering what the market is at this stage and what the market forecast is for the next few months.
Okay, all right, gentlemen, we appreciate you joining in and filling us in with your take on the index as well as individual stocks. For the time being, we slip into a short break, come back, we'll get straight to our popular segment, D-Street Chatter. We'll also tell you all the key market events you need to track. Stay with us, we'll join you on the other side.
CNBC-TV18 special coverage here, live from the World Economic Forum's annual meeting in Davos.
If I were to say even heart and mind put together, India is an exciting story.
CNBC-TV18 will celebrate 25 years. The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
Years of covering Davos.
Cement is cheaper in India than potatoes are.
IT services as a business, we are at the cusp of a very big inflection point.
What has the Maha pitch resulted in terms of MOUs?
So it's 60 plus and around $200 billion.
It's a pleasure, let me say this on camera, to speak to the diva of Davos.
We should see a better year than 24.
Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that. So we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest.
Welcome back. You're tuned in to Markets Forward. Well, let's take you through all the key management voices that we got during the course of the day. The management of JSW Steel says that steel prices have bottomed out and the EBITDA per ton will improve, led by solid volumes as well as lower cost and stable pricing. They also add that the industry is hopeful of a move on the safeguard duty by the first half of February. Next up is IDFC First Bank. The management tells CNBC-TV18 that slippages haven't increased, barring the MFI segment, and the gross NPAs for the MFI segment is 4.5%. They add that the net interest margin will stabilize at 6% as the bank pushes corporate loan growth in line with the retail segment.
Well, we also chatted with Abhishek Lodha of Macrotech Developers on the legal battle with his brother Abhinandan Lodha over the use of the Lodha brand. He says, well, he doesn't wish to wash dirty linen in public, but consumers should not be confused with who can use the Lodha brand. He added that the family agreement explicitly stated that all IPR, trademarks and copyrights belong to Macrotech Developers. On the business front, he is confident about meeting FY25 guidance of 17,500 crore rupees, and they don't see price growth outpacing wage growth. Okay, and with that, it's time to wrap. But before that, we'll get to the key market events to watch for tomorrow.
So absolutely, in terms of key events that we're watching out for tomorrow, on the global market front in the US, consumer confidence data will be coming out. Keep an eye out on that. The two-day policy meet by the Federal Reserve will be starting tomorrow. And finally, obviously, we'll watch out for the Fed decision coming in on 29th. But tomorrow is when the meeting actually starts. Global earnings, we have Boeing, LVMH, as well as SAP, which will be reporting their earnings on the global front. Keep an eye out on that. Domestic front, we have important numbers that are coming in. So in terms of Nifty, we have Bajaj Auto, Cipla that will be reporting numbers. Other than that, important numbers to watch out for: M&M Financials, JM Financials, CSB Bank, TTK Prestige, TVS Motors, Piramal Pharma, Star Health, Motilal Oswal, Arvind Limited, Colgate, among some of the names that I'm mentioning. And these are the list that one should be keeping an eye out on. Corporate action, let's watch out for JSW Infra. They will be meeting tomorrow. Other than their earnings, we'll be also discussing fundraising plans. So keep an eye out on that. And other than that, Thirumalai Chemicals also will be meeting tomorrow for discussing fundraising plans. So these are the important events to watch out for.
Thank you very much for that. And that brings us to a close of this edition of Markets Forward. We'll be back with more news and updates on the other side.
Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Trained. The last time we spoke here, you had given me a number. What does that number look like today in terms of the people that have been trained on AI within Infosys?
So within Infosys, it's a huge number because there are two types of training. One is what we call AI aware, and one is a deeper training where people are using it. The AI aware, which is a broad training, is over 270,000 out of about 320,000 people are in this AI training. And it's really across the board because there needs every discussion with client, every deal, every large deal, every medium deal, there's a lot of interaction on AI. So it's built into many things.
So clients are asking you now specifically for what the AI use case is going to be and how you can contribute to that?
Clients are interested in where generative AI can help them. And what we are seeing is through agents or through small language models, in the past through large language models, we have various ways in any large transaction or program where they can benefit from this AI. And so we are using it and they are quite happy with it.
So what is this going to do? Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a manic Monday on Dalal Street as weak global cues rock sentiment. The Nifty down to its lowest level in 7 months. Mid-cap index now down 15% from its record highs. All sectoral indices close in the red. Tech stocks are selling off across Europe and US. This after Chinese AI platform DeepSeek becomes the most downloaded app on the Apple Store in the US within weeks of its launch. This raises questions about US companies maintaining their dominance in artificial intelligence. The government invites applications for the post of SEBI chairperson by the 17th of February. The 3-year tenure of the current chief, Madhabi Puri Butch, ends on the 28th of February. She was the first person from the private sector to lead the institution. A fresh twist in the battle to control Religare. A US-based hotelier, Danny Gaikwad, throws his hat into the ring, approaches SEBI to make an open offer to buy 55% stake. The Burman family says Gaikwad has not made a competing offer and the request before SEBI lacks substance. Abhinandan Lodha cannot use the Lodha brand name as it belongs to Macrotech developers, says Abhishek Lodha. The brothers are embroiled in a 5,000 crore rupee trademark lawsuit before the Bombay High Court. India's Foreign Secretary Vikram Misri meets China's Foreign Minister Wang Yi in Beijing, both nations attempting to revive the bilateral relationship after the Galwan Valley clash between India and China that killed soldiers 5 years ago. The US and Colombia pulled back from the brink of a trade war. The Trump administration puts tariffs and sanctions on hold after the South American nation agrees to accept hundreds of deported immigrants from the US. Tens of thousands of displaced Palestinians returned to their homes in northern Gaza for the first time since Israel war began. Israel and Hezbollah also extend their ceasefire in Lebanon to the 18th of February. Aam Aadmi Party chief Arvind Kejriwal releases the party's manifesto ahead of the Feb 5th Delhi elections, promises monthly financial support for 2,100 rupees for women, free bus travel for students, free healthcare facilities for senior citizens, among others. All of that and more coming up, but let's start with the sell-off that we saw on the Lal Street today. The Sensex lost over 800 points and the Nifty dropped below 23,000 in what was a manic Monday on the Lal Street. That's the screen there, a sea of red. 824 gone on the Sensex, 263 on the Nifty. The Nifty mid-cap 15% off from its record highs, down over 1,400 points today and 650 points lower. That is the Nifty small cap index. Of course, weak global cues have also weighed on our markets. All sectoral indices, as I pointed out, closing in the red. Prashant is standing by now to wrap up the market action for us. It is a very weak picture as we get into trade this week, Prashant, and of course not being helped by what's happening globally either.
There are mostly all old worries, Shireen, but there are some new ones as well, as you pointed out, especially from the global arena. So, it's starting to hurt. And it has actually, to be fair, been hurting portfolios for a while now. Because, while the graphic will come up, which shows you how much we are down from the highs for the Nifty Bank, for the mid and the small cap part of the market. 13%, right, can live with it. But the point is, the broader market, stocks and one's portfolios are down between 30 and 40%. This is, of course, just the indices. Nifty Bank is down 12. Mid-cap index as of today's close from the highs is down 15. Small cap index is down about 17%. Actually, for the mid and small cap part of the market, losses have accelerated over the last 10 days or so. They were at par with both how much the Nifty or the Nifty Bank was down. These are sort of sectoral sort of cuts that we've seen. PSU Bank index is down 24% from the highs now. Again, CPSE is down 24%, which basically means an index is down, has lost about 0.25% of value, which means stocks are down 40-50% in some cases. Oil and gas, 25%. You've got the metal index, which is down about 21%. Auto, real estate, FMCG are some of the others. And this is the part. Real estate companies, and real estate is especially important because, it connects to so many other things in the economy. Many real estate companies are starting to talk about the fact that whether the urban slowdown that we are seeing will start to actually impact home sales. We had Abhishek Lodha with us earlier this morning actually sort of talking about it. Said so far they're not seeing any slowdown, but it's something to sort of be cognizant of. Now, as I said, just a combination of some of the older worries and of course, some new ones at the margin as well, high valuations. Just to give you an example, the median PE multiple of NSE 500 companies is around 40 times. Now, that's the median. And if you take out some of the lower price, cheaper companies, actually this number goes up, jumps higher. You can always argue and say that high P multiples are not a new phenomenon. It's been there, has been around for almost a decade now. This big step up in valuations, P multiples that we've seen. But I think this is something which I think comes to bite when markets look a little vulnerable. Of course, single digit F525 EPS growth is what we're looking at now because the slowdown started in the second quarter. There were some hopes that Q3 will be better, but I don't think it's panning out that way, which means that the full year FY25 number is basically going to leave us with somewhere around 9-10% kind of growth. And then, which means that FY26 earnings growth estimates will also need to be brought lower over the next one quarter or so. Tight liquidity has been, of course, has been spoken about quite a bit. And now I think it's the clamor is rising from market participants saying that some relief is needed. And some, lots of sell-side mainstream economists are also starting to say that actually, we need to see some action on that particular front. On the fiscal side, of course, the union budget is in front of us on Saturday, the 1st of February. Will the government acknowledge the slowdown with some measures, and what can they do? I think those are important questions as well. And of course, the new worry at the margin, and this is this is the new one, right? Because the question is this: will China's DeepSeek startup and the product that they've launched call into question the billions being spent on AI capex on companies like Nvidia, etc., which has basically been singularly responsible for this big, huge upmove in U.S. market? So, and that's a new thing which has been thrown into the mix, which has kind of complicated matters. I would have said that given the correction that we've already had, markets perhaps were at a point where we at least start to see a bit of a bounce. But with the fact that the last point that I mentioned with regards to global markets, with this DeepSeek thing, I think we are still in wait and watch mode, whether that will really cause damage or, it's something which will actually pass over and U.S. markets actually will be really unhurt in the larger scheme of things. So I think lots of things to track. It's a bit of a flux out there. But I think one thing absolutely clear, portfolios hurting out there. Back to you.
Yes, portfolios are certainly hurting, but of course, in the US, we've seen that mega tech rally, and whether this is just a bit of a breather or a pause is the big question, or whether it is going to be more sustained. Thanks very much, Prashant, for joining us. Now, tech stocks routed across Europe and the US after a little-known Chinese AI startup called DeepSeek became the most popular app in the US within weeks of its launch. So what is DeepSeek exactly, and why is it worrying the West? Rima joins us now to explain. Rima.
Thanks so much for that. Call it the AI showdown, the face-off. But, things are hotting up between ChatGPT, which was dominating generative AI so far, and the new kid on the block, which is DeepSeek, which is a Chinese AI startup. Well, till 2 months back, or even a month back, you probably wouldn't have even heard of DeepSeek. But it rose into prominence in December of last year when they unveiled their free large language model, DeepSeek V3. Now, this was positioned as a it was positioned as a free alternative to ChatGPT, OpenAI's ChatGPT. But the real deal came last week, on the 20th of January, when DeepSeek released a more advanced model, their latest model, DeepSeek R1, and their performance matches up in terms of efficiency to OpenAI's latest model, which is OpenAI O1. In fact, Satya Nadella, when he was asked, and he's a Microsoft CEO, when he was asked at the World Economic Forum about this, he said we should take the developments out of China very, very seriously. Now, here's why scientists are quite excited, but analysts, Wall Street analysts, are quite worried. For one, DeepSeek, again, it's a Chinese AI company. It's formed by this hedge fund. And this was actually made using fewer and inferior GPUs compared to the NVIDIA chips that were used for making OpenAI's ChatGPT. That's reason number one. Secondly, according to reports, this was built in less than 2 months, and the overall cost was $5.58 million, a fraction of what it took for OpenAI to build ChatGPT, which is why analysts are thrilled, but Wall Street is a bit worried. And talking about the fear on Wall Street's mind, is that will DeepSeek be the pin that bursts the AI bubble in a way? Some who believe that perhaps the tech stocks, the AI stocks like Nvidia, which have had a fantastic run-up of 135% last year, was that getting a little excessive? And will they get a reality check? Which is why NASDAQ futures too have come under pressure today.
Well, this is like the ChatGPT moment 2 years ago. DeepSeek causing a fair degree of concern across Wall Street and, of course, in the AI circles as well. Thanks very much, Rima. And speaking of ChatGPT, top Indian media outlets are joining the copyright fight against OpenAI. According to reports on Reuters and the Hindustan Times, a clutch of media outlets will join a lawsuit filed by news agency ANI, the digital news units of Network 18, NDTV, Hindustan Times, Indian Express, along with the Digital News Publishers Association, have filed an intervention application before the Delhi High Court. The case will be heard by the court tomorrow. In their application, the media outlets accuse OpenAI of violating intellectual property rights by using their content without authorization. OpenAI and other AI companies face multiple lawsuits across the world from news organizations, authors, artists, musicians for using their copyrighted work to train their AI models without permission. So this is going to be an interesting one to watch out for. On to the money market, where the rupee weakened against the US dollar. The rupee weakened by 13 paise. It remains above the 86 mark. There was a rally, though, in the bond market, with bond yields dropping to a 3-year low. The RBI bought bonds worth 10,000 crore rupees between the 15th and 17th of January. This has boosted sentiment in the bond market. And here's another big story that's moving the forex markets worldwide. The US and Colombia have pulled back from the brink of a trade war. The Trump administration has put tariffs and sanctions on hold after the South American nation agreed to accept hundreds of deported immigrants from the US. Take a look.
The U.S. and Colombia pulled back from the brink of a trade war on Sunday. U.S. President Donald Trump had threatened tariffs and sanctions on Colombia for refusing to accept military flights carrying deportees as part of his sweeping immigration crackdown. But late on Sunday, the White House said Colombia had agreed to accept the migrants after all, and Washington would not impose those penalties.
El gobierno de Colombia.
Colombian Foreign Minister Luis Gilberto Murillo on Sunday said his country's government had, quote, gotten over its impasse with Washington. Earlier, Colombia's President Gustavo Petro had condemned the military deportation flights and said that he would never carry out a raid to return handcuffed Americans to the U.S. However, he also said that Colombia would welcome home deported migrants on civilian planes and offered his presidential plane to facilitate their, quote, dignified return. The Colombian statement did not specify whether the agreement it had struck with the U.S. included military flights, but it did not contradict the White House announcement. It added that Murillo and Colombia's ambassador to the United States will travel to Washington in coming days for follow-up meetings. The use of U.S. military aircraft to carry out deportation flights is unusual. Some of them carried out 2 flights to Guatemala on Friday, while Mexico also refused a request last week to let a U.S. military aircraft land with migrants. Trump has said he is thinking about imposing 25% duties on imports from Canada and Mexico on February 1st to force further action against illegal immigrants and fentanyl flowing into the U.S.
So the US and Colombia pull back from a tariff war. Indian Oil Corporation shares tumbled after a weak quarterly performance that largely missed estimates. Revenue was slightly above expectations, rising 11.5% sequentially. However, both profits and margins were far below estimates. LPG under recoveries for the quarter of 14,325 crore rupees further dented the company's profitability. So that's IOC for you. A fresh twist in the battle to control Religare Enterprises. US-based investor and entrepreneur Digvijay Gaikwad has sought permission from market regulator SEBI to make a counter-offer for Religare Enterprises. He revised his open offer and has bid for 55% stake in the company, but the Berman family believe Gaikwad's move to approach SEBI lacks substance. Vivek joins us now with more on this acquisition battle. Vivek.
Well, in a surprising and interesting twist in the Berman family versus the Religare board feud, there was a very important development that took place over the weekend. A US-based investor, Digvijay Gaikwad, approached SEBI to make an open offer for Religare Enterprises. In fact, he has written 2 letters to SEBI over the weekend. The first letter going ahead and offering to buy close to 26% stake, and then subsequently revising that particular open offer to buy up to 55% stake. Remember, the open offer price that he is offering to make is at 275 rupees a share, a premium to both the current market price as well as the Berman family's offer price of 235 rupees a share. However, there was an immediate response from the Berman family. They've claim that Gaikwad has not made any competing open offer. In fact, he's just requested SEBI's permission to make an open offer. Along with that, they also state that he's missed a 15-day deadline to make a competing offer after Berman's public statement. Along with that, they say that the request lacks substance with no source of funds or capacity to purchase shares. They also say that Religare is accused of recklessly disseminating the letter to mislead public shareholders. It is important to note that today is the day in which shareholders can go ahead and tender their shares as far as the Berman family's open offer is concerned. What is the way forward? Well, number one, what is SEBI's response to the open offer and whether they allow Gaikwad to go ahead with this particular open offer. Along with that, they also have to determine whether the offer was made on time. Also, remember, when you're talking about this particular open offer, it has to be made through a merchant banker. And also, there will be worries about what will be the FII ownership limit allowed as far as Religare Enterprises is concerned. In fact, we spoke to Gaikwad himself. Gaikwad said at this point of time, they find significant value as far as Religare is concerned, and they believe that their offer is a much better offer compared to what the Berman family is offering to Religare shareholders.
It's nothing out of blue. Any offer you give, it's always be out of blue, because I saw the value and I thought that it's a good value to go after. I did a very, very reasonable offer. Because in America, if you look at it in US, most of the offers are at the closing time stock, and then you get it about 17 to 20%, 15%. That's all I did. This is nothing extraordinary or no other event. I don't think so. Is this some kind of criteria that you have to own, otherwise you can't own? Don't you have always the first try, first attempt, first time? Maybe not India, but I have a lot of experience in America.
Well, that's Danny Gaikwad there on making that open offer for Religare. Lodha brothers Abhishek and Abhinandan are slugging it out in the Bombay High Court over the use of the Lodha brand name. Macrotech developers have sought to stay on the house of Abhinandan Lodha using the trademark. Meanwhile, Abhinandan Lodha maintains that his use of the brand name has not caused confusion in the market. Ashmit is standing by with more on the court's observations on the matter. Ashmit.
Well, it all boils down to a sparring session between the two brothers on who gets to use the Lodha brand name. What Macrotech Developers has done is that they filed a 5,000 crore rupee suit in the Bombay High Court where they're saying that only they are entitled to use the Lodha brand name, that any use of the Lodha brand name by Abhinandan Lodha is in fact illegal and unlawful. They go back, Macrotech Developers goes back to a settlement agreement that was reached between the two brothers. That Abhinandan Lodha shall not be using the Lodha trademark in any shape or form. Abhinandan Lodha on his part is saying that, look, I have been the one bailing them out of difficult situations. I've been giving them NOCs, bank guarantees. I've been inaugurating various functions of theirs, but now they're coming back to sue me. Abhinandan Lodha goes on to say that there is no confusion in the market. There's the Lodha brand name, and then there's the one which he's using, which is the house of Abhinandan Lodha. Having said that, the Bombay High Court is insisting that there is a need for perhaps a push at settlement and allowing the parties one more day's time to go back to the drawing board to figure out what they need, to figure out a way of settling this dispute. The Bombay High Court saying we're even open to the idea of having a CJI help mediate between the two parties. So an answer to that question expected tomorrow.
All right. Many thanks, Ashmit, for joining us. Abhishek Lodha has said that his brother Abhinandan Lodha cannot use the brand name as it belongs to Macrotech. Speaking to CNBC-TV18, Abhishek Lodha said the use of the brand name by his brother has confused customers. Take a look.
But I can tell you in no unclear terms that the family agreement explicitly stated, and that time we were a private company. It was well before we became a listed company. It explicitly stated that all brand, IPR, trademark, copyrights of the group will exclusively and solely belong to Lodha Developers or Macrotech as it is known now. And Abhinandan or any new business that he starts cannot use, and I emphasize these words, cannot use the same in any manner whatsoever.
The battle between the Lodha brothers. We'll take a break, but up next, India's Foreign Secretary Vikram Misri meets China's Foreign Minister Wang Yi in Beijing. That and more when we return. The need to scale down hiring? Do you believe that you will continue at the pace that you are, or you may even have to look for more?
I think that you won't have to scale down at all. I do think that over time, and at least we've seen this in our software portfolio, that there is a certain non-linearity between number of people hired and actually growth. So I think that more and more not looking at them as, a direct correlation is something that will happen. But for example, in our engineering services in ERS, even though almost 80% of now, let's say, coding can be done through AI. But then what we are training our engineers is how to build applications on top of it and how to do a lot more of design around it.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting
India's Foreign Secretary Vikram Misri met with his Chinese counterpart, Foreign Minister Wang Yi, in Beijing. This is the second high-profile visit by an Indian official to China in a span of 6 weeks. Both nations are attempting to revive the bilateral relationship, which deteriorated in the aftermath of the Galwan Valley clash 5 years ago. Parikshit is standing by now with more details. Parikshit, what's the expectation? What is the hope that the MEA has with regards to this meeting?
Ever since Prime Minister Modi and President Xi Jinping reached a consensus at Kazan in Russia on the sidelines of the BRICS meeting, there have been efforts to reduce tensions at the border and also tensions in bilateral relations. Now, as a result of that, Foreign Secretary Vikram Misri has traveled to China for Foreign Secretary level talks. Now, in China, this is called Foreign Secretary Vice Ministerial talks. So, Vikram Misri met his counterpart Sun Weidong, who is the Foreign Secretary in China. He also met Foreign Minister Wang Yi, and he also met a senior member of the Chinese Communist Party, the international wing of the Chinese Communist Party. Now, Wang Yi communicated to the Indian side that both India and China must work for mutual benefit, must try and meet each other halfway, and not work towards increasing mutual suspicion and mutual depletion. The expectation from the Chinese side is to increase the economic engagement as much as possible, resume the issuance of travel visas for both tourists and businessmen, and also reduce the criminal action that we've seen against Chinese companies, also the action against betting apps which have been banned by the Indian government. On the Indian side, one of the immediate concerns is the building of a Chinese dam in the Tibetan plateau. Now, this concerns us because there is a worry that the flow of Brahmaputra into India would be impacted, renaming of places in Arunachal Pradesh and along the India-China border. Now, this seems to be a strategy by China to naturalize, normalize its disputed claims over these regions. So this is something that the Indian side is protesting over. And then having cross-border trade, opening up of the Kailash Mansarovar Yatra, these are some of the concerns on the Indian side. Let's see what kind of arrangement does India and China come up with in the days to come.
All right, Parikshit, many thanks for joining us. Now, thousands of displaced Palestinians have returned to northern Gaza after Israel and Hamas reached a deal to free 6 hostages. The displaced people returned home to their loved ones for the first time since the war began more than a year ago. The US and Lebanon have also announced the extension of the Israel-Hezbollah ceasefire deal till the 18th of February. This after the Israeli forces failed to withdraw from southern parts of the country and killed 22 people while they were returning home. Meanwhile, Palestinians have condemned US President Donald Trump's proposal to clean out Gaza. Trump has proposed to forcibly displace Palestinians to Egypt and Jordan. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. You're watching CNBC TV18. We're back in a moment with more.
into their businesses from top Indian honchos before putting your money on the line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that would also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and say,
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. Our per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prologue, that what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether the industrial licensing was scrapped, whether the socialist statist economy went through.
Hello and welcome to this special show, the Budget Town Hall. I'm Prashant Nair. The FY26 Union Budget will require the government to attain a tough balance between fiscal consolidation, capex-led growth and a boost to consumption. While everyone recognizes the importance of continued fiscal consolidation, the demand for some measures aimed at arresting the current cyclical slowdown is also there. The stock market, which has been correcting for a while, and has been a creator of such powerful wealth effect over the last few years, has also been falling. The Nifty is down some 13% from its all-time highs. The Bank Nifty is down 12%. The mid-cap and small-cap indices have come off between 15 and 17% from their respective all-time highs. Stocks, of course, have fallen anywhere between 30 and 40%, depending on what you look at. Real estate companies have started to wonder if the urban slowdown will start affecting home sales now. Can the government somehow put more money in the hands of the middle-class consumer? can the government use the budget to turn sentiments around? That's essentially the question we will try and discuss and debate here with three sort of market men who really need no introduction. Anish Tawakle is with us, Pankaj Tibrewal is with us, and so is Harish Krishnan. Gentlemen, great to have all of you here. Thank you very much.
Thank you.
So once again, we find ourselves at the cusp of the union budget, and expectations usually run high, but I have to say that this time it's a little subdued. I mean, I don't see anything big in terms of expectations out there at all. Pankaj, why don't you begin? What should we really expect at a high level, top down?
So, Prashant, I think we need to address three things. I think as a country, we are too obsessed by expenditure side. Though fiscal is very important, I'm not denying that fact. But over the last 3 years, our tax collections have stagnated between 8.8 to 9.2%. We got a tailwind when COVID hit, but after that, tax collections has been virtually stagnant. Elasticity is not being seen. So I think we have to start thinking about
on the
growth.
corporate tax side.
On the corporate tax side.
Personal income tax is
personal
essentially...
income. I'll come to that.
Yeah.
That the reason we are seeing personal income tax growth is largely because of the capital gains and STT. Our estimate is that 5 years back, that number was virtually negligible, 20,000 crore. This year, we are looking at a number of 2.5 lakh crores. So that's linked to markets. So if market doesn't do well, that collection will not be as buoyant as we have seen. My only thought is that at 4.5, mathematically, if you look at, if we are at 16 lakh crores of fiscal deficit and economy grows at 9.5, 10%, that 4.5, 4.6% will be achieved any which ways. So rather than getting obsessed further to take it to 3.5 and 3% as FRBM, we should cap at some point and start to think about the fiscal space and growth. And I think if government starts to think in that manner, that absolute debt to GDP is also very important, rather than only the fiscal deficit number. I think you will see growth coming back from a very different animal.
You're saying cap the target to about 4.5?
4.5, just do it for the time being.
But that is where it is now, right?
It will be.
So FY26 is 4.5.
Your budgeted number or FRBM targets.
Yeah, correct. But if we don't know whether they will put out a roadmap
for that part.
I mean, it's possible.
So my wish list would be cap it at certain percentage, focus on growth, get the pie bigger, so that your expenditures are taken up, because 75-80% of your expenditures are sticky in nature, any which ways, which is interest, wages, pensions, all those things. So you need to get the pie bigger.
Okay, let me ask you whether some help is needed, not whether it can be done now, immediately in the budget.
Two things you can do it.
Yeah.
So one, I think we have not done a great job on disinvestment. We have seen the...
No, I'll come to this. I'm saying from a spending perspective. Do we need some help?
Yes, we need some help. I'll tell you why.
Yeah.
If you go into the details of the capex, the 11.5 lakh crores, 1/3 of that capex has a lower multiplier. Let's look at the four heads. One is 65-70,000 crores has been parked with DEA, Department of Economic Affairs. I don't know why is it that, but that number is there. Then you have that number on the Home Ministry for upgradation of police. That is parked in the capex side. Then you have the defense, which globally has a multiplier of 0.6 to 1. Roads, infra, others have a multiplier of 1.5.
Sure.
And then you have the telecom, which is 85,000 crores, where you funded BSNL and others, which hardly has any multiplier effect. So I think 1/3 of that capex, if it start to put in higher productive use, you suddenly see that multiplier effect playing out. 11 lakh crores plus state of 6-7 lakh crores is not a small number, plus private sector capex. So I think we need to think about the capex part in greater detail, and then also look at disinvestment, which has been very, very smaller.
Harish, your thoughts? First of all, do we need help? And will it come from the fiscal side or from the government? Yeah.
So I think let's look at budget as a policy making, or let's say Modi 2.0 and of course the last budget as well. I think there's been a marked shift towards supply side reform as the key tenet of budget policy making, right? So be it in terms of announcements of PLI, corporate tax cuts, various logistic initiatives, everything that aids productivity is what's primarily mentioned in terms of the budget. To our mind, therefore, demand side is something which is kind of gone a bit out of sight from the from the budget as a process. Possibly the government believes that they can do it in other measures. It need not necessarily be in the part of the budget. The second, and I think something which is very timely for us to assess at this point of time, is that we had in May of 2024 S&P putting us on a watch list as far as a rating upgrade potentiality is coming through. And they had very clearly articulated, among many things, two clear identifiers or markers that they are going to monitor. One is the fiscal glide path, a combined fiscal deficit of 7%, and then the credibility of the RBI to maintain inflation in its band. These were the two key things. And this, to my mind, has kind of created a kind of a counter-cyclical policy response over the course of the last 12 months, wherein you've seen tightness both from the fiscal side and you've seen tightness both from the monetary side. Now, having got into the watch list as late as, say, about 9 months ago, and S&P says that they take a decision between 6 and 24 months, I would think that the government may not necessarily use the budget to make a big shift moving to demand side creation. However, given that there's been a change in the governor, at RBI, we think that the monetary policy opens up a range of possibilities. And it's just not about rates. There's been a whole amount of measures that may have signaled to various lenders about, wanting to cut down on credit growth. And one could see varying signaling instruments that can kind of, remove these layers out, which can help create the velocity. And therefore, possibly, I would suspect that while demand-side boost is necessary, I still think that it may come potentially outside the ambit of the budget. While, of course, there will be some relief to the lower sections of the society, there would be some relief to the lower middle class, maybe the new tax regime, etc. But the big heavy lifting of demand side, I think potentially outside.
So you're not expecting anything big? Let me put it that way. It's nicely contextualized, but from a budget, from how relevant it is for the market, for stock markets, you don't think...
I think staying the course is actually a very big positive. And I think there's no shame in admitting that we've got a very good fiscal prudent budget. I think it also has to be seen in a relative context. Across the world, you're seeing governments going haywire with very high debt to GDP. And mounting further, there are economies...
No, in the context of we've got a bit of a slowdown at our hands. So in that context, we probably need something, and you're saying it'll come from outside the budget?
I think the easier bullet to fire would come from the monetary side rather than necessarily from the fiscal side.
Anish?
So, to answer your question, do we need a stimulus? I would think the answer is clearly yes. But I would agree with Harish that if you were to choose between a monetary stimulus and a fiscal stimulus, I would prefer a monetary stimulus. See, the advantage with a monetary stimulus is that it can be reversed once the economy picks up. Whereas a fiscal stimulus tends to become entrenched and it becomes very difficult to then reverse it. If you look at sort of history, right, and if you saw what happened in the GFC, things are nowhere near as bad as the GFC, but let's look at what happened there, right? We got a big fiscal and a monetary stimulus. The economy recovered very quickly. And that was very good. But the mistake that happened was that we didn't pull back the fiscal stimulus after the economy recovered. And then we got overheating. So if you were to choose between a fiscal and a monetary stimulus, I would definitely go with a monetary stimulus. To the extent that we are using fiscal, I would love to see something more on urban infrastructure, particularly metro development, because I do think housing is fundamental.
It's been a long-standing
view of mine. And if you saw that, even when the economy picked up momentum over the last 3 years, housing was a big driver of that. So I do think a combination of monetary easing and, some little bit of stimulus on the urban infrastructure side would go a long way in addressing the current soft patch that the economy has hit.
And relative on the urban infrastructure side, relative to what we've seen, does it need a big pickup or more spending? Just in terms of
I think
specifics?
the monetary easing would also help, right?
Not monetary easing, I'm saying in the budget, spending on urban infrastructure.
Yeah.
Do we need a big
I think
step up jump in allocation or something, or what are you expecting?
No, I'm not expecting. I wouldn't say I'm expecting. I'm saying that would be the most, in my view, the best use of resources to the extent that they have the resources and they're willing to spend it. But on urban infrastructure, I think there is, as far as the need is concerned, it's phenomenal, right? So I don't think that I would ever say, oh, they've spent too much on urban infrastructure. I mean, the more metros we have, the more housing development we can spur, it would be a good thing. But having said that, I agree with Harish that there is no need we are not at that alarmist stage of the economy where we need to abandon fiscal prudence. And therefore, I would expect a little bit of help I would like a little bit of help on urban infrastructure and a lot more room from the
monetary side.
Yeah.
Okay, let's just, since expectations are generally, all three of you would agree, running low. So let's use our time the best. One or two sort of pointed things from the budget which kind of links back to the market in specific ways that you think are meaningful. I think, as Anish said, urban infrastructure is one. Pankaj, what would be?
My sense is that this investment has been a very big spoil sport. We have been able to do only 22% of our targets in the last 5 years in a market which has been super buoyant. And 66 CPSEs are listed.
The CPC index is lost 0.25% of its value.
So now the market cap, which was 37 lakh crores, probably would be lower. Can we generate that non-tax revenue part and fund it to the capex? If overall your tax collection is not going up, can we use the non-tax part? I think that will be something which we will work out very, very closely, and that's one thing which I would expect. Second is the granularity in the capex side, which I said. More projects which could have multiplier, as Anish mentioned. Urban, unfortunately, is a state subject. Can you have a model where center can support the state in developing that urban infrastructure? It may take some time, but I think that can be a great model over a longer periods of time. So if you start doing and thinking about growth in that aspect, I think markets will respond automatically over a period of time. And no tinkering on capital gains from a market perspective. I think that's the worry which most of the market...
Is there a worry this time at all? Or because I think last time...
You never know, because there is a worry that alignment of long-term, short-term across asset classes has to be there. So there is speculation in the market that can this time around be 12.5, be 15, and so on and so forth. So I think doing nothing will be a good thing because the sentiments right now are very fragile. Corporate earnings growth is not keeping pace with the expectation, and that's been reflected in the market itself. So I think keep a status quo budget. The speech will make a lot of difference in my view in terms of what we are thinking about in the next 12 to 18 months from an economic standpoint of view.
Harish?
So I would say that continue with the corporate tax cut for new manufacturing. I know that
we reported that for new manufacturing units,
that's
the 15, right. It may not be 15%, but 18%. I mean, but
no, I think it's still worth persisting with that. I know that private capex has been a lot lesser than what any of us anticipated, and definitely lesser than what the government expected. But we do see a two-track investment cycle happening, wherein we are seeing, at least on the conglomerate side, there are about 30 large business houses which are actually starting to re-leverage. So if I were to give an analogy of a car, they have moved from the first gear to the second and third gear. The vast swathe of rest of companies are still in the first gear. And I think we need somehow to create a payback period for this capex, a success story for the rest of them also to join into the bandwagon. So because at this point of time, maybe corporates have become a bit too obsessed with ROE and ROC. These are all great things. Nobody is saying that we should abandon them. But
fund manager complaining about corporates obsessing about ROE.
Yeah, but I was just saying...
No, I could take your point. I'm just joking. Please.
Yeah, but if all decisions are by the head, okay, then possibly you won't get the right decision, right? There are some decisions that need to be taken from the heart. And when I say that, capex decision, if it is left to, say, the CFO, okay, typically comes from a logical, and we love that as money managers, risk managers, we like that. But there needs to be some decisions that need to come from the heart, and that needs to come from the entrepreneur, the promoter. And I think it's still time to persist with giving them that glide path that, hey, invest in India. This is the best economic prospects that you have, and we'll continue to keep supporting. So I think even though it may be seen as, favoring the capitalist class again, but I think that would be a great thing. The second thing, if I may, would be, if at all you're doing something on the demand side, do it also for the old tax regime. Just don't keep it with the new tax regime. I think this tax forgoness is, of course, is a true statement of what the government loses out. But in terms of its ability to signal sentiment change, is a lot lesser. And when actually people see that there is a difference across the board, that is when I think it will start spurring. So if you're doing that route, keep it for both. Those would be my two.
Okay, I have to take a quick commercial break, gentlemen. So let me do that. We come back and continue this conversation with our market experts, budget, FY26, what to expect. And of course, we'll talk about markets as well, which are kind of precariously poised right now. Stay with us.
Post-89, because India was in such a horrible shape at that time. And my friends who kind of understood that with the simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
So markets will always be mispricing. But mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. You know, so that was a kind of scorching growth, and that's where kind of we used to take plunge. And but there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum, but the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top it becomes so what you call compelling. You know, I can sell the story to even a person like him. Or anybody, you know, and you sell, while selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, you know, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see, we have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you'll get to see 500 crores loss. So, I mean, I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money and HDFC Bank doesn't need to raise capital. And we have met the company and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global, this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody I say.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down.
Welcome back. You're still watching our market special, Budget Town Hall, and we are sort of debating, discussing what can be done, what should be done, and what will be allowed to be done as far as the budget is concerned this 1st of February on Saturday. Anish, Pankaj and Harish are with us, and we are talking to them. Gentlemen, thank you very much for waiting. One thing which everybody recognizes we need to kind of focus on is jobs in a very big way. And how do we get there? Harish, you believe that maybe focus on what kind of sectors? What should be the focus really? Because I think I know where Anish stands. It's housing is a pet kind of sort of subject close to his heart. Construction. Harish, what about you?
I think the direction that we have gone in terms of, say, the EMS jobs, these are low value add jobs. But there is a path to potential productivity benefits over a period of time. And we have to start somewhere. I would say that, even the gig economy is possibly a good way in which a lot of this, shadow labor, which otherwise is not finding jobs anywhere else, can get through. So I think more and more of these is possibly a solution rather than worrying about them whether they are adding value to the economy. So therefore, directives which help them flourish, I would say would be far, far more welcome, which the government in its wisdom maintains that and is continuing to persist with.
Pankaj, the electronics components PLI, I think we'll hear about it in the budget. You think that's, we need more of it, or you think the direction is largely set? Wherever the PLI schemes are required, it's been kind of announced and they need to be expanded, maybe the scope needs to be expanded like in the case of EMS. What are your thoughts?
I think we need to make the PLI work more effectively. Let me share a data point with you. So about 1.9 lakh crores is the total outlay by the government today. But we have only disbursed about 12,000 crores. So the schemes overall in spirit is looking great, but the execution in many sectors is missing. Except electronics and mobiles, which have been at the forefront of PLI implementation, many sectors have struggled to implement PLI. Also, I believe that auto industry is one of the largest employment generators, and it has a huge multiplier impact. Can we think about implementing effectively the PLI in the auto? And if we can do that, you will see huge investments coming in.
Which means that the PLI needs to be changed.
Tweak it, make it more effective, implement it. Otherwise, becoming a manufacturing base will be only a dream. We probably cannot achieve that. And mobiles have shown that we can do it if you really implement it well. Electronics, entire ecosystem is showing that. Semiconductor entire ecosystem has started to buzz. So I think if we can do that repeatedly in many other sectors, I think that could be a great opportunity for us from an employment generation perspective as well as growth perspective. And this is at a time when, the entire world is in a volatile environment. You don't know what Trump will do next to China, Vietnam, Mexico. So we have a great opportunity out here. And only the implementation is something which we need to be laser focused. I would have been really happy if I would have seen a large amount on the PLI being dispersed.
Which has not happened so far.
Which has not happened so far right now.
So let me turn that around, right? If there is a great opportunity, why do we need PLI? That's a simple question, right? Markets should fund that opportunity. And I find the market's response to PLI also a bit odd. A company gets a PLI of 1,000 crores. Its market cap goes up by 20,000 crores. That is saying we in the financial markets are so short-sighted, so myopic, and so lacking in understanding of business that, hey, there was an opportunity to spend 1,000 crores and create 20,000 crores of value. But with all the mutual funds of the world here, with all the private equity investors of the world here, we could not spot this opportunity. I don't agree with that. So my point is, look, ultimately manufacturing will follow if there is demand. The demand can come from two sources, either exports or domestic. Exports, why do we need exports? To pay for our imports. Our current account is already fine, right? There is no problem in the current account. So if we can meet our current account needs with services exports, I don't see any reason to push manufacturing exports, right? There is no inherent virtue in manufacturing.
Jobs, maybe.
Let me come to that, right? If you want to attract foreign capital into the country, right, you want a capital account inflow, by definition, you will have a current account deficit. There is, right, there is no two ways about it. A foreign capital inflow is a mirror image of a current account deficit. So my point is our external account is fine. Now, what do we need for domestic manufacturing? I've always argued that you need construction and housing, and domestic manufacturing will follow. If people have houses, all demand for durable goods depends on the size of your house. You will not have demand for lighting, you will not have demand for ACs, you will not have demand for anything, even clothes, right? You need a wardrobe to store clothes. If 5 people are living in a slum, they won't demand. So I think construction and housing is fundamental for creating. I'm not against manufacturing, don't get me wrong. I'm saying manufacturing will automatically follow construction if we get construction right. And if we don't get construction right, I mean, we cannot be attracting more capital inflows and saying we don't like a current account deficit. That's pointless, right? So I'm saying PLI is relevant for sectors that are inherently unviable but are needed for strategic objectives, right? If you say there's a defense sector which is inherently unviable and needs support because it's strategic, then you should give a PLI. But I don't see why, if there is a great opportunity, we need a PLI.
Okay, fair enough. Let me ask you, all of you, this. Markets and the budget. Pankaj, you've seen many budgets. What's the...
I think the good part is that we are going with very low expectations this time. Markets have corrected, a lot of froth has been taken out. And we were just discussing before this that index is masking the damage. Index may be down by 14-15%, but stocks on an average are down by 30 to 40%. So I think we are going with very low expectations across, which is a good news in my view. And historically, if you look at in the last 15 years, 15-20 days before the elections, markets generally tend to correct. That's the history which is suggesting. And after 2 months, if the budget is not so damaging, markets kind of find its level. And I am not as negative as or cautious as I was for the last 6 months. I think on the margin, I'm becoming a little more constructive after the correction. The reason I'm saying it could be not a very prolonged one, because the solvency issue is not there. In the previous cycles, we all were talking about balance sheets being blown up, either on the banking side or on the corporate side. This time we have 2 questions to ask, growth and valuations. And I think once growth starts to resume again and valuations are corrected already and more correction may be on the offing, I think you will find it good. But let me just caution that the easy money era is behind us. The last 4-year party which was going on, it's once in a lifetime. So don't expect those returns to again replicate in the next 2 years. But I think people who understand balance sheet, people who understand cash flow, good managements, all-weather managements, they will make a comeback again. And I think it will be men versus boys. So,
Harish, brief comment on markets.
So, markets interplay of earnings, liquidity, sentiment. 6 months back, we could do nothing wrong. Here we are, we can think, we are acting as though we can do nothing right. Right? I think the key is to figure out what we'll think about 6 months later, right? And over that 6 months later, I think that our rate of change in monetary policy will change quite dramatically. Potentially the fiscal stance is likely to at least improve. It may not dramatically change. Third, I would also think that, a depreciated currency can also do wonders for earnings. Of course, at the time of very sharp depreciation, maybe nobody wants it, but once it stabilizes, that can also be a source of tailwind for earnings growth. So you put all of them in totality, I would say that, I would be thinking of increasing risk at this point of time rather than worrying about what's happening on a day-to-day basis in the portfolios that I manage.
Okay, Anish?
So my view is you can invest in large caps from a 3-year horizon. I wouldn't say what will happen in the next 6 months or 12 months. One can never predict that in the equity markets. But I don't think there's any fundamental problem with the economy, right? A little bit of stimulus, etc., will help. And I do think earnings growth at some point will recover. So with a 3-year view, you can invest in large caps. I would still say that small and mid caps, the risk-reward trade-off is adverse. And I say it's not a valuation issue, it's a categorization issue. What Pankaj was mentioning, right? Some of the companies are not inherently strong. They have terrible balance sheets and some of them have a terrible track record of governance. So those it's like you'll find that when they are down 20%, people will come to sell, not new buyers emerging. Those are the ones to really avoid.
All right, I think I'm being told to wrap on this program. More questions, but out of time. Anish, Harish and Pankaj, thank you very much, all of you, for joining us. We don't have to wait very long to find out what the budget throws our way. Well, thank you very much for staying with us here on this special budget town hall. Programming continues on the other side of this break. Thanks for staying with us.
I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that, so we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia-Ukraine. They have a great deal of power over that situation.
Think about India. If we have them growing strong next year, consistent with what they grew this year, it's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story we are tracking this evening: in a bid to strengthen ties between India and China, Indian Foreign Secretary Vikram Misri has met Chinese Foreign Minister Wang Yi in Beijing today. This is the second high-profile visit by an Indian official to China in 6 weeks. As per the Chinese ministry, Wang Yi said that India and China must refrain from mutual suspicion, estrangement and exhaustion. He added that improvement and development of China-India relations fully aligns with the interests of both countries. Meanwhile, Misri said that the two countries have engaged in a series of beneficial dialogues and communication. To take this forward, I'm now joined by former Lieutenant General S.L. Narasimhan, also former member of the National Security Advisory Board and currently an adjunct distinguished fellow with the Gateway House. Thank you very much for joining us, General Narasimhan. What do you think is going to be the larger takeaway from this meeting? The sense that we get is that China wants greater economic engagement with India. there is a problem of surplus in the Chinese economy. But on the Indian side, there has been clamor within the industry for resumption of ties with China. On one hand, we need Chinese technicians, skilled professionals who can come repair machinery at factories, and somehow we are reliant on the Chinese supply chain as well. So what do you think could be the meeting ground?
Good evening. Thanks for getting me on this show. 3 points. One is, I think this meeting itself is one step forward in our efforts to normalize the relationship with China. Many people, when we signed that agreement on 21st of October 24, thought that that was the end of the story. But that was the beginning of the story, actually, of this India-China bilateral relationship. And so step by step, things are being moved forward. Initially, you found Prime Minister Modi and Mr. Xi Jinping meeting in Kazan. Thereafter, foreign ministers met. Then the special representatives, that is Mr. Ajit Doval and Mr. Wang Yi, met. And now, of course, Foreign Secretary has gone to meet for his own visit. So it is a step-by-step process. I think we are making a movement. If you look at the statement that has come out after the meeting from the Chinese side, it looks as if it is a little tentative kind of a step that is being taken forward. While Mr. Wang Yi talked about 3 mutuals, he did not talk about mutual respect and mutual sensitivity and mutual interest, which our foreign minister has been putting across. And Mr. Mishri has been quite cautiously optimistic in making the step forward in normalizing this bilateral relationship between India and China. On the second question of your the technicians, etc., coming in from China, I don't think there's been a problem in their coming in. I think selectively the visas have been given for those people to come in and operationalize the machinery, etc. So that is also being done in some form or the other. The industry, of course, wants more investments to come from China, but that I think we need to take it with a little bit of caution and see which all investments suit us, suit our requirements, and then take that step forward. I think this is the way I think we need to see this meeting.
We see the meeting. There are 3 concerns on the Indian side. Perhaps the top of it all right now is the China plan to build a dam in the Tibetan plateau, which could impact the flow of Brahmaputra into India. The second is the resumption of the Kailash Mansarovar Yatra and also have border trade with China. So what do you think could be the implications of China building this dam, and what really are India's options here?
Actually, I'll answer the second question first. India doesn't have much of options here because China is the upper riparian state and they've not do any kind of river water sharing agreement with anybody. That is point number 1. Point number 2, on the dam itself, there are mixed signals coming out of China. Some people say it is going to be run as a river, in which case the water is not going to be stored. And some people say it is going to be a dam that is going to be built for diversion of water towards the north. In the first case, there is no major implication. The second case, if that happens, then you may find the water level in Brahmaputra getting affected a little bit. Because most of the water to Brahmaputra accrues from the Indian tributaries that flow into Brahmaputra. The second thing is the seismological issues that get involved in such a big dam coming in that area is going to be a bit of a concern. However, the Chinese have been saying that there's been no need to worry. They have done all the work, etc. But we'll have to wait and see as to how this thing actually comes up. On the Mansarovar Yatra, for 4 years it has been stopped. Now there are talks of it being revived. That could be one of the issues being discussed during Foreign Secretary's visit. We'll have to wait and watch as to how that progresses. On the third issue of border trade per se was not a major trade between India and China. It is a very minor kind of a trade. However, it helps the people on the border on both the sides. So to that extent, if the border trade starts up, it will be a little positive in that relationship towards normalizing. I think this is the way you need to see these 3 issues.
Right. So clearly, India is wanting some low-hanging fruit and some major policy issues to be sorted out and get some clarity on that as well as to how China wants to approach relations in the long term as well. General Narasimhan, always a pleasure having you here on CNBC TV. And thank you very much for joining us with your views. Moving on to the union budget. Ahead of the budget presentation, the tech industry has recommended a slew of measures that the government could implement to support the sector's innovation and growth. India's IT industry body NASSCOM has advocated for the increase or removal of the eligibility threshold for the safe harbor rules. The list of recommendations also include the creation of a dedicated deep tech fund along with a grant framework. The industry has also called for the consolidation of TDS rates and a provision to carry forward business loss. Joining me now to take this discussion forward is Ashish Agarwal, Vice President Public Policy at NASSCOM. Ashish, thank you very much for joining us. This is going to be a year of AI. Donald Trump, while speaking at Davos last week, said the United States is going to be the capital of AI and crypto. Looking at the kind of changes, looking at the kind of developments we are going to see in AI, the race between US and China, what do you think the budget can do to propel more innovation in this sector?
Thanks, Parikshit. Obviously, this is an important topic, and I would take a step back and say that it is way beyond just the budget. So, and we see that India and the government and industry, there are many elements which are already in progress in terms of taking our agenda forward. There is an AI mission of the government, which is really, truly now at a stage where we see it getting operationalized over the coming months and days. So, but strictly, focusing from a budget perspective, which is now hardly a few days away, one of the things we are saying is that there are existing initiatives of the government, like I mentioned, the AI mission. We have also announced quantum mission. Now, from a private startup perspective, and this is where NASSCOM is really focused on, is the deep tech ecosystem. So one of the ways now we have seen that over the last 5 years, this deep tech ecosystem has shown quite a bit of promise. And this is reflected by the fact that more than 500 deep tech startups have come in just about last year. And cumulative investment we have seen of $10 billion odd dollars, which have come in the last 5 odd years. So given all of this, I think one of the things that we have identified as a gap is that this ecosystem requires at a level of Series A and B, a significant amount of funding. And that's where something that government can really come in to say that, can we create a funding mechanism where a significant amount of capital can be available, and combined with the private capital, can we create in certain areas, winners which are critical for India? And now that could be in the AI space, it could be in the quantum space, blockchain, IoT, and so on and so forth. Because as we see that it is not just one thing, but a combination of technologies which create these global winners. And this could also be areas where we want to succeed at a commercial level and show India as having that strength. So we have seen a lot of action happening in bioengineering, in EV markets. So I think to kind of summarize this, what we are really saying is that we need to promote our deep tech ecosystem, and that's where the focus should be. And out of this, we are hopeful that we will also have core AI winners.
Right. You've also made a mention of making safe harbor rules more attractive, simplifying transfer pricing assessment procedures. Give us a sense of what is the ask here and what is the pain point?
So in quite a simple terms, when we look at multinational organizations, and specifically when you look at something like a global capability centers, which are really, providing solutions to their global parent organizations and so on and so forth. These transactions are essentially related party transaction. That means the transaction is between a subsidiary and a head office. So therefore, from a determining of the pricing of these transactions, you have these laws which deal with transfer pricing. Now, what we are seeing is that over the last few years, we have seen this ecosystem of GCCs really, expand and grow in India. We have about 1,700 odd GCCs who are already there, and these are part of Fortune 500 companies and so on and forth, and so on and so forth. Now, this segment can continue to grow, and this segment not only does a lot of cutting edge work and providing all kind of global services, they also are a huge employment generator. So just to give you an example, out of about 5.5 million of direct employment in the IT sector, nearly about 2 million are employed in this global capability center space. So what we're really saying is that as one of the points of uncertainty on taxation, this could be really, eased. And one way of easing this is to say that, can we make the safe harbor regime much more simpler? So just to explain, the way the tax assessment happens in this, there are 3 ways the tax assessment happens. One is the safe harbor, which means that if you qualify for this safe harbor scheme, you're going through a green channel. So that's like a quick, process. And then you have another mechanism, which is that you enter into an agreement with the taxation authorities, which is called an advanced pricing agreement. Now, once you do that, then you are probably set for 5 years and you understand that, okay, this is how my profit will be determined and I'll pay my taxes. So that's another thing. The last way of doing it is through regular assessment, like everybody gets their tax assessed every year and so on and so forth. So now, thanks to the initiative of the Finance Ministry and the budget of July 2024, already the broad announcement has been made to say that, government will increase the scope of the safe harbor and as well as, ease the transfer pricing regime. Now, what we have done over the last few months is to work with the government to really focus on the implementation of that announcement. And that is what we are hoping will come through now.
And very quickly, any issues that you are seeking intervention on ease of doing business, any areas where the IT industry needs protection because of the tariffs that Donald Trump could unleash? There is also going to be a discussion between India and US on an FTA. So any kind of demands immediately?
So from a services point of view, I think largely what we are seeing is that there is a optimism in terms of growth. That last year was a bad year in terms of overall growth. We had about less than 4% of growth. This year we are expecting it to be slightly better, and moving forward, there is optimism in terms of improvement. So from our sector point of view, I think it's really about focusing on enabling growth, ease of doing business and innovation. And we are not really looking for any kind of a specific protection in that sense, because what we are seeing is that the more we can enable some of these innovation and growth, the more we become even more part of the global supply chain, the more we become a trusted partner for the world and provide these solutions even in our domestic market. So from that point of view, we are really approaching it from an enabling perspective rather than a protectionist mode.
All right, Ashish, thank you very much for joining us with your view on what the IT industry is expecting from Union Budget. Moving on, US President Donald Trump has hit the ground running, making it clear within days that tariffs will feature as a big theme during his administration's tenure. Trump has professed admiration for US's 25th president, William McKinley, who, as per him, made US very rich through tariffs and through talent, and not just wielding it as a stick. Trump, during his address to the gathering at the World Economic Forum's annual meeting in Davos, made it clear that he was willing to dangle it as a carrot as well. Trump promised lower taxes for companies manufacturing in US. The big question we're asking now is, what does all this mean for Asia and India in particular? We're joined by Chief Economist for the APAC region at Moody's Analytics, Stephen Cochrane. Steve, thank you very much for joining us. Clearly, there are going to be tariffs by Donald Trump, and he is likely to impose tariffs against India as well. He will deliver on that threat. That is the wider expectation. But how do you expect India to be impacted?
Well, first of all, I have to say there's nothing certain about any of the tariffs. It's hard to know exactly what's happening. During Trump's inaugural speech, he directed his advisors, as we had expected, to be looking at trade patterns and to be finding where the biggest trade imbalances were that could be corrected by tariffs. And yet the moves he's taken so far have been not related to a trade balance at all, but related more to the flow of drugs or the flow of immigrants, Canada, Mexico, more recently this weekend, Colombia. So we haven't really seen any indication of what the longer term strategy is going to be for tariffs. But having said that, I think it's easy to take a look at least one indicator, and that is which countries have a very large trade surplus with the US. That those might be targets for tariffs in an effort to try to rebalance trade country by country in a very kind of a transactional way. From this point of view, India, the risks to India are not quite so great. In 2023, India did have a trade surplus with the US of about $43 billion. But compare that with China, which had the largest trade surplus of any country with the US. It was about $280 billion trade surplus that China had with the US. So about 6 times what India has. From that point of view, then, one would expect that the trade tariff, the Trump tariff policies would be more aggressive towards countries like China or Vietnam or even the European Union, again, Mexico, Canada, which are much larger trading partners.
Right. Stephen, we'd also like to ask you about energy imports from the United States. With growing U.S. sanctions on Russia, there is a large likelihood that India will reduce the import of Russian crude. For over 2 years, we've been importing Russian crude at big discounts, and this has helped the Indian economy. But now if we stop that and start buying U.S. crude, do you expect this to significantly increase India's import bill? Is this a story that you are tracking very closely? Is this a trend that you're watching out for?
Well, I have been watching it because I think, again, if the loss of access to that inexpensive Russian crude does mean that there's a bit of a risk for recession, inflation rising again in India. Most of the energy that is used in India is imported. All the crude oil is imported into India, and so whether it comes from the U.S. or it comes from someplace else, it's bound to be a higher cost. Now, if India does import oil from the U.S., well, that does have an effect in terms of at least perhaps reducing the trade surplus that India has with the U.S. It might actually be a point in its favor if that becomes a bargaining chip for tariffs. But clearly, this would be one factor that would begin to raise inflation again, be something that the central bank would have to watch very carefully in its own policy as it tries to manage inflation.
Right. Donald Trump spoke about how he's going to demand the Fed to take certain decisions, how the rate cycle around the world should follow what Donald Trump says. So what kind of impact do you think this will have on central bank policies across the world?
To be honest, I don't think it has much of an impact on central bank policy. Central banks around the world, they really have a couple of things that they are watching very carefully. One, of course, is managing their own rate of inflation. And this is an issue in India where inflation it has come into the RBI's target range, but it's on the high end of the target range. So it has to be very, very cautious as well. Also, central banks are going to be watching very carefully foreign exchange values that central banks don't want to have a widening gap between interest rates in the U.S. and interest rates in the domestic economy, because if interest rates in the U.S. are much higher, then that would put some weight on foreign exchange. So really, those are the two issues that central banks will be concerned with, and I don't think they'll be taking clues directly from what President Trump has to say. It's really more the economic indicators that they will be watching.
Right. Now, in terms of supply chains, as a result of U.S. policies towards China, now because they have, China has the highest trade surplus with the United States, and the brunt of tariff actions from Donald Trump will be borne by China. How do you expect that to impact India's supply chains?
Well, we can look at this in one of two ways. One is the fact that India is not right now much of a platform for Chinese manufacturing, as opposed to, say, Vietnam or Mexico. That doesn't put India in the crosshairs in terms of being a target for tariffs. But it does mean that, well, there is actually some potential for India to become a manufacturing platform, an intermediate manufacturing of goods as Chinese companies look for locations outside of China. You can see it already in Vietnam over the last 3 or 4 years that Chinese companies have invested heavily in Vietnam and other countries in Southeast Asia. And those are countries that could possibly become targets for tariffs, at least tariffs that are targeted particularly at industries where Chinese firms have located manufacturing plants in those countries. So India will have to, in a sense, be very cautious, but it does provide some opportunity for China to become a location for some of the supply chains of goods coming out of China and then thus heading on to the US and European markets.
All right. Thank you very much, Stephen Cochrane, for joining us with that view. With that, it's a wrap on this edition of News Center. More news and updates right here.
I think there's a lot of value in health insurance companies, and you know the names broadly. They are at very beaten down valuations. You were discussing one of the names earlier during your conversation before I joined in. These are some of very exciting plays and available at very reasonable valuation. You will have a case of commissions across the health insurance companies coming at par today. Care Health is paying high insurance commissions. Then maybe a Star Health 1 year down the line they'll be at broadly the same levels. You are looking at 20 to 30% sort of a growth out here. You are looking at prices which are at 2-year lows. And there's adequate margin of safety. When it comes to large cap banks, of course, you have pain in the retail NPA credit cycle. Tier 2 banks won't be able to handle it that well as the large caps. And today we are talking about large cap banks, both in the public and the private sector, trading at less than 15 PE multiple. There's ample comfort out there. Pharma, in any case, both on the generic export side, domestic CDMO side, export CDMO side, the runaway is big. And depending on how each individual company reports numbers, there's a lot of play and value out here. I think there's a lot of value in health insurance companies, and you know the names broadly. They are at very beaten down valuations. You were discussing one of the names earlier during your conversation before I joined in. These are some of very exciting plays and available at very reasonable valuation. You will have a case of commissions across the health insurance companies coming at par today. Care Health is paying high insurance commissions. Then maybe a Star Health 1 year down the line they'll be at broadly the same levels. You are looking at 20 to 30% sort of a growth out here. You are looking at prices which are at 2-year lows. And there's adequate margin of safety. When it comes to large cap banks, of course, you have pain in the retail NPA credit cycle. Tier 2 banks won't be. So FY25 probably will end Nifty 50 EPS levels of 1075. And you add another 10% to that, that's 107. And you add another 10% to FY26 numbers. And you'll get to a level of 1315. So on average of FY26 and FY27, you broadly be at 1250 on the Nifty 50 EPS. And you give it a valuation of 17 to 18 times, you're broadly there at 22,000, 22,000. Last 10 years, median valuation has held at around those levels. I think we'll fall to those levels, given the spate of negativities that are surrounding in the market. And from there, it is going to be pick and choose. On the Nifty 50 numbers, companies that will deliver good numbers are likely to find support. Companies likely to report better than EPS growth estimates of 10% will likely outperform, is what my understanding.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving, because markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and say,
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, well, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. Our per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assume the past is prorogue. That what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that.
Jamie Dimon.
So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003. When mobile phone came, the month-on-month growth was 8-9%. You know, so that was a kind of scorching growth, and that's where kind of we used to take plunge. And but there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum. But the stocks will grow 200-300%. So the hype, so you ride the hype cycle, and right at the top, it becomes so what you call compelling. You know, I can sell the story to even a person like him or anybody. You know, and you sell while selling the story, you are obsessed, and you allocate, and that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, you know, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you'll get to see 500 crores loss. So I mean I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull like Rakesh, and I used to collect bulls and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money and HDFC Bank doesn't need to raise capital. And we have met the company and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India or I have to defend my...
We're talking capital. Thank you.
I have to remain bullish. And since then, I have become more cynical in general and also connect more to global, this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit and I no longer defend anything to anybody I say.
Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down. which frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term. We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that, so we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia-Ukraine. They have a great deal of power over that situation.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show, team.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a manic Monday on the Lal Street as weak global cues rock sentiment. The Nifty down to its lowest level in 7 months. Mid-cap index now down 15% from its record highs. All sectoral indices close in the red. Tech stocks are selling off across Europe and US. This after Chinese AI platform DeepSeek becomes the most downloaded app on the Apple Store in the US within weeks of its launch. This raises questions about US companies maintaining their dominance in artificial intelligence. The government invites applications for the post of SEBI chairperson by the 17th of February. The 3-year tenure of the current chief, Madhavi Puri Butch, ends on the 28th of February. She was the first person from the private sector to lead the institution. A fresh twist in the battle to control Religare. A US-based hotelier, Danny Gaikwad, throws his hat into the ring, approaches SEBI to make an open offer to buy 55% stake. The Berman family says Gaikwad has not made a competing offer and the request before SEBI lacks substance. Abhinandan Lodha cannot use the Lodha brand name as it belongs to Macrotech developer, says Abhishek Lodha. The brothers are embroiled in a 5,000 crore rupee trademark lawsuit before the Bombay High Court. India's Foreign Secretary Vikram Misri meets China's Foreign Minister Wang Yi in Beijing, both nations attempting to revive the bilateral relationship after the Galwan Valley clash between India and China that killed soldiers 5 years ago. The US and Colombia pulled back from the brink of a trade war. The Trump administration puts tariffs and sanctions on hold after the South American nation agrees to accept hundreds of deported immigrants from the US. Tens of thousands of displaced Palestinians returned to their homes in northern Gaza for the first time since Israel war began. Israel and Hezbollah also extend their ceasefire in Lebanon to the 18th of February. Aam Aadmi Party chief Arvind Kejriwal releases the party's manifesto ahead of the Feb 5th Delhi elections, promises monthly financial support for 2,100 rupees for women, free bus travel for students, free healthcare facilities for senior citizens, among others. All of that and more coming up, but let's start with the sell-off that we saw on the Lal Street today. The Sensex lost over 800 points and the Nifty dropped below 23,000 in what was a manic Monday on the Lal Street. That's the screen there, a sea of red. 824 gone on the Sensex, 263 on the Nifty. The Nifty mid-cap 15% off from its record highs, down over 1,400 points today and 650 points lower. That is the Nifty small cap index. Of course, weak global cues have also weighed on our markets. All sectoral indices, as I pointed out, closing in the red. Prashant is standing by now to wrap up the market action for us. It is a very weak picture as we get into trade this week, Prashant, and of course not being helped by what's happening globally either.
There are mostly all old worries, Shireen, but there are some new ones as well, as you pointed out, especially from the global arena. So, it's starting to hurt. And it has actually, to be fair, been hurting portfolios for a while now. Because, while the graphic will come up, which shows you how much we are down from the highs for the Nifty Bank, for the mid and the small cap part of the market. 13%, right, can live with it. But the point is, the broader market, stocks and one's portfolios are down between 30 and 40%. This is, of course, just the indices. Nifty Bank is down 12. Mid-cap index as of today's close from the highs is down 15. Small cap index is down about 17%. Actually, for the mid and small cap part of the market, losses have accelerated over the last 10 days or so. They were at par with how much the Nifty or the Nifty Bank was down. These are sort of sectoral sort of cuts that we've seen. PSU Bank Index is down 24% from the highs now. Again, CPSE is down 24%, which basically means an index is down, has lost about 0.25% of value, which means stocks are down, 40, 50% in some cases. Oil and gas, 25%. You've got the metal index, which is down about 21%. Auto, real estate, FMCG are some of the others. And this is the part. Real estate companies, and real estate is especially important because, it connects to so many other things in the economy. many real estate companies are starting to talk about the fact that whether the urban slowdown that we are seeing will start to actually impact home sales. We had Abhishek Lodha with us earlier this morning actually sort of talking about it. Said so far they're not seeing any slowdown, but it's something to sort of be cognizant of. Now, as I said, just a combination of some of the older worries and of course, some new ones at the margin as well, high valuations. I mean, just to give you an example, the median PE multiple of NSE 500 companies is around 40 times. Now, that's the median. And if you take out some of the lower price, cheaper companies, I mean, actually this number goes up, jumps higher. You can always argue and say that high PE multiples are not a new phenomenon. I mean, it's been there, has been around for almost a decade now. This big step up in valuations, PE multiples that we've seen. But I think this is something which I think comes to bite when markets look a little vulnerable. Of course, single-digit FY25 EPS growth is what we're looking at now because the slowdown started in the second quarter. There were some hopes that Q3 will be better, but I don't think it's panning out that way, which means that the full year FY25 number is basically going to leave us with somewhere around 9-10% kind of growth. And then, which means that FY26 earnings growth estimates will also need to be brought lower over the next one quarter or so. Tight liquidity has been, of course, has been spoken about quite a bit. And now I think it's the clamor is rising from market participants saying that some relief is needed. And some, lots of sell-side mainstream economists are also starting to say that actually, we need to see some action on that particular front. On the fiscal side, of course, the union budget is in front of us on Saturday, the 1st of February. Will the government acknowledge the slowdown with some measures, and what can they do? I think those are important questions as well. And of course, the new worry at the margin, and this is the new one, right? Because the question is this: will China's DeepSeek startup and the product that they've launched call into question the billions being spent on AI capex on companies like NVIDIA, etc., which has basically been singularly responsible for this big, huge up move in U.S. market. So, and that's a new thing which has been thrown into the mix, and which has kind of complicated matters. I would have said that given the correction that we've already had, markets perhaps were at a point where we at least start to see a bit of a bounce. But with the fact that the last point that I mentioned with regards to global markets, with this DeepSeek thing, I think we are still in wait and watch mode, whether that will really cause damage or, it's something which will actually pass over and U.S. markets actually will be really unhurt in the larger scheme of things. So I think lots of things to track. It's a bit of a flux out there, but I think one thing absolutely clear, portfolios hurting out there. Back to you.
Yes, portfolios are certainly hurting, but of course, in the US, we've seen that mega tech rally, and whether this is just a bit of a breather or a pause is the big question, or whether it is going to be more sustained. Thanks very much, Prashant, for joining us. Now, tech stocks routed across Europe and the US after a little-known Chinese AI startup called DeepSeek became the most popular app in the US within weeks of its launch. So what is DeepSeek exactly, and why is it worrying the West? Rima joins us now to explain. Rima.
Thanks so much for that. Call it the AI showdown, the face-off. But, things are hotting up between ChatGPT, which was dominating generative AI so far, and the new kid on the block, which is DeepSeek, which is a Chinese AI startup. Well, till 2 months back, or even a month back, you probably wouldn't have even heard of DeepSeek. But it rose into prominence in December of last year when they unveiled their free large language model, DeepSeek V3. Now, this was positioned as a it was positioned as a free alternative to ChatGPT, OpenAI's ChatGPT. But the real deal came last week, on the 20th of January, when DeepSeek released a more advanced model, their latest model, DeepSeek R1, and their performance matches up in terms of efficiency to OpenAI's latest model, which is OpenAI O1. In fact, Satya Nadella, when he was asked, and he's a Microsoft CEO, when he was asked at the World Economic Forum about this, he said we should take the developments out of China very, very seriously. Now, here's why scientists are quite excited, but analysts, Wall Street analysts, are quite worried. For one, DeepSeek, again, it's a Chinese AI company. It's formed by this hedge fund. And this was actually made using fewer and inferior GPUs compared to the NVIDIA chips that were used for making OpenAI's ChatGPT. That's reason number one. Secondly, according to reports, this was built in less than 2 months, and the overall cost was $5.58 million, a fraction of what it took for OpenAI to build ChatGPT, which is why analysts are thrilled, but Wall Street is a bit worried. And talking about the fear on Wall Street's mind, is that will DeepSeek be the pin that bursts the AI bubble in a way? Some who believe that perhaps the tech stocks, the AI stocks like Nvidia, which have had a fantastic run up of 135% last year, was that getting a little excessive, and will they get a reality check, which is why Nasdaq futures too have come under pressure today.
Well, this is like the ChatGPT moment 2 years ago. DeepSeek causing a fair degree of concern across Wall Street and, of course, in the AI circles as well. Thanks very much, Rima. And speaking of ChatGPT, top Indian media outlets are joining the copyright fight against OpenAI. According to reports on Reuters and the Hindustan Times, a clutch of media outlets will join a lawsuit filed by news agency ANI, the digital news units of Network 18, NDTV, Hindustan Times, Indian Express, along with the Digital News Publishers Association, have filed an intervention application before the Delhi High Court. The case will be heard by the court tomorrow. In their application, the media outlets accuse OpenAI of violating intellectual property rights by using their content without authorization. OpenAI and other AI companies face multiple lawsuits across the world from news organizations, authors, artists, musicians for using their copyrighted work to train their AI models without permission. So this is going to be an interesting one to watch out for. On to the money market, where the rupee weakened against the US dollar. The rupee weakened by 13 paise as it remains above the 86 mark. There was a rally, though, in the bond market, with bond yields dropping to a 3-year low. The RBI bought bonds worth 10,000 crore rupees between the 15th and 17th of January. This has boosted sentiment in the bond market. And here's another big story that's moving the forex markets worldwide. The US and Colombia have pulled back from the brink of a trade war. The Trump administration has put tariffs and sanctions on hold after the South American nation agreed to accept hundreds of deported immigrants from the US. Take a look.
The US and Colombia pulled back from the brink of a trade war on Sunday. U.S. President Donald Trump had threatened tariffs and sanctions on Colombia for refusing to accept military flights carrying deportees as part of his sweeping immigration crackdown. But late on Sunday, the White House said Colombia had agreed to accept the migrants after all, and Washington would not impose those penalties.
El gobierno de Colombia.
Colombian Foreign Minister Luis Gilberto Murillo on Sunday said his country's government had, quote, gotten over its impasse with Washington. Earlier, Colombia's President Gustavo Petro had condemned the military deportation flights and said that he would never carry out a raid to return handcuffed Americans to the U.S. However, he also said that Colombia would welcome home deported migrants on civilian planes and offered his presidential plane to facilitate their, quote, dignified return. The Colombian statement did not specify whether the agreement it had struck with the U.S. included military flights, but it did not contradict the White House announcement. It added that Murillo and Colombia's ambassador to the United States will travel to Washington in coming days for follow-up meetings. The use of U.S. military aircraft to carry out deportation flights is unusual. Some of them carried out 2 flights to Guatemala on Friday, while Mexico also refused a request last week to let a U.S. military aircraft land with migrants. Trump has said he is thinking about imposing 25% duties on imports from Canada and Mexico on February 1st to force further action against illegal immigrants and fentanyl flowing into the U.S.
So the US and Colombia pull back from a tariff war. Indian Oil Corporation shares tumbled after a weak quarterly performance that largely missed estimates. Revenue was slightly above expectations, rising 11.5% sequentially. However, both profits and margins were far below estimates. LPG under recoveries for the quarter of 14,325 crore rupees further dented the company's profitability. So that's IOC for you. A fresh twist in the battle to control Religare Enterprises. US-based investor and entrepreneur Digvijay Gaikwad has sought permission from market regulator SEBI to make a counter-offer for Religare Enterprises. He revised his open offer and his bid for 55% stake in the company, but the Berman family believe Gaikwad's move to approach SEBI lacks substance. Vivek joins us now with more on this acquisition battle. Vivek.
Well, in a surprising and interesting twist in the Berman family versus the Religare board feud, there was a very important development that took place over the weekend. A US-based investor, Digvijay Gaikwad, approached SEBI to make an open offer for Religare Enterprises. In fact, he has written 2 letters to SEBI over the weekend. The first letter going ahead and offering to buy close to 26% stake, and then subsequently revising that particular open offer to buy up to 55% stake. Remember, the open offer price that he is offering to make make is at 275 rupees a share, a premium to both the current market price as well as the Berman family's offer price of 235 rupees a share. However, there was an immediate response from the Berman family. They've claim that Gaikwad has not made any competing open offer. In fact, he's just requested SEBI's permission to make an open offer. Along with that, they also state that he's missed a 15-day deadline to make a competing offer after Berman's public statement. Along with that, they say that the request lacks substance with no source of funds or capacity to purchase shares. They also say that Religare is accused of recklessly disseminating the letter to mislead public shareholders. It is important to note that today is the day in which shareholders can go ahead and tender their shares as far as the Berman family's open offer is concerned. What is the way forward? Well, number one, what is SEBI's response to the open offer and whether they allow Gaikwad to go ahead with this particular open offer. Along with that, they also have to determine whether the offer was made on time. Also, remember, when you're talking about this particular open offer, it has to be made through a merchant banker. And also, there will be worries about what will be the FII ownership limit allowed as far as Religare Enterprises is concerned. In fact, we spoke to Gaikwad himself. Gaikwad said at this point of time, they find significant value as far as Religare is concerned, and they believe that their offer is a much better offer compared to what the Berman family is offering to Religare shareholders.
It's nothing out of blue. Any offer you give, it's always be out of blue, because I saw the value and I thought that it's a good value to go after. I did a very, very reasonable offer. Because in America, if you look at it in US, most of the offers are at the closing time stock, and then you get it about 17 to 20%, 15%. That's all I did. This is nothing extraordinary or no other event. I don't think so. Is this some kind of criteria that you have to own, otherwise you can't own? Don't you have always the first try, first attempt, first time? Maybe not India, but I have a lot of experience in America.
Well, that's Danny Gaikwad there on making that open offer for Religare. Lodha brothers Abhishek and Abhinandan are slugging it out in the Bombay High Court over the use of the Lodha brand name. Macrotech developers have sought to stay on the house of Abhinandan Lodha using the trademark. Meanwhile, Abhinandan Lodha maintains that his use of the brand name has not caused confusion in the market. Ashmit is standing by with more on the court's observations on the matter. Ashmit.
Well, it all boils down to a sparring session between the two brothers on who gets to use the Lodha brand name. What Macrotech developers has done is that they filed a 5,000 crore rupee suit in the Bombay High Court where they say that only they are entitled to use the Lodha brand name, that any use of the Lodha brand name by Abhinandan Lodha is in fact illegal and unlawful. They go back, Macrotech developers goes back to a settlement agreement that was reached between the two brothers. That Abhinandan Lodha shall not be using the Lodha trademark in any shape or form. Abhinandan Lodha on his part is saying that, look, I have been the one bailing them out of difficult situations. I've been giving them NOCs, bank guarantees. I've been inaugurating various functions of theirs, but now they're coming back to sue me. Abhinandan Lodha goes on to say that there is no confusion in the market. There's the Lodha brand name, and then there's the one which he's using, which is the house of Abhinandan Lodha. Having said that, the Bombay High Court is insisting that there is a need for perhaps a push at settlement and allowing the parties one more day's time to go back to the drawing board to figure out what they need, to figure out a way of settling this dispute. The Bombay High Court saying we're even open to the idea of having a CJI help mediate between the two parties. So an answer to that question expected tomorrow.
All right. Many thanks, Ashmit, for joining us. Abhishek Lodha has said that his brother Abhinandan Lodha cannot use the brand name as it belongs to Macrotech. Speaking to CNBC-TV18, Abhishek Lodha said the use of the brand name by his brother has confused customers. Take a look.
But I can tell you in no unclear terms that the family agreement explicitly stated, and that time we were a private company. It was well before we became a listed company. It explicitly stated that all brand, IPR, trademark, copyrights of the group will exclusively and solely belong to Lodha developers or Macrotech as it is known now. And Abhinandan or any new business that he starts cannot use, and I emphasize these words, cannot use the same in any manner whatsoever.
The battle between the Lodha brothers. We'll take a break, but up next, India's Foreign Secretary Vikram Misri meets China's Foreign Minister Wang Yi in Beijing. That and more when we return.
to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I think there's a lot of value in health insurance companies, and you know the names broadly. You know they are at very beaten down valuations. You were discussing one of the names earlier during your conversation before I joined in. You know, these are some of very exciting plays and available at very reasonable valuation. You will have a case of commissions across the health insurance companies coming at par today. Care Health is paying high insurance commissions. Then maybe a Star Health 1 year down the line they'll be at broadly the same levels. You are looking at 20 to 30% sort of a growth out here. You are looking at prices which are at 2-year lows. And there's adequate margin of safety. When it comes to large cap banks, of course, you have pain in the retail NPA credit cycle. Tier 2 banks won't be able to handle it that well as the large caps. And today we are talking about large cap banks, both in the public and the private sector, trading at less than 15 P multiple. There's ample comfort out there. Pharma, in any case, both on the generic export side, domestic CDMO side, export CDMO side, the runaway is big. And depending on how each individual company reports numbers, there's a lot of play and value out here. I think there's a lot of value in health insurance companies, and you know the names broadly. They are at very beaten down valuations. You were discussing one of the names earlier during your conversation before I joined in. These are some of very exciting plays and available at very reasonable valuation. You will have a case of commissions across the health insurance companies coming at par today. Care Health is paying high insurance commissions. Then maybe a Star Health 1 year down the line they'll be at broadly the same levels. You are looking at 20 to 30% sort of a growth out here. You are looking at prices which are at 2-year lows. And there's adequate margin of safety. When it comes to large cap banks, of course, you have pain in the retail NPA credit cycle. Tier 2 banks won't be. So FY25 probably will end Nifty 50 EPS levels of 1075. And you add another 10% to that, that's 107. And you add another 10% to FY26 numbers. And you get to a level of 1315. So an average of FY26 and FY27, you broadly be at
Hello and welcome to Startup Street. I'm Shruti Mishra. Web Summit Qatar 2025 is set to take place from February 23rd to 26th in Doha, and it promises to bring together entrepreneurs, top investors and leading innovators from the region and around the world. The Global Tech Conference will put the spotlight on technology, innovation and entrepreneurship. On this special edition today, we bring one of the Web Summit's key speakers, Jalak Jobanputra, founder of Future Perfect Ventures, a venture capital firm that focuses on investing in early-stage companies that are leveraging emerging technologies to drive innovation and tackle global challenges. Jalak, welcome to Startup Street. You know, you're a seasoned investor and a thought leader in the tech space. You've had an incredible journey in blockchain innovation. So first, tell us what inspired you to launch Future Perfect Ventures and focus on technologies like blockchain and crypto so early on.
Sure. Well, it's great to be with you. About 10 years ago, in 2013 and 14, I'd been a VC since '99. I'd been a tech, telecom, and media investment banker before that on Wall Street in New York and London. And I had seen the evolution of telecom, such as broadband, processing power. I was at Intel Capital from '99 to '03 on the West Coast. So just saw how much growth there had been in infrastructure. And then also the fact that people around the world, billions of people now had mobile phones and more processing power in their hands than NASA did when they put a man on the moon in 1969. And so I was thinking of all this connectivity, this global connectivity, all this processing power, all the data that was being created by these technologies that I'd worked on over many, many years. And I thought there was a next stage of technology evolution, and that would take advantage of all this connectivity. Before, innovation was primarily in the Western world, in Silicon Valley and in certain centers. And now I thought, people all over the world could contribute because of the processing power they had in their hands, because of the data they were creating. And as part of my exploration, and I was thinking of artificial intelligence, I was thinking of Internet of Things, so satellites, mobile phones, all these data crumbs that we're creating. As part of my exploration of all this connectivity, I went to a Bitcoin conference in 2013 and became really fascinated at the underlying blockchain technology behind Bitcoin. This concept that computers around the world could verify transactions without a intermediary. So in the case of Bitcoin, it's not needing a bank and people in between a transaction to verify that this person owns this much capital and this other person is verified to receive it. And you were getting rid of this intermediary layer so people could directly transact with each other. And that played very nicely with this thesis of connectivity, of people around the world being connected.
All right, Jalak, like you mentioned, you've worked in many areas of tech and investment around the world. How has this global experience shaped the way you see innovation and, most importantly, its impact on society today?
So I always say one of the reasons I could see the promise of Bitcoin and blockchain early was because I'd spent so much time around the world in developing nations, as well as having spent a lot of time in the United States and Europe. And I had seen how many unbanked and underbanked people there were around the world, how much, and going with that, how much legacy infrastructure there was in the Western world. So, a lot of people differentiated between developed and developing. They sometimes said first world and third world. The way I looked at it is the developing nations presented a lot of opportunity for new technologies because they didn't have existing infrastructure to rip out. So an example is mobile banking in Kenya. M-Pesa existed well before we had a true mobile banking in the United States. And that's because there was a need for people to transact. There weren't banks, and there was this new technology where people could transfer money with their mobile phones. When I went there in the mid-2000s and learned more about M-Pesa, they were amazed that we didn't have anything similar in the United States. And so I always look at the world as how can we leverage technologies from every part of the world? How can we leverage talent from every part of the world? And I think that's been a unique perspective that's allowed me to see some of these, the promise of some of these new technologies before even people in Silicon Valley did.
Jalak, let's now shift focus to the summit. You're one of the key speakers at the Web Summit Qatar. What excites you most about being part of this global event, and especially in this region?
Well, the region has an amazing demographic. If you look at it, it's a very youthful population, and that's true in India, that's true in countries around Africa and Latin America. So you have this built-in future workforce, existing workforce that is digital native and beyond digital native, Web3 native. So, for a lot of younger people, it makes perfect sense why Bitcoin could be a digital gold, why we should be able to have instantaneous transactions. In places that have more aging populations, they're again mired in legacy infrastructure, a different way of doing things. They're used to paying these high fees for wire transfers. And so I think any region that has this youthful population, this digital native population, this energy is an exciting one to invest in. I also think the Middle East has been very supportive of innovation, realizing they need to diversify their economies. And so I just think there's so much potential there.
So Jalak, share with us a sneak peek. Give us a sneak peek of the topics you'll be covering at the summit and why they matter for startups and entrepreneurs today.
I've been in the crypto sector for over 10 years now, and we've had a tremendous amount of growth from the underlying technology as well as usage. And in the United States particularly, and I think this will impact the rest of the world, we just had a presidential election where we now have a supportive administration and a supportive SEC and regulators in place. And so that was a big issue. And while there are countries around the world that have passed their own legislation, I think looking at, the US finally coming on board to this technology is going to spur innovation around the world. So, entrepreneurs that maybe were just focused regionally can now look at the United States also as a market. And so I'll be talking a lot about that. I've been involved in on the policy side for quite some time now. And also looking at not only crypto, but underlying blockchain technology and how it intersects with AI. At the end of the day, there are companies or technologies like Ethereum, platforms like Ethereum that are using smart contracts, which are innately utilizing a layer of data analytics and smart contracts. So there's a lot of intersection between these trends we're seeing, and AI, IoT, and crypto. And that was really the thesis of the fund over 10 years ago, and it's exciting to see it finally all coming together.
Sure. Jalak, the Web Summit is known for its focus on innovation and entrepreneurship. What advice would you give to startups attending the summit to kind of maximize their opportunities and their connections there?
Yeah, it's a great group of folks that they gather. I would say, while it's great to get in touch with the speakers, learning from each other and finding out what all the different attendees are doing. I think preparation's always great in terms of seeing who will be attending and targeting, who you want to meet. But there's just so many other events that happened there, and so serendipity is a big part of it. Over the years, I've been going to Web Summit since it was in Dublin, and I've seen them grow over the years in different regions, and it's always the same energy, the same serendipity of meeting people that you didn't think you'd meet, or that you end up working with many years down the line. And so I'd say look at it as an opportunity that way.
All right, Jalak, let's talk about Future Perfect Ventures. You've backed over 50 companies. The firm's portfolio includes a diverse range of startups that are tackling everything from artificial intelligence-driven medical diagnostics to the future of digital currencies. Can you share your top 3 bets? And if, you touched upon this earlier, but elaborate on your investment thesis as well.
Well, the investment thesis is I had alluded to it before, but it started off, and it's still very much the same from 10 years ago, which is the intersection of crypto and blockchain, AI and IoT would form the basis of the next internet. And what's evolved since then is the term Web3. And so, whether it's Web3 or, the next internet, that's been our thesis. We were very, very early. I think most people didn't understand how these technologies would interact, but right now we're seeing so many companies that are innately incorporating all of these technologies into their business models. Decentralized infrastructure is one area we're very interested in, which is with AI, you need a lot of computing power. You need a lot of data to create these large language models. Well, what if you could harness the data that's coming in from individuals, but you could compensate them for that data and create really robust, like local language models, local AI models. The other part of that around the infrastructure is compute power. What if you could leverage computing power that's not being used and be able to compensate people on a micro basis for contributing computing power? And so right now we have these massive server farms that are analyzing data. That is really unfeasible from a longer term perspective, or I'd say not the most efficient from a longer term perspective. It may be feasible, but it's going to use a lot of energy. And so I do believe blockchain technologies can contribute to the growth of AI. Another area we're very interested in is this real-time payment sector and stable coins and how different assets can be also put onto the blockchain. So one of my really interests around Bitcoin was the fact that anyone anywhere in the world could potentially buy it. So you didn't have to go through a brokerage. You could buy $10 worth, 100 rupees worth of Bitcoin, and you didn't have to buy a whole Bitcoin. And that gave access to people to an alternative to cash and depreciating currencies. And we've seen depreciating currencies all over the world, and not just in the developing world over the last 5 years. So imagine if you could then create other assets, bundles of assets, in the same way, fractionalize them and offer them up to people on a individual basis, and then assess risk and appropriately. So those are areas that I think we finally have some of the underlying technology, we have usage, and if I look at the next 5 years, those are areas I'm very excited about.
All right, Jalak, thank you for taking us through some of the most exciting areas, trends, or innovations that you believe startups should be paying attention to. And blockchain adoption is growing rapidly. That's what we're seeing. What industries do you think are most ready for disruption using these technologies?
Well, we've certainly seen a lot of growth in financial services. This concept of real world assets, so getting money market funds onto the blockchain. BlackRock, which is one of the largest institutional asset managers in the world, launched that product. They're looking at other products, financial products to put onto the blockchain. So that allows efficiency in transacting and buying and selling these assets, and creates efficiencies for BlackRock also internally. So I think financial services is certainly one. I think media, if you look at the proliferation of deep fakes right now, and this is again very related to AI and being able to create videos that are not real. Well, if you could actually track the provenance of that data, of how a video was created, what data came in, then you could more easily kind of alert when something has been generated versus, is truly valid. So those are two sectors. I believe healthcare is one that, at least in the United States, we have a lot of legacy infrastructure that has to be uprooted. But electronic health records, I mean, in the US,
Yes.
when we go to a new doctor, we still have to rewrite all of our medical history. Now, imagine if we could have a wallet with our own medical history that's portable. And so, that's, to me, low-hanging fruit. And so every industry, in our view, just like the internet disrupted every industry will be impacted by blockchain technology. It's just a question of timing.
All right, and on that note, it's time for us to head into a short break, but don't go anywhere as we continue with our chat with Jalak on the other side. Stay tuned.
On the Nifty 50 ETF, and you give it a valuation of 17 to 18 times, you're broadly there at 22,000, 22,000. Last 10 years, median valuation has held at around those levels. I think we'll fall to those levels, given the spate of negativities that are surrounding in the market. And from there, it is going to be pick and choose on the Nifty 50 numbers. Companies that will deliver good numbers are likely to find support. Companies likely to report better than EPS growth estimates of 10% will likely outperform, is what my understanding.
Learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving, because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. They're a new bunch of companies. So it was a great mistake to think that you could look back and say,
I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well. But when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue, that what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that, with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it,
so markets will always be mispricing. But mispricing to start with, but eventually it misprices on the other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth. And that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum. But the stocks will grow 200-300%. So the hype, so you ride the hype cycle. And right at the top, it becomes so, what you call, compelling. I can sell the story to even a person like him or anybody, and you sell While selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you're right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go.
Welcome back to Startup Street. We are in conversation with Jalak Jobanputra, founder of Future Perfect Ventures. Jalak, you founded the collective Future to promote diversity in blockchain. What steps can startups and ecosystems take to make innovation more inclusive?
I started Collective Future in 2018, and it came out of the fact that there weren't that many women going to these conferences, these blockchain and crypto conferences, but they were some of the smartest people in the industry. So I wanted to, get 20 of us together and spend a weekend together and learn from each other, and also get to know each other on a more personal basis. And what came out was, we shared a lot of the same challenges, and it was great to have a community when there's so few women in the sector. Now, as the sector's grown, we have more women. I would say, culturally, just being inclusive at conferences, right? Not being too. I remember in Miami many years ago, they did an after party at an adult club, right? That created a feeling of exclusion of some of the women that were there. So, just being mindful. That's a very obvious one, but I'd say just being mindful of the fact that this technology is there to create a more even playing field for everybody. And I would love, I'd like to encourage more women to just walk into those rooms, learn about the technology, contribute, because it's just so fascinating. And it's where the internet, I got into the internet in 1995. And I would say, those were some of the most exciting days of seeing the technology evolve. And that's where we are with crypto and blockchain.
Sure. Thank you for sharing those stories with us. But coming back to the upcoming Web Summit in Qatar, you mentioned earlier the opportunities the summit presents for the global startup ecosystem, especially the startups in Asia and Middle East. If you could elaborate on that also, Qatar is heavily investing in innovation and technology. What do you think are the key ingredients for creating a sustainable and successful startup ecosystem?
Creating a startup ecosystem is something I've been very involved with. When I moved back to New York from Silicon Valley in 2004, a lot of people in the Valley said, New York is not an entrepreneurial place. It's in terms of technology. There are very few VCs there. There are very few startups, and they'd gone through the internet bubble like every place had, and then people had returned to Wall Street, to large media companies. But I looked at what are the components that make Silicon Valley so successful. One is this kind of supportive policy and co-working spaces, and entrepreneurs need space. They need to have environments where they can kind of fail fast. And that really wasn't a culture yet in New York, but over the last 10 years, we've seen it grow tremendously. And one of the components was when the Bloomberg administration really said, we're going to create the spaces for entrepreneurs, and seed funds were certainly important. So I helped start one of the first seed funds in New York City called NYC Seed. And so there was a lot of later stage money, but entrepreneurs need that initial capital, and not all of them have friends and family. So that was a large component. Another was serial entrepreneurs. So entrepreneurs that were maybe from New York or had built a company in New York, and they were starting their next company, and they didn't move to Silicon Valley, but they stayed in New York to do it. And that creates a flywheel effect. And I think I certainly have seen this happen around the world, and I've talked to entrepreneurs who may have studied in the US who are now coming back to the Middle East to start companies because they see the potential. And I think that's a large component because entrepreneurs want to be in ecosystems where they can learn from each other, they can partner with each other instead of always getting on a plane. And with the government policies, with the number of entrepreneurs moving back, or people really looking at it as a career option, those are all things I'm starting to see happen there. And so I think that bodes well for the region.
All right, Jalak, one final question before we let you go. As someone who's been recognized as a trailblazer in blockchain investing, what is your vision for the future of this sector? How is Future Perfect Ventures positioning itself to stay at the forefront of innovation? What's lined up for the future?
Yeah, so each fund, we're currently investing at our third fund, and each fund, while we've had that same thesis around the intersection of those three platform technologies that I mentioned, Future Perfect Ventures has evolved as the market has evolved. And as I mentioned before, we are now at a stage where we're seeing entrepreneurs actually create these or combine these technologies in their startups. So we continue to evolve. This is the fastest growing kind of sector I've ever seen. And if you combine the AI and the crypto, that it's 24/7. There are new developments on a daily basis. So and it's global. Unlike the internet, a lot of the initial technology was being created in just certain hubs, and this is everyone's contributing. This is open source software. Everyone has access, or a lot of people have access to ChatGPT and Gemini and all these tools to create new apps and technologies. So we're certainly keeping an eye on all of that. You always have to be aware of what larger companies are doing because the incumbents have all woken up to the promise of all this technology. But we continue to see entrepreneurs more than ever get excited about the sector, especially now that we have regulatory, a more favorable regulatory environment.
Absolutely. And on that note, it's time for me to wrap up our conversation. Jalak, many thanks for joining us on Startup Street today. Appreciate your time. It was an absolute pleasure speaking with you. Thank you. And with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
We have written in one of the papers, but so any highs, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you'll get to see 500 crores loss. So I mean, I've incurred once.
And in the first 2-3 years of Helios, called Mr. Bull, like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money and HDFC Bank doesn't need to raise capital. And we have met the company and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody I say.
Saudi Arabia we'll be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately. Right now, the price is high enough that that war will continue. You got to bring down the oil price. You got to end that war. They should have done it long ago. They're very responsible, actually, to a certain extent for what's taking place. Millions of lives are being lost. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. Interest rates should follow us. All over, the progress that you're seeing is happening because of our historic victory in a recent presidential election. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto. My administration has also begun the largest deregulation campaign in history, far exceeding even the record-setting efforts of my last term.
Hello and welcome to this special program. We are calling this Stock Market Confessions, the program, the name of the program, that is. The idea germinated from a book which is coming out now. It's called Confessions of Stock Market Wizards. The author is lawyer and leading investor Safir Anand. Safir is one of the foremost IP lawyers in India, but also a passionate consummate equity investor. We talk about multi-baggers all the time, winning stories all the time. We certainly love to hear and tell a good story. But usually, the narrator ends up making a lot of money as far as these stories are concerned. What we are trying to do here is not talking about the winners, but the duds. And we will talk about the mistakes which some of the people in this gathering have made today. So with that short preamble, let me actually quickly welcome in our guests on the program today. They really need no introduction. Ramesh Damani is with us. So hi, thank you very much for joining us.
Thank you for having me.
Ramdev Agarwal is with us. Thank you very much, Ramdevji. And of course, Safir is with us as well. Safir, thank you very much. And
thank you for having me.
Thank you for giving us the idea of the book as well. And to help me steer this conversation, I have with me my colleague Rima Tedulkar. Rima, hi.
Hi, Prashant. And it's indeed a great conversation and one that we don't dwell upon very often. But as they say, learning from the mistakes of others is the best way. Well, at least better than making your own mistakes. And we hope that we're able to do that for you just here. And we have with us some great investors joining us in this gathering. So let me welcome Manish Bhandari. We've got Viraj Mehta, Ayush Bhandari, Jyoti Vardhan Jaipuria, and Punita Kumar Sinha. Well, excited about this conversation.
Absolutely. Should be good. It's a fantastic gathering, Rima. So let's get this started. Let me go across and join our sort of esteemed panelists here. And Safir, let me just start by asking you, what gave you the idea for the book?
See, when we studied commerce and we studied economics, and then we saw all these great people and learned from them all throughout, from the Bombay, Rotunda, Roundtable Time, etc., I felt that the only thing that was happening is that we were looking at the successes, and there's a reason why they've succeeded. But we have not been able to look at the concept of risk. And they have mastered risk because that's why they've been there for several decades. And I felt that it would have done justice to people to know the side. It's not as people don't make mistakes, but those mistakes don't impact them beyond a certain point. And therefore, the focus of the book was on the learnings that come from when they go wrong and how they attune their minds to get it right.
I think it's a fantastic idea. And the book is already out. It's coming out. It's
Well, the book is out at the Literature Festival on the 31st, but it was open for pre-booking yesterday, and strangely at night it was all sold out. Yeah.
Absolutely. I think reprints, right? I think already. So it's doing well, and wish you all the best of luck. So we've got a fantastic gathering, as Rima also pointed out, and we've got about 1 hour here, and let's dive straight into it. Mr. Damani, mistakes, right? We're talking about mistakes, regrets, whatever you want to call it, in your long career. What stands out?
You don't have enough time for that. I mean, 1 hour is too short. But jokes apart, we went to a marriage counselor, my wife and me, and the counselor told us, embrace your mistakes. So my wife hugged me. So Safir is not hugging me, luckily, but he's managed to extract some of my failings in the market. And it's really a building block of success. Failure is a building block of success. My old friend Rakesh used to always tell me that we'll all make mistakes, but make mistakes that we can afford. So to just give you some example in my own career, I bought a stock sometime in the mid-90s called MTNL, and that stock went straight from 200 to 0 or 10 or whatever it is right now. So I lost probably my entire capital out there. But I had a lot of other stocks in my portfolio that performed very well out there. So maybe I lost 80% in a particular stock, but other stocks were up 5x, 10x. So growth covered a multitude of sins, if you will. So what I would say is avoid leverage. I never made that mistake, but that's something I always repeat and tell myself, because I learned that from very astute investors. Don't avoid leverage. You don't know how to handle, most people don't know how to handle leverage. And hold on to your winners, because they will compensate for a lot of losses that you made. So the loss in MTN, while devastating to me, as Safir said, didn't impact me because I had a lot of winners in my portfolio at the same time.
Winners. Leverage, your own leverage, and leverage on the companies you invest as well. Both, I mean, maybe.
I mean, probably both, but definitely your own leverage. I mean, it's a very risky. There's some people who know how to handle it, but I would say the majority of your audience or the majority of people in the stock market don't know how to handle it.
Yeah. Mr. Damani, we were chatting earlier, and I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well, but when you began and when you started and you came back from the US and when you started the investing journey, you said, in a way, we didn't believe enough that, well, we could that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted you to take us through that.
Yeah, Prashant, I mean, think about it. I came back to India in the late 80s. India had a balance of payment crisis. Our per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assuming the past is prorogue. That what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that, with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it, I haven't forgotten about it.
So the learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. They're a new bunch of companies. So it was a great mistake to think that you could look back and say that because India didn't work for the last 30 years when I was growing up, it wouldn't work for the next 30.
Oh, that's wonderfully put. Ramdevji, mistakes? I mean, whatever you, not your biggest, but what has sort of stayed with you, impacted you, and molded you as an investor over the last 40 years?
Yeah. So what happens is when you start from zero, I started in 85, 86, literally with zero capital. So your mistakes, even if it happened earlier, the impact was very small in terms of financial terms. Now when we run thousands of crores, then your mistakes are also in thousands of crores. So then you start remembering them. So more recently, see, I would say, ultimate growth investor kind of, mad growth investor like. So our formula is also QGLP, and now we have made it high quality, high growth. So even one step further. So our belief is that high quality combined with very high growth of 50-60% is not mentally it can't be digested. So markets will always be mispricing, but mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. any news segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. You know, so that was a kind of scorching growth, and that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum, but the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top, it becomes so what you call compelling. You know, I can sell the story to even person like him or anybody. You know, and you sell. While selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, you know, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores. Straight you will get to see 500 crores loss. So, I mean, I've incurred once, okay, and I've seen earlier also, but now the losses are bigger because of my investment size is bigger.
And specifically, since you brought up the quick commerce, you're talking about quick commerce in the current
yes.
It'll just, I mean, just for, it'll be easier for people to understand where you're coming from in that sense.
Yeah, so when Swiggy came 3-4 years back, 3 or 4 years back at the COVID time, that time, when Zomato was getting listed and Swiggy was unlisted. So at that time, there was a possibility to buy private placements. You know, and Zomato itself was at a high, and Swiggy was comparatively, whatever comparative, say, Zomato was trading at 15 billion, this was trading at $10 billion.
$10 billion.
We went and put it there. And I was about to put money, I mean, I was asked to put money in Baizu also. Can you believe what would have happened? So that is the hype cycle of e-commerce, because they're growing at 100%, 200%. So that's what really happens.
But that has not been a mistake.
No, see, but then it collapsed, no? Zomato, if I was in Zomato, say 150, 160, that came down to say $45. So, I mean, okay, fine. From 45, it is again 300.
So your point is to not to allocate at the top of that
you got to
frenzied
be, see,
kind of
when you are
cycle.
investing, I'm not talking about speculation. When you are investing, you have to be very clear that are you riding a hype cycle? See, you could be in for 50% correction and then again ride back, but you could be in for 90% correction also or 100% correction. Then what do you do?
Absolutely.
So, particularly in growth, because as the economy becomes bigger, newer segments, whether it is a quick commerce today, tomorrow something related with the AI, and then something else, the system, these digital systems are accelerating the growth. So growth hype cycles will become even more louder, I mean, all over. So if you get stuck at the top of the cycle, my sense is you'll end up committing more of a mistake than good investment.
Absolutely. And to be clear, you're not calling quick commerce, I mean, you're not turning your view on quick commerce. You've been a big believer.
We already made money, no? From what I committed, that mistake automatically got corrected.
And you remain.
But you imagine what would have happened if I had invested in second one also.
Absolutely.
I actually, that time only we wrote the paper and I saw the Gartner hype cycle and yet I invested. I was so obsessed about that.
No, I think it's a fantastic point, and we will get newer and newer industries, newer and newer sort of cutting edge, and so much is happening, and it'll all come here. Let's go across to Samir, who's joining us from Singapore. Samir, you're the only person not here, but you can hear us, I hope, clearly. And you're someone who's a first principles thinker. You kind of sort of bring originality to the conversations that we have. In your long career, Samir, what would you say has been your biggest mistake and then learning?
First, I would like Ramdev to clarify that he's not calling quick commerce a hype right now. Otherwise, that will be your headline and everything else will be lost.
He's already clarified.
Okay. So I've also made the MTNL. By the way, I moved to India in 93, and in 93 December, we launched our offshore fund. And the first stock, therefore, in my life that I have bought professionally was MTNL at 310 rupees.
Oh, wow.
But separately, in this life, I have made each and every mistake that can be made, which include buying leverage stocks. which can mean remain bullish for too long. It can be like in 2008, it can be buying companies where you forgot too much to bother about balance sheet, looked only at the P&L. We bought Amitabh Bachchan Corporation, which went to zero. Buying unlisted stocks, that is my main example or the only example of buying an unlisted stock in the fund. And so all mistakes have been made, but the one which I have...
Samir, we lost your audio there. We can see you clearly.
Oh, is it?
Yeah, you're back. You're back. Please go on.
Okay. So in that book, I spoke to Safir more about what happened in 2008. I was in my alliance days, and in the first 2-3 years of Helios, called Mr. Bull like Rakesh, and I used to collect bulls, and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews, saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money, and HDFC Bank doesn't need to raise capital. And we have met the company, and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit, and I no longer defend anything to anybody. I say what I feel, and I collect bears. I even bought a bear. Normally, bulls you buy, you're okay. Bears you normally get as gifts, but now I'm even willing to buy expensive bears from Dom and others. But basically, over a life cycle, you more or less make every mistake that you can. The only mistake I have not made, which is why I remain cheerful, is that I never concentrate on any one stock in terms of weightage.
Right.
So normally the high weight will be 4-5%, so you lose 20%. You can recover it, or even if you don't recover it broadly, it gets lost in this thing. The process has to give the returns, not any one stock. And therefore, I'm not beholden to anybody. I don't care for any promoter because according to me, no one guy made me my returns.
Right. And your experience in 2008, Samir, made you appreciate, because I see you very firmly believing that what has happened around the world, what's happened in the US in terms of trends, I mean, it'll happen here. I mean, something extraordinary or very different cannot happen. So you're more appreciative there? Yeah, sorry, go on.
So that's what I was saying. The point was that, normally we can say our company fundamentals are different and that is different. But if the world is in a crisis or in a bad shape, then everybody becomes a financial investor, and that becomes the connection between different markets, that there are financial common investors, or even if you're not a common investor, you can look at the other market and feel bad. Therefore, I never, prayed for China collapse and things like that, which people were praying, 2-3 years ago or 2 years ago, that if it collapses, we may outperform, but we can't make money. Right now, it's going a little bit off because I think the world is good, everything is good, but somehow India doesn't seem to be performing. But that I will still go with this global macro, that if the world is positive and strongly positive, we can underperform, and sometimes we should, but we don't have to be negative.
Absolutely.
In returns of market.
Well, let's get in now, Punita, in the conversation. Since we're all reminiscing of the 1980s, 1990s, you were one of the earliest FI investors in India. And what, to your mind, is the biggest regret over your investing career?
So, thanks, Reema. Thanks, Prashant. So, you're right. I have to date myself. I did start around the same time as...
well, you need to take the mic.
Is it on?
Yeah, please.
So, I did start around the same time as Samir. In fact, we were classmates at Wharton, and then we soon started our careers the same time in fund management. So I started investing in India when India opened up for foreign investment. I was investing in other emerging markets before. And so there was no real interest in India per se, because Malaysia, Southeast Asia, those markets were far bigger and more interesting. And India was like, okay, it's just newly kind of liberalized. And we would have, I remember my first meeting was, Lalita Gupte coming with an ICICI convertible or some kind of debt instrument, and And we were like, okay, India's finally starting. My biggest mistake was when people came and sold us the India story. I remember Ratan Tata coming to our office and showing us penetrations of motor cars in India and how low it was compared to global. And the numbers were like so low compared to what you saw in the US. And he tried to persuade, saying, well, look where we can go and how far we have to go, and we will get there. And we were a bit skeptical, having grown up in India pre-liberalization. How can it really happen? And so whether it was Mr. Aditya Birla who came to our offices, all these luminaries would come and sell us the India story and how much potential India had. My biggest regret is actually not believing them fully and not betting as big on the opportunity as it existed, because one never really believed India would actually deliver. Of course, it is now 30 years later. So it has taken almost like 25 to 30 years to fulfill that promise on the opportunity. Now our penetrations, whether it's cellular, it's exceeding many other countries, and India has wiped out Southeast Asia. The markets there are so much smaller. But that didn't seem that it was possible. So I would say that I was a bit too conservative, having been one of the first investors in India. I had maybe too much skepticism. And sitting in the US, it becomes easy to be skeptical because you look at US and where it was, and you can't ever imagine India could get there. So I think whether it's the stock market, look, when I started, the market cap, believe it or not, it was only $110 billion. And look at where the market cap is today. Would I have believed that when someone told me 30 years ago that this is what India's market cap would be? Not at all. So the regret really is that not fully betting everything on India.
We'll have to take a quick commercial break here. I'm being told we need to. So we'll do that. We'll come back and we'll really get down to specific situations, specific stocks. And we'll bring in, of course, our other guests as well who are here to share their insights, their anecdotes with us. Stay tuned. Coming right back.
We're going to have a very good relationship. All we want is fairness. We just want a level playing field. We don't want to take advantage. We've been having massive deficits with China. Biden allowed it to get out of hand. He's $1.1 trillion deficit. It's ridiculous. And it's just an unfair relationship. And we have to make it just fair. We don't have to make it phenomenal. We have to make it a fair relationship. Right now, it's not a fair relationship. The deficit is massive, as it is with other countries, a lot of Asian countries, actually. But we have deficits that are very big, and we can't keep doing that. So we're not going to keep doing that. But I like President Xi very much. I've always liked him. We always had a very good relationship. It was very strained with COVID coming out of Wuhan. Obviously, that strained it. I'm sure it strained it with a lot of people, but that strained our relationship. But we always had a great relationship, I would say, and we look forward to doing very well with China and getting along with China. Hopefully, China can help us stop the war with, in particular, Russia, Ukraine. They have a great deal of power over that situation.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit.
Welcome back to our special show, Stock Market Confessions. We have with us the wizards of Dalal Street here right now, and they're going to share the mistakes that they've made, which has shaped them into the investors they are today. So Manish, let me come to you. Manish Bhandari is the founder and portfolio manager at Valum Capital. Manish, looking back, what would be the investment decision that you've made which you regret the most?
In 2 decades of public investing career, I had many mistakes. And maybe I'll resonate few of them. The first one is to think that you'll go right on every investment decision, which should not be the case. You'll always win some and you'll always lose some. So it takes a long time to really believe that you'll have some outcomes. As long as the bigger probabilities are in your favor, that's good. So that's one mistake which took a long time to really realize. And you pain yourself much when you think there are some few stocks which have lost. Second thing is, one of my biggest mistake has been taking some time to understand the really concept of time value correction. And I got invested in a pharmaceutical sectors way back in 2015, and which was in a resounding bubble at that point of time. And it took 7 or 8 years for those prices to come back again. And there was a huge loss of value which goes through down, as well as the time value correction. And it's painful because in nominal terms, you lose maybe close to 70 to 80% as those bubbles goes bust and comes back again, maybe the real price. And the last one, which is a bit noticeable, was that how to look at the divergence of the data and from the management commentaries. And we all get sold by those glorified managers. And I get invested into a rice leader company. And for a long period of time, there was a divergence in the data as well as the management commentary. And I was not able to capture that. And I was maybe looking at the glorified commentary for some bit of time. And that taught me a very valuable lesson that data is something you have to believe and you have to hold it very carefully and then just exit if the data is not in your favor, irrespective of the management commentaries.
But Manish, the data could be backward looking, while the management commentary could be forward looking. So in that sense, what's the lesson that you've learned? Because you could be missing out on an opportunity.
No, the divergence. Some point of time, see what has changed. If you look at the sources of alpha, initially when I came to the market in 1999, the investment bankers or the access to management was a very superior source of alpha. Maybe after some period of time, as the democratization of the information happened, the data flown in on the analyst or on the fund managers is significantly higher for you to make maybe 2 + 2 and finally figure out that what is going right and what is not going right in your direction. So it has changed a lot in this process. So definitely there'll be some point and data points which will really give you an indication that the things are not going as you are anticipating, and that will be a time. So those divergences can be figured out through some careful analysis, not in all the cases, but in many of the cases.
Okay,
in
so
this case, there was a corporate governance
Yeah, there was a corporate governance issue, and then they lost a big customer in one of the key GCC markets, and then we were very hopeful that those markets will come back again, and this commentary was always positive and always a step ahead with each quarter, but it didn't happen. It took a long period of time.
And the pharma example that you gave, Manish,
yes,
that was purely earnings. I mean, which kind of
so as Ramdevji was alluding to, so in a peak of the bubble, you'll always have the earnings which are galloping. And along with the earnings, the P multiple also expands, and which would have happened in the case of defense companies at this point of time. So you have a huge cycle, a tailwind of the earning cycle, and that certainly a 20p multiple or 20p multiple sector would finally become a 40p multiple sector. And when you fall off the cliff, there's a contraction in a P multiple, as well as there is a slowdown in the earnings. So there is a nominal destruction of capital. There is a real destruction of capital, and it'll take long for those capitalists to come back again. So you really, maybe it's a challenge that how do you figure out that when is the cycle going to end? And for that, the best thing is to look at the earning cycle analysis. Any company, if you bought any part of the world, if you're buying something at the bottom of the cycle, you can't go wrong. Many of the cases, unless until you have a case like a pager and a Nokia or something else which is going out from a technology perspective. Otherwise, you won't go wrong in most of the cases. So earning cycle becomes a very important aspect while you're doing the investing.
You know, Punita, you were also, we were talking earlier, and you were talking, sharing some, your own sort of governance kind of pitfalls, right? Why don't you share those with us?
Yeah, hi. So, you know, now I'm on lots of boards and I realize how little we tell investors or how little investors know what's going on in the company, because there's so much more to a company than what is communicated to investors. And, you know,
need to know basis.
Yeah, it's you know, mostly the investors are communicated mostly earnings results, right? There's not a lot of discussion on what's happening behind the scenes to get to those earnings, what struggles, what attrition levels we are seeing, what's happening in the culture of the organization. There's so much more that goes on that we don't, as investors, see. And I remember the times, and even now, one is prone to that, is that now, of course, SEBI has come up and Companies Act has come up with all these disclosures on related party transactions, and there's a lot more social media. So you get to know a lot more about a promoter because the data is better and the information dissemination about somebody is better. But way back then, I remember we, at least as foreign investors, we, of course, those who came to visit us in the US would get more attention. And I'm sure in India, those who were meeting investors more regularly ended up getting more money. So, and the storytelling, the ability to tell a story. So those who told us a good story were the ones that one would kind of tend to, you know, believe in. And I've had occasions like this. So I'll give you two examples: Global Telesystems, Himachal Futuristics. Of course, I've also got trapped in MTNL, the value trap.
You all did.
MTNL seems to be like
Mera telephone nahi lagta. That's what he called it.
Got trapped in ABCL.
Mera telephone nahi
as well.
Oh, I see. Okay.
But so there are these value traps, especially PSUs were like super big value traps.
Were.
Yeah, not anymore, But anyway, so these two companies, I remember I had this American analyst who came down from the US and he met with one of these promoters. I won't name which one of the two, but he went, they wined and dined him. They took him to see all their charitable endeavors. He was a very spiritual, religious kind of guy. So he came back and he said, not only the opportunity great, this man is super generous, he's so humane, he has all these charitable endeavors, he cannot do anything wrong. And so often you go by what the character is projected to you versus what the character might be, and what the numbers that are projected or shown to you versus whether they're inflated. We saw in Satyam, the numbers were being inflated, but Ramaligan Raju was a very nice man. So when you meet him, you could never imagine he would be like doing all of this. So what meets the eye isn't what's true. And so over the years, you can get trapped. And I've got trapped in Himachal and Global Tele. And when the hype cycle is in your favor, you made a lot of money. But when the .com bust happened, these things crashed like anything and you couldn't get out. There was no liquidity. And so you just saw a stock going from 1,500 rupees down to like, I think, few hundred rupees, and you couldn't get out. It's a falling knife. So you have to be very careful when you invest in all these small and mid-cap companies, not to get carried away. Actually, the closer you get to a promoter, the more mistake you're going to make, because you're going to hear what they want you to hear. So actually, to be a good investor, you should keep a distance so that you can be objective. And I was giving this example of my analyst who, the closer he got to this promoter, the more he saw the goodness and the good work. But who knows? I mean, people still do wrong things. They can do good work and bad work at the same time. And you don't get to see that. So best to focus on the numbers, best to get diligence, best to get investigative journalism, all of that, and focus on the governance aspect as well, the board, and not just... but of course, CEOs can also fake the board. So, you have to be very careful. You can get trapped. And so you always have to have a margin of safety and a healthy dose of skepticism.
Okay. Ayush, you've got an example to share where you invested in a stock and there were rumors of corporate governance issues. So how did you deal with that?
Hi, everyone. So I'm more of a very small mid-cap, micro-cap investor. And when it comes to those small companies, I think mostly you will find some issue or the other. And as an investor, you need to also learn how to ignore some of those things. You need to learn what is ignorable and what is not. So this is almost 7-8 years back during the previous bull market. There was this textile company I was crazy bullish on. I got in very, very early on it. It was hardly a 200-300 crore market cap company at that time, and they started doing very well. They had some excellent billion-dollar customers, US customers. You go to their facility, it's top-notch, excellent, world-class facility. So,
are we talking about Keytex?
Yeah. And it went all the way up. Like it got the market attention. It went all the way up, almost maybe from 300 crore market cap to almost 5,000 crore market cap. So that is the kind of delivery the company did, management did, all world-class. At the same time, there were always some concerns, red flags, which were always highlighted. But when you're a believer in something like someone shared, you're gung-ho on it. Like, I have seen the management, I've seen the facility, and you're all in it. And that's where, like Mani said, you need to learn how to spot where the numbers go missing. So when the performance falters, you need to wake up. You need to take note of it and not get carried away with all the story building, all the forward-looking things. So that is, I think, what is important and what was a lesson for me, that once, especially this happens more when things are very expensive. Like once things are small, they are cheap. At that time, the risk of going wrong is much lesser unless the company is a total fraud. Some softer aspects are ignorable. But once things really grow, they become big, then one has to be much more critical of the governance part. That is what I feel.
What happened in that instance, though? I mean, were you able to get out?
No, I was too late. I was totally committed. Like Samir said, I was defending all the way that, no, my company is right, this is right, this will happen. But, and it went all the way down by 70-odd%, 80-odd%.
Kept buying along the way.
On the way. So earlier I was making a lot of money. Then due to averaging, my cost went up and I was at a loss. And that wasted maybe 4-5 years. But again, see today, the company is back. It is doing very well. So there are cycles in the market. Like Manish was saying, that rice company may be doing back very well again. But at certain times, you need to be very careful and not make those mistakes of staying into something which is too expensive, which is in that hype, like Ramdeji was saying. So you need to take some action or the other and not just be blind to it.
Absolutely. Viraj, come in. Viraj, of course, is a star investor, needs no introduction. In your experience, Viraj, you want to take us through an instance and through the prism of that one episode. I mean, what came through?
No, thank you so much for having me here. I think I'm probably the youngest investor here. I started investing just 15 years back, so I have at least no baggage. I only hear what happened in 2008 or what happened in .com bubble, but I've not lived through it. And COVID was too small to actually regret too many things. I think my regret essentially is just, I think the biggest mistake I've done is underestimating a promoter who overestimates himself. I think a lot of guys in India are growth hungry and they do a fabulous job of it. And I just lose patience very, very quickly. Like, I buy a stock and I lose patience in like 4 quarters. Like, mentally I made up my mind that I'll give this company 6 quarters. And after 6 quarters, like, you give 1-2 more quarters, but like, if the business cycle is just not in their favor, it's not in their favor. And you lose patience and you sell out just before it's going to like do really well. Even though the company is like fabulous, at least you have done your part. You bought it very cheap. You bought it at like 1/3 sale, 10 times P or 8 times P, 25% ROE, great business. So everything you have done, but the growth is not coming and market is punishing for no growth. No growth gets no value essentially. and then you lose patience, and then the growth comes. So my only learning is, if you have done that, I mean, cheapness plus growth is magic. Just wait for that magic to happen. And more importantly, when that magic happens, even if you have sold it earlier, don't get biased. Like we talked about Technocraft, right? It was a fantastic company. I bought at 500 crore market cap, and it went down to like 300 crores and growth wasn't coming, and I sold it. When the growth came back a year later after I sold it, I was just too biased. कि नहीं ये तो एक ही साल ग्रोथ आएगा, फिर वापस ग्रोथ नहीं आएगा क्योंकि पहले 5 साल नहीं आया. And then growth just keeps coming, and that hurts you so much, because today it is 5,000 crore market cap. But the problem is, it is in your watch list. You see the quarterly results every quarter. You attend the con call every quarter, and you feel so dejected. In my fund, I owned 2.5% of that company. I'm like, that would have been worth 150 crores and probably going to 500 crores. So yeah, I mean, when I actually have absolute capital loss and I lose 25%, that day it hurts. In the evening you feel sad, but next day I forget. Like that at least I'm okay with. But this hurts me far more.
So the notional loss of a missed opportunity is what?
Yeah, and not able to get back in.
Not able.
That's very well put. Very, very well put. Let's bring in Jyoti as well, who's a long-time equity analyst. You were on the sell side, Jyoti. And I discovered personally very late that you are such a fantastic micro and small cap investor. I mean, all your life you were talking about, at Merrill you were, and you were talking about FII flows and the big stuff. But you really got the head for, bottom-up stock picking. Tell us...
in your form of a PMS just now.
Tell us, Jyoti, what have been your sort of learnings, and give us one or two instances.
Yeah, so, everybody discussed stocks which went down, right? And each of us, I think if we start listing down, probably each of us can write a book on how many mistakes we made. But 2-3 themes which are, this time is different is the most, difficult phrase I find. Every time, it's never different. But at that time, it seems different. It's like you take the 2000 era, the market was paying companies for, clicks on their website. So there are companies who are sitting and employing people, just keep going, click it on my website, do nothing else, just keep clicking. And the market value is going up. In 2008, we paid for land bank. And so, people were just buying land left, right, and center that, okay, I buy a land for 1 crore, my market cap tomorrow goes up by 8 crores. So, a lot of times market does something which, incentivizes promoters to do misallocation of capital because, they just feel today my market cap is going up, I'll, do this. So, but let me shift because I'm the last speaker on the first round. A lot of times we always talk of mistakes as stocks which went down. There are many other mistakes we made. So one is, we bought a stock which went up a lot, but we didn't weight it enough. So we bought a very small fraction, so it feels very good that I did a 8-bagger on this. But you know what? I had only 1% of my portfolio in it. So why I had only 1% when the portfolios? So we've had it with a couple of stocks in our fund also. One of the media stocks was up 8 times in 2 years, but we had only 1% in the portfolio, so it didn't really help us. Sometimes, we buy a stock early, we end up selling it too early. So, just in my old era, we covered Eicher Motors at a market cap of 1,000 crores. And we put a buy on it. And frankly, at that time, all of us put buys on Eicher Motors, not because of the, lifestyle motors bike business, but we put it because of the Volvo joint venture which was coming up. And, as the Volvo joint venture took up, the stock went up. But, that whole bike business was becoming bigger and bigger. But everybody was anchored to, this bike business it's a niche business. It will do well, but beyond a point, there's no growth in it because the addressable market is very small. And so for a lot of us also, we put 1,000 crores. I thought we got cautious somewhere at a 10,000 crore market cap. And today it's 1,40,000 crore market cap. So very often the mistakes are you sell stocks too early. You get negative on them too early because, there's an early bias. You've seen like a multi-bagger. You don't want to lose the money which you made. or you don't weight it enough, and then you regret it that why didn't I weight it enough. So probably some different angles of mistakes which are not which everybody's been talking about.
Jyoti, I must say, if the worst confession you have to make is that you made only a 10x return and not a 100x return, it's not such a bad problem.
No, I said there are lots of stocks went down, but I don't want to talk about them. It's
right,
too
so
long ago.
Exiting prematurely is one of your regrets or lessons, right? And if you're going in, then go big.
Go big and go to some size. Samir is not a great fan of concentration, but we probably are more concentrated than he is. Right. So we own like 20, 25 stocks in the portfolio. So for us, generally now what we've done is, as a rule, we don't do anything less than 3% in the portfolio. So our minimum weight is 3%.
All right, here's what we're going to do. We're going to slip into a very short break. But on the other side, we'll continue our journey. So even the more seasoned investors do make a lot of mistakes, and we'll chronicle their journey.
With Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I think there's a lot of value in health insurance companies, and you know the names broadly. They are at very beaten down valuations. You were discussing one of the names earlier during your conversation before I joined in. These are some of very exciting plays and available at very reasonable valuation. You will have a case of commissions across the health insurance companies coming at par. Today, Care Health is paying high insurance commissions, then maybe a Star Health. 1 year down the line, they'll be at broadly the same levels. You are looking at 20 to 30% sort of a growth out here. You are looking at prices which are at 2-year lows, and there's adequate margin of safety. When it comes to large cap banks, of course, you have pain in the retail NPA credit cycle. Tier 2 banks won't be able to handle it that well as the large caps. And today we are talking about large cap banks, both in the public and the private sector, trading at less than 50